So professional ethics, actually, so this kind of colored smart notes we have made. See, generally, so we call it as smart notes. See, this is not something I call it as short notes. This is not a short notes. Getting it? I personally, I don't believe in short notes or flowchart material, because the problem with flowchart materials and short notes is you are able to understand or you are able to revise it, but the problem is you are not able to present it on the paper. Students, most of them are only looking at until what, like, do they understand? Do they understand? Do they understand? Only to that extent they are thinking. But what you need to question actually, after reading all this, can I be able to present in exam? Because that is what ultimate output, right? You should always work toward output oriented. So you should always work for that ultimately. After reading from this, can I able to write entire sentences in full-fledged sentences in exam? Because remember, ICai suggested answers are completely based on ICai material. From ICai material, only suggested answer will be developed. As it is, they will copy paste in suggested answer. The content and ICai material. And when that is the scale of the content, and when you are reading from a flowchart material, see, generally, if you read that content, you produce 70% of it in exam. If you are reading 30% already, how much you will produce? Able to understand? So the terminology you are unable to produce in exams because you are reading from cut short format. The moment you read from short sentences, flowchart material, you can't retain, you can't get the command on terminology. This is a problem which everyone says. In audit, I'm unable to get command on terminology. The reason is you're not reading full-fledged sentences. See, big definitions, I'll just like that, I'll speak all the definitions easily. The only reason is, whenever I read, I only read from full material. Whenever I read from full material. Because when you read from full material, every time you read the definition completely, naturally, some sort of expertise will develop in that. And moreover, I'm teaching also. So that is also one reason why I'm having more grip. So if you read from short materials, you will only produce 70 to 60% out of it. If at all the original sentence is 100 and your short material is already 50, and out of 50 you are presenting 60, means 30% you are presenting. So 30% compared to suggested answer 100, think of the marks that you are going to get. Because the person who is valuing the paper, he will not understand either suggested answer or your answer sheet. He will neither understand both of this. He will look at the suggested answer, look at your answer book and evaluate accordingly. Best example, if I was given FR valuation, or if I am given with some SEMP valuation, suppose if I applied for institute for paper valuation, I got SEMP subject. Now tell me, do I know SEMP means? Obviously no. I didn't remember. Now your paper only came to me. Now what I will do, how do I evaluate? Since I don't know subject anything at all, how I do evaluate? I look at the suggested answer and look at your answer. If it is matching, I'll put marks. Otherwise, I'll deduct the marks. Getting the point. So this is the loophole. So recognize the loophole and accordingly prepare. Next. And even like one more important thing, when you're watching any videos in YouTube or anywhere else, watch them at standard speed. If you're watching them at higher speed, what happens is you can't really understand the things properly. You just listen. You just get the satisfaction that you listened. I feel so stupid. Some people are recommending 2 times views. Watch it 2 times. What you're going to get? You listen a song at 2 times. You're listening, no, every instrument, every sound you're listening, yes or no. But the thing is, you will never get that emotional connect. You understand. See, why you people are so fascinated about face-to-face classes? Because to get some emotional connection. Getting it? Now, when you're watching the classes in video mode, what happens is, suppose whatever I'm speaking, if at all I put a layer and I just changed the speakers into 2 times playback speed. What happens? Tell me. Will you understand? You listen. Same thing you're doing in YouTube. Same thing you're doing in actual classes. You're trying to finish classes as soon as possible, but you're forgetting that class is the way to learn. You're only treating it as listening, not learning. Since here, you're listening at standard speed, because whatever the speed at which I'm speaking, you're also listening at the same speed. The retention level will be high. If at all you're trying to listen at a higher speed than what I speak, obviously your retention will be low. These are the mistakes which you do. Next. So ethics, directly I'm going to the CA Act. Okay. Directly I'm going to CA Act. Objectivity, independence, professional behavior, professional competence. Do you think I have to teach all this? CA inter-syllabus, no? Threats to independence, self-interest threat, self-review threat. This is completely CA inter-syllabus. We discussed this in Nature, Objective and Scope of Audit, first chapter. And by the way, for you, this nuclear concept is removed. Getting it? For November 2022 exams, nuclear concept is not applicable. Next, write about membership of the institute. This is smart notes. This can also be downloaded in the same application. Yesterday I told right, there's an application. In that also you can download this. Full notes is not yet uploaded. I will upload by the time we complete our revision lecture. Getting it? So same there itself we will find. Next, register of members. Write about membership of the institute. First of all, what is the membership? Once you qualify CA final examination and you completed level 2 IPT and orientation, all that, nothing but GMCS, whatever. Once you complete them, you are eligible for membership of the institute. You are eligible for membership of the institute. Now, in order to become a member, there are some disqualifications. If at all you do not come under those disqualifications, then only you can become a member of the institute. Now, membership is not an automatic process. First of all, understand. You need to manually apply for membership in self-service portal. You need to manually apply for membership in self-service portal of the ICI. Like so, once you pay membership fee, you will get certificate of membership. Right now it is 6-digit number. Right now the membership number is 6-digit number. And remember, just because you are having membership number, you cannot practice. You cannot practice. By the way, the practice means our practice spelling is CE, not SE. Getting it? So practice means COP, certificate of practice means CE. Getting it? It means practice means it's a license. It's nothing but a license. Okay, you can start your profession or a business. Getting it? Of rendering professional services to a clients, prospective clients. So that's a license given to you. Doctor in practice, lawyer in practice, a CA in practice means it's a license, nothing but license given by that corresponding regulatory authority. For us, ICI will give this COP. And COP will have same membership number. What is COP number? Certificate of practice number. In ICA, we are following the membership number itself as a certificate of practice number. Getting it? So the member has to apply certificate of membership separately, and for along with that, if you want to pay COP fee, you pay COP fee also. Registration fee will be there. Along with that, annual fee will be there. So that is COP. Now, originally, first time when you apply for COP, first when you get the membership and got the COP, you are first called as, yes, you are associated with institute. You are associated with institute, ACA. After 5 continuous years of practice, continuously 5 years of practice without a break. Without a break, if you are in continuous 5 years of practice, then only ACA will become FCA. Just because you are having 5 years membership, that doesn't mean you will become FCA directly. Able to understand? You must have COP continuously for 5 years. If at all there is a break in practice, once again 5 years will be counted freshly. Able to understand? So 5 years continuous practice if at all you are in, then you get FCA. After getting FCA, even if you have break, no problem. Are you getting the point? Even if you have a break, no problem. But if you have a break after getting FCA, what will happen is, like insurance company audits, bank audits, you will not get. Insurance company audit, bank audit, there is a requirement. The CA must be in continuous practice of 15 years. Continuous practice of 10 years. Continuous practice of 7 years. Likewise, there are requirements in the RBI empanelment. Even IRDA empanelment. So when this kind of requirement is there, if at all there is a break in your service, so naturally you will be disqualified to get that kind of audit. Are you clear? And once you get FCA, later if there is a break in service, your FCA will retain. Your FCA will remain like that as it is. You need not worry. Getting it? Now, look at this. So register of member, ICA will maintain register of membership, which will contain all this. Like you have member card, right? You'll have this something called member card, yes or no? So member card, like I'll show you the member card as well. It's okay. I mean, I'll not show, some details will be there. Okay. Fine. Next up. So register of members. The member card is, you can download it from a self-service portal. ICA self-service portal is there, no? Same you can download. It's okay, I'll show, no issue. So in self-service portal, you can download SSP ICA. Have you seen it? Membership card, all that. And institute, no, they'll give you like, I think in office you might have seen, no? Your partner's members card like that. I'm not talking about membership certificate which they frame it and then keep it in the wall. That's a certificate actually. What is it? That's actually called as certificate. So this is the self-service portal. This is about some conference going to held at Mumbai. International conference is going on. So this is the membership card. Getting it? So where you will have member card means whatever details, register of member ICI shall maintain all those details. So date on which I enrolled. Because of my articles excess leave, I enrolled late. I have excess leave in articles. I couldn't serve. Getting it? Because it was very late, so I enrolled very lately. So fellowship date I got on 2021, exactly 5 years after. Okay, without any break, fellowship. So that's called FCA. And this is the professional address and the partnership form details and who are all articles working under me. So that's it. And are you in practice or not? Holding COP? Yes. Having employment? No. Are you in partnership? Yes. Is there any personal practice apart from partnership form of practice? No. So you will get entire information here. And is there any removal from membership? COP cancellation, all that. Whenever a bank is allocating you audit, they will ask this member card. And they will look at the date here when this is generated. See, this is generated today at this time. So membership card will have this date and time. Getting a default generated. So banks will ask this PDF, original PDF. And before they allocating any audit. And they will get directly data from institute as well. That's it. Next. So disabilities. So for the purpose of getting membership of the ICI, what are the disqualifications a member has? What are the disqualifications? Disqualifications are very simple. Not attained the age of 21 years. If you have not completed 21 years, you are disqualified for getting membership. Is of unsound mind or undischarged insolvent or discharged insolvent, not obtained from the court a certificate stating that his insolvency was caused by misfortune. What is that? Undischarged insolvent means your insolvency proceeding is still pending in the court, or you did not repay any liability. Getting it? But undischarged means you are not yet discharged by the court completely. Suppose you are discharged as insolvent by the court. You are discharged already. Now discharged insolvent is of two types again. Is this insolvent discharged because of misfortune or other than misfortune? Misfortune means what? Unintentional. Unintentionally, because of some calamity or some reason, his business was spoiled completely because of COVID or whatever. Getting it? And naturally he defaulted everybody. No specific intention behind this default. So this is called as discharged insolvent, which caused by misfortune. Able to understand? Court will give that certificate. Court will give a certificate that this fellow's insolvency was caused by misfortune. So this fellow can be permitted to do business later on. Whereas if a fellow did not get this misfortune certificate, getting it, which means what? Court declared him as intentionally defaulter and intentionally he became insolvent and he absconded or something might have done. So that fellow is not disqualified. Who is the fellow who was discharged as insolvent by court and the misfortune certificate is not obtained. Court has not given him the misfortune certificate, which means what? He is an intentional defaulter, fraud, which means he is disqualified from getting into membership of the ICI. Or he has been convicted. He has been convicted by a court for an offense involving moral turpitude and punishable with imprisonment, or an offense which is not of a technical nature committed by him in his professional capacity. Some professional capacity, some mistake has been done. Next, found on inquiry guilty of professional or other misconduct. Institute has found on inquiry that he is guilty of professional or misconduct. What is professional or other misconduct? We will discuss in Schedule 1 and Schedule 2. Getting it? So now what is this? This reason is, this is the reason where institute will remove your membership. Though suppose if at all you already got membership, if at all institute found you are guilty of professional misconduct, then also you are disqualified subsequently. Institute will remove your name. And remember, Disqualifications for purpose of membership, the answer is different. Write about circumstances when the institute will remove a name of member from the membership register. Removal of member is different. The answer for removal of member is different. The answer for disqualifications for entering into the register is different. Able to understand? Suppose you see here itself, removal also we will discuss. Removal of name. One, the person who is dead, or the person directly requested the institute to remove his number, or he is affected with a disability. He is affected with a disability, nothing but disqualification. Or he has not paid the annual fee. Every year we have to pay some annual fee for COP as well as membership. For ACA, annual fee is different. For FCA, annual fee is different. The fee details are not required from exam point of view. Able to understand. Now, institute, in examination, you might get a question on removal itself. You should not read disqualifications point. Disqualification, all the points, whatever we discuss, no. That is one of the reason for removal. When a member name will be removed, means what? Removed means what? Already is a member of ICA. We already have membership number. When it will be removed? When he died. Or member himself given an application that please remove my name. Or he has not paid annual fees. Annual membership fee is not paid. Then also it will be removed. Or if the person has been affected with disabilities. After getting the membership, he became disqualified. Now what are the reasons why he will disqualify? Here it has been given. Clear? All of you? Reprimanding means giving warning. Not permanent, temporary. Removal is also temporary. Actually, Schedule 1 offense, member name will be removed for certain period of time. Whereas Schedule 2 offense, institute will decide for how long it should be removed. Depending upon the severity of the offense, Schedule 2 offense. See, I'll discuss now. I'll discuss that chat also. So I'll tell you what is exactly the difference between Schedule 1 and Schedule 2 offense. Next. Transportation or importation are synonymous. Both are nothing but imprisonment. Both are imprisonment. Getting it? Next. If a member fails to disclose the fact that he suffered from any of the above disabilities, it will also be amounted to misconduct and his name will be removed permanently from register of members. Suppose if at all you applied with wrong data to the ICA for membership, though you are a CA, you qualified everything, but you are affected with some disability, you are hiding it, and you apply for a membership saying that you are not disqualified, you are eligible. Later ICA found that you are disqualified, then they will remove your name permanently. Getting it? But generally institute will not exercise all these powers. Then types of memberships I told, ACA and FCA. Whose name has been entered in the register shall be deemed to have become associate of the institute and shall also be entitled to use the letter ACA after his name. Fellow means what? Who has been in continuous practice in India for at least 5 years. A person who is in India for continuous practice for 5 years. Now here many are asking, can CA practice outside India? What is the use? Where you will sign? Tell me, what do you mean by practice outside India? You can do consultancy works. For that you don't require COP. COP is required for what? Statutory functions, attestation functions. Statutory attestation functions are given for which CS? Only Indian CS by Indian government within India. Outside India, who will take your CA signature? Getting the point or not? You see, if you want to work in US or in that particular zone, there is an institute they have. So there is only recognized, those institute members only recognized. Britain, region, UK, they have their own CS. Only those CS can authorize it. They are only authorized. Simple logic, man. If an outside India, US CPA comes in India and put a practice and want to sign balance sheet P&L, will you agree? No, right? Same way, they will also not agree. So what is the question about, can a CA practice outside India? The question should be, can a CA who is practicing in India, can he reside outside India? Yeah, he can reside. That is the right question. Able to understand. First you must know which question to ask. Getting it? Can a CA practice outside India? No meaning at all in that. Able to understand? If a CA is residing outside India, yes. Now you might get it out. Can we do articleship outside India? CA itself cannot practice outside India. How will you do articles outside India? Logically, no. But can you do industrial training outside India? Yes. If any CA is working in any company outside India, Employment. See, you can do industrial training not only under practicing CA, but even under the membership of member of the institute. So if that member has got the permission from the institute to industrially train, getting it? So that member can train an article for industrial training. Able to understand? Now, which companies are eligible for industrial training? ICI database has a list. Which are the companies which are eligible for industrial training? And if those list include some foreign companies which are operating outside India, if any member of the institute is working in that company, under that member, this fellow can register as an article for industrial training. Able to understand? What happened? Okay, clear? Next. Now suppose a member who has been an associate for continuous period, and as an associate who is not in continuous practice of less than 5 years, he is not continuously for 5 years, but he possesses all the qualifications, to ensure that he has experience equivalent to and normally acquired as a result of continuous practice like 5 years. Like how a continuous practicing chartered accountant for 5 years, what kind of experience he has? If I am also having a similar experience, even though my official COP is less than 5 years, or my official COP is zero, but I am doing exact same job like what he is doing. Getting it? Then also I am deemed to be an FCA. Example, in audit firm, CS are working, no. What is the difference between partner and him? Nothing. Correct? Partners are doing the same work. These fellows are also involved in the same work. Only thing is they are not signing in the official capacity. Correct? In audit firms, you might have done articles, no. In that firm, some CA employees there, no. Paid assistants, chartered accountants. So they are equal to partners, right? They are equal to COP, right? For them also, institute gives a COP. So they are deemed to be in practice, but are exempted from getting certificate of practice. Are you getting it? So if I work in an audit firm as an employee, full-time associate with the audit firm as an employee, and if I am working in any firm, any number of firms, doesn't matter. One firm 1 year I worked, another firm I worked 2 years, another firm I worked 3 years. Totally like that I worked for 5 years. Getting it? Continuously for 5 years I worked. So I will get FCA status later directly. I may not be having COP. I will directly get FCA COP later on directly. Able to understand? So my work in the audit firm is treated as equal to certificate of practice. So whether you work in Big Four, see actually Big Fours, no, they are network names. Suppose KPMG, the firm name is actually BSR & Co Chartered Accountants. Correct? You did there, no? BSR & Co Chartered Accountants. That is the KPMG actual firm name. KPMG is a brand name. They use the word KPMG as a brand name because they use common work methodologies. So like they do, they develop common checklist. Across India, wherever KPMG you go and see, the audit methodology, audit tools, audit process, everything is same. So networks are formed to develop those kinds of tools, those kind of work methodologies. Able to understand? We have network discussion there, I'll cover. Next, are you clear until now? Next, removal we covered. Now, restoration. By the way, I told one of the reason why a membership of a member will be removed is non-payment of membership fee. Remember, for us, the question for COP is different, question for membership is different. Now we are only discussing which one? Membership discussion. We are not yet discussing COP related discussion. Now, so restoration of membership, what is meant by that? Suppose if a member name is removed, whatever reason it is, if a member name is removed, removal can be two types. If member name is removed, so by reason of non-payment of fee, and other reasons. By reason of non-payment of fee and other reasons. Suppose actually for this year, right now which year is going on? Right now 22-23 year is going on. For 22-23 year, by what time I should pay fee? 30th September. By which time I should pay the fee? 30th September. For every financial year, every member of the institute shall pay annual membership fee plus annual certificate of practice fee separately. But of course, in the payment fees, that challan, both the columns are there enabled. If you take both at a time, challan will be developing its single amount. If you pay separately, it will show separate challans. Able to understand? So every member shall pay annually for the respective financial year the annual fee by 30th September of the respective year. That is a provision. Suppose by 30th September, suppose I failed to pay. I did not pay annual fee. What will happen? 1st October, non-payment of fee. 1st October up to 30th September, if the institute did not receive 1st October, I'm talking about the law. In reality, how it works is slightly different. So 1st October, institute will remove my name. Institute will remove my name from the register and they will intimate with that your name and COP is cancelled. Getting it? Suppose within 31st March of the same year, same financial year, but by 31st March, I was late. 1st October it was removed. Later I got to know about this removal somewhere in November or December. Later by 31st March, immediately after removal, 31st March will come, right? Which means same financial year. Within the same financial year, if I once again pay along with the late fee, institute will restore my name. Now from which date they will restore? From the date of removal. From which date they will restore? From the date of removal. Which means if they restore from the date of removal, is there any break in service? That's it. That's the advantage. Suppose if I paid after 31st March, if I paid after 31st March, then the restoration will be from the date of actual payment. From the date of actual payment. Means my name is removed on 1st October. I paid somewhere next year, July month. This 8-9 months, I am having break in service. So break in service will be visible in member card. Getting the point? So even if you are late in payment of membership fee, by 31st March at least pay, so that your restoration will be from the date of original removal. So break-in service will not be visible. Are you clear? All of you. If the name is removed for any other reason, then restoration date will be with effect from the order. Whatever the order mentions. Suppose your name is removed because of a disciplinary action taken by the institute. Your name is removed. Whatever the period as per the disciplinary action, your name is removed. After that, the disciplinary order will be there. The order will be there. In that they will mention from which date it will be restored. That actual date. Clear, everyone? So you see here. No, that's what. No, removed means what? You should not sign. You should not sign. You may say, sir, after it is restored, but you should not sign. You should not sign. Nothing. It will come under your violating institute rules, schedule 2, clause 1. Yes or no? Violating institute rules. Violating institute orders. Yes or no? Where disciplinary orders and all you violated, you are liable for punishment. No, under schedule 2, schedule 1. So there I will connect all this. Next. No, they actually not. Logically means name is removed, right? When the name is removed, and see, probably what happens in reality is, I also have not seen the situation, but probably what might happen is, they will remove your name provisionally. They'll review your name like provisional registration, provisional removal might be there. They will give you an intimation that up to 31st March with late fee you can pay. They'll give an intimation. If you don't pay that, we will remove your number with effect from 1st October, they'll give an order. If you don't pay by 31st March, your name will be removed from the register with effect from 1st October. So please pay fee by 31st March at least. They will give you a permission directly. By default, they'll give you a permission so that you can sign all this. Are you getting it? So it's a provisional removal. It's not actual removal. That's it. I mean, I'm talking about reality, not in the act. In exam, don't write all this. Next, restoration. Suppose if restoration was made in the same year of removal, application for restoration is made. If removal happened because of non-payment of the fee, restoration shall with effect from the date it was removed, provided the member pay required fee, including entrance fee, additional fee, okay, as may be prescribed. There will not be any break in service. Suppose if the name is removed in disciplinary action, the date of restoration shall be in accordance with the order. Suppose any other case. What is any other case? Example, suppose you did not pay membership fee within 31st March later. Then it will be from the date on which application and fee is actually received. Clear? Next. Penalty for falsely claiming to be a member. All CA students are liable for this penalty. Yes or no? They are using CA, no? In all their accounts everywhere. So, a person not being a member of the institute represents that he is a member of the institute, uses the designation as chartered accountant. If at all you are representing yourself as a member or you are a member of the institute. See, generally If you have only membership from the institute, you are not having COP, you cannot use the designation chartered accountant. Remember, CA is a qualification, chartered accountant is a designation. What is it? CA is a qualification. You always have the freedom to keep your qualification beside your name. Getting it? But you can't use full form. Full form signifies designation. Getting it? If a person is using designation called chartered accountant without COP, so it is also, you're falsely claiming that you are in COP. Getting the point? You're falsely claiming that you are having COP. So for you, there is a penalty. First time offense 1,000 rupees. Subsequent offense 5,000 or imprisonment up to 6 months or both. Getting it? Or you are a member of the institute, but not having practice. You are representing that you are having practice. Then also you are treated as, you are treated as it is treated as violation. Accordingly, this penalty is applicable. Next. Write about chartered accountant in practice. In this note, deemed to be in practice is something critical. Now, first of all, what do you mean by a practicing CA? He is a person who is a member of the institute and is holding certificate of practice. And it includes all such members who are deemed to be in practice. What is meant by deemed to be in practice? Deemed to be in practice is a definition given to bring all chartered accountants or all CAs who are actually taking practice works, they must have COP. They must have COP. If they must have COP as per law, without COP if they continue, it's a violation. Correct? So deemed to practice, the definition is defined with an objective of bringing all chartered accountants out there, whoever is actually taking practice kind of work but not having COP. So they all come within the ambit of COP. So they have to take COP, they have to pay annual fee. Able to understand? Some CS know what they do is, see, if I take COP, I am governed by so many clauses under Schedule 1, Schedule 2 offenses. Suppose if I do not have COP, I can advertise happily my services. I can open a consultancy firm. I will not render audit services. I will not render attestation service. I will render IT filing. I can file GST returns. So the moment I remove COP from my thing, I can open YouTube channel. I can advertise like anything that I am ready to file these things. I'm having CA qualification. I can advertise all this. You know that? But if at all you're having COP, you can't solicit. You can't advertise. Having COP will bar you from advertising all. Getting it? So some members, what they're doing is, they don't have COP, they don't take COP. Naturally, if a member do not take COP, most of the provisions of CA Act, they will not be applying on that member. But what this member is doing, this member is rendering all services which practicing CAs are rendering. So now institute finds a need for the definition. What is the need? So let us first define which services if you provide, you are deemed to be in practice. Which services, if a member of the institute provides, they are treated as deemed to be in practice. If at all they are deemed to be in practice, what they need to do? Get COP from the ICI, become an actual COP. Are you getting the point? So deemed to be in practice is a definition which covers list of activities, list of services which only a member of an institute can render who is having valid COP. If at all you are rendering the services falls under DDP, you must have COP. If at all you are already having COP, no problem. If you are doing some services which a deemed to be in practicing chartered accountant can only render, you are also deemed to be in practice, and accordingly you must have COP. Without COP, if you are practicing, I've seen penalty. Previous question, 1,000 rupees first time, 5,000 rupees or imprisonment up to 6 months or both. That's it. Able to understand? No. So what is the significance of COP? No member of the institute shall be entitled to practice unless he obtained COP. And every such member shall pay annual fee. A member of the institute have no other capacity in which he can take a practice separable from his capacity to practice as a member of the institute. The moment I am using my CA qualification and I am taking a practice works, you can only do that work only as a member of the institute. You cannot say, hey, from ICI and for me, no relationship. I don't have any COP, but give me able to accounts audit services. You can't. You can take up accounting services, audit services, all these services only as a member. You will not have a separate capacity. Suppose I'm a partner in a partnership firm. Partnership firm is involved in some business. One of the clause in partnership firm is I can also do my personal business related to same business. That's what they told me. In clause they explicitly gave me the permission. In the partnership deed they gave me explicitly the permission. Suppose our firm is engaged in construction service. So on behalf of firm I have some clients. One of my client is introducing new client. So I told him, no, don't give to my firm contract, you give me the contract. Getting it? Here, in this contract, between it is between you and me only. No relation with the firm. Like this, you cannot practice. Able to understand? So in one company audit, you are taking as a chartered accountant having COP. In another case, you are saying between me and ICA, no relation, but I will give you attestation service. You can't. Able to understand? You can provide attestation service. You can provide statutory audit service. You can provide statutory functions only as a member of the institute. You don't have any other separable capacity. Clear? The moment you are signing as a chartered accountant, you are deemed to be member of the institute. You must have COP. Clear? That's what the sentence meaning. If COP is cancelled, you cannot undertake any assignment, which generally only member of the institute can take up. Whatever services comes under DTP definition, you cannot render if COP is cancelled. So that is the significance of COP. Able to understand? Simply, whatever services comes under DTP, if you want to render them as a member of the institute, you must have COP. You don't have COP, don't render. Simple. Next. Cancellation and restoration of COP. Cancellation. Your COP will be liable for cancellation in the following cases. First reason, first of all, your membership is removed. If your membership is removed, naturally, COP is removed. Or you got COP by giving false information. Or the member stopped from practice. He ceases, like he stopped practicing. Then he intimated to ICA voluntarily that he is not practicing. Or he has not paid annual fee till 30th September. Now, restoration will be more or less similar logics, so I'm not repeating restoration. Whatever restoration of membership is there, no, same logic applicable here also. Able to understand? Next. Now, what do you mean by deemed to be in practice? So, shall we take a small break? Okay? Yes. So, we'll take a break and then we'll continue deemed to be in practice and we'll start schedules, all that. So if you observe for this chapter, I'm using this colored notes. Even for peer review, quality review, mostly I'll be using this. For few chapters, I'll be using these notes. And here, the reason why I highlight with colors is only because of not for getting attention, not for grabbing attention. But when you're reading, you must change the sound. You may be reading internally. But whenever, like suppose you see, there are two classes of members. Those who are in practice and those who are otherwise occupied. You see the sounding, getting the point. So whenever the color changes, your reading sound should change. So that's how you understand better. Your reading skill, if you properly read, you understand in much more better way. It's all about the reading skill. Anyhow, so deemed to be in practice, we need to discuss, right? So what do you mean by deemed to be in practice? Can I continue? Yes. So a member of the institute shall be deemed to be in practice when individually or in partnership with another chartered accountant who is in practice or in partnership with members of such other recognized professions. This is nothing but multidisciplinary firms. This is nothing but multidisciplinary firms. This is nothing but unidisciplinary firms. Means what? With the same people if I practice, with the same CS. So, a member of the institute, remember this definition applicable only for the member of the institute. A member of the institute shall be deemed to be in practice either individually or in partnership with another CA in practice or with some other recognized profession. Right now, though multidisciplinary firm concept is permitted by ICI, the full-fledged guidelines were not yet released because until other disciplines also bring these guidelines, we can't start multidisciplinary firms as on today. Able to understand? Consulting firms can be started, but attestation firms cannot be started. It is permitted in ICA, but the guidelines were not given of this. Able to understand? Next. And consideration of remuneration is received or to be received for being. These are the services. If you are providing these services, you are deemed to be in practice. What do you mean by deemed to be in practice? If you are deemed to be in practice, you must have COP for sure. Without having COP, you cannot render these services which only a practicing CA can render. Like what services? You are engaging in practice of accountancy. You are performing services involving auditing, financial transactions verification. You are preparing, verifying, certifying financial accounting and records. And you are holding to the public as a chartered accountant. Accountant means what? You are calling yourself as a chartered accountant. When you are holding to the public, when you are exhibiting to the public as a chartered accountant, you are deemed to be in practice. If you are deemed to be in practice means what? You must have COP for that. If you have COP, you are doing all this, no problem. If you don't have COP, doing all this, then that's a problem. Able to understand? Or you are rendering professional services or assistance in or about matters of principle, detail relating to accounting procedure, recording, presentation, certification of financial facts. So in accounting, you are giving accounting related advices, or you are giving some accounting procedures in a company to be followed. You are designing and implementing information systems in the company. Example. So all that comes, or you are rendering such other services in the opinion of the council can only be rendered by who are CAs, that too who are in practice. If the council gave some additional services, these services must be rendered only by chartered accountants, and you are rendering that services, then you are deemed to be in practice. Now, what do you mean by deemed to be in practice? If at all you fall within this definition, what is the consequence? You can render all this, provided you have COP. And remember, a member shall be deemed to be in practice only in the professional capacity. Deemed to be in practice is not a personal capacity. Certificate of practice is not your personal capacity. It's a professional capacity. Able to understand? So, neither in his personal capacity nor as an employee. Getting it? So, a member shall be deemed to be in practice if he is acting as liquidator, as a trustee, executor, administrator, arbitrator, receiver, advisor, representative for financial matters. Even if you are providing representation services for taxation matters, even if you are providing representation for taxation matters, representational services you are providing, but not as an employee. You are not providing as an employee, or you are not providing them in your personal capacity. What is meant by personal capacity? Representation of taxation matter, personal capacity means what? What is meant by that? Suppose income tax department sent a notice to one SSE, demand notice. Now that person doesn't know anything about income tax. He employed me as a representative. I am not a chartered accountant, or maybe I am a chartered accountant, but I am not using that qualification. I just want to represent him, go and talk with the officer, and then somehow resolve the issue. Is there any compulsion that in income tax only a chartered accountant should represent on behalf of SSE? SSE himself can represent. If SSE do not have that knowledge, anybody else as employed by SSE as his representative, power of attorney is required. That's it. If attorney is given to me, to anybody can represent. Now here, on behalf of SSE, I am going and representing in my personal capacity. I am not deemed to be in practice. But suppose I asked him to select CA option in the IT. In the e-grievances cell, no, I am asking him, appoint representative, select option as CA, which means I am using my professional capacity. The moment I am using my professional capacity to represent a taxation matter, and in professional capacity I am going, it is deemed to be in practice. Able to understand? So these matters, if at all you are rendering in personal capacity or as an employee of some organization, even though you are a member, you don't have to, you need not be having COP. Suppose if at all you are doing all these activities in professional capacity, then you are treated as deemed to be in practice. Even if you are acting as liquidator, you see, these services are not covered in the above list. In the above list, the following activities are not covered. Representative for costing, representative for financial, representative for taxation matters. So, if you are acting as a representative, or if you are acting as a liquidator, you are appointed as a liquidator by some government for one company. For one company, a court appointed you as a liquidator. And in your official capacity, they appointed you. You are a practicing CA, they appointed you as a practicing CA. Then you are deemed to be in practice. They appointed some company as a liquidator, and that company sent you for doing all the liquidation process. You are employed in that company. You are not deemed to be in practice. Able to understand? Getting it? Or You are taking up an appointment given by central government or state government or court of law or any other legal authority or acting as a secretary. So if you are taking any of these appointment in professional capacity, if you are taking any employment made by central government, example, a company, big company is there, some scam has burst out, and in that company, you are appointed as an independent director in professional capacity. Since you are a chartered accountant, so central government issued an order that appoints some 2 chartered accountants who are having more than 5 years COP as independent directors in this company. So there is an order. Because of that order, some 2 of you were selected. Because you are practicing as a CA, 2 of you were selected and employed in professional capacity. You are deemed to be in practice. Able to understand. Unless that employment is on salary come full-time basis. Suppose government employed you as an employee in that company. On full-time basis, they employed you. Then you are not deemed to be in practice. Are you getting it? Suppose if they just appointed you as an independent director in a company, getting it? Not on a salary come full-time basis, but as an observer. Then you are deemed to be in practice. Clear? Next. And an associate or fellow of the institute who is a salaried employee of another chartered accountant or firm of chartered accountant or a multidisciplinary firm. If you are a member of the institute, you are a member of the institute or you are a fellow of the institute, but you are right now working as a salaried employee in a CA firm, you are deemed to be in practice for the limited purpose of training article assistance. We all know that, and you can register for articles only under practicing CA, correct? Suppose I went to one firm, they are having only 3 partners, 10 already filled articles. I want to register in that firm, but they have an employee who is a CA. They can register articles under his name. So a CA working in an audit firm, he is also eligible to train articles. He will also get eligibility to train articles. For the purpose of articles alone, you are deemed to be in practice. However, you are exempted from holding COP. Getting it? Next. And this is a clarification. What is this clarification says? Now what is meant by deemed to be in practice we have seen. There in deemed to be in practice definition, what are covered? Advisory services are covered. What are covered? Advisory services are covered. Practice of chartered accountancy is covered. Auditing services, financial statements verification, financial statements, financial accounting preparation. So all these services only a CA can do, only a practicing person can do. Or you may give a detail about accounting procedure, or you can render such other services, all that. Now, this do not talk about administrative services. This do not talk about consulting services. These do not talk about non-attestation, non-audit services. Able to understand? Now, what about this non-attestation, non-audit? What are all? They are all popularly called as management consultancy and other services. Now the question is, can a chartered accountant who is in practice, can he provide MCOS services? I am a practicing CA. Can I provide MCOS? Yes, you are permitted. First of all, deemed to be in practice definition is given to bring people, to bring chartered accountants or members of the institute who are providing all those services, to bring them within the ambit of COP, so that all the laws and regulations of ICI will apply on them, so that ICI can monitor. That is the reason why DTP is defined. Now, another question is whether these chartered accountants who are having COP, can they provide consultancy services? Are we permitted to provide consultancy? Yes. You are permitted to provide entire range of management consultancy and other services. What are MCOS includes? They have given. Now, most importantly, what management consultancy and other services does not include, what MCOS excludes: statutory, periodical audit, tax audit, representation, advising on tax matters, acting as liquidator, trustee. These are all statutory functions. These are all not treated as consultancy services. These services can only be rendered only by CA having COP. Whereas MCOS services can be rendered by non-member or by member. May have COP, may not have COP. Just because you are a member of the institute or non-member of the institute, this MCOS can be provided by anybody. This consultancy services can be provided by anybody. Can CA having COP provide? Yes, they can also provide. But remember, management consultancy, other services do not include the following. You know why this definition is given? This exclusion list is given. Why? You know, we have council guideline regarding corporate form of practice. What is corporate form of practice? CAs can open a company. Which is exclusively engaged in management consultancy and other services. A company can render management consultancy and other services. For that purpose, instead of using your firm name, you can use your company name. That company shall get approval from Institute of Chartered Accountants of India, because that company is created by a chartered accountant. In that company, this fellow is acting as a managing director, whole-time director. Generally, as per clause number 11, CS are not permitted to act as a managing director or whole-time director or working director. They are not permitted to have any other additional occupation except practice. Yes or no? They can have shares in a company. They can have ownership in a company. But they are not permitted to include in the affairs of the company. However, only one exception is there. If a company is exclusively incorporated for management consultancy and other services, in that company, the CA can act as director, managing director, whole-time director, full-time employee. Anyway, he can work. Able to understand. Provided that company got approval from Institute of Chartered Accountants of India. Now, MCOS services it can provide, right? Now, MCOS means what? Attestation also MCOS. So, that's why the exclusion definition is given. This definition is given so that corporate form of, the companies which are incorporated by chartered accountants who are acting as directors in those companies, they should not provide these services on behalf of company. If at all you have to provide attestation service, you can only provide on behalf of your firm. Able to understand? Wherever you did articles, some of you might find in your same firm name, company is also created. Yes or no? In the same firm name, ABC & Co. Chartered Accountants is a firm name. ABC Private Limited is a company name. Getting it? ABC Consultancy Private Limited is a company name. So, in ABC Consultancy Private Limited, who are all the directors? All the partners. These are the members, these are the directors in the company. In ABC & Co, who are the partners? Mr. A, BC, who are all chartered accountants. Anyhow, I'll come there, I'll once again connect with this. Are you clear? So, these services are not treated as consultancy services. Accordingly, these services are treated as deemed to be in practice. Only CS who are in practice can provide. Whereas, MCOS means what? It's a general consultancy services. Anybody can provide. Forget about CS. Anybody can provide. Can CS provide? Yes. Can CA having COP? Can they also provide? Yes. Now the question is, here the confusing point is, can we provide these services to the company where I'm acting as an auditor? This is a question. The answer is not straight away no. This MCOS is a very big list. In Companies Act, prohibited services, 144, it only talks about 9 services. Except those 9, if any other service is there, they can be provided to the company. For a company, what other additional services statutory auditors can provide? Companies Act has to decide, not you and me. So, Companies Act, instead of mentioning what services auditor can provide, they mentioned what services auditor should not provide. In that, if you see, the last service in that prohibited list is management services. What is it? Management service. What are we saying here? Management service. What are we saying here? Management consultancy and other service. Suppose, if I'm acting as an independent director in a company, that's a management service. Management service means it's a service provided by any person involving decision making for the company, which involves decision making for the company, which directs the company to do something. Able to understand? That's called management service. Whereas MCOS do not involve generally decision making activities. We just provide additional consultancy. We just provide additional works. Are you getting the point? That's the basic difference between management service and management consultancy and other service. Whatever prohibited in Companies Act, except that remaining all other service, even though you are my auditor, you can provide me. You are not disqualified. All of you. But when an auditor is providing services to the company, in addition to audit, some other services are provided. It is creating self-interest threat. It is creating what? Self-interest or familiarity threat. Now, because of this, maybe auditor independence can be compromised. That's why the council guidelines says, one of the council guidelines, the fees received for other services, the fees received for other services shall not exceed fees received for audit service. There is a restriction on the fees. Getting it? Okay, I'll come there, I'll discuss. Now, what are all covered in MCOS? Almost so many services are covered. So many services are covered. Whatever I highlighted in bold letters, no, these you can take it for purpose of examination. Remaining you can ignore because these are very popular. Whatever I highlighted in bold color is very popular. Read carefully, entire this list once later. Okay, later once you can read this carefully, just once the list. Next. Administrative service like word processing service, company published annual report. They just asked you to read an annual report. Sir, just read the annual report completely, see any mistakes are there. That's called word processing service. Okay. Preparing administrative forms for client approval. Okay, or submitting forms as instructed, ROC forms you're filing, or you're filing GST returns and all, that and all is permitted. You're filing IT return for the company, you can do that. That's just an administrative service. They're just consultancy works. Now, even you're not actually attestating, you're not actually, doing attestation, but you are offering to attest. It is also treated as deemed to be in practice. So what do you mean by deemed to be in practice? Only when you actually render? No. The moment you offer to the public some practice related works, it is also deemed to be in practice. So invitation to offer is also deemed to be in practice. And another clarification given, if at all you are serving with armed forces, if at all you are serving with armed forces, for whatever the period you are serving with armed forces, you are treated as deemed to be in practice. Means it is counted for COP calculation. It is counted for COP calculation. Able to understand? Suppose I just qualified CA and I got membership of the institute. I want to go for COP, but because of some urgent requirements in Indian Armed Forces, let's assume they requested me. Example, I went and worked there. 5 years I worked there. 5 years I will be treated as in practice. And the moment I came out, I can directly go with the FCA. For army officials and all, the number of years, whatever they serve in army or navy or air force, that number of period is excluded from their age for determining government job calculation. Suppose government job you will get, assuming you are having maximum age of 35. Let us assume at the age of 25 you went to army. 15 years you served. You came out at 40. These 15 years will be removed from your age for the purpose of calculating your actual age for the purpose of treating government job. That's why those who came out from the army, they will get bank job, they will get some job in state government entities like that. Actually, that job they don't get if they calculate as per normal age criteria. But their age will be calculated. Adjusted age will be calculated. Actual age minus period served in armed forces. That is a revised age. That is considered for government job calculation for the people who worked in armed forces. This is a benefit given to the citizen whoever is working in armed forces. So, if a CA is working in armed forces, it is treated as a COP. Are you getting it? Next. Now here we have seen management services is something that cannot be provided to a company if at all he is appointed as statutory auditor. If a chartered accountant is in full-time employment and you are representing your employer in a tax assessment, it cannot be treated as deemed in practice because you are representing in taxation matter as an employee. That is not deemed to be in practice. Suppose I am using my qualification CA. My colleague is having some tax issue. I am going to department to argue on behalf of him. There I am not going as an employee. I am going in my personal capacity, again fine. Personal capacity means don't use CA qualification. Just to defend him, no problem. If at all you are using CA qualification and then defending him, again you are using professional capacity, which means you are deemed to be in practice. So a chartered accountant can render representational services, or if a member of the institute is rendering representational services before income tax or GST or any other authority using the qualification, he is deemed to be in practice. Are you clear? Next. Now, suppose, what if you are deemed to be in practice? What are the implications? You must have COP. However, it is not applicable if you are an employee in an audit firm. You must pay annual fee. You must follow council regulations, guidelines and professional standards when you are discharging the work. Clear? And remember, if at all you open a company, suppose you qualified as a CA, along with some 2 more friends were there. All 3 of you qualified as a chartered accountant. You all got membership and COP. You 3 of you together opened a private limited company. You want to provide audit services in the name of the company. Prohibited. Section 25 of the Chartered Accountants Act says no company shall practice as chartered accountant, which means what CA Act indirectly says, you can practice either individually or as a partnership firm or as an LLP. Only 3 modes are permitted. Only 3 modes are permitted. Whether you are practicing as individual, it is called as sole proprietary firm. By the way, here let me talk about MRN and FRN. MRN remains member registration number. FRN means firm registration number. Firm registration number means what? Partnership form or proprietaryship form? Both are covered. Firm means it may be sole proprietary form or it may be a partnership form. Both. Getting it? Suppose if I take COP and I will be called as Harsha Chartered Accountant. That's it. Suppose if I obtain a name for my practice, I applied for name Harsha and Co. Harsha and Associates. Getting it? Then it's a firm name. When a firm name is approved by institute, naturally they will allocate a name, membership number for it. FRN will be given. Remember, a chartered accountant can accumulate goodwill only if it is having a firm name. Suppose tomorrow if you want to practice with firm name, not in your personal name. You want to practice individually, okay. Only sole proprietary firm you create. Don't take partners. Suppose you created one firm. Example, GP Kapadia and Co. You know, that's the first chartered accountant. He is the one who created this institute. GP Kapadia and Co. Is it partnership firm? Yes. Today it's a partnership firm. Originally, what is it? Only one person is owning that entire firm. Means it's a sole proprietary firm. In that firm, if you take additional partners, then it will become a partnership firm. Understand? But GP Kapadia and Co. is a firm. That's it. It's a firm. Having firm registration number. Now GP Kapadia is no more. Able to understand? Still that firm's name is carried. Suppose if I don't create firm, what will happen? If I expire, obviously my firm will also dissolve naturally. I don't have firm first of all. Able to understand? If you create a firm, whether you continue in that firm or not, the experience of the firm will be counted continuously. Are you getting it? Now bank audit will be allocated to a firm which is having experience of 10 years, 15 years, 5 years. Firm experience they will see, not a partner experience. Able to understand? That's it. So whenever tomorrow you are practicing, when you are obtaining COP, immediately you should simultaneously apply for firm name. Because if your firm name is there, tomorrow you don't want to practice, you can sell your firm to somebody. You know that? You can sell your firm to somebody. You can withdraw from the firm as a partner and the people can continue. Remaining people can continue. And if you are having a firm, your legal representative or legal heirs will get some goodwill. Are you clear? All of you. It's like a brand name. Firm name is like a brand name. Next. The term company includes a LLP, which has a partner company. Even if I want to open an LLP, in that LLP, if company is a partner, then that is also not permitted to practice. So if I have to practice, I can practice individually with a firm name. Or I can practice as a partnership firm LLP with a firm name, where all the partners must be individuals. Able to understand? But in my firm, if at all a company is a partner, then again my firm cannot practice. Next. Now, member in practice is prohibited using any other designation other than chartered accountant. With this, we will discuss in clause number 7 of part number 1 of schedule number 1. The section 7 and this clause number 7 of part number 1 of schedule number 1, they are discussing about the same thing. Schedule 1, part 1, clause number 7, what it says? A member is not permitted to use any other designation, or a member is not permitted to advertise his professional attainments or use any other designation. So no, this section is also talking about designation. So we will be already discussing there. So it will be covered naturally. Clear? Next. What about maintenance of branch offices? What about maintenance of branch offices? Can a CA open a branch office? Can a chartered accountant, whoever is practicing, can he open branch offices? Yes, he can open a branch office, provided every branch he is opening should have a full-time CA associated with it. He may be a partner or he may be an employee. Doesn't matter. Whenever you want to open a branch, it must have CA with COP. Just remember, these are professions which involves personal participation. These are the professions, yes or no? CA is a profession, doctor is a profession, lawyer is a profession. For all these professions, can they open branches? Means yes, provided same professional was also heading that branch. Able to understand? Suppose, very simple, if at all this branches related condition is not there, separate in charge condition if it is not there, what will happen? I will have branches across India. Why? What's very simple. I'll come to Chennai. I'll go nearby tax consultant. I'll ask him to use my name. I'll ask him to use my name. Get all the files. I will sign. Is it possible or not? So my personal participation should be there if I have to open a branch. But if I participate in that, who will participate in head office? So what ICI put, in order to prohibit this kind of scams, what ICI did, when a member of the institute want to open a branch, that branch must have been handled by a full-time associate chartered accountant. One full-time associate with that branch should be there, and he must be a chartered accountant. Are you clear? So a member of the institute is permitted to open branches. So separate in charge. There should be a separate in charge for every office, and he must actively associate with that office. When do we say he is actively associated? If at all he is residing in the same place where the office is situated for minimum 182 days. In Chennai I have a branch, and I told Mr. B is the in charge of the Chennai. In such a case, Mr. B should reside in Chennai for minimum how many days? 182 days. Suppose he is not residing. Okay, he may be residing in nearby town, but he is attending the office minimum 182 days. Then also institute says, yes, he is associated with the branch. Or in such other circumstances, in the opinion of council, establish such active association. So when I say something is my branch, it must have a separate in charge who is member, who is actively associating with that branch. Able to understand? Separate in charge must be there. What do you mean by separate in charge? Very simple. I showed my membership number, right? I showed my professional address. Suppose my firm has 3 professional address. 3 professional address. 3 professional address. Means one professional address in one city, another city, another city. Definitely for these 3 professional address opposite, which CA is leading? Which CA? That's why you see, when you're joining in an audit firm, no, they will not permit you to have your own COP. If at all you're having your own COP and also joins in an audit firm, okay, they may not, see, like very simple, the firms will have to file every year written with the institute. Or they will have to file, some empanelment forms with C&AG, empanelment form with RBI, empanelment form with IRTA. Like that, these forms will file. In that form, they will have to intimate how many full-time CEOs associated with your firm. How many full-time CAs associated with your firm. The firm has to give a list. Suppose you are working in my office. You are a CA. But you are not fully associated with me. How can I say you are not fully associated with me? You are having your own COP. You will not be counted in my limit. When you are not counted in my limit, I don't need you. Getting the point? Whatever the work you are doing, my senior article will do. Because you cannot sign, article cannot sign. Whatever the work you are doing, he is also doing, senior article. Able to understand? Now, what is the advantage if I recruit you? If at all you surrender your COP and join in my firm, I will intimate to CA Institute that you are full-time associated with me. And I have some branches. For some of the branch, I will make you in charge. If at all some in charge is there, I will remove him and I will make you in charge. Able to understand? So, this is how in reality it works. Suppose bank, no, branch audit. Bank branch audit. Suppose there is a bank, there is a State Bank of India, which has a branch in Kanchipuram. Okay, I want to get State Bank of India Kanchipuram branch audit. What is the condition? I must have branch in Kanchipuram. State Bank of India will give priority to those firms. Whenever branch audit is allocated by a bank, they will give priority first to the local practicing firms. What do you mean by local practicing firms? They are having an office in the Kanchipuram. Now, if I have to open office in Kanchipuram means what? I must have a CA residing there. I must have a branch. And I must need a CA who is residing there, who will act as a in charge of that branch. Are you getting the point? Now, you may say, sir, how do institute know that you are residing there? Member card, your residential address is there. That is the proof. Able to understand? Getting the point or not? So that's it. So you must either reside there or you must attend the office. Attend the office means you must prove the institute when they ask for any inspection. Now, can a member act as in charge for more than one office? Not permitted at all. Only for one branch you can act. However, if at all the second office is in the same building, that is not treated as branch. If the second office is located in the same city, that is not treated as branch. If the second office is situated within 50 kilometers from the municipal limits, within 50 kilometers, there is a branch. That is not treated as a separate branch. That is treated as part of the main office. Able to understand? So in such a case, no need of separate in charge. Suppose in the same building, I have 50 articles. My office space is not enough. I took another space in the same building. Well, how come you call it as branch? It's hardly 2 minutes. I'll go up and down. Getting it? Or if it is in the same city, hardly 1 hour. If it is within 50 kilometers, hardly 2 hours traveling time. This is not somewhere in the remote locality. I am only every day I'm going there. Half day I'll be staying here, half day I'll be staying there. That is actually not a branch. That's just an extension. I did not find space in the same building. I did not find rental premises within the city at my affordable rate. So I opened office within 50 kilometers. You can argue, yes or no. That is not a branch. So if at all you're opening branches within the same building, same city, within 50 kilometers from the municipality limits, it is not treated as a branch. It does not require a separate in charge. Yes or no? Have you seen all this? Your faces are pretending as if you don't know this. Fine, right? Now, suppose, sir, I want to open a branch office in hill area. But that is only a temporary office. In hill area, which chartered accountant will reside, sir? First of all, tell me. Yes, sir, I want to open a branch in Kodaikanal, or I want to open a branch in, Woody. Because my clients are there, tea plantation, coffee plantation, some plantation clients were there. Okay, and they will come and submit records. If I ask them to come to Chennai and submit records, they will first of all find another CA there. So whenever season comes, especially IT filing season, June, July, August, September, yes or no, these 3 months especially, I want to have a branch there. But for these 3 months, how can I find a separate in charge who is residing there? First of all, in Kodaikanal, there is no registered CA. Example. Getting it? So how can I find a CA who is residing there? So considering the hill areas, considering the clients in the hill areas, ICI said you can open temporary branch office for not exceeding 3 months in the hill area without a separate in charge. And what are the conditions they gave here? Are you clear? At the time of opening the branch, you should intimate to ICI. At the time of closing the branch, you should intimate to ICI. And the branch should not operate for more than 3 months. After 3 months, name board, everything should be removed. Able to understand? These 3 months you can keep name board, no problem. But after 3 months, your name board, everything should be removed. If at all your name board is continued, no. Your advertising, no. Indirectly that you are having a branch there. You understand? All of you. Name board. A member is allowed to put name board at his residence. Which name board? Member board you can put. Your firm name you should not put at residence. Wherever you put firm board, it's a branch. Understand? Main office. When more than one office is located in the same city, which is your main office, you should inform to ICI. The member in charge of the branch can be either partner or maybe paid assistant. If at all is a paid assistant, he must be full-time employment with the firm. That's what I told. Full-time paid assistant. Only he will be counted. What do you mean by chartered accountant in service? Simple. Whoever is not having COP but who are having membership but who are working in the industry. Getting it? They are called as chartered accountants in service. Next. Then write about types of misconduct. So we have 2 types of misconducts. First of all, misconduct in relation to profession, misconduct other than profession, but you are involved. Because you are involved, suppose no, a CA no, suppose if at all he drank, example, and car auditor is just driving the car and met with an accident. They will not write Mr. Harsha met an accident. A chartered accountant drinks and drives. Correct? Epo headlines attractive irukom. Ninga parunga doctor. A doctor is making nuisance in the pub. Yes or no? Andha madhiri they'll be writing because that only cuts. If at all they put a name, your name nobody knows. Yes or no? But if a doctor name is used, entire doctor sentiments will hurt. No. That is what the newspaper wants, news channels want. So, if at all you do some behavior, you know your behavior was in such a way that it is bringing disrepute to the profession. Even though it is your personal activity, it is treated as misconduct by ICI. So, those misconducts are treated as what? Other misconducts. Able to understand. So, எப்பாவது நீங்க அந்த மாதிரி வேலை பண்ணும்போது don't tell that you are a CA. நீங்க சொல்லல இருந்தா உங்க கார் பின்னாடி CA sticker இருக்கும். I never keep car sticker, CA sticker and all in my car. Not because I do all that, okay? just that I don't want to get that attention. Next. So professional misconduct, other misconduct. Now, these are the clauses that we have. So first schedule, we have 2 schedules. First schedule, So what are all various offenses that are punishable? What are all various offenses or activities that are punishable from the ICI? These offenses or these misconducts are broadly divided into two schedules. Schedule 1, Schedule 2. You know what exactly difference between Schedule 1 and Schedule 2? Schedule 1 talks about your general misconducts. General misconduct related to your practice. Related to your practice or your normal profession. Getting it? Here, no client is affected. Here, your clients are not affected. You are running practice with so much of advertisement like that. It is regarding your business practices. See, you need to run your practice in certain way. How you should not run your practice? That is what first schedule is indirectly talking about. Suppose you are running practice. You are accepting some audit. You are accepting some audit. But when you are doing that audit service, you are violating so many provisions. You are violating so many norms. You are grossly negligent. You are not working properly. Because of this, some third party affected. Those effect, wherever third parties are affected, that is covered under Schedule 2. That's the primary difference between first schedule and second schedule. Suppose I am advertising and getting a new client. Because here no third party is affected, but you are violating institute norms. First schedule offense. I got a client, I accepted statutory audit, I did not verify any books of accounts and I gave an audit report. Members have lost, so many people have lost money. That is second schedule offense. Which is more severe? Second schedule is more severe. Second schedule, because in second schedule offense, because of that offense, many third parties are affecting. Getting it? In first schedule, you and institute only will affect. Third party is not affected. But when third party is affected, that's a more severe offense. That's why schedule 2 offense will have higher punishment. In schedule 2 offense, the institute will remove your name any number of years. Whereas in first schedule offense, they will reprimand and remove for certain temporary period. So schedule 2 offense will be, penalty will be higher, 5 lakhs around. In first schedule, it is 1 lakh penalty. Primary penalty. So that is it. I think you are the one who asked, no? That's it. Able to understand. Next. Now, schedule 1 has totally 4 parts. The misconducts have been totally classified into 4 parts. Part 1, 2, 3 and 4. Getting it? There are 3 professional misconducts related parts and there is only 1 other misconduct. Other misconduct means practice or non-practice. That and all doesn't matter. Other means what? Not related to profession. So obviously, other misconduct by members of the institute in general. Now first one, professional misconduct by people who are in practice. Professional misconduct by people who are in service means the second schedule, second part of the first schedule do not apply for practicing chartered accountants. First part of the first schedule do not apply for non-practicing chartered accountants, whereas the third part applicable for all generally. Now there are 12 misconducts. There are 12 misconducts which are discussed for practicing CS. There are only 2 misconducts which are discussed for service people, because with service people we don't have much complications. They are not practicing. They are not associate. They are not using institute name everywhere. Able to understand. So obviously the number of offenses will reduce. Then generally, which are not covered in above 2 are covered here, and other misconduct which are not related to profession. Clear? Same way, schedule 2, members who are in practice, but because of their work culture, third parties are affected. So those kind of offenses are 10. And general misconducts. Schedule 2 talks about general misconducts by all the members of the institute. There is no service. In the second schedule, servicing chartered accountants, their misconduct is not covered specifically. They are covered here generally. Generally means what? Practice, not in practice. Both are covered. And finally, other misconduct. Here there is only one other misconduct. That is, if more than 6 months imprisonment is there per member, that is treated as other misconduct under part 3 of the second schedule. Whereas here, no, less than 6 months misconduct is there. Less than 6 months imprisonment was there, one of the item. So then also that is treated as other misconduct. If the imprisonment is less than 6 months, then it's a other misconduct in schedule 1 part 4. If it is more than 6 months imprisonment means, 6 months or more than 6 months. If that is the case, then it's a second schedule offense, part 3. Are you clear? Next. So what is the schedule 1, we are discussing part 1. And in that clause number 1, so what is this clause number 1 says? A chartered accountant in practice is deemed to be guilty if he allow another person to practice in his name. Suppose I find a local tax consultant and I asked him to put my name board and asking me to practice and get the clients. Yes or no? It is treated as branch. That branch must have a separate in charge. Without separate in charge, if I open a branch office and allow somebody else, a non-chartered accountant, to practice in my name, it's treated as guilty of professional misconduct. However, if at all the other person is a practicing CA or he is associated with the firm as a partner or employee, then it is fine. This is what, right? Separate in charge. Correct? This exception is nothing but what? Separate in charge. If I open another office where separate in charge of another member is there as an employee or as a partner, then it is permitted. No. When it is not permitted, I opened a branch, somebody else is heading that branch in my name. That is a misconduct. Clear? So this and separate branch in charge concept is interlinked. Next. Now, can I share profits to a non-member? Not permitted at all. Can I share profit? See, first of all, opening partnership with a non-member itself is not permitted. Letting another person to use my name itself is not permitted. Then how come my revenue, how come my profits I can share to a non-member? So, if a CA agrees to pay, allows or agrees to pay or allow or agree to allow any share, commission, brokerage and the fees or profits of his professional business to any person, it shall be treated as guilty of misconduct. Why are you paying to non-members? Out of the fee, whatever you collect, why are you paying to non-members? Are they referring your clients? Are they referring you the clients? You paying a mediator fee? What? Able to understand. So, institute says, institute put a restriction on your payments itself. Remember, whatever the payments, institute is putting a restriction on that. Sir, he can pay through cash. No. If at all you are paying through cash more than 20,000, you will not get deduction in income tax. No. So, if at all you are paying in cash, you are naturally prohibited by income tax law because you don't get deduction. You have to pay higher tax. If you want to pay in bank, if payments audit is performed by institute, they will identify to whom and all you paid. Suppose you paid it for administrative expenses like rent, salary, that and all fine. Some unexplained payments were there. For whom you paid? For what service you availed from them? Where is the bill? The institute will ask. Able to understand. So, however, you can share the fees to another member of the institute because he is a separate in charge. Or you can pay to your partner because he is a partner. Or you can pay to retired partner. You can pay to retired partner. Retired partner can continue to get some goodwill. Getting it? Or you are paying to legal representative of the deceased partner. Or you are paying to member of any professional body where you formed multidisciplinary firm. Or you are paying to a person having recognized qualification as prescribed by council. What are recognized bodies? CS Institute, CAA Institute, lawyers, architects, actuaries. And these persons are recognized qualifications. So to them, if you are paying any fees, that is permitted. Are you getting it? Now, look at the substance of the transaction, not the nomenclature of the transaction. Whether it is called as office expenditure, reference fee, what name it is used, doesn't matter. To whom it is paid, that is what important. Is it paid to a non-member of the institute? Yes. Then you are treated as guilty of professional misconduct. However, if it is for administrative expenses like office expenses and all, really office expenditure, really rental expenditure, rental agreement and all is there, getting it, then it is allowed. Next. If CAP is sharing fees in the form of deposit with state government treasury incurred in the process of assignment of audit, like sometimes no, society's audit, no, they will also have empanelment form. Now, there is a condition in the society's empanelment that CS must deposit 10,000 caution money. Caution money. If you keep a caution money deposit because of empanelment condition, that is permitted. That is not treated as guilty. Next. Now, what about treatment of share of profit or goodwill on death of a partner? In case of partnership firm, as per the partnership deed, if a retired partner or legal representative of the deceased partner is getting some profit share, that is permitted. For a sole proprietary firm, the proprietor died. Where is profit share? The firm will be sold to another person. There is only a lump sum amount called goodwill. Can this goodwill be received by legal heir of the deceased partner? Yes, it can be received. Now, what is the process to sell this firm? What is the process to get this goodwill? That is what given here. Sharing of fees is strictly prohibited. Once the proprietor died, this firm is being used by another person or another partnership firm is using this firm name. They can't share profits to this fellow every year, every month, they can't. But when they are getting this name, no. See, first of all, when a proprietor died in an audit firm, that's a sole proprietary firm, it has firm name, separate name from the individual name. That firm name has some goodwill. this legal heir can sell that firm name to somebody else. If at all he don't want to sell, that will lapse naturally after 1 year. Getting it? Why to lose it? It has some goodwill. A group of chartered accountants are ready to buy this firm and they want to offer me a lump sum amount. I am a legal heir. Can I sell this? Yes, you can sell this. Able to understand? You can sell this and the new firm, whoever is buying this firm name, no, they can continue using this firm name even though the concerned person is not existing. Are you clear? You see in the market, G.B. Kapadi and Co., T.N. Manoharan Chaudhary and associate, R. Bhupati and Co. There are so many firms which are open, R. Murali and Co. There are so many firms whose proprietor names were nothing but firm names. Even after the death of the proprietor, the firm name will still continue with the proprietor name. Correct? That's next. So, share of goodwill. Can I sell the goodwill? Yes, permitted. This case alone is important. On or after 1998. No need to remember the date. That is nothing but latest provision. That is the latest provision regarding sale of goodwill. First of all, if you want to sell the goodwill after the death, you are a legal heir. You want to sell the goodwill. First obtain permission from the council. First obtain permission from the council. First of all, what do you mean by council? Council consists of 32 elected people, 8 nominated people by Government of India, totally 40. These 32 people will be coming from South region, Western region, Northern region, Central region, Eastern region. Getting it? So these are all called as Central Council members. Central Council. Apart from this council, ICI is also having few other councils. Southern Regional Council, Western Regional Council, Eastern Regional Council, Central Council, North Council. These are regional councils. These are regional councils. So ICI is having first top level management, Central Council. Then middle level management, respective zone councils. Then branch level councils. That is branch, Sikasa elections like that. Yes or no? Branch, Chennai branch, SIRC. Madurai branch of SIRC, Thrissur branch of SIRC, these are branch wise. So branch wise management is different, zone wise management is different, overall ICI management is different. Able to understand? I am here, council means which management? Overall ICI management. This total ICI management consists of how many? 32 elected members. 32 elected members, 8 nominated members by Government of India. Totally 40 people will be there. And these 40 people these are nothing but board of directors in case of company. How board of directors are there in case of company? For ICI, who are the directors? These 40 people are the directors of the ICI. Now, for different see, ICI, no, they have to release accounting standards, they have to issue auditing standards, they have to consult on various matters, they have to talk about tax audit, they have to talk about peer review, they have to talk about various other reviews. Yes or no? Since the activities are so many, which ICI has to do, these 40 directors of the ICI divide these activities among various committees, accounting standard board, auditing standard board, peer review board, quality review board. Sir, quality review board is not ICI. Tax audit quality review board. There are various other boards. I will show you here itself. So ICI.org, Central Council Library. You see here, members, standing committee, non-standing committee, non-standing committees, accounting standard board, audit committee board, auditing and assurance standard board. Auditing and assurance standard board is the authority which will issue auditing standards and accounting standards in India. Yes or no? So this auditing standard board is headed by whom? Is Sanjeev Kumar Singhal. He is actually one of the council members, central council member, maybe from north region or west region or east region. Who knows? Getting it? Then who are the members of this? These are all the members of this auditing standard board. Out of these members, some of them are central council members, some of them are outside industry representatives. Some of them are industry representatives. We have something called peer review. We have something called peer review board. This is peer review. So peer review board. So we have peer review topic, no? Peer review board shall have maximum of 12 members or 11 members. Something is there we have. Okay, maximum. So here out of them 50% must be from the council of the institute, then 50% must be others. Like that it is there. So these are the members. And about ICI, the council, you see these are the nominated members are approximately 8. 8 members are nominated. From southern region, these are the elected people. From southern region, these are the elected people to the council of the ICI. Getting it? So totally 40 central council members will be there. So this is the council from whom you have to get the permission. By default in self-service portal, whenever member files an application, by default it goes to council panel. For the council panel, there will be some administrative staff. They will look at. If they have a doubt, they will ask the concerned person and then get approve it. If they have clarity on that, they will approve it. Are you getting it? Next. So first, if a sole proprietary firm which has a firm registration number and that proprietor dies, the legal representative can sell the goodwill, provided within 1 year he should get the permission. Within 1 year from the death of the proprietor, they should get the permission from the council. And once you got the permission, within 1 year from the death of the proprietor, the goodwill of the sole proprietor can be transferred to another eligible member of the institute after death of the proprietor, and sale must be completed in all aspects within 1 year from the date of demise. Means the moment the proprietor dies, the firm has some goodwill, immediately legal heirs should take measures to get the permission, sell the firm, everything. And remember, the purchaser can use the firm name and continue. After they die, they can sell the firm name to somebody else also. Able to understand? Now, suppose until 1 year, see, one of the reason for removal of member is what? Death of the member. Name can be removed, no. For 1 year after the death, the institute shall not remove the name of the member. Getting it? At least the name of the firm. The further, the name of the firm shall not be removed for 1 year. Member name can be removed, sorry. Member name can be removed, but firm name shall not be removed for 1 year. After 1 year, firm name will also be removed by the ICA. Able to understand that FRN will be cancelled if that is not sold to anybody. Suppose if there is a dispute regarding the ownership, regarding the legal heir, there is a dispute. Suppose that member is having 2 wives. Yes or no? Okay. So, like they are having, kids. So, regarding who is the actual legal heir, there is a court dispute going on. Once a dispute is finalized, from the finalization date, 1 year shall be calculated. That's it. So, this is important process. Death of the proprietor before 29th August, at the time, transfer of goodwill and all was not there. That's it. Like 1 year limit, that and all were not there. That is not required also now. Before 1998 issues, why it is relevant for us? At that time, I think you might have not born also. Next. Okay, second clause is saying you should not share profits to a non-member. Okay, and to whom you can share, they have given exceptions. Can I get share from non-members? I will not give to a non-member. Can I receive from a non-member? No. Can I receive from non-member? No. By the way, I can share referral fee to another chartered accountant. I can pay referral fee to another CA. Suppose I'm a newly opened practicing firm. I went to one big firm nearby. I explained my situation. I want clients. That new firm, no. They referred me some clients. Getting it? And I told them, I will do this work. I will pay 30% fees to you. They agreed. Getting it? That we can always. Because you can pay referral fee to a member of the institute. Same way, a member of the institute can accept referral fee from another member. So, this is similar to whatever we have seen there. So, to whom you can pay. Here, to whom you can receive. Like opposite, exactly. So, referral fee amongst the member. It is not prohibited for a member in practice to charge referral fee. It is not prohibited. It is permitted. Then. So first clause, what is it saying? Don't let somebody to use your firm name. Second point is what? Second and third point, don't share anybody your revenue. Don't accept any fees from anybody other than a member. Fourth point, don't enter into partnership with a non-member. Getting it? So, if a CA enters into partnership with any person other than chartered accountant in practice shall be treated as guilty of professional misconduct. This indirectly creates a prohibition on entering into additional business as well. This is indirectly creating a prohibition on entering into additional business as well. Suppose there is a partnership firm which is engaged in some rice or cotton, whatever business. Can I enter into partnership with them? You cannot. Any sort of partnership. Exception. With another CA, you can enter into partnership. With a member of recognized professional body, you can enter, or with a member having recognized qualification, you can enter, or with a member whose qualification is equal to ICA. Suppose you want to enter into partnership with CPA or CWA, ICAEW, something like England and Wales Association, some CS were there. So, CS of Britain, you want to form partnership with them, that is permitted. Wherever institute has recognized them through a memorandum of understanding. With foreign accounting bodies, institute has entered into some memorandum of association. ACCA, Australia, institute is having a memorandum of association. CPA, Canada, institute is having MOU. Getting it? So you can enter into partnership with them. CPA USA, institute don't have partnership. But soon means in the sense like within another 5 to 10 years, ICI will recognize all the accounting bodies across the world. All other accounting bodies across the world recognize all other accounting bodies across the world, including ICI. This kind of mutual participation is required. Having considering the scale of operations, the business growth, yes or no? Next. Right now, multidisciplinary firm is not permitted because till such time, regulators of other professionals also permit partnership with chartered accountants. Right now, ICI temporarily blocks multidisciplinary. Actually, this clause indirectly says what? You can enter into partnership with recognized qualifications. You can enter into partnership with a lawyer. You can enter into a partnership with a cost accountant, company secretary, architect, actuary, engineer. You can enter into partnership with all of them. Multidisciplinary firm is actually permitted by clause number 4. But what the council guideline says, one of the clarification, till other bodies also issue guidelines regarding this. Temporarily right now, forming multidisciplinary firm is prohibited. Clear? So there are some decisions. Yes, give a note about this. In exam, you need to give this as a note. But of course, if that point is tested indirectly, suppose in examination there is a straight question on this. A CA has formed into a partnership with a non-member, they said. They didn't mention specifically about who. You can straight away say that as per clause number 4 of part number 1 of schedule 1 of Chartered Accountants Act, a member is prohibited to enter into partnership with a non-member. However, he can enter into a partnership with the following people: another CA in practice, or another person having equivalent degree like CA, or a member of the recognized professional body, or a member having recognized qualification. With them, he can enter into partnership. In the given case, the member of the institute has entered into a partnership with non-member, within bracket, assuming not covered in the exception list, bracket close, and hence the member is treated as guilty of professional misconduct. Accordingly, his name will be removed from the register of members. Like that you can write. Are you clear? All of you? Next. Clause number 5, clause number 6, clause number 7 are interrelated. I will come to them later. First, I will finish remaining clauses. So, you are not permitted to enter into partnership with anybody. Okay. Same way, clause number 12, you see. You are prohibited to allow a non-member or non-partner to sign on your behalf. You see, clause number 1, 2, 3, 4, 12. These 5 you need to read at a time. Because these 5 more or less talks about same stuff. Getting it? First clause, don't allow somebody to use your name. Second clause, don't share your revenue with a non-member. Third clause, don't accept any remuneration from a non-member. Fourth clause, don't enter into partnership with a non-member. Clause number 12, don't allow another person to sign on your behalf. Yes or no? More or less same swing. Okay. So what is it here? A CA is treated as guilty if he allow to sign on his behalf or on behalf of his firm a non-member, a member but who is not in practice, or is a person who is not a partner of the firm. Means if in my firm there is an employee who is a chartered accountant, even though he is having COP, if at all, exceptionally, still he cannot sign because he is not my partner. When my firm has received some work, only the partner should sign or the proprietor should sign, not my employee, because the work is delegated to my firm, not to my employee. Able to understand? So when my firm is appointed, only my firm related partners or proprietor can only sign. Able to understand? That is a very simple logic, which means naturally whatever functions, whatever documents your firm has to sign, nobody else can sign. Your employee who is a chartered accountant, he himself is prohibited. Obviously outsiders are also prohibited. So a non-member is prohibited, non-partner is also prohibited. Clear? However, the following documents can be signed by your staff. Administrative routine documents can be signed by your staff. Suppose you all did articles. At the time working paper you arranged. At the end of the working paper arrangement you are signing every one of your article teams. signing the working papers, that yes, I arranged this working paper. So is it guaranteeing any attestation or assurance service to anybody? No. So that can be signed. Now we are going for cash verification in a client premises, physical cash verification. On cash verification, person attended, you are signing. No. Is it guaranteeing, or are you providing any assurance service to any third party on this? No. Internal purpose documents, anybody can sign. Getting it? Those documents which are being sent to public, which your firm is exactly liable, your firm is liable 100%. Those documents only the partner of the firm who is in practice can sign. Getting the point? Suppose if you're having a partner who is not a member of the institute, even he cannot sign. So like issuing of audit queries, this point is important. In exam also recently it was asked, what are the documents which, this will be asked as an MCQ. How they will give you is, they'll give you the following documents are signed by, non-members. Point number 1, issue of audit queries. Point number 2, issue of audit report. Point number 3, asking for information or something like questionnaire. Draft observations document, option number 4. And fifth point, 1, 2, 3, 4, 5. Fifth point, balance sheet of the company. Now, option A, which of the documents, which of the above documents, out of the above 5 points, which documents non-member can sign? 1, 3, 5. Option 2, 1, 2, 5. Option 3, 2, 3, 4, 5. Option D, 1, 2, 3, 4, 5. Like this they will ask. Able to understand? So they'll give 5 points. Out of those 5 points, which 2 points are correct or which 3 points are wrong? They may ask in any way the question. And they'll give you 4 options. So this kind of MCQ will be given for 2 marks. This kind of MCQ has been asked as a case-based MCQ. In one MTP or RTP it is there. Leo. Next. So this is the list. Please go through this list. Now, whenever you're signing a document where statutorily you have to disclose his name, the member should disclose his name while you are attaching your signature to a report or document. Where there is no such requirement that your name should be there, then member may put just a firm name. But as a standard practice, what we do, we will put firm name, we will put the partner name as well. Correct? We will put MRN, we will put FRN. Everything we will put. That's it. So with this, part 1, main clauses were completed. Clause 1, 2, 3, 4 and 12 is completed. Now let's come to clause number 11. For clause number 11, what is clause number 10? Okay, clause number 10 also we will finish. Clause number 10 and 9 will finish, then go to 11 and then go to 5, 6, 7. Getting it? Now clause number 10 you see. A member of the institute is prohibited to accept fees as a percentage of profits of the company or contingency basis. You cannot quote fee for audit services on a contingency basis, or as a percentage of profit you should not take the fee. However, if you're acting as a liquidator, if you're acting as a receiver, or if you are providing some non-audit service where you will create some value to the client, based on the value creation you will take percentage of the value addition. That is permitted. But statutory services, whenever you are providing, don't take fees as a percentage of some profit or percentage of some other thing, or don't take fees which is contingent in nature. I think it. Now you see. A CA is treated as guilty of professional misconduct if he charges, accepts in respect of any professional employment fees as a percentage of profit or which are contingent upon findings or result of that particular engagement. I think it. Exception. Suppose if it is permitted by any regulation, it shall not be treated as guilty. It is to be noted that fees cannot be considered as contingent if it is fixed by court or public authority. Example, disputed fee. Suppose there is a dispute between you and client regarding the fees. Later, finally, court fixed it. You cannot say that is contingent. And there are few other exceptions. These exceptions are important. Like how in examination, they may ask you a question. Generally, a CA is prohibited to accept fees as a percentage of profit. But there are some exceptions. Give any 4 exceptions. They'll ask you, right? Any 4 exceptions. These are the exceptions. Like you see, you are acting as a receiver or a liquidator. You can accept as a percentage of funds received. You are acting as an auditor of society. In that society, it might be permitted. So there it is permitted. Or you are doing the valuation services for the purpose of direct taxes. You may receive a percentage of valuation or value fixed by you. Or you are providing some management consultancy services. There you can get on a percentage basis on findings. Or you are doing some fundraising services, underwriter, you're acting as an underwriter. By default, you will get commission based on issue size, yes or no. Next, you are doing debt recovery services. A bank appointed you as a recovery agent. Your remuneration will be percentage of recovery. Getting it? Or you are providing services related to cost optimization. So how much ever cost you save to the company, out of that some percentage they will pay you. So these are the cases where and all you get percentage which is permitted. Following activities are decided by the council. Insolvency professional. If you are acting as an insolvency professional, there you can take percentage of some settled amount. Or you are providing some non-assurance services to non-audit clients. You are providing non-assurance services to non-audit clients. So there is a client, they appointed me only for one non-assurance service. Getting it? They appointed me for filing GST return. They appointed me for conducting so-and-so survey. They appointed me for conducting some research. There and all I can take a percentage. Attestation functions, assurance functions, audit functions. In all these cases, percentage of profit is prohibited. Because I should be independent. In all other non-assurance works, I need not be independent. Clear? Everyone. That's about clause number 10. Then clause number 11. Just 2 minutes. Yes, let's continue. So clause number 11. What is this clause number 11 says? You are prohibited to engage in any other occupation other than as a chartered accountant. If you are practicing as a CA, your full-time attention, time, everything should be devoted only in practice, because you need to continuously update your knowledge. You need to continuously, you are rendering so many services, you are accepting so many types of works. So you should deliver the work with utmost competence. So in order to make sure that you are rendering the work with utmost competence, you should not focus on some other activity. If you should not focus on other activity, it should be prohibited by law. That's why clause number 11 has been added. Getting it? So what is it saying exactly? A CA is treated as guilty of professional misconduct if at all he is engaging in any other business or occupation in addition to a chartered accountant in practice. However, if at all you are given a permission by council, then it is permitted. Or if you are just a director in a company, not a managing director or whole-time director, not a managing director or whole-time director, it is not disqualified. You are permitted. Many chartered accountants who are in practice are acting as independent directors in many companies. So that is permitted. Further, you can act as a liquidator, a trustee, executor, administrator, or you may take up some appointment made by central or state government unless it is on full-time basis. Okay, normal part-time basis, you can always take these additional occupations. These are permitted. Now, what are all any other occupations? Like you are saying, here, business or occupation permitted by. Hey, what happened? So here you see here. So what are the occupations which are permitted? So these are the following occupations where no permission is required. You are automatically given permission for doing these additional occupations. What you see bottom, agriculture is permitted. You can own an agriculture land and do cultivation activity. That is permitted for chartered accountants. By birth you are permitted to do agriculture. Next, you can act as a recovery consultant in case of a banking sector. That is naturally permitted profession. You can act as a surveyor or loss assessor under Insurance Act. Getting it? Suppose we all take car insurance or any, for stock insurance, current assets insurance like that. Now that suddenly that particular car met with a damage. So insurance company has to give compensation. In order to fix compensation, insurance company want a surveyor to estimate the compensation. So they appointed me as a surveyor to estimate the loss. That work I can do without any additional permission from ICI. Or I can be editorship for any professional journal related to our professions. Related to our profession, these journals, whatever published is called as professional journal. Suppose taxman want to publish a journal on budget. Getting it? Budget amendments. So I can be editorship. I can act as an editor for that and receive honorarium for that. Then I can do valuation of papers. I can act as a paper setter. I can set examiner for any examination. Which examination? ICI board examinations, not other board examinations. Getting it? Or I can work as a part-time tutor under coaching organization of the institute. Chapter officers are conducting classes. There I can have a teachership, like I can do some private tuition, or I can attend any class, I can appear for any examination, no problem at all. I am in practice, I am pursuing some additional courses, permitted absolutely, no permission is required, because that is not occupation. Yes or no? Or I can hold MP position, MLA position, MLC position. Getting it? Or I can have, like, see, our central ministers are himself there. Ministers himself there. Yeah, Piyush Goyal is there. Previously, railway minister is there. Yes or no? And even some, right now, another minister is there from AP, Vijay Shai Reddy. So there are so many. There are so many who are chartered accountants, but who are still acting as MLAs, MPs, MLCs. Or I can have leadership of a charitable, educational, or non-commercial organization. For any education institute which has got charitable organization license. For that, I can act as a leader for that. Or I can act as a notary public, justice of peace, executive magistrate, and the like. Next, I can hold a life insurance agency license for just getting renewal commission. Like, you can get LIC agency and do LIC business, like insurance business you can do on your own. You can promote, get customers, and take commission. New business is not permitted. Suppose before you become member of ICI, before you hold COP, earlier you are doing some LIC agency business. So you have activated so many policies. And many of the policies are even today active. They are paying renewal charges to insurance company. Now the moment I took COP, I should surrender this license. Because I cannot engage in additional occupation. If I have to engage, what should I do? I should get special permission of council. But I don't want to get special permission. Getting it? I don't want to engage in this because now CA qualification is there. I will focus on practice. Let me stop this business. But what about renewal commission? If I surrender this LIC license, no, I will not get renewal commission. For the purpose of renewal commission, you can have that LIC license. You should not do new business. Whoever client is coming, sir, LIC policy, sir, will you buy? Don't ask. Getting it? So renewal commission you can take. Next, you can become an author book. You can be an author of a book, or you can publish any articles. However, retail reports are not permitted. Retail reports are not permitted. Private tutorship. I'm teaching final classes. No, I'm teaching for you. Yes or no? Right now, that is permitted. However, in a week, it should not exceed 25 hours. As a whole, they will check. Not every week they will check. Getting it? Weekly 25 minutes. As a whole, they will check in a year. That's it. You may be telling, sir, this week only you are taking 35 hours, 30 hours. So, employment under CA in practice, that is also permitted. A CA who is in practice can also be an employee in another chartered accountant firm. That is automatically permitted. Now, where and all you require special and prior permission. See, this is actually a stupid provision. What you should do, what you should not do, both I need not tell. Either only one of this I should tell. Don't do this, I should tell. Correct. That is fine. Don't do this, do this. How can I give both the list? It is confusing, no? So here they gave a list of activities which require special and prior permission. Other than these activities, what about them? They also require special permission. This is just an inclusive list. This is what? Inclusive list. See, they have given where permission is not required, and they have given where permission is required. They have given where permission is required. When they give a list of activities where permission is not required, that is enough. Every other activity is permission is required. Correct? So, but since they gave a separate list, we will read. But remember, this list is inclusive list, not exhaustive list. Getting it? Whereas the above list is exhaustive list. The activities which do not require permission is exhaustive. That is the only activity don't require permission. Rest all other activities require permission. So, if you want to be in employment, full-time or part-time in a business concern, company, provided the member or relative do not hold a substantial interest in that concern. Suppose no, if you want to have substantial interest in a business concern, that is again a different provision. That is again a different provision. First of all, can a CA acquire substantial interest in a business concern? Can a CA buy shares of a company? More than 20%? Yeah, I can have substantial interest. That is permitted. In the same concern, can I act as an employee? If institute gives special permission, you can. Logically speaking, you can. Look, this is only inclusive list. This is only inclusive list. Suppose if I want to work as an employee in a business concern, where I am having substantial interest, I went and obtained special permission of the council. Obviously it is permitted. Able to understand. Next, I want to have an employment in non-business organization. Then also I require permission. I want to act as a managing director or whole-time director. Then also you require a permission. Suppose, can I have interest in family business concern? Like, suppose my father or my grandparents, they are having one business where my grandparents' brothers are the partners in a partnership form. So that is a some cycle manufacturing or cycle trading company, whatever, some company. Now, after they expire, it is devolved by our fathers. Now after that, we are inheriting that business. Can I inherit family business? Yes, you can inherit. But if you want to inherit, inherit means what? You are getting ownership in a partnership form. And remember, partnership form, proprietorship forms, partners and proprietors are one and same. You will have unlimited liability for outsiders. People think you are ultimate owner. Yes or no? It resembles like as if you are doing the business. It will come under additional occupation. That's why you require permission. Further, you should not actively involve in that. You should not actively involve in that. Suppose you want to actively involve in that. Get special permission for that also. Here, the point says interest in family business concerns, where the interest has been acquired because of the relationships and in management. Getting it? You are having a relationship with the previous owner. Okay, because of the relationship, you inherited that business. That is permitted, provided you do not take any active part. This is what the notification, this is what the special permission rule says. Suppose I want to take active part. Institute council permitted me. Then permitted. Able to understand? I told you this is only inclusive list. Understand, this is only inclusive list. In exam point of view, no active part will be tested. No active part will be tested. Getting the point? No active part will be tested. So, as per from examination point of view, you should not take any activity in the family inherited businesses. It may be HUF, partnership firm, proprietorship firm, whatever it is. If a member inherited from his forefathers or fathers, getting it, he should not actively participate. He can have ownership. Some other else will take care of the business. He just can be a owner. For this also, for just having ownership also, you should take special permission of the ICI. Provided you should not engage in active business. Clear? From exam point of view, keep this only. Can I have ownership in education institution? Yes, take special permission. Next. Can I teach as a part-time, can I work as a part-time lecturer other than ICI chapter offices? Yes, for which you require special permission. Getting it? There are many CA coaching centers, MTADK like that, the many coaching centers, Shankara Institute is there. If I want to take a part-time employment here, I need to get ICI special permission. Able to understand. Next. Part-time or full-time tutorship under any other education institute other than coaching organization of the institute. That is also requiring special permission. Editorship of journals other than professional journals. Professional journals don't need to have permission. Retail journals, retail reports, stock market reports, I am going to, edit them. I am going to work as an editor for them. So for that all, I need to require special permission. Any other business, any other occupation which committee considers that permission may be granted. That's what this is residuary clause. If committee considers it is necessary for the member, they will grant approval. So whatever above list we have seen, none of it. Waste of the discussion. But in exam they will test. The person who is testing this don't understand the provision first of all. So he will test because it is there. Next. And further remember, just because they have given permission, no special permission list is there, no permission list is there. In a specific case, council may refuse to give permission to a particular individual. So on a case to case, for somebody they may give permission, for some they may not give permission. It is council choice. Next. Now, there is a word no. Relative has substantial interest in a business concern. In that concern, I should not take up employment. If at all in a business concern, me or my relative do not have any substantial interest, I can take up employment in that business provided institute give me special permission. Now, what do you mean by relative? They gave here the definition. This is income tax relative definition. This is income tax relative definition. Getting it? Husband, wife, brother or sister, any lenient ascendant or lenient descendant. Next. Can I act as a director or promoter of a company? Yes. Simply sit or. You are simply a director, independent director. That is permitted. So ordinary director or simple director who do not involve in executive affairs. You can be a non-executive director in any company. No permission is, permission is required, but you can act only as a non-executive director. Suppose you want to act as an executive director, you need to get special permission. Of course, ICI will not give that special permission. Where and all ICI will give special permission, the list is predetermined. Getting it? Maybe if council gives, they may exercise last clause of the special permission list and they may give you additional permission. Getting it? Next. And there is another guideline. The auditor of a subsidiary company cannot accept appointment as a director in holding company of such a subsidiary company. Getting it? See, we have seen company disqualifications. What is the disqualification? Officer of the company is disqualified. Employee of the company is disqualified. Officer of holding company, subsidiary company, they didn't mention. But institute guidelines says about that. Suppose you are acting as an auditor of a company. It has a holding company. Can you act as a director in that holding company? No. If you are already acting as a director in that holding company, don't accept auditor of a subsidiary company. Is this a disqualification in company law? No. It's a disqualification given by CA Act under clause number 11. Clear? Next. Further, what is prohibited is you cannot be an executive director. You cannot be an employee in a company. But can I be a promoter of a company? Yes. Can I sign memorandum and articles of a company? Yes. Can I form a company? Yes. But don't take active participation. If you want to take active participation, get special permission. See here below they have given a member can accept office of MD, whole-time director only after obtaining specific and prior approval of the council. For engaging in all special activities, you require prior approval. After engaging the activity, if you take approval, you are deemed to be guilty of professional misconduct. Clear? Next. Now, can a member in practice, can he have interest in family business concerns? That's what we have seen, like a proprietary concern, partnership firm or HUF. Can he have? Yes, you can have membership, take special permission, show that you are only a owner, but no activity is undertaken. You show that they will give you easily the permission. But if you want to actively engage in the business also, then institute may refuse. Getting it? So it is necessary for the member to prove that interest in the business is devolved him as an inheritance, succession or partition. It is not that I bought ownership in a firm. It is that something I got through inheritance. It's my family business. I cannot eliminate it. Getting it? Also, it is necessary to prove that he was not actively engaged. Only then you will get that special approval from ICI council easily. If at all you want to actively participate in the business also, you apply for my application, you ask for approval, they may not give 99% of the cases. Getting it? And remember, the family, the business is not created by you. If at all the business is created by you, you only opened that new business, then institute will not give permission. If you want to open a business, what? Surrender COP. This clause number 11 will not apply. This part number 1, schedule number 1, clause number 11 will apply for whom? Part number 1 is applicable for whom? CS who are in practice. If you surrender COP, you can open any number of companies, any number of partnership firms. Next. There are few other cases. Can a chartered accountant in practice, can he register as a registering authority for creating digital signature certificates? Yes. All our audit firms will do that. 200 rupees RT the cost, but we will bill 2000 to the client. Next. Can he be a research advisor? CA may act as a research advisor, but you cannot be a publisher. Publisher means you are doing a business, book selling business. Next. A CA cannot receive remuneration for financial advisory role to a bank, FI, mutual fund, insurance. Investment advisory services is a separate business, understand. It's a separate business. A CAP cannot take agency of general insurance, Unit Trust of India, NSDL. A CAP cannot hold custom broker's license. You cannot trade in stocks. You cannot trade in derivatives. As it is original occupation, you require special permission. Many CAs know they are opening demat account and start investing in trading. Start doing derivatives. Get special permission and have demat account and trade. Otherwise, it is guilty of professional misconduct. By looking at this list, you can find how many violations your firm is doing. Yes or no? Correct, huh? Most of the CAs know they will come under this particular radar. Under this radar, they will definitely come. So, with this, clause number 11 is also completed. So, we still have clause number 8, 9, 5, 6, 7. So, 5 more clauses of part number 1 is pending. So, in the next session, we will finish that. Once this part 1 of schedule 1 is completed, remaining parts are very easy. They were not that difficult. Okay, that's it. So we'll take break. So we still have 4 more clauses to be discussed in part 1. So we'll discuss now clause 8, then 5, 6, 7. With that, part 1, schedule 1 will be completed under revision. Fine. So what is clause 8 is dealing with? Clause 8 says, with respect to all audit assignments which you are accepting as a chartered accountant in practice, all audit assignments, very important, all audit assignments. Remember, what are all various audit assignments? Stat audit, tax audit, GST audit, internal audit, concurrent audit, any type of audit assignment. Previously, another chartered accountant has performed, another chartered accountant in practice has performed more appropriately. Getting it? And now you were replaced with that appointment. In such a case, what the clause 8 says is, first get a no objection certificate from the previous auditor. He may be stat auditor or tax auditor or GST auditor, whatever. First get NOC from him. After getting NOC, look at clause 9 requirement. What is clause 9 requirement? You need to check provisions of Companies Act. You need to check provisions of Companies Act. Before you accept the audit, check the provisions of Companies Act. Yes or no? So after checking all the provisions of Companies Act, and if your appointment is validly made and already you got NOC objection, then you accept the appointment. See, here the procedure is very simple. When a client requested you for appointment, first check your eligibility, disqualification, ceiling limit, all that. Then give your consent. Okay, I'm interested to act as an auditor. Then client will propose your name in the general meeting. Shareholders will approve, will appoint you. Now you need to give acceptance letter. Before you give acceptance letter, this clause 8 procedure you need to do. Before you give acceptance letter to the company, before you take up the position of auditor, appointment is over. Before you take up the position of the auditor, communicate once with NOC. Sir, is this requirement applicable only for appointment made in AGM? No. This is applicable for all types of audit. Government audit it is applicable. Non-government companies it is applicable. Even for first auditor this is applicable. Even if you are appointed under casual vacancy, that is also applicable. Even if you are appointed under casual vacancy, some previous auditor became insolvent, so he disqualified. Get an NOC from him once again. Yes, you need to get. In all types of appointments, whether it's a government company, non-government company, first auditor, subsequent auditor, auditor appointed under casual vacancy, whether rotation, whatever, you were appointed. That's it. Before you accept the position, who is the previous auditor? Who was there before my place? Before I came into this company, who was there previously? Communicate with them and get NOC. So that is what this section. If you do not communicate, your appointment will be invalid and you are treated as guilty of professional misconduct under clause 8. And see, sir, what should I communicate? How should I communicate? What is the mode of communication? This itself can be asked as a 4 marks question. Write about mode of communication with previous auditor with respect to obtaining NOC. What is the mode of communication with the preceding auditor as per clause 8 or council guidelines? They may ask you like this. You need to write this matter. Not entire points required. Any 4 points you need to write. What they say is communication. How you need to communicate? See, nowadays we are communicating in mail IDs. Through mail we are communicating. Generally, we will get the previous auditor's registered mail ID address. ICI is having a database of, practicing CS registered with them. We get a registered mail ID. What is the registered mail ID as per ICI database? And we type the letter. The so-and-so company proposed me to appoint as an auditor. Previously, we observed that you are the auditor in that company. So, do you mind, or is it okay for you if we accept this appointment, or do you have any objections to raise? Kindly raise within so-and-so time limit. This is a simple format. Of course, Institute have given a very good format for communicating with previous auditor, so we can follow that format as well. You can communicate it through mail now, but earlier communication must be in writing through registered post. So earlier we will have letterheads, right? On the letterhead we will take a printout and we will fold that and then keep it in the envelope and then send it to the previous auditor's address. postal address. Which postal address? Registered professional address with the ICI. And further, you must have evidence that the outgoing auditor has received this in hands. That is why we call it as, mode of communication will be registered post acknowledgement due, RPAD. Registered post acknowledgement due. What is registered post? I will mention Mr. X, previous auditor name. Only to him the post will be delivered. Somebody came from his home or office. No, this will not be delivered. Only to him it will be delivered, and he has to sign that at the time of delivery. So that is called registered post acknowledgement due. So only under a RPAD method you must send communication. Just posting, I posted letter, that is not sufficient. There must be a proof of delivery to the addressee, and it must be through RPAD. Getting it? Or by hand against a written acknowledgement. And further, via email address, retiring auditor may send you acknowledgement. Through a mail, he may send you acknowledgement that yes, I received NOC. Getting it? So that is also enough. Suppose if, sir, I sent letter, sir, premises found locked, it is deemed to be delivered. If premises is found locked, it is deemed to be delivered. Even if the firm was not found at the mentioned address, and that address is correct address as per ICI database, but that firm is not operating there, even it is treated as deemed to be delivered. That's, we did our duty. Next, sir, okay, we are sending, sir, and you are saying he has to give acknowledgement or he has to give NOC consent. Is it compulsory? Is NOC consent compulsory? Does reply must from the retiring auditor? Okay, we sent letter. As you mentioned, we sent letter. NOC letter we sent. We are asking for NOC. Getting it? Now he need to reply, right? Is it compulsory to get a reply? Until he replies, should we wait? So generally, you will get a reply. Reply is obtained. And he did not raise any objection. Happy, accept the audit. Suppose he has raised some objections. Look at what points he raised. Are they reasonable? Are they justified? If the points that incoming auditor raised objections are justified, what are the justified points? He was removed. Unjustified manner. He is removed in unjustified manner. The previous auditor was removed by the company in an unjustified manner. And that reason, that objection raised by that auditor is a reasonable point because he was removed unjustifiedly. So, or his fees is not paid. His fees is not paid. Which fees? Agreed fees. Agreed fees means what? Undisputed. There is no dispute. There is no dispute. Client agreed to pay 1 lakh and he is also agreed to receive 1 lakh. But that 1 lakh client has not yet paid. And that is called undisputed fee. That undisputed fee not yet paid by our client to that previous auditor. And he raised that objection. Dear new auditor, I need to receive my old fee pending outstanding. There is no dispute on this. 1 lakh I agreed, he also agreed, but he is not paying. Kindly make sure that it is paid to me and then you accept the audit, is it? So objection, if it is justified, I will reject the proposed appointment or I will not accept the proposed appointment. Suppose incoming auditor, hey, I want to continue for another 5 years. This company removed without considering my interest. That's unjustified. Accept the audit without any problem. Sir, he did not reply at all, sir. In spite we send repeated reminders, he is not replying at all. What should we do? Accept the audit. Continue the engagement after waiting for a reasonable time. So what is reasonable time? Generally, very simple. Let me tell you. Once company appointed you as an auditor, within 15 days. What? Within 15 days, company shall file ADT1. What company shall file? ADT1 they need to file. Yes, so-and-so auditor was appointed in AGM or so-and-so auditor was appointed in board meeting. So the company has to file with the ROC a form called ADT1. Now this form has to be filed 15 days of appointment date. 15 days of appointment. Now in this form, auditor's acceptance letter must be attached. In this form, auditor's acceptance letter must be attached. I think I might have missed this point in the original class. Sometimes when we are taking anywhere 1 or 2 points I'll miss definitely not just me, anybody else will miss. but in revision, it is lucky that reasonable time means I can able to give you a precise idea. Even in the recent physical class which I took at Chennai, I didn't raise this point. Now suddenly I remembered and I'm just giving you more clarity. Lucky you are. Okay, fine. So this much level examiner will not test at all. But reasonable time means company has to file ADT1 form with ROC. In that, acceptance letter should be attached. You can give acceptance letter when? Only after you got an NOC. Getting it? So which means reasonable time means what? 15 days you can take happily. That's it. So that is the point. Sir, auditor, the previous auditor is objecting me that. He's objecting me. Why? He has not received fees, sir. What should I do? Suppose fees is not paid. Getting it? That generally be the root cause of the problem why auditors are being changed. Especially this is a very important reason in non-corporate entities. In corporate sector, no, this is very rare reason. In non-corporates, partnership firms audit, LLPs audit, sole proprietary audits, this is very. Sir, by the way, clause 8, is it applicable for non-statutory audits as well? Yes. The clause 8 have not differentiated between stat audit, non-stat. If it is stat, it may be corporate or non-corporate. It may be tax audit, income tax audit, Companies Act audit, GST audit, or any other audit. Special audits will be there. Suppose under corporate society law, there is a special audit. Under old service tax law, there is a special audit. For special audits, no. Special means we don't know when the audit will apply. That government will appoint. The auditor will be appointed by government directly under special circumstances. There, previous auditor communication, that and all will not apply, because previous auditor, who knows? Special audit for this company was conducted 10 years ago. Again, in the 11th year, it is being conducted. First year they conducted, 11th year we are conducting. Why you need to communicate with auditor who has done special audit 10 years ago? So special audits, this is not applicable. That's it. And in case of undisputed, okay, fine. Suppose if the fees is not paid and there is no dispute on the fees amount. Fees is fixed. No problem with respect to amount. The problem only with respect to payment. If it is undisputed, getting it, incoming auditor should not accept unless fees is paid. Incoming auditor should use his influence in favor of the previous auditor. Where previous auditor is not available for accepting payment, it is not possible to transfer to him electronically. We don't know his bank account details. You advise the client to purchase a DD in favor of him, and getting it to ensure that payment is made to the retiring auditor at the earliest possible. So you need to make this kind of arrangement. So they may ask you a question like this: if previous auditor's undisputed fee is not paid, what procedure the incoming auditor should follow before he accept the appointment? See, actually the guideline here, what it says is, the guideline very clearly says, if at all fees is not paid, based on that reason, you don't deny acceptance. You accept, but make sure fees is paid within reasonable time. You use your position. You influence the management so that they'll pay. That's it. NOC is required for all types of audits. NOC is not required for special audits. Getting it? Even NOC is not required for accepting works which are conducted by other professionals, which are not conducted by chartered accountants. Suppose last year internal audit was conducted by a cost accountant and he was removed and now I was appointed. No need. Only when my fellow, getting it, another chartered accountant performed that work, I need to communicate. So this is clause 8 as a whole. Remaining points, sir, what are the reasons for communication? So just give a single reading. Just give a single reading to it. Correct it. And here also, you know, sometimes there are some appointments like bank appointments or bank auditor's appointment, insurance auditor appointment. There, you need to give acceptance within certain time bound. In such a case, whether you get a reply from the retiring auditor or not, doesn't matter. Accept it. Getting it? First, communicate with him RAPD mode. You didn't receive reply within reasonable time, accept it. Within the time prescribed, accept it. And it is deemed that you complied with this provision. And just give this AN point a single reading. So mostly we have covered entirely. So there is this point you have to observe. We don't know. Generally, no question will ask. Sir, can a new auditor accept a reduced fee? Last year, the previous auditor conducted audit for 10 lakhs, but whereas for you only 7 lakhs is given. Can you accept that audit? What's wrong? If there is a reasonable justification behind the fees amount, the workload, all that, yes, I can accept. 2019 companies were really good. So they paid 10 lakhs. 2020, COVID affected, profits affected. So company asked the auditor to pay only 7 lakhs. Generally, reduced audit fee is not permitted, you know. Previously, if more than 10 lakhs is paid, this year also at least 10 lakhs you must quote fee. Otherwise, institute will interpret as you influenced the client with discount and you got this audit. Such how institute may influence, or the previous auditor may file a complaint on you that so and so auditor quoted lower fee and hence client was taken away by him. Careful. If there is a genuine reason, most of the times whenever there is a reduced fee, you can easily show genuine reason. So that's about clause 8, and I hope you are confident on clause 8. 15 minutes hardly took, and I don't think you need to read again. Next. So 5, 6, 7 clauses. Once we finish this, we will be completing. Once we finish these 5, 6, 7 clauses, we will be completing this ethics. Sorry, part 1. Part 1 will be completing. So what this clause number 5 says: prohibiting on securing professional business. Prohibiting on securing professional business by means which are not open to a chartered accountant in practice. By means which are not open to a chartered accountant in practice. Sir, what are the means through which I can ask for work? You ask for work only under permitted manner. Sir, I'm a newly become a member. I'm a new member to the ICA and I newly entered into practice. How should I get a client? Can I advertise? No. You know, what are the means which are prohibited? Clause 6 and clause 7. These are the two clauses which specifically contains how you should not advertise yourself. How you should not advertise. If you advertise your professional services, whatever you are performing, you are treated as guilty under these two clauses. Whatever mode of advertisement covered under clause number 6 and 7 cases, except that remaining you can follow. Remaining advertisement techniques you can follow. Like what it says: if a chartered accountant in practice, securing means obtaining either through service of a person who is not an employee, who is not a partner, any professional business that you are acquiring shall be treated as guilty. Shall be treated as guilty. What indirectly they are saying: if your employee is bringing a client, out of his own friend circle or relatives, not advertising again your pamphlets, brochures and all. Remember, getting it? If your employee is bringing some business to you, get it. No problem. Take it. Your partner is bringing some business, take it. Further, remember, if your employee is a chartered accountant and even if your partner is also a chartered accountant, they should also comply with clause 6 and clause 7 while bringing the work for you. Are you getting the point? Mine is a firm. All the partners, clause 5, 6, 7 applicable. All the employees, whoever is chartered accountant, clause 5, 6, 7 is applicable. Sir, my employee is not a CA, sir. He is going and advertising on behalf of me to all others. Not permitted. That is indirect way of solicitation. That is indirect way of marketing. Directly or indirectly, both are prohibited. But if your employee, whatever route permitted for you, in the same permitted route your employee is bringing, accepted. In the same permitted route your partner is bringing new client, accepted. So if you are securing professional business through the services of a person who is not an employee, who is not your partner, or by means which are not open to a chartered accountant under clause 6 and clause 7, by means which are not open, you are getting some work which is not in the right manner, you are treated as guilty of professional misconduct. This clause shall not apply if the work is obtained through permitted ways under 2, 3, 4. What are 2, 3, 4? Sharing profits with non-members, prohibited. Exceptions: recognized qualifications, recognized professional bodies. If an actuary, my friend is an engineer, his client is there for whom he rendered some architectural services and he is looking for auditor, and my friend brought and asked me for work. Yes, I can ask my friend who is an engineer. I can ask my friend who is a lawyer for work. That is permitted. This council decision says give one reading, not an issue. Now, sir, what are the means which are prohibited for a chartered accountant? By what mean a CA should not get work at all? If a chartered accountant solicits, grabs the attention of clients or professional work directly or indirectly by a circular, by an advertisement, by a personal communication, or even by an interview or by any other means. See, this any other means is so powerful. It covers so many. He shall be treated as guilty of professional misconduct. In the form of interview in a news channel, you are trying to show up your firm name, all that, and you are trying to exhibit yourself as a practicing CA. You are indirectly influencing the audience to become your clients. Or your personal communication, you are personally visiting to a new person and then explaining yourself that you are a chartered accountant, asking for work. Prohibited. Advertisement, circular, getting it, all these are prohibited. Circular means what? Pamphlet, brochure, all that, mass media, print media, getting it. Advertisement, all digital electronic media. Through any medium you can't get the work. However, this will not apply if you are asking for work from another chartered accountant in practice, or you are getting the client, you are getting a new client as a consequence because of a response to a tender for various services. Sir, what is tendering? So this third point itself can be asked as a 3 marks question. Write about acceptance of work or client under tender mechanism as per CA Act. They may ask you like this, sir, like suppose there are so many companies, sir, who are opening tenders. We are looking for internal auditors, like that. Now, can I reply to the tender, sir? Can I find in classifieds and all and reply for all the tenders? You can reply only if minimum fees is quoted in the tender document. Only if the minimum fees is quoted. Or you replied to the tender because it is not exclusively reserved for CS. It is not exclusively reserved for CS. So internal audit, anybody can do, CS can do, CMA can do, company secretary can do, anybody can do. The company also said in the advertisement or in the tender document, whoever having the following qualifications, like that, they listed 10 qualifications. In that, CA is also one qualification. So it is not exclusively kept for CA. It is not exclusively kept for CA. In such a case, you can respond to the tender. Can I respond to a tender? 2 cases you can respond. 1, what is the fees which the client is going to give is already mentioned in the tender document. Yeah, no problem, respond happily. Fees not mentioned. Then what is the criteria? Second thing you need to check, fees not mentioned. Okay, can I respond? Check. Is the tender is open for every person, like not just for CA, it is open for multiple people. If it is exclusively reserved for CA, if it is exclusively reserved for CA, our company is looking chartered accountants for internal audit, minimum fees 10 lakhs, respond. Our company is looking for chartered accountants, minimum fee not quoted, don't respond. We are looking for internal auditor, and the following are the people who are eligible, CA, CES, cost accountant, MBA, all this. Again you can respond. Again you can respond. That's it. So can you please go through this once? Sir, I'm a practicing CA and also in private tutorship, which is permitted under clause number 11 under automatic permission, private tutor. Or I'm teaching with ICI Institute branches. Can I advertise my coaching activities? You are prohibited to advertise your coaching activities except by signboard or name board. See, this is a guideline released long ago, approximately 12 to 14 years ago. I think 13-14 years ago it was announced. Later, when the digital era has come, very recently in the 2021, a new guideline has been added. What are they saying? Educational videos. As a CA, I'm involved in teaching. I'm in practice. Right now I'm in 7th year of practice. Getting it? So can I do educational videos? Like you see on my YouTube channel. So I'll be doing Harsha YouTube channel. I'm doing certain certain educational videos. How to prepare for exams, how to put up the strategies, all that. Can I do? Yes, you can. As long as you are not giving any contact details or website address. Which contact details and website address? My firm contact details and website address. You see in my YouTube channel, you will not find a single reference to my firm. In fact, till date I never spoke about the firm name where I am the partner, and I will not speak. They're not required. Getting it? Sir, can I advertise relating to change of partnerships? So my firm is a very famous CA firm, sir. There are 5 partners. 2 partners just now left. Another 2 partners newly admitted. These two partners, I don't know whoever left to know. They may still use our firm name and get personally clients to them. I want to alert the public that they were not associated with a firm. Can I? Yes, change of partnership, dissolution, change in address, contact details, all this you can advertise, provided you are just stating the facts. You're only mentioning the facts, and the area of the advertisement, getting it, it is appropriate. You should not advertise in a front page of Times of India, very big. No, you need to advertise it as a classified, only statement of facts in a black and white only. Color also not permitted generally. If at all the entire newspaper is in color mode, okay, fine, you give it in color. Otherwise, black and white. Sir, can I advertise about my, my firm, all that in the journal or newsletter? Generally not permitted. However, if it is of the institute journal, you can advertise for sharing work or for seeking partnership or salaried employment on accountancy. Institute related journals, where you are inviting for sharing the work, getting it, or you are asking for partnership, or you're looking for employment, or you want some employees here, all that you can advertise. Only in the institute journal it is permitted, provided it only contains name, address, telephone number, fax number, email address. Sir, this empanelment and all, okay, not required. Sir, entry in telephone or trade directory. Generally, BSNL approached me, sir. Like all telephone numbers, we are a BSNL client or Airtel client. So telephone directory. Can I put my name also in telephone? You can put, but don't put it in a highlighted manner. How other names are appearing, same way your name also should appear. So, can I send greeting cards and invitations? You can send happily greeting cards, invitations only to client, relative, and close friend. Sir, close friend means how do institute know whether we are close friends or not? Institute generally will not know to whomever you distribute. Suppose if the other person to whom you distributed, he complained to the institute, hey, I got a greeting card from CA. He is advertising. I don't know him personally. I went and complained. You are caught. So here the mechanism, regulatory mechanism works in reverse direction. If somebody gave you a complaint, it is your onerous responsibility to prove that he is either your client or relative or close friend. If you prove, you are not guilty. So marriages and religious ceremonies, opening or inauguration of office, change in office premises, change in telephone numbers, for all this you can give greeting cards and invitation, provided this all can be given only to clients, relatives, and close friends. Or if you are giving it as a classified advertisement, you only talk about change of firm, change of partners, dissolution, only that. That's it. Sponsoring events, give a single reading. Right of representation not required. Sir, can I share my firm profile with a prospective client? Like suppose when I'm looking for as an employee, I prepare resume. Now how audit firms prepare resume? They don't prepare resume, they prepare a profile. When the firm established, who are the partners, how many staff we have, how many articles are working, how many employees here are working. So what are the clients that we handled in past? Getting it? So what are the various other services that we provide? So like that we will build a profile. Now can I give this profile to my future clients? Yes, you can give, provided he requested you first and you are giving him as a response. Don't distribute the profile. Don't distribute it like a pamphlet. So that's what here which is mentioned. Transfer of original work. What is this transfer of original work? Suppose I'm a CA in practice. My friend is also CA in practice. We both met in a restaurant. He introduced his client to me. Just casual introduction. And I am grabbing him. Prohibited. You can take your friends, another CA client, another CA, no. He introduced you a new client. You can take his client only with his consent. Only with his consent. Suppose some fellow, some new client coming to my office and asking for me work. Previously somebody is the, CA for him. That and all okay. If it is audit assignment, follow clause number 8. Communicate with him once before accepting. So, can a CA use website? Yes, absolutely. Okay. What points a website shall not contain? This is very important. What point website shall not contain and what it may contain. So it may contain here any 5 points you can remember, and what it shall not contain, it is very important, this entire E. So just go through it once. Next. So with this clause number 6 is also over. Clause number 7. This is also a prohibited mean for you to secure a client. Clause number 5 says, a chartered accountant who secures work from any person other than employee, other than partner, or by any mean not open to CA, then he is treated as guilty of professional misconduct. What do you mean by any other mean? Clause number 6, advertisement, circular, personal communication, interview, or any other mean. Clause number 7, sir, I am not using circular, advertisement, or any mean, sir. I am describing about myself and my achievements. If you are advertising your professional attainments, sir, I am just advertising the services which I am offering. Sir, I am grabbing people attention by using powerful designations, not just chartered accountant. In all these cases also you are treated as guilty. A chartered accountant is deemed to be guilty of professional misconduct if he advertises what are your professional attainments, what are the services offered, or uses any designation other than chartered accountant. If you are a CA in practice, you must use only a chartered accountant designation, and that is what even section 7 of CA Act also says. Section 7 says a chartered accountant who is a practicing person shall use only one designation, chartered accountant. Beside your name you may put CA, CMA, CS, BCom, MCom, DSA, all that, no problem. But when you're using full form, you can use only chartered accountant. You are in practice, you must use only one designation, chartered accountant. You must use only one designation. Sir, I'm not in practice. Can I use multiple designations? Your wish. No problem. That's your choice. However, a chartered accountant can mention about a degree of a university, membership of ICI, or any other institution that is recognized. A member empaneled as insolvency professional can use this designation also. Okay, insolvency professional, registered valuer on visiting cards and letter. You can use these additional designations along with chartered accountant. Only insolvency professional registered. Remaining qualifications you can use. Just as a qualification you can mention. Sir, can I mention about date of setting up of practice in my website, or date of setting up of practice in my, this one, visiting cards, all that? Never, not permitted. In your website, you can mention about year. You can just mention about your year of incorporation, provided that year will come only on pull mode. Pull mode means what? The moment website opened, everything is flashing like this. Firm opened 1980, firm having 10 partners, flashing like this. That is push mode. Pull mode means what? The person visitor should search when the firm opened. He need to click profile, year of incorporation, like that. He should click, only then data should come. That is called pull mode. So can a CA mention about his directorship details? Okay, yeah, you may give information about where you are director, but on visiting cards and all you should not give. In website you can mention. Sir, a CA is giving his photo on magazine. Yes, passport photo is enough, provided you are not mentioning any of your professional achievements, all India first rank holder, all India 10th rank, all India 8th rank. No. QR code on visiting card, is it permitted? Yes, absolutely permitted, provided whatever content permitted on visiting card, same content must be there through QR code as well. Sir, can I give a newspaper advertisement for recruitment of staff? Yes, absolutely, provided for your own office staff recruitment allowed. Even on behalf of your client also it is allowed. Even if your client want to sell a business or a property and member is acting in a professional capacity as a trustee liquidator, in such case also you can announce on behalf of the client. That's it. Can you attend conferences and give speeches? Very much. Are you permitted to write articles? This is also called as write-ups. Actually, write-up is having a different name. Council guidelines were there separately as a write-up. Write-up means till date even I do not understand, honestly speaking. I never seen write-ups anywhere. So what I understood as a overall plain reading and understanding and discussion with others, what I understood is write-up means it's an advertisement about services offered. It would advertisement about services offered by chartered accountants. Where they advertise about this? In institute journals. Okay, that's it. Actually, in write-up, no. They say a CA can advertisement in newspaper. That is actually not permitted. Write-up says it is permitted. But logically speaking, clause number 6 says any sort of advertisement it is not permitted. When I can mention about my form details, all that in newspaper, when there is a change in partner, dissolution, getting a change of office, at that time only I can mention. Can I advertisement a newspaper normally in black and white? Simple column. What is my firm? How many partners we have? How many staff we have? What are the services we offer? Can I mention like that in newspaper logically? No. So then what write-up says? Then what write-up guideline says? You can say write-up guideline says you are permitted, right? It says you are permitted. I feel after interpreting all this combinedly, what I felt is you can give write-ups advertisement in institute journals, institute professional related journals. That's it. Signboards are permitted, glow signs not permitted. Directorship in a company, we already discussed about this in clause 11 also clearly. And sir, can I have my own logo? You must have only this logo for your firm. As a practicing chartered accountant firm, you cannot use any other logo. Now immediately you might get it out. Sir, Deloitte, PwC and all using some other logo. Deloitte is not an audit firm. PwC is not an audit firm. Big Four is not an audit firm. They are networks. Networks will have their own logo. Now Deloitte is having 10 firms associated with it. That 10 firms logo must be CA. Understand? That's it. So with this, part 1 schedule 1 is fully completed. Approximately it took 1.5 hours, right? Part 1 schedule 1. Revision itself is 1.5 hours. Fine. See, I just want, because this revision is only purely to my students, mainly whoever is regular course students, I'm giving this. So that's it. So with this, part 1 schedule 1 is completed. Now let's discuss about part 2. Part 2 is about for whom? It is for members who are in service, means who are not having practice. So for them also, there is a concept of professional misconduct. So what? Suppose a chartered accountant who is in service, who is in employment, is prohibited to pay, prohibited to share his salary. Getting it? Prohibited to pay his salary. Like, see, if a member of the institute is deemed to be guilty, if he is an employee of a company, firm, whatever, and during that employment, whatever he is receiving benefit from the company, he is paying, or he is allowed to pay, or he is agreeing to pay some part of it directly or indirectly to somebody. What is this for? This is to prohibit obtaining employment opportunity using brokerage method. You know, especially in engineering colleges, no, or engineering courses or foreign engineering courses, foreign jobs in technology, there will be consultants who will recruit job for you, and you need to pay for next 6 months 50% of your salary. Like that, they will enter into a contract. You, as a chartered accountant, you should secure a job by your merit and by your skill, not through consultant. And if you're sharing any of your salary to a consultant, and if institute comes to know, they'll treat you as a guilty of professional misconduct. Exception. However, it does not restrict sharing commitments among relative, dependent, friends. Okay, see, so you got salary and you are sending some amount to your family. That is okay, permitted. The intention is don't pay brokerage or commission for securing the employment opportunity. And not only that, you are prohibited to accept tips from employer related service provider. I'm a CA working in a company as internal auditor. Employee. My company wants stat auditor. I immediately went and requested my friend. He came as a stat auditor and I took from him commission 20%. Prohibited. Sir, you said no. Referral works permitted in part 1. That is only for CA in practice. That is only for CA in practice. Referral work is permitted. I'm a stat auditor. The company asked me for internal auditor of external audit firm. Not as an employee. I referred and got commission. That is permitted. A member in service treated as guilty if he accept, any profits or gains from a lawyer, CA, broker engaged by such a company by way of commission or gratification. You should not get anything unauthorizedly from third parties who are clients or customers to the company where the member is. These are nothing but called as in corporate terminology kickbacks. Kickbacks. That's it. So only 2 clauses. Part 1 is having 12 clauses and here it is 2. Another thing is professional misconduct. Generally, you are not a fellow of the institute, but you are acting as fellow of the institute. I'm a CA in practice. 5 years continuous practice not completed. I can use only ACA designation. I cannot use FCA. If I say I'm FCA, it is treated as professional misconduct for every member. The moment you become a member as an employee, even though you are in employment, you can have membership number, right? You may not have COP, but you might have membership number, right? If you are claiming yourself as an FCA, you are disqualified. You are treated as guilty of professional misconduct. Or I'm in practice, still an ACA, but I'm claiming as FCA. Again treated as guilty of professional misconduct. Next. So, or you are failed to supply information called by the, if a chartered accountant fails to supply information called for or does not comply with requirements of these guidelines, you are not complying with the following guidelines, or you are not giving information called by these people. They are calling for some information from you for some inquiry. You are not responding at all. Remember, non-response is less severe offense, than false information. If you are giving false information to the institute, it is treated as a part 2 schedule to misconduct, professional misconduct. False information if you're not giving information, that's a less severe misconduct. That is coming under part 3 of schedule 1. And of course clause 2. Getting it? Once again, when I come to schedule 2 part 2, I will reconnect with this. Or you are giving false information to others, it is not to the institute, it is not to ICI or council members, not to others. You are claiming yourself as a very powerful chartered accountant, or you are saying you are having 20 employees to a company, a company is approaching you, you are having 20 employees, you don't have hardly 2 employees also, but you are saying 20 employees I have to another company. You are giving false information while inviting work from another CA, while responding to tenders, while advertising through write-up or anything. While you are advertising through write-ups, you are giving false information to others. You are misrepresenting to the others. In such a case, this will apply. That's it. This clause will apply. Suppose if you are giving false information to the institute and disciplines or committees of the institute, that comes under schedule 2. And coming to other misconduct. What is other misconduct? It is not in relation to your profession. Sir, I was held guilty, sir. I was held guilty by a civil or criminal court, sir, because I was involved in something called moral turpitude, and I was punished with imprisonment not exceeding 6 months. In such a case, it's a schedule 1 offense. Sir, it is no way related to CA profession, sir. Even then, this other misconduct ICA will take it. Suppose if you are in the opinion of the council, you are bringing disrepute to the profession or the institute as a result of the action, even though not related to professional work, you are bringing some disrepute to the institute. This will also be treated as other misconduct. That's it. So that is about part 1, entire schedule 1. So in the next video, I'll talk about schedule 2. So almost till now I spent approximately 2.5 to 2 hours 40 minutes. I think still another 1 hour 15 minutes, maximum 4 hours. This entire ethics revision will be completed. That's it. So again, when I'm discussing schedule 2, any related points comes in schedule 1 or anywhere else, I'll connect it. I hope you are still enjoying. I'll be happy if you send me your feedback, right now, or maybe after completing the 2 more parts, you can share me your feedback, how you felt about a revision of this ethics. I'm not giving this anywhere outside, only for my students, full course and smart course students. This encrypted revision is not for outsiders, because outsiders, ethics, no, there are so many points which people think they understand, but actually not. There's so many points which I think in this revision you might have felt improved clarity. You might have felt improved clarity in the revision class. That's it. So schedule 2, let's discuss about 3 parts in the schedule. There are totally 3 parts. Part 1 have 10 clauses. Part 2 have 4 clauses which are applicable for all members generally and professional misconduct. And clause 3 is other misconduct. Part 3 is other misconduct. It has only 1 clause. So which means under schedule 2 we are totally having 15 clauses. Under schedule 2 we are totally having 15 clauses. Whereas under schedule 1 we are having totally 19 clauses. Part 1 is having 12 clauses. Part 2 is having 2. Part 3 of schedule 1 is having 3. And again other misconduct is having 2. So 2 plus 3 plus 2. 7 plus 12. Totally 19 clauses under schedule 1. Whereas in schedule 2 we have only 15 clauses. That's it. Anyhow. So let's discuss. First one, I told you very clearly at the beginning itself, schedule 2 mainly deals with offenses when the member is carrying out the work. So part 1, professional misconduct. Part 1 is professional misconduct by a member who are in practice. Professional misconduct by a member who is in practice, and the second schedule part 1. So for this parallelly we have in schedule 1 part 1, which also deals with chartered accountants and practice, member who is in practice. Fine. So what it says, prohibition, the keyword is actually prohibition on disclosure of information pertaining to client confidentiality requirement. Even in our fundamental principles, one of the requirement is confidentiality. That time itself I spoke about, I will discuss it in the clause 1. So a chartered accountant in practice is prohibited to disclose information related to the client to the third parties. You're prohibited. There are two exceptions. One, if the client has given consent, the client has permitted you to disclose, no offense, or the disclosure is mandatory under law. It's a requirement under law. Suppose under company audit, when you're doing company audit, you discovered a fraud. You discovered a fraud. When you discover a fraud under company audit, it is your responsibility. If the fraud amount is more than 1 crore, if the fraud amount is more than 1 crore, it is your responsibility to report it to central government by filing a form called ADT4. If it is a requirement under law, there is no point, nothing wrong in disclosing. Next. Even the duty of non-disclosure, the confidentiality requirement applies even after you finish the audit, even after you finish the engagement. Remember, this confidentiality is not only for audit, for all engagements that we take up. I may be filing IT return for my client. His information I should not disclose. See, confidentiality is a requirement which is there under every profession, not just for chartered accountants, even for doctors, lawyers, engineers, actuaries, architects. For everyone, confidentiality requirement is common. Next. Now, so there are some clarifications which are given. What is a chartered accountant's duty in case of unlawful acts which are made by the client? Just a minute. Yes. So what is the auditor's duty? What is the chartered accountant's duty with respect to unlawful act? Something, an act which is not as per the law, an activity which is conducted which is not as per the law. What is the responsibility of the member? For this only we have given nuclear concept. For this only we were given with nuclear concept. What nuclear says is, if you have any responsibility to report that non-compliance with any legal and regulatory authority, report it. If there is no such responsibility, it is enough if you report it to board of directors and those charged with governance, nothing but audit committee or whatever. First, whenever we discuss some non-compliance, whenever we discover some non-compliance, we by default report to audit committee or board of directors, as the case may be, depending upon that. And if there is a reporting requirement for lawmaker, then you need to report to the legal and regulatory authorities. Now, so what the clarification says, a chartered accountant in practice is not duty bound. Very important disclosure, not duty bound to disclose income tax authorities about taxation frauds committed by his client, which came to know during the conduct of the professional work. Any frauds relating to tax, especially if at all any frauds committed by the client relating to taxation matters earlier, and in my audit I discovered them, I won't report to tax authorities unless in the tax audit report 3CD list of particulars, or in 3CB or 3CA, if there is a specific requirement for you to report, then you have to report. If there is no such a kind of specific reporting requirement, you are not duty bound to report. Sir, my client, tax fraud he did, sir. Some tax fraud he did. Sir, he claimed some expenditure which is not allowed under income tax law. Okay, report it in 3CD if it is applicable. If not applicable, leave it. Next. So why this power has been given to auditor is because of section 126. Suppose when I'm representing my client before income tax authority, I'm acting as a lawyer. Nothing but I'm acting as a vakil. Getting it? So any communication the client is making to me, whatever information he is disclosing to me, how a lawyer should keep it confidential, same way the auditors should also keep confidential. Should also maintain confidentiality. So the proceedings under income tax authorities or judicial proceedings, accordingly, 126 protection applies even for a chartered accountant who is in practice on behalf of the client. So if a particular client approaches me for income tax search or seizure case, a client has affected with some search or seizure case. Okay, he recruited me. The client has committed certain frauds, has committed certain mistakes, definitely, no doubt about it. But I am not bound. I am not bound to disclose with the income tax authority. I am here to protect the client who recruited me. That's it. However, if you discover any fraud or any crime which is committed newly after you started the work, the client did a new fraud, this 126 protection will not apply. You may be required to disclose if there is a responsibility on you. If there is a responsibility on you, you may be requiring to disclose. You need not go and hide under 126. If a new fraud is committed without your knowledge, getting it, you need to communicate if there is a requirement. If there is no requirement about to communication of fraud, all that, ignore that aspect, simple. Next. See, actually, there is a chapter called liabilities of auditor. There is a chapter called liabilities. I always tell students to read it at last. Very lengthy chapter, very crux, very critical chapter, which actually talks about liabilities of auditor to third party, liabilities of auditor to management, liability of auditor to shareholder, liability of auditor to investors, liability of auditor to lawmaker or legal and regulatory authorities. It talks about so many provisions and how the American context says, or how European context says, and what Indian context says, what are various judgments involved. Oh, so much is there in that. And that chapter weightage is hardly 4 marks or maximum 6 marks in a worst scenario. But to read that and understand and to retain it, it takes lots of efforts. So that's why what I always tell students is ignore that chapter completely. Anyhow, suppression of facts in past IT returns. Suppose you discovered when you're doing tax audit especially some facts which are hidden, which are not disclosed by the client. You can still support your client. That's what past frauds. You can support your client. You need not. Unintentional suppression, whatever. Suppose client accidentally missed to put some information. You discovered that. If there's a responsibility for you to report it now as a prior period item, okay, report it. Otherwise, leave it. Fraud, it is relating to past accounts which you certified. Sir, what about this case? Suppose last year financials were audited by me. And now in this year, I discovered a fraud related to the financial year which I did audit. Oh my God, it's audit conducted by me and fraud related to the year for which I gave audit report. If there is a fraud discovered like this, first get a legal opinion and then disclose accordingly wherever it is applicable. So if the member shall advise the client to make a disclosure, if the client refuses to disclose, you can withdraw from the engagement and you can inform authorities that past records where you have examined and reported are unreliable. You can ask management to revise the financial statements under 131. You can ask management under 131 revision of financial statements. Okay, if you discover any fraud which is not rectified in the financial statements and you reported already, you gave audit report thereon, 131 if time limit is applicable. If you think it's a very severe fraud which is affecting multiple parties, report it to ROC or MCA, Ministry of NCLT. Report it to them, file an application. They may open reopening of accounts under 130 and they will take care. And suppose if any information is suppressed relating to the current year and you are doing audit, if suppression related to current period accounts, then member shall advise the client to make full disclosure. Obviously, financial statements, man, you are the auditor. Suppose you are the auditor of the financials, you have to give opinion on the financial statements and client suppressed some information, important information. You need to insist on client to disclose. If the client refuses, give a modified report. First, if it is wherever you need to give a disclaimer opinion, don't give disclaimer opinion, withdraw. If you are unable to withdraw, give a modified report containing disclaimer if it is so severe. That's about clause 1, confidentiality. Indirectly, I explained you in detail this entire provision. So now I think might be, if at all you're not having clarity on this earlier, now I think you might be having clarity, right? That's it. Next, clause number 2. What it simply says, clause number 2 prohibits a chartered accountant to certify accounts not verified by him. It is prohibiting you to certify accounts which are not verified by you. See, clause number 1, part number 1, schedule 1. If you look at that particular clause, what it says, you are prohibited to allow somebody to sign on your behalf. It is you are prohibited to allow somebody to sign on behalf of your firm. Getting it? You received the work on behalf of your firm. You are allowing somebody. Sorry, no. Clause 1 talks about it is prohibited. Clause 1 prohibits you to allow somebody to use your name. Clause 1 prohibits somebody to use your name. Clause 12 prohibits somebody to sign on your behalf. If you are allowing a non-member, non-partner to sign on your work, you are prohibited. This also indirectly correlates with that. It is prohibiting a chartered accountant to certify accounts not verified by him. You didn't verify any accounts. Getting it? You are certifying it. This is very popular in real cases. In practice, there are many auditors who are lending their signatures. Lending means what? Some tax consultant will do tax audit. This fellow will sign all tax audit reports at the end of the year without verifying. Grossly negligent. Clause number 7 will also attract. In the schedule 2, part 1, clause number 7, most powerful and most frequently used clause. Grossly negligent. So a CA is deemed to be guilty of professional misconduct if he certifies or if he report on financial statements which are not examined by him or by his partner or employee or another chartered accountant in practice. If some other CA or your partner or your employee, if at all any of them have verified it, okay. If none of them verified and you are directly signing without verifying, you are treated as guilty of professional misconduct. How can you sign without verifying? In this relating to clause 2, there is another clause. There is another clause which is also needed. You shall obtain. Clause number 8, clause number 2 and clause number 8 are closely related. Clause number 2 and clause number 8 are related. CAP shall obtain sufficient appropriate evidence. You must get sufficient appropriate evidence before you certify. Before you certify something, you should get evidence. You should get reasonable assurance. A chartered accountant is deemed to be guilty if he fails to obtain sufficient appropriate evidence which is necessary for opinion. And you expressed opinion without getting anything. Somebody you did not even verify anything and you certified. You see what clause 2 says? What clause 2 says? You have not verified. Somebody would have verified or nobody has verified. Clause 2, a CA is deemed to be guilty of misconduct if he certifies finances which are not examined by him or by partner or employee another CA. You didn't examine it all. Without verifying, you are signing. Without verifying means you did not get sufficient appropriate evidence, which means wherever clause 2 attracted, clause number 8 is also attracted. Wherever clause 2 and 8 are attracted, clause number 7 is also attracted. How dare, how negligent you are. Without verifying, how can you sign? How negligent you are. Clause number 7 also attracts. So clause 2, 7, 8 are closely related. Clause number 2 says without verifying, don't certify. Clause number 8 says it is your duty to get sufficient appropriate evidence. Without getting sufficient appropriate evidence, don't give opinion. So if at all, if it is related to financial statements, expression of opinion, you did not get sufficient appropriate evidence and you gave opinion, clause number 8 violation. Without examining, you certified indirectly. So naturally clause number 2 also applies. And clause number 7, because of this you are treated as grossly negligent. Your basic responsibility you did not fulfill. How negligent you are. Clause number 7. Suppose I gave some stock certificate. Clause number 8 may not apply. Clause number 8 talks only about financial statements specifically. Okay, look, clause number 8. Let's bring more clarity. A chartered accountant is treated as guilty of misconduct if he fails to obtain sufficient appropriate evidence which is necessary for expression of opinion. It is in relation to opinion. If he is unable to obtain evidence, deny expression of opinion. See, you could not get the evidence. You gave disclaimer of opinion. That's okay. Clause number 8 will not apply. If you gave opinion without obtaining sufficient appropriate evidence, this will apply. This clause covers both expression of opinion and certification. Okay, sorry. This is applicable for both the cases, opinion as well as certificates. Stock certificate in all the cases, simply speaking, all sort of certifications and opinions are covered under clause number 8 and clause number 2 both. Clause number 2 says without verifying, don't sign. Clause number 8 says get sufficient appropriate evidence, only then give opinion. That's it. If a member fails with this clause, it may be further treated as grossly negligent. What do you mean by grossly negligent? That is what clause number 7. A CAP shall be deemed to be guilty of professional misconduct if he do not exercise due diligence or grossly negligent. What is due diligence? See, you need to do audit as per standards. You need to do audit as per guidance note. You did not care about them. You did not even verify. Basic minimum effort that you need to put, you did not. Physical cash verification, you did not even verify. That is one of the fundamental requirement as per guidance note on verification of assets. Your fundamental duty is to verify cash. CARO report fixed assets, you said everything positive comment without even verifying. You are grossly negligent. Most of the times, see, in minor irregularities, suppose you did not issue engagement letter, but you did overall audit, got evidence, everything fine. You know, we may not treat it as grossly negligent. We may not call it as grossly negligent. Getting it? So, it is a duty of the auditor to perform work with skill, care, diligence, and caution. Any matter, whatever gives some doubt, you should probe it into the bottom. You should investigate. Negligence generally would not be a gross negligence in case of minor errors and don't require a reference to disciplinary committee. The council would nevertheless bring the matter to attention to the members that greater care may be, like, even wherever you miss minimum due diligence, though it may not be grossly negligent, council will warn the member. Please be careful. Please be careful. That authority is always there. Not every negligence amounts to grossly negligent. Remember, if in the entire balance sheet, external confirmation I did not receive for trade receivables, maybe you're negligent. It's a minor error. You may argue, I did all other audit procedures. I obtained sufficient appropriate. I convinced. So I did not perform external evidence. I did not perform that procedure alone. Okay, maybe negligent. You did not even care. You did not verify trade receivables at all. You did not even verify at all. You didn't touch at all. You may be called as grossly negligent. So that's how clause number 2, 7, 8 are related. Getting it? Next, sir, when I'm doing audit, I discovered a material misstatement. Have you reported? When you discover material misstatement, what you should do? Tell the management to rectify. They did not rectify. What you should do? Give a modified opinion. If you give a modified opinion, no problem. You did not modify and material misstatement is still existing, you are treated as guilty. A CA is deemed to be guilty if he fails to report a material misstatement in the financial statements known to him. That's it. Next, clause number 3. So you see clause number 2, clause number 7, 8 and 6 also. 2, 6, 7, 8. Related clauses. Please be careful. 2, 6, 7, 8. All these are related clauses. And of course 9 also related clause. I can say 9 also related clause. In part 1, schedule 2, 2, 3, 7, 8, 9. These 5 clauses you need to read 3 times. Now itself, after watching this video, these 3 clauses please refer once again. All these 5 are interrelated. Any one of these clause attracts generally remaining clauses. There is a high possibility. What this clause number 9 says, you are deemed to be guilty if he fails to comply with generally accepted audit procedures while performing. If you are unable to comply with GAAP, mention the same in report, then this will not apply. What do you mean by generally accepted audit procedure? Standards, guidance note, technical guides, all these are generally accepted audit procedures. Suppose trade receivables I did not verify at all. I did not get sufficient appropriate evidence. Indirectly, I violated guidance note. So, clause 9 will attract. And since without verifying, I certified the financial statements that they're true and fair. Getting it? Clause number 8 will attract because I did not obtain sufficient appropriate and I certified. Clause number 2 also will attract. What it says, without examining, how can you certify? That is clause number 2. Clause number 7. Trade receivables a very major component in the organization and you ignore that. How negligent? Grossly negligent. Clause number 6 will not apply in this case. I did not verify. I don't know whether there is a material misstatement there or not. Whether there is a material misstatement, I don't know. I did not verify. Without verifying, how do I know a material misstatement? So clause 6 do not apply in our example. In this example. Hope you are able to figure out how the clauses have to be collectively to be applied. That's it. So that's about clause number 9. And there is a requirement in the SEBI notification for listed entities, only those who hold valid certificate of peer review, only those who are having a valid certificate of peer review board, they can only do the audit of listed company. That's it. Not required. Next 3, 4, 5. If we finish these 3 clauses, part 1 of schedule 2 is also completed. So what is this 3? It is prohibiting a chartered accountant to use his name on reports which are related to earnings estimate, the key provision. So what is the main provision? If a chartered accountant in practice allows his name on a report or his firm name on a report which deals with earnings estimate which depends upon contingent future transaction, example, prospective financial statements, projected financial statements. Many of the CS are signing projected financial statements. Yes or no? Actually, you are prohibited to do that. When you are signing the, sir, but many of our offices, principals, where I did articles, we do sign projected financial statements. You can. When? 3 conditions. Clearly you indicated the source of information, and you also clearly mentioned what is the basis of the forecast and underlying assumptions, and you clearly, most important, see, you mentioned the fact that you did not vouch for the accuracy. How far the projected financials I put up, I did not verify how far they are accurate. If you mention these 3 conditions, if you mention these 3 points in your report, getting it, you are not guilty under clause number 3. Now, clause number 4. This is to protect independence again. What it says, a CA is deemed to be guilty if he expresses opinion on financial statements of a business or entities in which either he or his firm or his partner has a substantial interest. Sir, what about relatives, sir? What about relatives, sir? Relative is not covered here, but relative is covered in the council guidelines. Relative is covered in the below chapter council guidelines. Okay, so if you or your firm or partner is having substantial interest in a one organization, it may be company, it may be partnership firm, it may be LLP, whatever, you should not certify, you should not audit, you should not give opinion on the financial statements. A CA is prohibited to express opinion on financial statements of the entity if one or more of his relative has a substantial interest. This is as per guidelines. Once again, we have added here the point for the sake of convenience. As per the guidelines, even if your relative is having substantial interest in the entity, you're prohibited to give opinion. For all attest functions, this provision is applicable. A chartered accountant should not by himself or in his firm name accept auditship of a college where you are working as a lecturer. You should not accept the audit of a trust where your partner or your employee or a trust, they are all trustees. That's it. Anyhow, these 2 are the important point. Now this is, suppose, sir, there is a company where I acted as a director, independent director. Okay, well, now I came out of the company. Can I accept that audit of the company? No. For 2 years from the date of completion of your tenure as a director, don't accept audit of the company to avoid self-review threat, to avoid or overcome familiarity threat. That's it. So that's about clause number 4. See, actually 3, 4, 5 are not that important clauses. They are not that important clauses. Okay, what is most important is 6, all that. Clause number 5. A CA is deemed to be guilty of professional misconduct if he fails to disclose a material fact known to him which is not disclosed in the financial statements in accordance. Suppose, as per applicable framework, some material information is there that is not disclosed in the financial statements by the management, and you also fail to disclose that fact. You know that fact that management has missed some disclosure in the financials that is required as per accounting standard, that is required as per Ind AS, that is required as per Schedule 3. You know that they didn't disclose. You need to disclose, right, in the audit report. It's a material misstatement, right? Naturally, it attracts clause number 6. Wherever clause number 5 attracts, clause number 6 may also attract. If it is a very big thing, clause number 7 also will attract. However, if it is on the part of the member who is in employment and that information is not meant for any outside authorities, then it is not treated as guilty. Suppose if it is relating to employment, and it is not meant for outsiders related information, we are not going to publish it for outsiders, no point, this provision will not apply. Actually, clause number 5 and 6 are something repetitive. Non-disclosure is also treated as a misstatement, yes or no? We understood misstatement definition in the very fundamental chapter. Non-disclosure is also misstatement. So with this, almost 9 clauses we have done. 10th clause, administrative clause. What it says? Sir, I'm a chartered accountant in practice. Many of my clients are individuals who are filing IT returns. Now, whenever they have to pay tax, self-assessment tax, they will give me the money to pay the tax. Along with my fee, they'll give me tax money also. What should I do? Can I keep it in my personal bank account or my firm bank account? No, keep it in a separate bank account. If at all you are not going to use that money immediately and it's a client money, don't keep it in your personal bank account, keep it in a separate bank account. Any amount received from client must be kept in separate bank account and shall be utilized only for the purpose mentioned therein. However, if you received advance against services to be rendered, suppose you received your fee advance, that is okay. Money received for expenses to be incurred or payment of statutory fee, purchase of stamp paper, taxes which are to be spent within reasonably short time, okay, you can keep it in your personal account, no problem. Do you see these cases? Many CAs are mentioning their bank accounts while filing IT returns for IT refunds. Many of my friends I know who are mentioning their bank account details in the client IT return. Severe offense, man. Severe offense. It retracts directly clause number 10, part number 1, schedule 1. Very severe. Don't do that. I don't know. Many of you, I think you're in articles. I don't know how many of you are doing this. How many of you are promising your relatives or friends that you'll bring refund and you're mentioning your in their IT returns your details. If at all they know this provision and if at all they want to take a revenge on you, if at all on any occasion, they may file a complaint with the institute. Sir, I'm not a chartered accountant in practice, sir. I'm just an article. Some other provisions are there for you. Don't worry. So that's it. All 10 clauses we have done, completed with respect to part 1, schedule 2. Now what you need to do, pause the video. Once go through the entire clause. I told you these clauses are very related to even 5 also you read. 5, 6, 7, 8, 9. These 5 clauses are closely related, even 5. What is 5? Material fact I know, which is not disclosed in the financial statements. That also I know, but I did not disclose. When something is not disclosed in the financial statements, which is a material fact, what should I do? I give modified opinion because it's a material misstatement. That is what 6th clause says, right? If you fail to disclose a material misstatement, known to you. Getting it? And 2, without you being examining or your partner not examined, your employee not examined, or another CEO also have not examined. Without examination by any CEO or your employee, whatever, if you certify the financial statements or report, you're treated as guilty. What clause number 8 says indirectly the same. Without obtaining sufficient appropriate evidence, if you're expressing opinion or certifying some facts, you're treated as guilty of professional misconduct. What clause number 9 says? Without complying with gap, don't do any work. If you do any work without complying with gap, you're treated as guilty of professional misconduct. If the offense, whatever you committed, is so severe, so sensitive, you're treated as grossly negligent. You're treated as grossly negligent. Next, part 2. This is having 4 clauses. 4 clauses. Some of them might appear again like repetitive, but I'll clarify you why they are not repetitive. Clause number 1, it indirectly says member is deemed to be guilty if he fails to comply with the CA Act or any regulations made thereunder. A member is treated as guilty if you do not comply with Chartered Accountancy Act or any regulations made thereunder. I am running a branch office without separate in charge. I am violating that provision, separate in charge provisions. Accordingly, Schedule 2, Part 2, Clause 1 will attract. I am not paying my article assistance stipend on a monthly basis, minimum stipulated stipend. I am liable for clause number 1, part number 2, schedule 2. There's so many. We have given violations, common violations. Common violations we have given. Premium for articles, nothing but dummy articles. If you are giving dummy articles, you are liable for schedule 2, part 2, clause number 1. Sir, we have seen in schedule 1 also something, sir. In schedule 1, part number 3, schedule 1, part number 3, to all CAs in general. To all CAs in general, in that clause number 1, I think, there we spoke about fails to supply information. Fails to supply information. If you fail to supply information called by the institute, if you fail to supply information called by the institute, or clause number 3 deals with what? if you are giving wrong information to others, not to ICA related people, others, that and all comes under part 3 schedule 1. Now, sorry, clause 2 part 3 schedule 1. If at all you are not giving information, if you fails to give information to the ICI, if you fail to supply information asked by ICI, you are liable under schedule 1. You are not giving information. Whereas here, what you are doing here, what is the offense here? Under schedule 2, clause number 1, what is the offense here? You are not complying with the CA Act. Sir, I failed to comply with some CA Act. Did ICI ask any information? No, not that. I failed to comply, later discovered. Schedule 2, part 3, sorry, schedule 2, part 2, clause 1. Clause number 3, you see, providing misleading information to whom? Institute. You are providing misleading information to a future client while responding to tender, while inviting work from another CA. That will come under schedule 1, part 3. That will come under schedule 1, part 3. Clause number 3. It will come under clause number 3. Getting it? It will come under clause number 3. Just I will open once again. Okay. First schedule we are having 3 parts. Sorry, 3 parts. Clause number 2 is talking about you are failing to give information called by institute. You failed to give information called by institute. Institute is calling someone you are not giving. That's a general offense for practice people or service people, whatever. You're getting it? Any of you, institute is calling some information, you are not responding. You are liable for clause 2, part number 3, schedule 1, professional misconduct, because it is in the course of profession. It is not something personal related. You are giving false information. You are giving false information while inviting work from others, while responding to tenders. Getting it? Or while you are giving advertisement about yourself. You are giving false information to others. Suppose, sir, to the institute, I am giving information, sir, but false information I gave, misleading information I gave to the ICI. In that case, which clause apply? Not schedule 1, schedule 2 apply, part 2 will apply, clause 2 will come into picture. I mean clause 1 will come into picture. Getting it? Sir, so sorry, I'm giving false information, sorry, false information to ICI, you'll come under clause 2, clause 2. Getting it? I'll once again go there. And sum up here, sum up there itself. Just once again, slight confusion in the clause. Okay. Schedule 1, part 3. This is little important, ma. On this, generally many students confuse. Just note it down. Part 3. You know, need not note down. Just observe. Schedule 1, part 3. Okay. Clause 2, clause 3. We are discussing these 2 clauses mainly. Clause 1 I am not discussing. Clause 1 says you are not a fellow but acting as a fellow. You are not an FCA but you are presenting yourself as an FCA. Guilty. Clause 2 says what? You are not giving information. You are not giving information to ICAI. Not giving information. Suppose you are not complying with the act. You are not complying with the act. That will come under schedule 2, clause 1. See, suppose no, institute want to test about your articleship payment details. Example. I'll tell you how the issue. Are you paying stipend properly or not? Give me report on your articles, how much you paid stipend, to which bank account you paid stipend, all that I asked for you. You did not send me. You did not send me the report. Now tell me, as an institute, without checking the data, can I say you failed to comply with the CA Act? No, I cannot say. But you did not give me the information, right? It's a schedule 1 offense. Later I discovered from other sources, you are giving dummy articles, which is against the ICA Act. That is a very severe offense, a schedule 2 offense. So that comes under clause 1. I hope you are able to figure out now. Not giving information. Maybe you did not do any non-compliance. You may be complying with the law or you may not be complying. I don't know. But you are not giving information. You are not cooperating the ICA. Schedule 1 offense. Clause 2, part 3. For all members it is applicable. Even here schedule 2 part 2 is also applicable for all members, practice or service both. Okay, now again, schedule 1, I'm talking about schedule 1. I'm talking about part 3, which is applicable for all CS. Sir, you are giving wrong information to other people, sir. You are giving wrong information to other people, not ICA. Some others asked about your profile. You sent your profile mentioning, exaggerating your claims, exaggerating your audits, staff members, everything. You are giving wrong information to others while getting work. You are treated as guilty of professional misconduct under schedule 1. ICA asked you some information. If you do not give that information, schedule 1, clause number 2, part number 3. You gave information, but wrong information. You gave complete artificial, created data you gave. Then clause 3. Then clause 3. I hope you are able to figure out. If you do not comply with CA Act, a severe failure, schedule 2. Schedule 2, clause number 1, part number 3. Sorry, part number 2. Part number 2. You gave wrong information, false information, misleading information to institute. How dare you cheat the institute? Schedule 2 offense. Clause 3, part 2. Okay. You're not giving information to ICA which is asking for. Clause 2, part 3, schedule 1. Because there have you failed to comply with ICA or not? Still not yet detected. But you didn't give information. You are giving false information to others. Clause number 3, part number 3, schedule number 1. That's how it is. Then this clause you see. This is again related to schedule 2, part 1, clause number 1. This is applicable for CA in practice, right? Whereas this is applicable for CA in employee. A member is deemed to be guilty if he disclosed any confidential information relating to his employer. So naturally this is applicable for whom? Member in service. This is applicable for which person? Member in service. If a CA who is a member who is in service, no. If he discloses confidential information belonging to my employer to outsider, guilty. If this does not apply, if the consent of the employer is obtained, then in this there is one more clause. Suppose you cheated money received in professional capacity from the client. You received from client some money, not your fee, for some other purpose. You defalcated. So a member shall be deemed to be guilty if he defalcates or theft, embezzles any money received in professional capacity. This act amounts to fraud. How this happens, sir? Suppose I told the client that his tax liability is 10 lakhs. But actually I paid only 8 lakhs to the income tax authorities, 2 lakhs I retained myself. I told client I paid 10 lakhs already. Later he discovered 1.5 to 2 years later that actual tax is 8 lakhs only. This CA told me that it is 10 lakhs and cheated me with the 2 lakhs. This fellow went and filed a complaint with ICA. So ICA will punish you under clause 4. Generally, this clause many will not remember at all. Many will not remember this clause. That's it anyhow. So if a CA defalcates money received, so that's it. And other misconduct under schedule 2, part 3, nothing but. If at all you are having imprisonment by any court for more than 6 months, it is treated as guilty of other misconduct under part 3 of schedule 2. There is only one clause, other misconduct. There is only, one clause. So like once let me sum up. Schedule 1, schedule 2. Schedule 1 we are having part 1, part 2, part 3, part 4. Schedule 2 we are having part 1, part 2 and part 3. This is applicable for chartered accountants in practice. This is applicable for member in service. This is applicable for all. And all these 3 dealing with professional misconduct. Whereas this is applicable for chartered accountant in practice. This is applicable for all members. This is also deals about professional misconduct. During it is here schedule 1 3 parts, schedule 2 parts. They are in relation to your profession. Schedule 1 is with respect to your business practice, your business practices. Schedule 2 is generally mainly focuses on your work related offenses. Whereas schedule 1 talks about your business related offense. Part 4 of Schedule 1, other misconduct. Part 3 of Schedule 1, Schedule 2, other misconduct. Here you are having two clauses. Here you are having two clauses. Here you are having only one clause. Getting it? If it is more than 6 months imprisonment, other misconduct will come. Schedule 2. If it is not exceeding 6 months, up to 6 months imprisonment will come under other misconduct part 4. And I told you here in part 1, these are the clauses which are interrelated. Just 2, 5, 6, 7, 8, 9. These are the clauses which are interrelated. Whereas in part 2, Schedule 2, we are having 1, 2, 3, 4 clauses. This is about cash theft, defalcation of cash, all that. This clause number 3 talks about false information to ICA, Clause number 1 talks about violation of CA Act and regulations. See, I'm only talking in this summary sheet, I'm only talking about the points where you generally confuse. Now this part which talks about, okay, this part, clause number 2 talks about fails to supply information to whom? To ICA. You failed to give information to ICA. Part 3, Schedule 1, Clause 2. You are giving false information to ICA. Clause number 3, Part 2, Schedule 2. Have clarity. Severity. You did not give information. Is there any violation conducted by you? No, I just failed to give information. It's a lesser severe offense, Schedule 1. You gave information wrongly, you gave. It's a more severe offense, Schedule 2. Clause 3. You are giving false information. To others. If you give false information to others, outsiders, business practice mistake. So, Clause 3, Schedule 1, Part number 3. You gave false information to ICAI. Clause number 3, Part number 2 of Schedule 2. Hope you're able to figure out. And here in Schedule 2, there is one more important thing. Schedule 2, Clause number 1 is there, right? That is the confidentiality breach by CA in practice. Whereas this one is also confidentiality breach by member in service. Clause number 2 of part number 2, confidentiality breach by member in service. Clause number 1, part number 1 of Schedule 2, confidentiality breach by CA in practice. So these are the clauses generally where students confuse in exams. And what is clause number 2 here? You didn't examine the accounts and certified. Clause number 5, you know a material important disclosure not disclosed in financials and you also did not care about it even though you know. 6 is what? Material misstatement you know but you did not report. 8 is what? Without getting sufficient appropriate evidence you gave your opinion or you certified fact. Without even complying with gap you did audit. And negligence. That's it. Hope this summary sheets helps you to have a very good idea. The summary sheets will help you to have a very good idea. Most confusing. These clauses are generally most confusing. That's it. So remaining are easy clauses. They're not big deal. They're easy clauses. Okay. So with this, Schedule 1 and Schedule 2 are completely done. In our next lecture, I'll be discussing about council guidelines. With that, ethics revision will be over. Of course, I know strongly that I did not conduct this like a revision. You may felt it's not like a revision, sir, but you can feel it because you already finished regular class. My regular class, you see professional ethics, 15 to 18 hours, I think so. Now I finished the entire revision, including next video, put together less than 4 hours. If at all our original class is like this, you will not understand anything because you already have listened to my original class, later revised once and then watching this, easy for you. Otherwise you would have felt very difficult. That's it. Okay, come to the next lecture. So we'll continue. So now we will discuss about council guidelines. So unlike this entire ethics chapter is broadly divided into 4 parts. One is act, like regarding membership, practice, branch offices, and using designations. Just a minute. So this entire ethics is broadly divided into 4 categories. One is CA Act. In that, we are not discussing all the sections because we don't have all the sections in the syllabus. We only have membership related sections and we have practice related sections like that. Then we have schedules to the Act. That is one more thing that we just discussed, all the clauses and parts. Then we have council guidelines which are given in 2008 and updated until today. Getting it? Then we have self-regulatory measures. Which these self-regulatory measures are only recommendatory, not mandatory right now. These are the 4 parts which professional ethics consist of actually. In that, CA Act provisions we covered, schedules we have covered in this revision. Now we are going to discuss about Council Guidelines 2008. Then we will discuss briefly self-regulatory measures. Next. So these guidelines are applicable to all the members of the institute, whether in practice or not. So this itself can be tested as a true or false question. Council Guidelines 2008 applicable only to those chartered accountants who are in practice. False. I think it. A member of the institute who is an employee shall exercise due diligence and shall not be grossly negligent in conduct of his duties. If at all you are grossly negligent in practice, clause number 7 of part number 1 of schedule 2 punishes you. If at all you are grossly negligent in employment, council guidelines will punish you. Able to understand? Then chapter number 3 and chapter number 4 of the council guidelines were omitted. Then next guideline is regarding maintenance of books of accounts by a chartered accountant in practice, irrespective of your 44AA provision, irrespective of your section 44A of the income tax. Income tax 44AA says if you are in a specified profession, if your gross receipts exceeds 1.5 lakh, something like that, limits were there. Only then you have to maintain books of accounts. Otherwise, you need not maintain books of accounts. Irrespective of that, a member of the institute in practice or a firm of chartered accountant shall maintain, in respect of his professional works, proper books of accounts, mainly cash book and ledgers. This is to be maintained irrespective of whether 44AA limit applies or not. Getting it? Next. Now, how many tax audits a chartered accountant can accept? Maximum in a financial year. In a financial year, 60 tax audits can be signed by you. Maximum, how many tax audits that you can give attestation? 60 tax audits in a financial year. 60 tax audit is not per assessment year. It is in a financial year. Suppose right now I am in which financial year? April 1st, 2022 to 31st March 2023. Within this gap, I am signing 60. Example, these 60 breakup. Assessment year 22-23, I am signing 48. Assessment year 21-22, I am signing 12. So 0 balance. So which means total is 60. See, what is the purpose of ceiling limit? To preserve quality of audit. It is not to protect independence. It is to protect the quality of audit. If at all there is no limit on number of works that you do, you can accept any number of works, especially some CS. They can accept any number of works. Every day one audit, how can you finalize? If a CA is accepting 350 tax audit files, only one CA, which one he will verify? When he will verify? So that's why the CA Institute put a ceiling limit saying a chartered accountant in practice cannot sign more than 60 tax audits. Actually, according to me, personal opinion, it should be brought to 20. It should be brought to 20. Getting it? We all know, right, how tax audits are finalized. Getting it? See, for small files and all, it's okay. But what is happening is, in the last minute hurry, even the big files are also, we are not exercising proper diligence, proper verification, and treating them as if they are small files. Now, exclusion. No, I'll tell you. I'll discuss. How the 60 tax audits we should distribute. The 60 tax audit is per partner. Getting it? If at all a firm is having 5 partners, 300 tax audit. Now, these 300 tax audits a firm can accept right in a year. Now, how these 300 tax audits should be signed? Any one partner can sign all the 300 files, no problem. Getting it? If a firm is having multiple partners, number of tax audits, how many number of tax audits the firm can accept? Number of partners multiplied by 60, the firm can accept. Now, which partner will sign? The firm can distribute 60 each to all the partners, or the firm can allocate entire 300 to one partner. That is also fine. But the work will be performed by multiple partners. Able to understand? No, it's compulsory. Council guidelines are compulsory. You have to obey council guidelines. Are you getting the point? Council guidelines are not recommendatory. That's what I told. Entire ethics is divided into 4 parts. CA Act, Schedule, Council guidelines. All these 3 are mandatory to be followed. Self-regulatory measures alone recommendatory. Self-regulatory measures, I'll tell you. One of the self-regulatory measures is how much fees you should charge for every work. ICAI has given minimum fees guidelines, minimum scale of fees. For ITR1, you should charge 5,000 rupees. You know that? But how much the company, how much real CS are charging? If it is bulk ITR1, 100 rupees for ITR1. You know that? Yes. For IT companies, many CS are tendering and getting 5,000 employees IT files. Getting it. 150 rupees per file. So 5,000 employees IT return, they will only file ITR1. One firm will take the contract, they will file ITR1. They will put article assistants, and the article assistant will file all the 5,000 ITRs within the next 1.5 month. Some 5 articles. For these 5 articles, they will pay a stipend of 5 multiplied by 6,000, hardly 30,000. But this company will get 5,000 multiplied by 157.5 lakh. Able to understand? So bulk services they will be taking. But ICAI recommends minimum scale of fee. This minimum scale of fees is recommendatory. We'll discuss that later. Now, so in case of a partnership firm, the number of tax audit assignments is decided based on number of partners. Even remember, even if you are doing tax audit in respect of one branch of one company, it is treated as one file. It is treated as one assignment. Suppose if a company is having multiple branches, still it is one only. Able to understand? Because do you think a company will have multiple PAN numbers if they have multiple branches? PAN number is only company wise. So whether you do tax audit of one of the branch or entire branches put together, it doesn't matter. It is treated as one assignment. Are you clear? The audit signatures may be distributed between all the partners as per the choice of the firm. Same way, we have audit ceiling. We have ceiling on number of audit assignments under Companies Act. Getting it? How many audits that a CA can do under Companies Act? Getting it? Council guideline is there. How many audits a CA can sign? Just a minute. So how many audit reports a CA can? Yes. So in company audit chapter, in disqualifications, there is a ceiling limit given. What is the ceiling limit given in the disqualification? A CA cannot accept more than 20 company audits at any point of time. At any point of time means what? As on today, if a company approached me to appoint me as an auditor, let us assume I am a proprietor. Maximum how many I can do? 20. Right now I will just open my client list where I am acting as an auditor right now, where I am holding position of the auditor, where I am holding office of the auditor. I saw the list. It is 22. Already I violated. Getting it? I should not accept this. One more company. Immediately tomorrow I resigned from 2 companies, stating the reason that I violated ceiling limit. Now it is 20. Day after tomorrow another company approached me. Again, as on day after tomorrow I checked. It is 20. I can't accept that audit. Suppose this company is offering me very good fee. I'll resign from a old company which are not paying fees from past 3 years. Getting it? So 19 clients now I have. Now I will accept this company. At any point of the time means on any day. When we check how many companies right now you are holding the position of the auditor, you should not exceed 20. Now in company audit, Companies Act, the ceiling limit do not include the following companies. 1-person company, small company, dormant company, and the private limited company whose paid up capital is less than 100 crore. These companies are not counted. And what CA Act says, what CA guidelines says, CA guidelines says you can render maximum 30 audit assignments. You can render maximum how many company audits? Only 30 you can take. And the 30 do not include 1-person company, dormant company. Small company, private limited company is not excluded if you observe. Able to understand? So what do you mean by that? Which act we should follow, sir? Both you should comply. Which one you should comply? Both you should comply. Suppose I'm having 15 government company audits, example. 5 small company audits I have. 5 1-person company audits I have. Then 15 private limited companies whose paid up capital is less than 100 crore I have. Then I have 10 private limited company then I have 5 private limited company whose paid up capital is more than 15 crore I have. These are my client list. Actual my client list is 15 plus 5, 20, 25, 40 plus 5, 45. Total my client list is 45. Now I will have to check. Did I violated Companies Act ceiling limit? First I will check Companies Act ceiling limit. Which are not counted? As per Companies Act, small company not counted, 1% company not counted, private limited company having less than 100 crore is not counted. So this is counted, this is counted. Total is how much? 15 plus 5, 20. Companies Act I satisfied. Companies Act I complied. I have not violated. Not only this, you should also check CA Act. So CA Act I will check. In CA Act, 1% company is only not counted. Small company is counted. CA Act, small company is counted. Government company is counted. Private limited companies, everything is counted. There is no such paid up capital criteria. Only dormant company, 1% company are excluded from ceiling limit as per CA Act. So now 15, 5 and 15 plus 5. How much it is? How much it is? 20. Total it is 40. More than 30. You violated ICA provisions. When you violated ICA provisions, Schedule 2 offense. What is it? Member have to comply with the ICA Act, guidelines, all that. It's a Schedule 2 offense. Able to understand. So you should cross verify both Companies Act and CA Act. As per Companies Act, in ceiling limit, private companies may not be counted. But in CA Act, even private companies will also be counted as part of ceiling limit because quality of audit has to be preserved. Able to understand? Next. And in case of partnership firm, 30 audit assignments will be counted per partner. Next. Now what about non-payment of undisputed audit fee? Write about non-payment of undisputed audit fee. We have already covered this point in clause number 8 of part number 1 of schedule number 1. The incoming auditor shall not accept audit of the company if at all previous auditor was not paid undisputed audit fee. Getting it? So this prohibition shall not apply in case of sick units. This prohibition shall not apply in case of sick unit. What is a sick unit? It's a company registered minimum for more than 5 years. It's a company which already established after 5 years and its accumulated losses are equal or exceeding the net worth. Means the company is in negative. The company is having negative. Capital is completely eroded. That's it. What is undisputed audit fee? They have given definition. It is a provision for audit fee in accounts which is signed by client and the auditor along with other expenses if any incurred. That is called undisputed. So whatever client originally agreed that I am ready to pay this much, that is undisputed audit fee because only for that provision he will create. Disputed audit fee, client will not create any provision. It is only shown as a contingent liability. Next. Prohibition if other services fee exceeds a statutory audit fee. This particular guideline applicable whenever you are doing audit of a PSU, audit of a government company, audit of a listed company or any other public company having turnover of 50 crore or more. Suppose you are doing audit of a private limited company. This particular guideline do not apply. 1% company, dormant company, small company, this guideline will not apply. So what is this guideline? A CA where he is acting as an auditor in a company, along with audit, he is also permitted to render MCOS services, provided they do not fall under prohibited services. Any other service other than prohibited services, I can provide to my audit client, even though I am auditor. Here, what the guideline says is, the maximum how many other services I can provide. Can I provide any number of other services the company is asking? You can provide, but maximum fees in respect of other services that you are charging shall not exceed statutory audit fee. If at all you are charging more than statutory audit fee, you are treated as guilty. The logic is very simple. If at all you are getting more revenue from non-audit service compared to audit service, it will create a self-interest threat, advocacy threat. Your independence will be compromised. When in a situation where you have to give a modified opinion, you will stop thinking. You will start thinking that, okay, if I give modified opinion, I will lose this work also. Better let me compromise. So whenever you are providing some other services to the company, naturally your independence is compromised, remember. So in order to protect that, they are not asking you to stop providing other services. If you want to provide, but ensure that the quantum of other services that you provide shall not exceed this statutory audit fees. That's why what people do, suppose building name they will change. Getting it? What in reality Big Four they do this. Getting it? What they do? Suppose they have audit client. Anyhow, for Big Fours, SEBI has given a notification saying these entities, listed entities, the auditors are prohibited to provide any other service. This is as per SEBI notifications. Getting it? That's not covered here, but as per SEBI notification, and even many of the Big Four entities have voluntarily adopted that practice. They have voluntarily adopted the practice that the audit firm, which is falling under those networks, Deloitte or KPMG or whatever, they will not accept other assignments from the same client where they are rendering audit. They will not accept any other work. So in order to promote better corporate governance, but they will make sure that work will go to another network firm. Getting the point? We have fees restriction guidelines for network firms also. So that also we have. Next. By the way, other services, right? Fees for other services, right? What other services do not include audit, certification work required by stat auditor, representation before any authority. These are not treated as other services. For these, whatever the fee you are getting, that is not counted in this limit applicability. Are you clear? All of you. So, whatever the fees that I am charging, whatever fees, like the audit of these companies shall not be accepted if audit fees is less than aggregate fees received for other services rendered. Getting it? Now, the restriction shall apply in respect of fees that is payable to stat auditor and their associate concern. What is associate concern? These auditors have a company where the same partners are directors. That is called as associate concern. Are you clear? Next. See, generally, when you are indebted to a company, up to 5 lakhs that is permitted. Suppose you are doing an audit of a partnership firm. There is no indebtedness, disqualification, nothing is given. So what about disqualification criteria for indebtedness in case you are doing audit of a partnership firm? In case you are doing audit of an LLP? So there 1 lakh is the limit. So when a CA is disqualified, when he is indebted to a client, if the indebtedness is exceeding 1 lakh, you are disqualified. Or if the indebtedness is exceeding the limit fixed by the statute. In Corporate Societies Act, the limit is 1,000 rupees. In Companies Act, the limit is 5 lakh. Getting it? Next, it's not required. Guidelines on tender we covered. UDIN we know. Guidelines for networking. The guidelines for network firms. When a group of firms associated together, we call them as network. Network can use the word and affiliates. Affiliates. Getting it? They can't use the word associates. Associates is a word. And co is a word for firms. And affiliates is a word that is to be used for network identification. Now, when you want to form as a network, if group of audit firms want to create a network, they need to register that network with ICI. They need to register that network with ICI. In that network, these firms will act as members. That network may be registered as a partnership firm, or as an LLP, or as a society, or as a mutual association, whatever. Getting it? The network can have any, legal constitution. Here they have given. Network can be a mutual entity, network can be a partnership firm, network can be an LLP, network can be a company. Suppose all these big fours know, these networks are LLPs, most of them. They are LLPs. In that network, all these firms will act as partners. All these firms, BSR & Co is a partner in KPMG affiliates. Getting it? KPMG LLP. Okay, BSR and affiliates itself is network and it has a brand name of KPMG. Yeah? Okay, then this affiliates is forming part of the international network called KPMG. That's what, right? Yeah. See, these networks now again two types actually. That's what, like international network and Indian wide network. Probably within India, whatever he said is BSR and affiliates is Indian network registered with ICA. See, we can register our firm with only one network. First understand. We can register our firm only with one network. I cannot register under multiple networks. I can only register my firm with one network. This network can participate in international network. With how many international networks a national level network can participate? Again one. That is what. Able to understand. So we have that point as well. You see, affiliates and associate. The network may have a distinct name which should be approved by the institute. To distinguish a network from the firm name, the words Enduco and associate shall not be used. The words affiliate shall be used after the name of the network. Getting it? Network will not carry any practice. Getting it? Sub KPMG and affiliates is a network when they will not engage in practice. The firms, whoever is part of the network, will engage in practice. Registration of network. First, they should reserve the name. That name will be reserved by ICI for 3 months. Getting it? After the name of network is approved, the institute shall reserve the name for a period of 3 years. The network shall get itself registered with the institute by applying in so and so form within 3 months. So, after expiry of the said period, registration of network with ICI is compulsory. One more thing. If different Indian firms are networked with a common multinational accounting firm, they shall be considered as part of that network. Listing of network along with entities or firms outside India. What are they saying? A member, individual member or a partnership firm or any such entity or member, they are permitted, shall be permitted to join such network with entities outside India, provided the individual member, partnership or whatever it is, they are allowed to join only one network. And firms having common partners shall join only one network. If different firms are there having common partners, they should also join the same network. Able to understand? And the change in constitution of the network. Suppose you created network with LLP. You want to change it to another firm. Or in network, you are having 10 firms originally. Now 2 firms are removed. Or 2 firms are going to add. It is like admission or removal of partner. Something like that. That changes shall be intimated to ICA. And network will have some ethical rules. What is that? If one firm of the network is stat auditor of a particular company, then associate, including networked firms. If the word including networked firms is used, then only they will be counted. If the word including network firms is not used, associate means my firm is there. If my firm partners are partners in another firm, then only it is called as associate. Or my firm partners are directors in a company, then only that company is an associate to my firm. Able to understand? What is an associate for a CA firm is not defined anywhere. When a particular entity is treated as associate for a CA firm. For a CA firm, another entity will be treated as associate in the following 2 cases. Same partners were there in that firm. Or that is a company. Our partners are directors in that company. Or our partners are having significant influence or control in that company. Then that company will be treated as associate. Now, do associate word include other network firms? Generally, no. Do associate for a partnership firm, what do you mean by associate? Does that associate include other network firms? Suppose KPMG is having 10 firms, let us assume, in India. Now, for one of the firm, what do you mean by associates? Remaining 9 firms, will they come as an associate? No. Only if they use the word networked firm along with the word associate, then only it is covered. Otherwise, it is not covered. Associate for an audit firm shall not include network firms. Associate for an audit firm means only that company which is created or incorporated by these chartered accountants for providing management consultancy and other services. Only that is an associate. Or our partners have formed another firm for some other purpose. That is an associate. Clear? Now you see, if one firm of the network is stat auditor of a company, then the associate, even including networked firms or the said firm, directly indirectly shall not accept internal audit, bookkeeping, such other professional assignments which are prohibited for the stat auditor. If KPMG, one of the firm, is providing stat audit service to Infosys, remaining network firms shall not accept prohibited services, only prohibited services. Able to understand? Companies Act is silent about network firm concept. CA Act is saying. What about management consultancy, other services? The auditor itself can provide. The auditor himself can provide. But the maximum fees that he can collect is how much? Shall not exceed stat audit fee. What if I am also providing MCOS? My network firms are also providing MCOS too. The same company where I am acting as an auditor. So there is a ceiling. There is again a ceiling limit. Auditor firm providing other services. If auditor, whoever is conducting audit, that firm only providing other services, fees shall not exceed stat audit fee. Other network firms are providing, then the total fee shall not exceed 3 times of the stat audit fee which I am charging. Now you see, for other firms of the same network collectively, it shall be 3 times of the fee payable for carrying out statutory audit of the same undertaking. Example, suppose there is a KPMG and they are having some 10 firms, or else 1, 2, 3, 4, 5, 6. So firm 1, firm 2, 3, 4, 5 and 6. Some Infosys is the client, firm 1 is the stat auditor. They are charging 1 crore audit fee, and this firm is also providing MCOS services. Maximum fees is how much? 1 crore. Now these other firms, these other firms are also providing MCOS services to Infosys. How much fees maximum they can charge? 3 times of the 1 crore means 3 crore. That's it. Able to understand? Which means the firm which is providing the services and other network firms collectively maximum how much? 4 times. Indirectly, nothing but. Are you clear? So for other firms of the network collectively, for all other firms of the network collectively, it shall be 3 times of the fee payable for carrying statutory audit of the same undertaking. Understood the example? Everyone. Next. Rotation of auditor. Rotation of auditor guidelines itself says incoming auditor, outgoing auditor shall not form part of the same network. Same point. Network may advertise the network to the extent permitted by advertisement guidelines. Whatever guidelines, advertisement guidelines applicable for the firms, same guidelines applicable for the networks also. Network cannot solicit, cannot issue circular, cannot advertise. Getting it? And you need to get the consult of the client. Suppose you're an audit firm, you're doing audit for a particular client, and you want to join in one network. You should get your client consult also. You should get all your clients consult, because you are now entering into a network. Until now, your identity is different. Now onwards, your identity is going to be different. So that's why you need to get a consent of the client. So the effect of registration of network with institute will be deemed public notice of the network, and therefore consult of the client will be deemed to be obtained. Of course, we have to specifically obtain. We have to specifically obtain from the clients. Getting it? And network firms can frame internal bylaws. They can frame all the bylaws, like who will be the managing committee for the network. So what is the membership fee, so that in order to become a part of the network, suppose if you opened a practice, you want to become KPMG network, you want to be part of KPMG, there will be some membership fee that you have to pay. Only if you pay that membership fee, KPMG will come and set up your entire office in that way. It is something like franchisee model. Network is exactly like what? Franchisee model. Some KFC nearby, whatever is there, some Domino's nearby, some Pizza Hut nearby. These are all franchisee models. Franchisee models means what? Need not be the same owner. Owner can be different, but the methodology, the product, the process, everything is uniform. Getting the point? Then logo guidelines we already discussed previously. As part of clause number 6, we already covered. Yes or no? Then guidelines for corporate form of practice, which is again important. So what is this corporate form of practice? The council decided to permit members in practice to hold managing director position, whole-time director position, manager for a body corporate. Provided, what is the condition? The body corporate is engaged exclusively in rendering management consultancy and other services, and provided they comply with all conditions specified by the council. So, the members can still retain full-time practice. No restriction on quantum of equity holding. You can have 90% shareholding in that company, no problem. The name of the management consulting company shall be approved by the institute, and that company has to be registered with the institute. So not only with the Companies Act, you should also register that particular company with the ICAI. No audit practice can be done in corporate form. Only individual and firms will have the permission to do practice. That's it. And ethical. This is associate company, so they are not permitted to accept prohibited service. So for a partnership firm, what is associate? This company is an associate. Ceiling on non-audit fee is applicable even for the company, management consulting company. Company shall not do solicitation because the firm is prohibited. The company is incorporated by the same partners, so they should not do solicitation. They shall give a declaration that it will comply with all the clauses. The the object clause of that company should be only management consultancy, other services. Can a CA open manufacturing company? No. Are you clear? So this itself can be asked as a question. Write about guidelines for corporate form of practice. A straight question can be asked. Which one? Yes. Yes, we should get permission, nothing but. See, we have to, the company itself should get the permission. Forget about CA getting permission. The company, you want to incorporate a company exclusively engaged in management consultancy. See, nowadays what many CA firms are doing is, CA firms, they not only provide audit and attestation, they also provide IT filing service, ROC filing service, administrative service, advisory services. Most of these other services, which are non-statutory, these services, they don't want to provide from their firm name. They want to provide through another firm, another organization. That other organization is company. So whenever your firm is filing or charging fees for GST return, they will bill in the name of the company. Have you seen this? So that is, the main purpose is separation. Our audit firm is only for attestation and audit functions, statutory functions, not for other services. All other services we will route through management consultancy and other services company. That's it. They can't. The company itself cannot provide prohibited service. And remaining are a bit easy, not so complicated. Now this is something noteworthy. Application based service provider aggregator concept. Suppose you have something called urban company, remember? Urban company. Yes or no? So it's a very popular, like where you can book for hair cutting, grooming, or even cleaning, household works. So many works you can book. Suppose if urban company decided innovatively and started CAs also. CAs can register. You can contact CA nearby like that. Can you register in that platform? You should not. That is prohibited. Registering in Gestdial is prohibited. But you open Gestdial, just to select CAs, you will get so much big list. Getting it? So much of big list you will get. But aggregator model, Gestdial is not an aggregator model. It is just an informative model. It is not aggregator model. Getting it? Then self-regulatory measures. These are just recommendatory measures. As much as possible, if a company is having branch accounts separately, you should recommend the company that please appoint separate branch auditor. That's a recommendation for the member. If a company is maintaining branch accounts separately, but the company have not appointed branch auditor, they appointed you for the entire company. In such a scenario, you should request the company to have a separate branch auditor. So that's a recommendation. Suppose if the accounting records of the branch are maintained at head office, this recommendation you need not follow. And in case of large companies, practice of associating a practicing firm with less than 5 members as a joint auditor should be encouraged. Like if a firm, like in case of large, what is large company? They have not defined. Nothing is defined. In case of large companies, what they are saying is simply, if your firm is a small firm having less than 5 partners, please encourage the company to appoint joint auditors. Ratio between qualified and unqualified staff in your audit firm. Getting it? Like every audit firm shall have 1 qualified chartered accountant for every 5 non-qualified members of the staff. Which means if you have 5 paid assistants, 1 CA should be there as your employee. Able to understand? Staff. By the way, here I think the staff may be in the form of partner or maybe employee. Doesn't matter. But 1:5 ratio, they should have a CA. Now, by the way, non-qualified member means what? Who are excluded? Articles are excluded. Typist, peon, or other person not engaged in professional work like maid, servant, janitor. These are all excluded. Getting it? Means normal paid assistants we will employ, right? Paid assistants, non-CAs. Non-CA paid assistants. Like if at all they're having 5, 1 CA must be there. That's a recommendatory. The self-regulatory measures are only recommendatory. These can also be tested in examination. The council has decided that it is a good and healthy practice. Auditors should make a disclosure of payments received by them for other services through a medium of different form or forms in which they may be a partner or proprietor. It is better to disclose information about another firm where you are already a common partner. And it is better to follow minimum scale of fee guidelines. ICI have given minimum fees to be charged for every service. For ITR 1, how much you have to charge? ITR 2, how much you have to charge? Tax audit, how much you have to charge? Corporate client tax audit, how much you have to charge? Non-corporate client tax audit, how much you have to charge? Trust audit, how much you have to charge? So they have given a rate card, minimum fees. But this is recommendatory to charge. Getting it? If at all every CA firm started charging like this, getting it? Most of the clients will make so much of nonsense. And for your information, one more thing I'm telling you, very soon, within down the line 3 to 4 years, private companies will lose statutory audit status. Most of the CA firms are dependent on this. Correct? I am giving, like I even spoke about this in 2019 itself. Like mostly, very soon, private companies will lose audit status. Stat audit is not compulsory for private company. See, the logic is very simple. Suppose me and my friend want to start a business. Some restaurant we want to start. We can directly start the restaurant activity, get GST registration and start paying tax and file income tax return as AOP. Correct? I can do like this, right? Without any registration. Is it compulsory that I must register under some prevailing law? No. Only thing is tax law registration is compulsory because my turnover is crossing so and so threshold limits. Why should I register under Partnership Act? That is not compulsory. LLP Act registration not compulsory. Companies Act registration is not compulsory. But somehow I met one auditor because of his fees requirement. Getting it? He compelled me to register a company. Telling me these are the advantages. After registration, he opened up and told me that audit is compulsory. After registration of the company, he told me that you have to maintain accounts. And I asked him, who will do all that? He is saying, I'm there for everything. Getting it? And because I registered my business under Companies Act, I have to maintain accounts. Because I registered my business under Companies Act, I have to go for audit. If at all I didn't register my business organization under Companies Act, I'm not liable for all this. Maybe I'm liable to prepare books of accounts as per income tax, and if I just get tax audited, that is enough. What is the use of private limited company audit? Tell me. You might have done audits of private companies, right? Who are the shareholders? One person will be there, his mother or his father. One person will be there, his brother and his brother's wife. Another person and his wife or his son or daughter. These are the members, no? And you have never seen any of them. Only one person only dealing with you every day. Remaining two, where are they? Hey, my son is studying in college. My grandfather retired and sleeping at home. Yes or no? And he's a shareholder. Only for namesake they are shareholders. Yes or no? In a private limited company, most of the private limited company, they are keeping just a number of shareholders. The number of shareholders is also suggested by his astrologer. Hey, 3 of you should be there. Business. They might have got some astrological advice. Yes or no? That is the only reason why they formed 3. Otherwise, your party private limited company shareholder. Correct? A party signature போடுறது சொன்னா signature வராது. ஏனா ஒண்ணு வராது. Getting it? So, ஆனா அவ shareholder இருக்க கம்பெனில why she is a shareholder in my company? Because the astrologer told my party hand is lucky hand. You seen that? Have you seen? So now then you ask him, you ask any private limited company shareholder, sir, who suggested you to incorporate the company? Hey, my CA suggested me. Why he suggested, sir? Should I tell you? He suggested the company to incorporate company because if you incorporate company, you require audit. Since you require audit, he will survive. That's the only reason. Tell me, apart from this, what is the advantage of company audit? Shareholders' interest is protected. What? Inga irukadhu ivanu iva amma iva party avalada. Yaar interest protect panno? Logical illa. 99% of the private limited companies that are there in India, the shareholders were close family members. Majority cases. And the only reason why they incorporated a company is because they approached CA to register their business. The client just approached me, sir, I want to start business. What should I do? Avalada. I made all the registrations for him. Getting it? No? That's how people are doing. Now see, whether they're paying tax or not, tax audit is there. Whether they are paying GST properly or not, GST special audits are going to be conducted, investigations are conducted. And whether, sir, you may say, sir, bank loans and all will get, no. Bank will do due diligence and all. Even you give signed audit report, signed balance sheet, P&L, bank will throw that away. It's only a secondary documentation for the bank. Primary documentation for the bank is your business transaction and your GST return. Based on that only he is giving loan. Now where your audit report is helping a private limited company to succeed? Literally not. This is the problem. In most of the developed countries, private enterprises are not liable for audit. Only in India it is liable for audit. Recently, 2021, NFRA announced these guidelines, saying for private companies it is proposed to remove auditor, and all the CS made so much of nonsense. Hearing all that, hey, audit removed, company, we are backbone. Enna backbone? Ethana backbone irukum or nation ku? Getting it? See, we must also slowly, see, like now you may temporarily boycott everything and somehow you succeed now. But tomorrow, government also can't do anything. See, if today investors has to come to India, they are worried a lot about the compliances here. If investors are coming to India, they start working in India. Without our knowledge, stat audit is a very minor income for auditors, I'm telling you. Only for small and medium-sized practitioners, stat audit income is higher. For all big level clients, for all big level firms especially, for all big firms and all, stat audit fee, audit and attestation fees is hardly 30% of the total turnover. Getting it? 70% is from value added services. Stat audit is purely a compliance service, understand? If in the organization public interest is involved, if it's a public company or listed company, there is a definitely importance for some review by an independent person. So audit is compulsory in case of listed company. But in case of unlisted, private limited companies whose operations are not wider, for them audit is not compulsory. So if not today, maybe today because of the pressure received from CS, the NFRA would have taken a back step. But after 5 years, even if NFRA do not take front step, investors will push the NFRA. Able to understand? Every notification released by government is because of a push created from the industry. Remember, even if you try to stop, you can't stop the industry. Are you clear? And one more thing, very important thing that every one of us should remember is, our role is only a supportive role. We are not creating business. We are only supporting them. Understand? Getting it? July 1st vandodne, nariya post varum Instagram ella. Yes or no? Proud to be CA, we are creating nation. Enna building nation. We are only praising ourselves. Outsiders should praise us, correct? Because nobody is praising, we are praising ourselves. Did any client came and told you, because of you only I am existing today? Any client? No. You only tell yourself, sir, we are, because of us only clients are able to earn. Exactly. Correct. So this is what happening everywhere. And these CS students, especially with hypocrisy, with superiority complex, see, even like very simple. Or eduthala proud to be CA student. Unnar eduthala van CA padikave padikadpa. Dual standards la. Correct, yes or no? In front of others you show off, hey, I am a CA student. Vile vandittu hey, nee CA padikadpa venappa. Yara unga thambi illa sister vandittu CA padikano, hey, vena. What? It's a double standard, no? Logically correct, It's human mindset at the end of the day. Okay? But you should accept for all the changes proposed by government. See, nobody want to suppress institute. First of all, understand. Institute of Accountants, IIA, even if it comes, our institute identity will not affect. It's a competitive world. Whether you agree or not, the changes will come. If not today, it will come tomorrow. I'm telling you, if it comes today, you can prepare better for tomorrow. If it comes for tomorrow, you can't prepare because by day after tomorrow, you will die. Getting it? That's what Jack Ma, he'll say one quotation. Okay, yesterday is beautiful, or yesterday is difficult. Today is even difficult. Tomorrow is wonderful, but most of the people die today. So there's some quotation like this. Getting it? So if at all a change is proposed, it is better to accept rather than opposing it. Fine. So with this, ethics is completed. Yeah. No, that's a similar quotation, but I'm talking about his speech. In one of the speech, no, he gives this, but most of the people will die today or yesterday. Something he will say. That's it. So with this, we have completed ethics chapter. So the next chapter we will start is corporate governance. Okay. Yes. So just one more point I left in CARO, that is CARO applicable on consolidated financial statements? The answer is no. But there is a 21st clause in the CARO which talks about, like, suppose we are taking one company. In that company, in the 21st clause, what auditor has to comment is, what are the qualifications or remarks in CARO reports of other companies along with this company which are going to be included in consolidated financial statements. So by looking, it's very simple. Suppose Tata Motors is one subsidiary company among many subsidiary companies to Tata Sons Private Limited. So no? There is a company called Tata Sons Private Limited. Tata Motors is one company among many companies where where consolidation, the Tata Motors will also be included. Now, as an auditor of Tata Motors, when I am giving CARO report in Tata Motors, in 21st clause of the audit report, CARO report, inside the Tata Motors, I should talk about what are all the other group companies where the auditors have given a remark or qualification in the CARO points. I should give entire list here. Getting it? You see here, but anyhow, I'll show you this example. So you see, this is actually annexure to the audit report. This is actually an annexure to the audit report. And this audit report is on consolidated financial statements. Actually, CARO do not apply on consolidated financial statements. CARO report will not apply on consolidated financials. But only one point in CARO has to be given in consolidated financials as per guidance note on CARO. So you see here, in our opinion, what are they saying? In our opinion, and according to the information given to us, following companies incorporated in India, which are included in consolidated financials, have unfavorable remarks, qualifications, adverse remarks given by respective auditors in their reports under CARO. So this actually Tata Motors consolidated, financial statements. In Tata Motors consolidated financials, there are many companies which are included. Example, like Tata, Marco Polo, Tata Passenger, Tata Motor Passenger Vehicle, Bravo Robotics, something, Automobile Corporation. These are the companies. May not be this. There may be many other also. But approximately, in the Tata Motors consolidated financials, there are some 15-20 companies might have been there. But out of that, 10 companies, respective auditors have given qualification under respective clauses in their CARO. Suppose if you open Tata Motors Limited standalone financial statements. The auditors in the CARO report on the standalone financial statements have qualified clause number 2B, have qualified clause number 3C, has qualified clause number 3D, 9D and 11A. These are the clauses which are qualified by the auditor in Tata Motors financial statements related CARO report. Able to understand? Like this, they need to give. Except this, on consolidated financials, CARO will not apply. Able to understand? But anyhow, when I'm discussing 21st clause, again, I will be showing this. Clear? Now, so what are the 21 clauses to be reported in CARO? First of all, I generally don't take crash batches. See, whenever I want to give revision, I'll give free revision on YouTube. Because when we give it free of cost, people will not complain. Even if at all it is not effective. Getting, even if I don't cover 100%, even if I don't cover at least 70-80%. So the reason why till date, I never sold a crash course or even fast track course also. I only sell regular course. I have only regular and have 1,000 students admissions till date. Getting it? I never sell crash course. The only reason is expectation will be same. Whether I sell fast track course or crash course or full course, the student will expect same 100% in depth. Getting it? If I start selling fast track course, what will happen? Simply the student will go and say he is not covering full syllabus. And the primary fact that he got a fast track course itself, that fact he'll forget. Getting it? So even now I'm very hesitant. I'm recording, but I'm not sure whether I will open it for sales or not. I'll just keep it. So I'll take a decision after 3-4 days. Getting it? But the reason why I'm hesitant to sell is because I don't want to disturb my feedback which I have. Whoever buys my full course, they watch in depth. Like whatever, see, until now audit report, this point is, this particular 21 clauses we will be discussing somewhere in 18th or 19th hour in audit report chapter. So imagine the length of discussion that takes place in a regular session. So when that kind of knowledge is given to the student, obviously no point of negative feedback. No point of negative. So obviously 100% syllabus coverage means obviously 100% syllabus coverage will be done for sure. But in fast track and crash courses, it is impossible because of the timelines, whatever. So that is one reason why I don't generally take. Anyhow, I just want to share. Next, so fixed assets. Now in CARO, how to remember all the 21 clauses, mnemonic codes, cheat codes. Especially when I see for CARO, I feel very furious. Who will ask in exam? Who will ask in exam? Hey, give me list of 21 points in CARO. Is there any question? Have you seen that? No. But outside, because they don't have anything to tell, they tell all the stupid stuff. Getting it? What is asked in exam is, last time in CA final, which question was asked? In CA final, they asked on this point. They asked on this point. And that too, they asked a practical question. They asked a practical question on this point. What is the reporting requirement related to working capital loans? They gave an illustration. What is your reporting requirement in CARO? That is a question they asked. They don't ask you, tell me clause number 7 what? Getting it? Maybe some people, like whoever examiner, whoever is paper setter is there, unless he is of unsound mind, he will test clause numbers. Why should we test clause numbers? Tell me. Yes or no? Is there any point of testing clause number? Hey, tell me clause number 6 is what? Cost records. Intelligent. Yeah, I know. That's why I'm telling you. Those people are unsound minds. Getting a lunatic or unsound mind, contract law. I don't know why they test. That kind of stupid question, why they test, I don't know. Getting it? In reality, when auditor is preparing CARO report, what he needs is understanding of the reporting requirement. And accordingly, he needs to report the fact. It's not the clause number which is important. But some people test that also. I'll show you when I'm discussing, as I'm proceeding further, what kind of stupid questions they are making. In MCQs or even in main examination also, what kind of stupid questions. But the percentage of these stupid questions will be very less. You don't expect too many also. And further, one more instruction I forgot to give. Don't buy outside true or false questions or MCQ booklets. Don't follow anything except ICA book. Only ICA MCQ booklet, please follow. If at all you are solving ICA booklet properly on your own, without looking at the answer and then interpreting. First interpret and then look at the answer. If at all you are able to solve ICA MCQ booklet properly, which means you are having enormous grip on audit. If at all you are unable to solve ICA booklet properly, means you don't have grip on audit. Are you getting my point? Especially the initial 115 or 120 MCQs were given, standard MCQs, normal MCQs. So that itself you will feel a lot of difficulty. Then coming to case-based MCQs, you feel even more difficulty level. Getting it? Outside MCQs and all, they will ask you, they will be giving you this kind of line. They'll be giving you, they'll give you this sentence and put blanks here. And ask those kind of stupid questions. But that is not how ICA is testing in reality. You just look at MTP, the MCQ quality, see how the quality of MCQ. And outside MCQ booklets, people are selling, no, you see that quality. Auditor will obtain which evidence? Persuasive or conclusive? Obviously persuasive. Getting it? This kind of stupid MCQs were there. They are of no standard. Like that, you solve 2000, 3000 MCQs also, no use. Standard MCQs if you have to solve, that is when your skill set will enhance. That is when your thinking ability will enhance. Getting it? Now, so what is the reporting requirement in relation to fixed assets? There are 5 aspects the auditor has to talk in fixed assets. There are totally 5 aspects. 1, he need to talk about fixed asset register. He need to talk about physical verification. He need to report about immovable property. He need to report about revaluation. He need to report about Binami transactions. These are the 5 issues which auditor has to report related to fixed assets. See, side headings and all given for convenience. Original CARO notification do not have any side heading. Getting it? Now, what auditor has to talk in fixed assets? Whether the company is maintaining proper records showing full particulars including quantity and situation. So very simple here, what they are asking is the company maintaining fixed asset register properly? Fixed asset register will be there. Every company should have fixed asset register. Every asset will have some identification number. Getting it? Every asset will be given some numbering. In big organizations and all, the assets are enormous. So many assets will be there. Thousands of assets will be there. So there must be some control on that. So they have a record of number of assets. So how many ACs were there, where they were installed, on which date it was installed, what is the purchase price, what is the GST paid in that, what is the depreciable amount, how much is the accumulated depreciation, entire that information will be available in fixed asset register. And they're asking you, did the company maintain the fixed asset register? You need to tell to the shareholder whether the company maintained records of fixed asset register or not, which will contain quantity and location details. Next. Then they're asking you whether these fixed assets were physically verified by management. Is the management of the company verifying these fixed assets at reasonable interval? They're asking you. Getting it? You need to check. See, in Tata Motors, once in 3 years they'll verify fixed assets. It is not once in 3 years. Actually speaking, in big companies, fixed assets verification process is a continuous process. In a big companies, every day you go, every working day, somewhere in the location, physical verification activity is going on. Somewhere. You take Infosys, TCS, Tata Motors, Reliance Industries. For them to verify entire fixed assets once, it will take 3 years. It will take how many years? 3 years. And there will be a team of approximately 30-40 people whose job is only verifying fixed assets. And this team is nothing but internal auditors. These are actually what? Internal auditors. See, in a company, internal audit department will be very big. They may be having 150-200 staff members. In a big companies, 150 to 200 staff members might be there. Out of them, some 20 people might be for fixed assets verification. Some 10 people will be continuously checking stock. Some 10 people will be checking continuously purchases. Some 10 will be employed in sales. Some 10 will be employed in some GST workings. Some 10 will be employed on TDS. So likewise, entire internal auditors department staff, they will delegate the work and then do it. Able to understand? Again, the internal auditors in a company, they were not completely employees. Some of them are employees. Some works company will give outsourcing to audit firms, practicing CA firms. Able to understand. So, internal auditors are there who are part of the management, who continuously do fixed assets verification throughout a year. Likewise, Tata Motors auditors or Tata Motors management, getting it? They have taken 3 years to verify fixed assets. And according to the size of the company, having regard to the nature of the business, looking at the internal controls, the 3 years once verification is absolutely reasonable. Are you getting it? If it's a very small company, once in a year is reasonable, at least. If it's a very big company, once in 3 years, once in 5 years is also reasonable. Getting it? So whether fixed assets have been physically verified by the management, whether any material discrepancy noticed, and how they were dealt in the books of accounts. Suppose you ask management, see physical verification records. Ask them whether are there any material differences identified. Material difference means what? Excess assets identified which are not accounted. Or assets, whatever is there in the books of accounts but not there in the reality, shortage. So, if at all any excess assets are identified or shortage is identified, how the management is dealing them in the books of accounts, you need to verify. And you just have to comment here, there were no, you see how Tata Motors have commented. How Tata Motors have commented. So under report on legal and regulatory requirements, CARO report is coming. Yes or no? But if at all entire 21 clauses, if they put here, it will become bulky. So what they did, instead of giving here, they gave it as a annexure. Remember, in exam, additional sheet also equal to main sheet. Yes or no? Same way here also. Annexure is not a separate report. Annexure is part of the report. So you see what automotives have commented. The company has maintained proper records. The company has maintained proper records showing full particulars of intangible and full particulars of PPE. And according to the information explanation given to us, the company has a regular program of physical verification over a period of 3 years. In accordance with the program, PPE were verified during the year, certain PPE. So every year, some portion of assets they will verify physically. In our opinion, this periodicity, having regard to the size of the company and nature of the assets, is reasonable. They are saying reasonable and no material discrepancies. So which is a positive comment. Getting it? Next. So that is regarding physical verification. Next. Immovable property. What are they asking? Whether title of the immovable property is held in the name of the company. The company is having immovable properties. In the fixed assets, they are showing land, factory, building, so and so, all that. Are these immovable properties, are they in the name of the company or in somebody else's name? If at all they are not in the name of the company, what is the property, factory, gross carrying value, so much, held in the name of director? Why it is not held in the name of the company? You need to clearly mention. Getting it? Because you are showing it as a fixed asset, but it is not in the name of the company. Generally here, which assets will come, leased assets information might come. Leased assets information might come here. Next. That too, suppose if the lease agreement, which is financial lease and the lease agreement is in the name of the company, again no need to report. Able to understand. Next. Now, they are asking revaluation point. Whether the company has revalued property, plant and equipment or intangible assets during the year. During the year, is there any revaluation happened? They are asking. If so, who has done the revaluation? Is it by a registered valuer? You need to check. Is it by a registered valuer? You need to check. So, like I think there is a course, NISM registered valuer course is there. CS and all are doing. Getting it? So you get a valuation or registered valuer license. So then onwards you are eligible to do valuations for various reasons. Getting it? So if a company did valuation, any revaluation of property, plant and equipment or intangible assets, the CARO is asking the auditor, dear Mr. Auditor, please check who did this revaluation. Is it done by a registered valuer? Check it out. And specify amount of change. How much is the percentage of change? If the change is 10% or more in aggregate of net carrying value of each class of property, plant and equipment. 10% or more in the aggregate of net carrying value of each class of PPE. So what do you mean by that? Suppose I have this balance sheet. This is last year figure and current year figure. Now I have fixed assets, inside the tangible assets, inside the plant and machinery. Getting it? Now inside this plant and machinery, gross plant and machinery 500, last year 400. Gross plant and machinery last year depreciation 50, last year 40. So here it is until now 450 and here it is 360. Now company has done some plus or minus revaluation. Some company has done plus or minus revaluation. Last year no revaluation 360 and now current year there is a revaluation done by the company some 50. Getting it? So again total it is coming to 400. Getting it? Total it is coming to 400. Now what is net carrying value? This is the net carrying value. What is this? Net carrying value means what? This. For plant and machinery this is net carrying value. Able to understand? Now in the net carrying value, if the change is 10% or more after revaluation, look at the net carrying value before revaluation, after revaluation. Actually, I told you here last year, current year, actually it is before revaluation, after revaluation. Let us take before revaluation, after revaluation. Take before revaluation figures, take after revaluation figures. And identify net carrying value before revaluation, identify net carrying value after revaluation. If the difference is, it may be 10% increase or 10% decrease, whatever it might be. If the difference is more than 10%, auditor has to mention what is the amount of the change. What is the amount of the change? During the year, so and so plant and machinery, 45 crore is the amount of the change. Within bracket, more than 10% change in net carrying value of the plant and machinery. Check for electrical fitting, check for buildings, check for other assets also. Net carrying value of each class of property. Each class means what? Plant and machinery is one class. Immovable property is another class. Electrical fittings is another class. Able to understand? Next. Now, next, another reporting requirement relating to fixed assets. Auditor has to report whether any proceedings are initiated or pending against the company for any Benami property held under Benami Transactions Act. So there is an act called Benami Transactions Act. You might have covered this in other laws like economic laws. Getting it? So as per that law, if any proceeding is initiated on the company you're doing audit, or any proceeding is initiated but still pending on the company, you just have to give details of the same. If so, whether the company disclosed the details in the financial statements, whenever Benami proceedings are initiated against the company, as per Benami transactions law, in the financial statements of the company, they need to disclose some information. Able to understand? All of you. So whenever a company was taken up a case, whenever the company was selected under Benami Transactions Act for a particular case, the company has to voluntarily shall disclose entire these details in the financial statement notes to account. And you auditor have to report in CARO what? Did the company disclose or not? Did the company disclosed or not? Able to understand? So this is the reporting requirement for CARO for fixed assets. They may ask you this entire question. Write about reporting requirement for fixed assets under CARO 2020. They may ask you a 6 marks question. Getting it? Or they may ask you, write about reporting requirement in respect of physical verification and immovable property related to fixed assets under CARO. They may ask you only these two and ask you for 4 marks. Able to understand? Anyway, the question can be framed. Are you clear? So if you remember main headings and ignore this main content, there is no point. So what is important is the inside content, not the outside content. Clear? Next, inventory. So what auditor has to talk about in inventory? Same again, physical verification. Whether physical verification of inventory has been conducted at reasonable interval by the management. For inventory, what is reasonable interval is maximum 1 year. So for fixed assets, it may be more than 1 year, because in fixed assets there will not be any movement. But for inventory, it is continuously movement will be there. So for inventory, at least once in a year, physical verification is compulsory. Auditor has to check whether management has done physical verification at reasonable interval. What is reasonable interval? Guidance note also says at least once in a year. If it's a very big company, at least once in a year it must be done. Clear? Next. And if any discrepancy of 10% or more for each class of inventory were noticed, whether they were properly dealt in the books of accounts. So for each class of inventory, raw material is one class of inventory. Work in progress is another class of inventory. Finished good is another class of inventory. Able to understand? These are the three clauses. So for these 3 classes of inventories, if there is a change of more than 10%, if material discrepancy is identified for more than 10%, see, in fixed assets they use the word material discrepancy, whereas in inventory they didn't use the word material discrepancy. They straight away said 10% or more discrepancy. They quantified here clearly. Whereas in fixed assets they just mentioned material discrepancy, whereas here they quantified. Able to understand? They may ask you as an MCQ this also. Which of the following statement is correct? The auditor has to qualify if auditor has identified any material discrepancy in aggregate for each class of inventory noticed or reported during the year. If so, how they were dealt in the books of accounts? Option A. Option B. The auditor has to qualify if auditor identified discrepancies of 5% or more. Option C. If auditor identified discrepancies of 15% or more in overall aggregate inventory, they'll put. Option D. Then correct option they'll give. 10% or more in each class of inventory. In one option, each class they may use. In another option, aggregate inventory they'll use. In another option, they will not use 10%, they will use material discrepancy. In another option, they'll give you entire this as it is provision. Only if you observe what exactly the provision is, you can pick out the correct answer. Clear? Next. Now working capital loan. This is what tested as 5 marks question in the last attempt, May 22 attempt. Whether during any point of time, the company has been sanctioned working capital limits in excess of 5 crore rupees. In excess of 5 crore rupees in aggregate from all the banks, all the financial institutions on the basis of security of current assets. So the company showed current assets, hypothecation, got working capital loan, maybe overdraft facility or cash credit facility, anything might be, but some working capital limit was sanctioned to the company. Now, whether the quarterly returns, quarterly statements filed by the company with those banks and institutions are in agreement with books of accounts of the company, if not, give details. Like what many companies do, They have actual stock. See, generally there is something called sanction limit and drawing power. There is something called sanction limit and drawing power. Suppose you are sanctioned with 5 crore limit. Here you see, if the sanction limit only they are asking. If the sanctioned limit itself is more than 5 crore, this reporting requirement applies. Drawing power need not be 5 crore. Drawing power may be less than 5 crore. What is sanction limit? What is drawing power? Sanctioned limit means based on your repayment capacity, I will sanction this much loan. But how much you will withdraw? It depends upon how much value of security you are giving me. Able to understand? Suppose I sanctioned a particular company 10 crore limit. I sanctioned a particular company, how much limit? 10 crore limit. But they sent me 6 crore worth of stock value statement. They sent me a stock statement, stock audit report, where the stock audit report certified how much stock value? 6 crore only. But I cannot give entire 6 crore disbursement. I cannot disburse entire 6 crores. I will give margin, 20-30% margin I'll give. I will reduce some 20%. I will give only 5 crore DP, drawing power. Means what? Though you are sanctioned with a 10 crore limit, you can withdraw maximum how much? 5 crore. Now you sent me a stock statement, right? In that how much is there in the stock statement? 6 crore is there in your godown. That is what people also certified. But on so and so date, the statement you sent, right? As per your books of accounts shows only 4 crore stock. For the purpose of getting higher drawing power, your company sent a wrong stock statement mentioning 6 crores. Stock value is overstated in the statement filed with the bank. Whereas in the books of accounts reality, the stock value is only 4 crore. The company, in order to get higher drawing power, overstated. And many auditors are supporting this. Getting it? When you are giving stock audit certificate, stock certificate, what you need to do? You need to check books of accounts. You need to check books of accounts. You need to look at the value correctly. You need to look at the stock records. You need to casually inspect, surprisingly, that particular stock. Finally give stock value certificate. Very recently, for one of the company for which one of my friends signed 6 years back, stock certificate. Very recently, he was called for CBI inquiry. Very recently. Nothing happened. They just called 4 questions they asked, because the person, whoever is sitting other side, whoever is asking, the CBI inspector, whoever is there, he doesn't know accounts much. That's the advantage of this fellow. So this fellow could easily escape. Getting it? So he certified a fake stock statement. Now you are not, now you are caught in CARO. If you certify fake stock statements and all, auditors have to report. Stat auditors have to check. See, stat auditor may not be the person who certified this. Some CA certified, you certified. Suppose I am the auditor of Tata Motors. See what I discovered. In Tata Motors, what we discovered, you see. You see how many differences we discovered. According to the information expression given to us on the basis of examination of the records, the company has been sanctioned with more than 5 crore in aggregate from all banks. Working capital limit sanctioned is more than 5 crore. See, means this clause is applicable. Now, what are they saying? In our opinion, the quarterly returns statements filed by the company with the banks are in agreement with the books of accounts positive, except statement for the quarter ended June 30, 30th September, 31st December with the State Bank of India, Bank of America, Citi Bank, HDFC Bank, ICICI Bank, Standard Chartered Bank, Union Bank, Kotak Mahindra Bank, Bank of Baroda, where differences were noted. How much differences? 689 crore, 490 crore, 758 crore, 30, so some different amounts. Okay, the overdraft, they have given different amount. Different in case of debtors, these are the differences. In case of stock, these are the differences. 44 crore, 38 crore. See, actually, they said everything is true. And the exceptions, all the banks they listed in India. Clever, actually what they should tell? The stock statements were not in agreement with the books of accounts. That is actual statement should be. But company would have, back end what happened, I can imagine now. Getting it? So company and auditor would have sat together. Okay, what you want, tell me. Okay, this fellow would have requested only one thing. Next year also I should be the auditor. Next term also, I will tell my friend, okay, we appoint him. Okay, that might have been the quid pro quo here. Getting it? See, auditors really don't take any bribe. Logically speaking, they want the worker, they want the client to be retained for long term. So that itself is enough. In the fees, they'll get most, as much as possible. Getting it? So, see, almost they listed all the banks and they listed all the quarters. And you see at the end of the statement, and all these were subsequently rectified by 31st March statement. After 31st March, they rectified all the statements and sent revised statements to banks. So that's why they covered only 3 quarters here. 30 June, 30 September, 31st December. So clever, la? See, now onwards you are caught. Everywhere auditors are locked up. Getting it? If at all on this, if tomorrow Tata Motors something went wrong, if at all default was there, if at all CBI inquiry officer was appointed, if at all that fellow is also chartered accountant previously, if at all he understands this CARO point in depth, this fellow will screw the chartered accountant like anything. Obviously, correct? Because how can you give these many banks under exceptions? Almost they listed all the banks in India. Correct? So this question only was asked in exam. In the recent exam, they gave stock statements, debtors statements, as per books, as per a stock statement submitted with bank. So what is the reporting requirement here? So they asked this question for 5 marks. Clear, everyone? All of you. Next. So working capital limits, that point also understood. Everyone, are you clear? So what you need to write in exam now in the last paper? First you need to write this provision. You need to write this provision. Then in the given case, stock statement filed for quarter 1, quarter 2, quarter 3. These were the differences identified. The differences, the above differences shall be reported by auditor in the CARO report. That's all you have to write. Get all of you. Next. Investment guarantee security loans or advances. Here it is very simple. If the company has given any loans or advances, remember this point is only talking about loans and advances, investment security given. Getting it? Not taken by the company. How much is the aggregate amount given to related party? How much is balance outstanding at the balance sheet date? How much is the aggregate amount given to unrelated party? Actually, they don't use the word related party. I use the side heading for comfortable purpose. Like subsidiaries, joint ventures and associates. How much loans were given to subsidiary, associate, joint venture during the year? What is the outstanding amount as at 31st March? During the year, how much is given and what is the total outstanding as on 31st March? To which company is subsidiary, associate, joint venture? And to others, how much? You see, auditors have given clearly information here, Tata Motors auditors. So, like loans, how much were given? Advances in the nature of loan, how much is given? Advance in the nature of loan. Like what is advance in the nature of loan might be, what might be advance in the nature of loan is, suppose you see here in Tata Motors like they have some like advance in the nature of loan means, suppose I gave some advance to a supplier or I gave some advance to my subsidiary company, but I'm not able to recover it for long period. Naturally that advance turns into loan. Able to understand? So long-term advances generally were called as advance in the nature of loan. So that reporting is clearly mentioned. Here they clearly mentioned. So how much is given to subsidiaries, how much is given loans, and to employees. Others means what? Employees, suppliers, all other comes under others. And what is the balance outstanding? What is the aggregate amount during the year? What is the balance outstanding as a balance sheet date? For subsidiaries, associate, joint venture, for others. So they are giving breakup, yes or no? Clearly. So the same point only they were asking in books. Then auditor has to check. What are the terms and conditions for grant of loans and advances? Are they prejudicial? What are the terms and conditions based on which these loans and advances are given? If the terms and conditions are as per the company articles of association, company powers, board of directors powers, within their powers only they give, then it is not prejudicial, not unfavorable. If at all, the company has given board of directors some power, like the company told, as per the company policy, whenever they are giving a loan, they need to charge a 12% per annum rate of interest. But we gave to one subsidiary company a loan where we are charging 5% rate of interest. This is not prejudicial for the company. This is prejudicial for the company. This is harmful for the company, unfavorable for the company because they are giving loan against a company policy. Able to understand? Now auditor has to check whether these loans and advances given by the company, are they repaid regularly? It may be interest, it may be principal, or it may be both. As per the terms and conditions of the loan agreement, are they repaid regularly? Regularly means what? Within due date. Regularly means what? Within due date. Now, if at all, if any outstanding loan is more than 90 days overdue, what recovery steps company has taken? What recovery steps company has taken, auditor has to talk. Now you see regarding that, I will come to that later. Rescheduling demand loans, okay. First I will show you reporting requirement here. According to the information explanation given, the terms and conditions prima facie not prejudicial to the company. Further, the company has not provided guarantees or advances in the nature of loan. That's okay. According to information explanation, in our opinion, repayment of principal and payment of interest has been mentioned in the agreement and the receipts have been regular, except in case of two wholly owned subsidiaries outside India. There are two foreign subsidiaries, except, for them, where cumulative amount is 613 crore, interest amount is 144 crore, which was due for repayment in earlier years, has not been collected even as on 31st March, since management believes that these amounts are not recoverable as these subsidiaries are in losses and the amount have been provided for in the financial statement. So they already created provisions. So some company has given some loan to foreign subsidiary, 613 crore principal amount, 140 crore interest amount. These were not recovered even as on 31st March, and the company believes that these are not at all recoverable, and company has already created a provision. The company has converted loans given to other subsidiaries into investments for an amount of 107 crore. How much of the amount given to subsidiaries is converted as investment? Investment means what? I gave a loan to subsidiary and the subsidiary is unable to repay. They issued equity shares to me. Able to understand? So that's called conversion into investment. That's it. So they are giving complete. So through CARO point today, auditors are talking indirectly. The auditors are talking about all these points, regularly repaid or not. If not repaid, you need to give details thereof. Next, whether any loan or advance in the nature of loans granted which has fallen due, has been renewed, has been extended, or fresh loans were granted to settle overdues of existing loan. Suppose company has given some loans, right? Is these loan agreements renewed again? Or do we give any extension for the due date? Or do we give any fresh loan to repay the existing loan? This is also called as takeout finance. This is also called as what? Takeout finance. Actually takeout finance is between two different banks, it will happen. But here also, suppose a customer has to pay me so much of loan. He is unable to pay. I'll give him another loan. I'll tell him to pay existing loan so that his account will not become NPA. Able to understand? Like this, company can do replacement financing. So any such incident happened or not, they're asking you. First of all, understand these points and all, we are applying for a non-banking company. Understand? For a banking company, CARO do not apply. A non-banking company generally cannot give loans and advances. If at all they are giving loans and advances for more than 50% of the total assets, it becomes NBFC. For NBFC, giving loans and advances is a regular activity, operating activity. For a normal company, manufacturing, Tata Motors is a manufacturing sector, industry, which is manufacturing cars. For them, giving loans is not an operating activity. It might be a financing activity or investment activity. Correct? For Tata Motors, giving loan is what? Is it an operating activity? It's not in the business. It's not their business. So it might be an investment activity or it might be a financing activity. So when they are giving loans, they should recover. There also, if at all they are having defaults, it will be danger for the company. Something company is not supposed to do, they are doing because of a special permission given under Companies Act. Correct? Able to recollect with law and all. In law also, you have this concept of intercorporate loans and advances. Which companies are permitted? How much they are permitted for? Board of directors, how much they can give? All that powers and all you might have seen. Yes or no? 180. 185, 186 conditions. Yeah, that's what in the next section also it is there. In the next one also, 185, 186 also you need to verify. The next point is saying indirectly, whenever the company has given loans, advances, investments, guarantees, check 185, 186 criteria. Actually, in this point itself, they can merge this condition, they can merge this clause, but they gave it as a fourth clause. Able to understand? So, suppose if the company has given any loans and advances during the year, are they renewed? Are they extended? Are any fresh loans were given? If so, how much is the aggregate amount of such dues? How much of the total loans out of the total outstanding as on the balance sheet date, how much of them were renewed, were extended, were settled by fresh loan? What is the percentage of the aggregate to the total loans and advances? So renewed plus extended plus settled loans, like fresh loans, to settle old loans. So total it up, divided by total loans outstanding. You will get some percentage. That percentage you have to specify. So out of the total outstanding item, example, Tata Motors is having, let us assume 1000 crores loans and advances given. Out of 1000 crore, 25% were renewed loans, extended loans, replacement finance. Able to understand? So this indirectly rescheduled extension of overdue, it is something like a doubtful. To whom we renew a loan, to whom we extend credit period, to whom we will give replacement finance, those who already defaulted. Getting it? So this clause is indirectly giving information about prospective defaulters. Correct? Next. Same way, if the company has given demand loan without repayment period, that information also the auditor has to. Generally, companies don't give any demand loans. Companies don't give any demand loans. Whether company has granted any loans and advances in the nature of loans, either repayable on demand or not mentioning any terms of repayment. If at all the company has granted loan where there is no repayment clause, or if the company has given a loan with a condition that whenever the company wants, the other party has to repay, that's called demand loan. Are you getting it? In banking terminology, it is called as money at call at short notice. Money at call and short notice. That is permitted only for banks generally. For normal companies, it is not permitted. Actually, there is no explicit condition that it is not permitted. But some companies are engaging in demand loans concept. If the company has given any demand loans, what are they asking? What is the total amount given under demand loans? What is the percentage to the total loans? During the year, 5% of the total loan is given as demand loan. And what is the aggregate amount of loan granted to promoters related parties? So in this, how much of the demand loan is given to promoter related parties? All that amount also you have to give separately. So totally 5% of the total loans were demand loans. Out of them, some 1% belongs to promoters and related parties. You need to specifically mention. Of course, Tata Motors have not given any demand loans. Clear everyone? Next. Deposits point is very simple. Cost records point is very simple. I'm not discussing. Statutory dues. Clear? Only important clauses I will discuss. Next, statutory dues. So what auditor has to comment here? First of all, statutory dues have been divided broadly into two parts. The statutory dues have been broadly divided into two parts. Undisputed statutory dues, disputed statutory dues. So what auditor has to give? Disputed dues means what? Very simple. If at all the company has received a notice of demand. What? Notice of demand. Not intimation. I'm not talking about intimation. I'm talking about notice of demand. If the company received a notice of demand of tax or duty from any statutory authority, that this company has to pay some tax or duty, and the company did not agree for it, the company went for next appeal. The company went for appeal against this notice. Now there is a due under dispute. Now there is a due demanded by the statutory authority, but the company disputed that particular due that they don't need to pay, and that dues are called as what? Disputed statutory dues. Now what auditor has to give? Auditor has to give information about forum where the dispute pending, amount, how much under the dispute it is pending. So where the dispute is pending, how much amount is involved in the dispute. But voluntarily, in all the cases, auditors give what is the nature of the due, what is the act under which it is due, what is the period to which it belongs to. Suppose nature of the due, income tax act, period, assessment year 1920, forum, income tax appellate tribunal, amount 10 crore. So auditors voluntarily give so much of information. But as per the CARO statement, only 2 points you have to give. Where the dispute is pending, how much amount is involved. That's it. But we will give for better interpretation, period, to which period it belongs to, under which act it belongs to, which due exactly. See, under income tax act, it may be your tax, income tax due, or it may be TDS due. TDS due is different. Income tax due is different. Understand? Income tax is your personal obligation. TDS is others responsibility, but you are only acting as a mediator. Correct? Next. So, in case the due have not been deposited on account of any dispute, the auditor shall indicate what is the amount involved in the dispute, forum where the dispute is pending. So here, what CARO, what auditors of Tata Motors are discussing here, you see here. So what is the due? Income tax 2 crore, assessment years belonging to these, 92 crores belonging to these, 59 crore belonging to these. So this 2 crore is pending at High Court, something is pending at ITAT, something is pending at CIT. Same way, excise duty is pending at 3 forums. Service tax is pending at few forums. Sales tax is pending at 5 approximately 4 levels. Customs is pending, GST is pending. Able to understand? These are all pending disputed dues. These are all pending disputed dues. And now here they gave a statement. A mere representation to the department will not be constituting as a dispute. Just because you are going to a department and representing for an intimation or for some assessment proceeding, that is not a dispute. There must be a demand order. There must be a demand order, and you disagreed with that order and filed an appeal to that in the higher level of authority. Able to understand? Then only it is called as disputed due. Clear, everyone? Then undisputed, which is not a disputed due, is called as undisputed. Remember, across the world, tax laws are voluntary compliance. Most of the tax laws we do voluntarily comply with them. Example, GST, we will pay every month by 20 voluntarily. Yes or no? Most of the companies, whatever you have done audit, they would have paid voluntarily by next month 20. Current month, whatever GST collected, they do workings next month, file GSTR 1 by 10th or 11th, and file GSTR 3B by 20. Before that, they'll pay tax voluntarily. Yes or no? Voluntary payments, whatever company is making, all of them are what? Is it because of dispute you are paying or voluntarily? Voluntarily. Undisputed dues are nothing but voluntary taxes and duties that you are liable to pay under all the laws and regulations. Able to understand? All of you. Now, what auditor has to comment about undisputed due? And for your information, statutory due means what? It is only talking about taxes, duties, or any statutory liabilities. Any statutory liabilities. Statutory liability means what? That is something you have to pay to some legal authority because of a compulsion under law. Because there is a compulsion under law. Example, see, income tax, service tax, all that you can easily understand, it's a statutory due. But provident fund is also statutory due. ESI is also statutory due. Profession tax is also statutory due. Property taxes, municipal taxes, all of them will fall under statutory dues. And in addition to that, income tax, GST, earlier we have sales tax, VAT, CST, and customs, all that, excise, everything. Able to understand? Now here what auditor? Is the company regular in depositing undisputed statutory dues? The question is the company regular in depositing undisputed statutory dues? If the company is regular, they're regularly depositing all the statutory dues, you say that they're regular. Regular means what? Within due date. Within due date. When you are preparing CARO report, you might have filtered the data where and all the company has paid after due date. Only after due date list you are giving in CARO. Have you did this working? Next. If not, suppose if the company is not regular, what is the arrears of outstanding statutory due which is still outstanding as on last day, and it is outstanding already for more than 6 months. As on 31st March, it is outstanding. It is not March liability. It is already liable 6 months ago. Still it is liable as on 31st March. What is that arrear? You need to specify the amount. Please indicate that amount by the auditor. Here also you are giving one information, not opinion. Here also you are giving information, not opinion. Able to understand? All of you. Next, here there is a question in central sales tax. There is a question which was asked in central sales tax. Is electricity a statutory due? No, electricity is a consumer good. It's called as goods. Energy, Central Sales Tax Act defines energy is a good. You can touch and feel, yes or no? Getting it? So electricity is something which is movable from one place to another place. You can store it. All the features of goods were there for electricity. Electricity is not a statutory due. It's a commodity. You are using it and then paying it. By the way, you will pay electricity to government. You will pay to Power Distribution Corporation Limited. You will pay to a company. The company will give you connection. They will distribute. See, electricity generation company will be there. Electricity distribution company will be there. Distribution company will buy electricity from generation company. Coal India Limited is an electricity generation company. Tamil Nadu Power Distribution Corporation Limited, TNPDCL, something you might have seen on the electricity bill. That's a distribution company. They will buy the electricity and then distribute the electricity, sell at a particular price fixed by the government. The price fixation is only by government, but government is not the one who is dealing with the electricity. Understand? Everyone. Next. This is regarding discovery of undisclosed income. Discovery of undisclosed income. This is newly added in CARO. Getting it? 2020 CARO, it is newly added. Whether any transaction not recorded in books have been surrendered, disclosed as income during the year. If so, whether previously unrecorded income has been properly recorded. So nothing but during the year, some income tax search or seizure, some operation was carried out, some undisclosed income is discovered. Now, when undisclosed income means what? In the previous years, some income was earned by the company, but not disclosed in the financial statements, not disclosed in the IT returns. Now it is discovered. Now tell me, it's a prior period item, no? Any error or omission, because of omission or error, if any item is not accounted in the earlier year but discovered now, what we will record it as? How we will record it as? We should record it as prior period. They are indirectly asking whether the previously unrecorded income, is it recorded in the books of accounts during the current year? So I am giving a note that it may be treated as prior period item. So they are simply asking, okay, during the year income tax raid happened, some amount discovered. See, it's an undisclosed income, right? Now it is disclosed, right? Last time it was not accounted, right? Did the company accounted it in current year at least? So they are asking. Are you clear? Next. Just 1 minute. Okay. Just I'll take voice just 1 minute, okay? 2 minutes I'll take, okay? Next. So default in repayment of dues. So what auditor has to comment here? First, auditor has to give a list of default. Details related to default lender wise. Lender wise information auditor has to give. By the way, default in due means what? For the company it is due. Means it's a loan. It's a loan taken by the company. Whether the company has defaulted in repayment of borrowings to a financial institution, bank, debenture holders or even government. So if the company has taken any loan from government, example, Air India has taken so much of loan from government. Getting it? Or if the company has taken any amount from debenture holders, if the company has taken any loan or advance from bank or financial institution, did the company defaulted in repayment of that borrowing? That is the first question. If so, yes, the company defaulted. For how long it is defaulted, how much is defaulted, lender wise you need to give the following details. Nature of the borrowing, working capital limit, name of the lender, ICICI bank, amount not paid, 10 crore, whether interest or principal or both, it's an EMI. Delay number of days, 35 days as on balance sheet date. Getting it? Remarks, company agreed to pay on so and so date and even acknowledgement has been obtained from the bank regarding extension period. Able to understand? So that details auditor has to give. In Tata Motors, no defaults were there. Now, whether the company is declared as a willful defaulter by any bank or financial institution, when a company is declared as willful defaulter, if they have reserves, cash reserves, still they didn't pay. So that is one of the primary criteria for declaring a defaulter as a willful defaulter. In spite you are having money, you did not pay EMI properly. In spite you are having funds, you are not paying you are not honoring the commitments. So intentionally you are defaulting. Able to understand? Suppose you do not have funds because of some misfortune, incidents, some default happened and you became insolvent. Bank may not classify you as a willful defaulter. Able to understand? Because in COVID, so many employees have lost their jobs and they couldn't repay the loans. They were not declared as willful defaulter by banks. Willful defaulters are who? They parked the funds at somewhere else. They diverted money. They took loan for some purpose, invested in some other purpose. When bank is asking for the proofs, they are unable to submit the proofs. Means they misutilized the funds and now they defaulted. These people are treated as what? Willful defaulters. So whether the company which you are auditing is declared as a willful defaulter by any bank, check it out. And for what purpose term loans were applied and for what purpose they were obtained, cross-verify. If there is a diversion of funds, for which purpose it is actually used, please report it. Working capital loan can be used for any purpose. Building loan can be used only for construction of building or purchase of building. Next, whether company obtained any short-term loan and used for long-term purpose. This is again threat for company liquidity. Getting it? So whether funds raised on short-term basis were utilized for long-term purpose, indicate what is the nature of the short-term loan you got and amount to be indicated. How much amount was diverted. Now, did the company taken any loans to meet subsidiary company needs? Nothing but whether the company has taken any funds from any organization or any person on account of or to meet obligations of its subsidiary, associate, joint venture. If so, details thereof, nature of transaction, amount shall be reported. So if you have taken any loan from any person, not necessarily banks, not necessarily banks. The company has taken some loans from so and so people. Now this loan has been given as a loan to subsidiary company again. Nothing but to meet subsidiary company, joint venture, associate company obligations, I raised some finance. In such a case, please indicate. Nothing but wherever your subsidiary is using funds and you are acting as a mediator for those finance. So you need to give a report. Next. Loan. Have you taken any loan? By keeping the securities you held in subsidiaries. How the company became my subsidiary? Because I invested major percentage of shares. And those shares, I kept it as a security and again got a loan. Getting it? Means the shares which I held in subsidiary company, my ownership, that ownership is kept as encumbrance and obtained loan. Auditor shall report whether the company has raised any loan on pledge of securities held in subsidiary, associate, joint venture. If so, details. And report if the same is defaulted. You know what will happen on this default? Suppose my subsidiary company is there. I have shares in that company. This investment, the control, which means I'm having control. This control has a value of 100 crore. The control which I have on a subsidiary company, that control value is how much? 100 crore. That 100 crore I kept it as security and got 75 crore loan and I defaulted. Naturally, control will transfer from me to them. Able to understand? So, control will be diverted. Means, if I take any loan against a pledge of securities held in subsidiary company, if I keep them as pledge and got a loan and defaulted, I will lose the holding company status because the lender will gain the status of holding company. Able to understand? All of you. Next. So that these are the reporting requirements. In this also they may ask you either 1 or 2 points or they may ask you entire point. This is also important. And the end use of funds, this is actually similar to CARO 2016 only, which you are reading from CA Inter. Actually earlier preferential allotment, IPO, FPO were there as 2 separate points. Now they merged it into as a single point. Not so difficult. Next. Reporting of frauds. Reporting of frauds. Here accidentally it came. Please strike off this. If at all in your book also officer or employee word is there, please strike off. That word is not there. That word is not there. Getting it? You are using which material? Oh, mine only. I told you to strike off. You did? Yeah. So whether any frauds noticed or reported during the year. Just a minute. Like in class, have you seen, right? Like how in depth we discuss. Getting it? I hope you are able to feel the difference. Now is it helping like revision? It's overall, I mean, is the purpose fulfilled? It's fine. Next. So, what auditor has to report? Reporting of frauds. Whether any fraud by the company or any frauds on the company. Whether any frauds by the company or any frauds on the company has been noticed or reported during the year. Remember, these are the frauds identified by company internal control system or company management, company those charged with governance. These are the frauds identified by the company actually. And these are the frauds committed by the company or it may be committed on the company. These are the frauds were committed by the company or on the company. This company has committed fraud on whom? Maybe on third parties. Somebody did a fraud on this company. By whom? The officers or employees or third parties. Anybody can do a fraud on company. Whether any fraud by the company noticed or reported or whether any fraud on the company noticed or reported during the year. If so, if yes, what is the nature of the fraud? Stock theft. What is the amount involved? 5 crore. Tata Motors have reported the same. You see what Tata Motors have reported in this. During the course of examination of books of the company and according to the information, no material fraud by the company or on the company has been noticed, except that we have been informed about 3 incidents estimated to aggregate of 15 crore involving 3 employees who, in collusion with certain vendors, means it's a purchases fraud. Okay. Certain vendors processed payments with inadequate documents and benefited from them. The services of these employees were terminated. But actually what CARO is asking, what is the amount involved? What is the nature of fraud? Nature of fraud is what? Vendor management fraud. Getting it? In most of the companies, frauds will happen in vendors only. Tenders, procurement, vendor selection, vendor payment, kickbacks. Getting it? Most of the frauds happens in vendors only. Sales and all, not much frauds because everything is computerized. Vendors also computerized, but I can have a discussion in the back end with the vendor. Yes or no? With the customers also I can give a special discount on a condition that you have to pay me some money in return. So these kind of frauds will be higher. See, today organizations are highly decentralized. Yes or no? Highly decentralized. Suppose somewhere here Reliance Trends one store is there. Some Reliance Trends store is there. So that store is selling some, clothes. Now the store manager is aware of some special coupons. So the store manager can enter into a side agreement with customer. Actually, I have a special coupon for you. As per company normal policy, that is not given. If I scan your purchase, it will come at MRP. But if I give you this special coupon, you will get 50% discount. You pay me 20% back end. These kinds of frauds will happen. But these are not something traceable, even by the company also, even by the auditors. I think it. Fine, anyhow. So, whether any frauds were noticed or reported during the year. Here, Tata Motors have reported totally 15 crore worth of fraud performed by 3 employees in collusion with vendors. They did this fraud. So, auditors have reported. Now, 143 subsection 12. 143 subsection 12 is regarding fraud identified by the auditor. Who identified as per this section? Fraud is identified by auditor when he is doing the actual audit. Now, whether any fraud reported under 143 subsection 12 in respect of which ADT4 form has been filed. See, 143 subsection 12 classifies frauds into 2 types. Less than 1 crore, more than or equal to 1 crore. Any frauds identified by the auditor. If auditor has reason to believe that a fraud has been committed in the company for an amount involving less than 1 crore or for an amount involving more than or equal to 1 crore. If it is more than or equal to 1 crore, the auditor shall report to central government within 60 days. The reporting process is first within 45 days, inform to board of directors, get their comments and all. Within next 15 days, file ADT4 form with ROC. Naturally, it is intimation to central government. Now, CARO is asking what? Is there any such form filed? So, here Tata Motors auditor said there is no such form filed. You see here, no report has been filed. Getting it? If it is filed, say that it is filed with the, central government. Now, see, every company shall establish whistleblower mechanism, especially listed companies. They need to establish whistleblower mechanism as part of corporate governance practices. Whistleblower mechanism means what? Company has to create an environment where an employee, top management or low level management, if they come across any incidents of suppression or misutilization of funds or, they're doing some unauthorized activities. If they discover that, anybody can report with anonymous name. Getting it? With anonymous or they should give it clear cut their data and company should retain their data confidentially. Their name and all should not be revealed. If the company top management reveal this name and somehow disturb this employee can go for, redressal mechanism under SEBI. So every company should create a whistleblower mechanism. Now, the company, because they created whistleblower mechanism, suspected frauds, possibility of frauds, that information company will be receiving. These complaints are called as whistleblower complaints. So, whether the auditor has considered whistleblower complaints, if any, received during the year by the company. So, company have received so many whistleblower complaints. Have you considered them as part of your risk assessment? As part of your risk assessment, if you consider these complaints, you understand where and all frauds might happen. You can do audit more productively. Able to understand. All of you, this point is not required. The Nidhi company, this you can easily understand if at all you studied Nidhi rules already under company law. You have Nidhi company provisions right in company law. If you study them, this you can easily understand. Are you clear? Everyone? Next. Related party transaction, very simple. Internal audit. This is also a newly added point. Whether the company has internal audit system commensurate with the size and nature of the business. See, internal audit is compulsory as per section 138 for certain class of companies. Listed companies, it is compulsory. Public companies have given criteria. Private companies have given criteria. So, subject to that criteria, these companies must employ internal auditors. Internal auditors can be a CA, can be with a non-CA. They can be in practice, they may not be in practice. They may be employee, they may be an outsider. So internal auditor can be anybody, no restriction. Now, many companies, especially private limited companies, what they are doing is, they are for namesake keeping internal auditors. Namesake. One person they are recruiting and keeping as internal auditor and saying that we satisfied section 138 of the Companies Act. Now you, Mr. Statutory Auditor, check. The company has internal audit department, right? Is the department have enough staff? Suppose for this company, 100 crore turnover, 10 branches were there, operations were so many, transactions were so many, they have only one person as internal auditor. How this internal auditor can do all the internal audit activities? So here you need to qualify. The company do not have internal audit function incommensurate with the nature and size of the operations. You need to apply professional judgment here. Able to understand. So whether the company has internal audit system, commensurate, proportionate, nothing but proportionate to the size of the company. Now, please, internal audit reports will be there, right? Have you considered? When you are doing your overall statutory audit, have you considered internal audit reports or not? Regarding this, we will discuss in SA 610. Are you getting it? Using the work of internal audit, there we will discuss slightly. Next, non-cash transactions. Whether company entered into any non-cash transactions with directors, and if so, 192 provisions have been complied or not. NBFC. Regarding this, I will discuss in NBFC audit. Regarding this point, I will discuss in NBFC audit revision. Okay. So NBFC audit revision we have, there I will discuss. Cash losses. Whether the company has incurred any cash losses in the financial year, and even in the immediate preceding financial year. So what is the current year cash loss? What is the preceding year cash loss? You need to report. If so, state the amount of cash loss. What do you mean by cash loss? See, your profit and loss account, if you look at profit after tax, this profit is arrived after reducing tax, before that, after reducing non-cash expenditures. Correct? Non-cash expenditure is nothing but depreciation provisions. These are the expenditures which the company, where the cash flow might have been already made last time, or provision is for expected cash outflow. Provision is for expected cash outflow. Provision for warranties, expected cash outflow. Provision for debtors, expected seizure of cash inflow from debtors. So in future, debtors inflow might not come. And in financial management, reduction in cash inflow is an outflow. Correct? Reduction in cash inflow is treated as an outflow. Getting it? So exactly. So current year profit after tax, for that please add back provisions, please add back depreciation, please add back all other non-cash expenditure debited in P&L. You will still get some amount. If that amount is still loss, then it's a cash loss. Then it's a loss incurred in cash. Means this loss is something exact realized loss. Able to understand? That is called cash loss. So how to calculate cash loss? Guidance note gave clear-cut guidelines. That is not required from exam point of view. Are you clear? Now, they are asking one more thing. Resignation of auditors. During the year, is there any resignation of statutory happened? Like you are the auditor, right? You are giving CARO report, right? And how come you resign? Suppose if there is already an auditor who was originally appointed, he resigned and you are appointed to fill casual vacancy. So you are finishing the audit, you are giving CARO report. So if at all you are appointed to fill casual vacancy caused by resignation, able to understand, in such a case you need to fill this point. So whether there has been any resignation, if so, whether the auditor has taken into consideration the issues, objections, concerns raised by outgoing auditor. Remember, obviously I have to consider. I will consider, only after that I will accept, because outgoing auditor communicated with me under clause 8 of the ethics. I need to, when I'm accepting the audit, I need to communicate with the outgoing auditor, and he raised so many objections. I considered all of them. Only after that I accepted the appointment. So that information you give here. Clear? All of you. Next. This material uncertainty is very important. This question is asked in CA final also, I think so. In CA final it is asked. I think December attempt, I think so. December or that before attempt. No, probably in December only, because in December only first time CARO is applicable, this 2020. Before that, CARO is not applicable. May 2021 attempt, CARO do not apply. December 21 attempt, CARO is applicable. Somewhere, either in final or inter, somewhere it is asked. Okay. So what is it? On the basis of ratios, on the basis of aging analysis means trade receivable analysis. on the basis of realization of assets and liabilities, payment of liabilities, and on the basis of other information along with financial statements, and on the basis of knowledge of board of directors and management plans, whether the auditor is of the opinion that no material uncertainty exists as on the date of auditor's report. Understand, the word used is auditor's report. MCQ, they may put balance sheet date. They may put balance sheet date and ask you as a true or false statement. Getting it? It's incorrect. Date of auditor's report. Nothing but by using the word date of auditor report, they are asking you to consider all the subsequent events up to audit report. They're asking you, they're indirectly hinting you that you have to consider all subsequent events up to audit report date, that the company is capable of meeting its liabilities existing at the date of balance sheet. Here it is a balance sheet date. Getting it? As and when they fall due within a period of 1 year from the balance sheet date. See, once upon a time, Jet Airways auditors, ILFS auditors, DHFL auditors, none of them has pointed out going concern issues. Only when the company actually defaulted, only that news broke in the stock market, everybody came to know. First time from the auditor, nobody has received this information. So now with this point, see why, what is the defend, the auditors, what they defended, in most of these cases, they said, we didn't find any such symptoms. We didn't find any such conditions. We didn't find financial indicator. We didn't find any operating indicator. We discussed with management. Everything seems fine. That's why, though SA 570 says this point is already covered in SA 570. You have to verify all this in SA 570. But most of the auditors have not performed this duty and defending themselves that they didn't find any of this incident. Now you need to calculate all this. Now you need to calculate specifically, and you need to specifically comment whether you find a condition, whether you find a symptom on going concern or not. Doesn't matter. I am asking you, you are the auditor, right? You are the auditor. You are appointed as an auditor for 21-22. The balance sheet date is 31st March 2022. As on this balance sheet date, the company has so many liabilities. The company has so many assets. You are giving audit report somewhere on 10th June 2022. As on 10th June 2022, you are preparing CARO report on this date. 19th clause you read just now. As on this date, do you still believe the company will repay all these liabilities? The company will repay all these liabilities with the assets they have. Whenever these liabilities fall due, will the company repay? Check it out and please report. So which means you have to do a proper cash flow analysis now. Yes or no? You have to do a proper cash flow analysis. As on 10th June, I will do cash flow analysis. Out of these liabilities, so many were already became due and the company would have already paid. Still some dues might have not yet due. Suppose no, as on 10th June, in between some due dates were there. Though on those due dates, company defaulted. You have to give that list here. Able to understand? As on 31st March, there is a liability. And the liability was due before your audit report date and company has already defaulted. You need to give that information here. Getting it? In our observation, on so and so due dates, the company has not paid on time. You need to give that list here. Now by giving this list, you are alerting everybody. Getting it? So which means before the company become insolvent, you are checking here whether the company can first of all satisfy all the liabilities or not. What is meant by default? What is meant by insolvent? Insolvent means what? You are unable to pay on time. So default is the primary cause of insolvency. Correct? So if auditor is giving list of defaults here, straight away all the liabilities, whether it is term loan. See, they are asking you loan details about defaults. Here they are asking you everything. Here they are asking you every default. Getting it? All of you. So on the date of auditor's report, check whether the company can meet all its liabilities on respective due dates, which are having liabilities as on balance sheet date. So can the company repay them on respective due dates? Please check as on the date of audit report. As on the date of audit report, once again check the financial position, aging, discuss with the management, everything. And finally give your final word whether the liabilities mentioned in the balance sheet as on 31st March, all those liabilities will the company repay on the respective due dates. Please check and then tell you. If you think company cannot repay, if you think company do not have enough cash management, please qualify here. Able to understand all of you? That's it. Then corporate social responsibility fund, CSR fund. See in CSR, no? In CSR, every company has to spend some 2% of average profits. 2%. Like suppose Reliance Industries, you take average profit is 30,000 crore approximately. 30,000 crores. 30,000 crore multiplied by 2% means how much? 600 crore. 600 crore they need to spend in the 1 year. Sometimes, see, as part of CSR project, one of the approved project is rural development. I can adopt one village and lay roads, lay all the infrastructure, pipelines, everything. That is also forming part of CSR. But developing a village may take more than 1 year. But as per CSR guidelines, what it says, you have to spend in the same year, 2%. So in the CSR rules, what they gave one point is, if at all you want to spend this on a particular project which has a span of more than 1 year, if it has a span of more than 1 year, whatever the funds which you kept aside but not yet expended, means not yet utilized, that unspent CSR amount in respect of ongoing project, you should keep it in a separate bank account and spend from that bank account within 3 years. Remaining amount you are spending naturally, this amount is not reserved for separate project. This is normally you are spending. Still, after spending for whatever purposes, getting it, still some amount is left. This is not in respect of any project more than 1 year. Some 10 crore was left, okay, which is not spent. This money you have to transfer to fund, Schedule 7 fund within 6 months from the end of the financial year. Able to understand? So, whether amount remaining unspent is transferred to special account with respect to any ongoing project. If it is other than ongoing project, is it transferred to Schedule 7 fund as per the guidelines? They are simply asking you, the unspent amount is 2 types. If it is ongoing project, transfer to special account, from there spend within 3 years. If it is other than ongoing project, directly transfer to Schedule 7 within a period of 6 months. Able to understand? All of you? That's it. For this, you need to have clarity on CSR provision. If you want, you can watch my CA Inter Law Marathon. In that CSR provision, 1.5 hours is there. For your information, you have CSR provisions, accounts of companies as well. Getting it? You do one thing. You have company audit chapter, right? In that, dividend topic is covered. CSR topic is covered. NFRA is covered. Remember? And there is a new section called 129A. Periodical filing of results. Getting it? So do one thing. Company audit chapter, you have company audit chapter in CA final material. After 139 section, after 147 section, again 128, 129, 130, 131, 132, 133, 134, 135, 136, 137. These sections are there in your syllabus. But institute CA final material, they have not given proper information. Proper material they have not given. They just namesake covered. But they are asking questions in depth. Suppose you see dividend topic in CA ICA material, they just gave dividend related material, but not in full. They didn't give full material. But they are asking you MCQs, calculate what is the average rate of dividend, calculate what is the dividend that can be maximum declared by the company. In-depth questions they are asking. That's why what I told is, we have CA Inter Law Marathon. You can just open caramharsha YouTube channel. CA Inter Law Marathon is there, very recently uploaded. In that, timestamps were given. In the timestamps, there is a chapter called Accounts of Companies. That entire chapter you need to watch. It will be 1.5 hours. It will be 1.5 hours. Getting it? Entire chapter you need to watch. So I'll just show you here itself. Suppose if you observe, this is the marathon material for law.
Next month.
And here we have given timestamps. You can open in phone as well. This dividend topic, accounts topic, both you need to watch because this is there for you in CA final. On dividend also MCQs and all might be coming. So what is final dividend? What is interim dividend? If company has insufficient profits, how much maximum rate of dividend they can declare? What are the conditions? How much balance reserve shall be maintained after declaration of dividend? There are so many conditions you can watch. Approximately this dividend topic is handled by me. Accounts of companies is handled by me. Getting it? Both together approximately it will start at 3:40. So approximately both together 3:40 minutes will be there. Both together. It's a revision class only. Able to understand? Please watch this. But keep it as a last priority because actually basically CA Inter syllabus kept it CA final. It is there in your study material. I say study material company audit chapter. This is there. But watch them at last. If you watch them, that's enough. No need to read. I'm telling you, you need not require reading later. These two topics, you need not read at all. Clear all of you? Next, I told no modified opinion in other group companies. Whether there have been any qualifications, adverse remarks by respect to auditors in CARO reports of companies which are included in consolidated financial statements of this company. If so, indicate details of the companies and paragraph numbers of the CARO report containing qualifications or adverse remarks. So Tata Motors is having so many subsidiary companies. Tata Motors is preparing consolidated financials. In this consolidation, so many subsidiaries, associate, joint venture companies were also included. And these companies were not audited by me but by another auditor. Now they have given some qualifications in CARO reports of the respective companies. What are all the qualifications they gave? Please give in Tata Motors CARO report. So that by looking at Tata Motors CARO report, I can understand what are all non-compliances they made with respect to CARO requirement by other companies. Able to understand? At one place we will get. Yes. Applicable only to the holding company. But actually what cross-referencing must be there. In every company it must be given. So suppose Tata Motors consolidation, 15 companies are being consolidated. In Tata Motors CFS, let us assume 15 companies are being consolidated. Now, in all the 15 companies' CARO reports, all the 15 auditors should cross-refer about other companies. Able to understand? But actually, here, one company audit report might be ready by then, one company audit report might not be ready by then. So, what people are doing is, straight away they are not considering it in. They are not considering it in CARO report of standalone financials. Straight away, whichever the company prepare consolidated financials. In that company, actually CARO did not apply on consolidation. But, consolidation will be done when logically only after all companies' financials are finalized. Only after all companies' audit report is finalized. Then only consolidation process will start. So on consolidated financials, whoever is giving audit report, he will give entire the data. That's what I showed in Tata Motors. Able to understand? That's what I showed in Tata Motor consolidated financials. They gave annexure A and they discussed entire this point. Actually, CARO do not apply on consolidation. But they gave this because of the convenience purpose. Are you clear? We'll see Tata Motor standalone, what they gave. I think that will be clarified, no? You see, they only gave about Fiat. Only one qualification they gave. But you see Tata Motors consolidated financial statements, inside that audit report, inside that CARO is not there, but this 21st clause alone they spoke. There 10 companies qualifications they gave. Yes or no? Just at the beginning also we have seen. Able to recollect? That's it. Okay. So with this, CARO has been completed. I hope you are able to understand. So wherever you're having positive comment, give positive statement. Negative comment, negative statement along with reason. Whenever you're giving something is not followed, give reason clearly. And if at all you're unable to verify something, mention that you're unable to verify. So with this, CARO report is also completed. So we still have 143 subsection 3 checklist where we need to discuss 15 clauses. In that, the 10th clause only amendment was. All these fund transfers, transactions of fund transfers between companies, mediator, ultimate beneficiary, the topic. ABG Shipping Yard, recently that fraud happened some 6 months ago. Getting ABG Shipping Yard, there is a fraud. Most of the frauds are happening most of the frauds are happening in that way, and that observatory point has been kept in audit report. Getting an auditor had to observe that kind of fraud. Anyhow, so I'll discuss when I'm discussing that 143 subsection 3. So with that, audit report chapter will be mostly done except 4 standards. I told you 620, 610, 710, 260. So if at all those 4 standards are also done, audit report related all the standards we will be covering it. Clear? So in the next session we will be discussing that. So we'll start with Audit Committee and Corporate Governance. So in this Audit Committee and Corporate Governance, our main focus of understanding is regarding Audit Committee. Because corporate governance topics, namely Board of Directors topics in company law and various other committees topics in SEBI regulations, this is something which is extensively covered in law. This is not something which we discuss as part of audit, because on Board of Directors topic and SEBI, both together in law you are having approximately 40 hours of discussion. Board of Directors is an important topic, right, in law? Board. So entire that Board of Directors topic is also covered in that corporate governance. So what is the composition of board of directors? What are the powers of board of directors? What is director responsibility statement? What is board report and contents of board report? Almost all that contents were covered as part of corporate governance. So that, LODR regulations that will come under SEBI, that we will not be discussing here. Same way in company law also, you're having audit committee provisions. Generally when audit committee provisions were referred under company law, that there also it will be general referred to audit subject, because audit committee is something which we extensively discuss as part of auditing. Now, see, in SEBI, we have some listing obligations and disclosure requirements. We popularly call them as LODR regulations, which were released in 2015, updated version. So, as per that regulation, every listed company must have audit committee. Like until now, audit committee means what we understood is it's a requirement under Companies Act, which is section 177. But now we need to discuss both the provisions, 177 requirement as well as LODR requirement. The composition is only a difference. Only the composition is slightly different. And in this audit committee composition, there is a slight small amendments were also given. So what is this further? So composition of audit committee in case of listed entities. First of all, every listed entity shall comply with audit committee provisions. They must have audit committee. See, company board of directors are so many. For the purpose of convenience in operation of affairs, these directors divides among themselves certain duties. Not every director will involve in accounts and audit. Only few directors will have that knowledge related to accounts and audit. So those few directors will form as part of audit committee. Same way, in the company, few directors will be there who are aggressively participating in business, who are aggressively bringing new customers, creating new market, creating new opportunities for the company. And those people, those directors are generally being part of risk management committees. And the directors who are actively involved in salary fixation, HR policies, all this, so they will be generally part of nomination and remuneration committee. And a director directors or group of directors who are mainly involved with overall governance of the company, they are generally part of corporate governance committee. So, if a company has 14 or 15 directors or 10 or 8 directors, whatever the number, not every director will involve in every FIR of the company. Getting it? Just like you look at parliament or assembly, there are approximately 100 plus MLAs will be there. There are 500 plus MPs will be there. Yes or no? In a state government it is MLAs. At central level it is MPs. But not everybody is involved in every FIR related to the economy. Out of them, some people will form as a committee. And that committee will be headed by minister. Able to understand? Parliamentary committees, we call them as what? Parliamentary committees. In parliament also we have committees like finance committee, estimates committee, public sector undertakings committee. Why these committees are formulated by parliaments? Because not every member of parliament will look into each and every FIR related to economy. So the member of parliaments divides the duties among themselves as a committees. So who will fix all this? Some leader in the company, leader in the government, he will fix. Same way here also. The leader, whoever is the managing director of the company, he will discuss with everybody and allocate certain specific roles and responsibilities. And for that purpose, committees were created. So committee means a group of or an association formed for a specific purpose. So audit committee is also accordingly a committee which is exclusively formed by same board of directors, but this committee exclusively looks into audit and accounts related matters. Now, so what is the provision related to audit committee? It is applicable for all listed entities. It shall have minimum 3 directors. So minimum 3 directors together should form this committee. If 2 directors only were there, it cannot be formed. And moreover, for a public company, we all know that minimum 3 directors are required. For a public limited company, what is the minimum number of directors? 3. In listed companies, it will be more than 3. And the audit committee composition, The audit committee composition must be what? Generally, here they have used the word at least. They have added the word at least. In the recent RTP, if you see, the word at least has been added. Of course, the intention is the same. The intention is exactly the same. It is at least. Earlier also, the intention is the same. But the only thing is, the word is explicitly not covered. So this is the RTP which was released a few days back. So insertion of the word at least. Getting it? Earlier it was not there explicitly. But remember, the intention of the section is always it is at least. Getting it? At least 2/3 of the directors of the audit committee shall be independent directors. Minimum 2/3. Getting it? Suppose in 4, 2/3 means 3 directors. 2/3 means what? 3. 2.6 director cannot be there. No. We always have to round up to the next number only. Always. Getting it? Now, all the members of audit committee shall be financially literate. What do you mean by financially literate? Means they must be able to understand the accounting principles, accounting procedures, audit principles, audit procedures. They must be able to read and understand the financial statement. And at least one member shall have accounting or related financial management expertise. Now, what do you mean by financial literate? What do you mean by financial literate? They have given definition. What do you mean by accounting and related financial management expertise? Definition is given. Accounting or related financial management expertise includes the people who have rendered previously as a CFO or as a finance manager, or who is a chartered accountant or company secretary, cost accountant, or management in finance. Getting it? So if those who are having this kind of qualification or this kind of work experience, these people are considered as those who are having accounting and related financial management expertise. In the smart notes I have not given the definition, but if you look at the full material, you will find all the definitions. And further, the chairperson of the audit committee must be independent director, and he must present at annual general meeting of the company. Now, whatever the company has secretary, overall company secretary, the same person will also act as a secretary to the committee. See, secretary to the committee means what? This fellow coordinates communication about meetings to be held, minutes to be written, checking the conditions. Getting it? So everything is formally done as per law and regulation or not, this secretary will ensure. And for audit committee meetings, at their discretion, they may call a finance director, they may call any financial head, they may call internal audit head, or they may call stat auditor, or they can call any other executives. So they can invite anybody to their meeting. It is not compulsory also on the other people part. See, suppose I am a stat auditor in the company. Audit committee invited me for that particular meeting. Of course, I will not have any right to vote because I am not the member of the committee. I am only invited to look at the proceedings. I can't vote. Is it compulsory for me to attend? No. Getting it? Because under Companies Act, I don't have any duty to attend audit committee meeting or board of directors meeting. My duty is only with respect to annual general meeting, extraordinary general meeting. That's it. Able to understand? No. Suppose you take this Reliance company. This is latest annual report. So first of all, how many directors this company is having? Now here they are speaking about the list of directors, all that below it will come. Yes, these are the directors in the company. So totally they are having 8 plus 6, 14 directors. Reliance is having totally 14 directors. And if you observe this letter C and color, you see here these are the colors given. So what is this color signifies? They have given somewhere the color coding. Yes, they have given. So if it is purple color, it's an audit committee. If it's orange, stakeholdership relationship committee, CSR committee, and governance committee, corporate social responsibility and corporate governance committee. HR and Nomination Remuneration Committee and Finance Committee, Health and Safety Environment Committee, Risk Management. These are the committees. And regarding all these committees, you are having in LODR regulations as part of this chapter. And I told you to refer to company law book for this. Getting it? You are having all this in SEBI regulations. Now, you see here, now audit committee means what? This purple color. So we have to identify those people where purple tag is given. So here he is a M. M refers to member. C refers to chairman. So here he is also a member. Yeah, he is also a member of audit committee. He is also a member of audit committee. You see, he is a non-executive director, non-executive director, non-executive, and most of them are independent directors. Most of them are independent directors, and he is the chairman of the audit committee, and he is also an independent director. He is an advocate in Supreme Court, practicing advocate. Most of the independent directors are taken from professions. Getting it? You see, all the independent director, he is a Supreme Court advocate, he is a scientist, or he is some chairman of some Quality Council of India regarding various aspects, and he is a finance secretary, and so approximately 1, 2, 3, 4, and Ambani was not there as part of any committee. I mean, he is only chairman of finance committee, and here he is also a member of audit committee. You see, Reliance has adopted all the members of audit committee were independent directors, non-executive directors. Getting it? Now, one more point. Non-executive director not necessarily mean independent director. But here they are all independent directors. By the way, for your information, though they have not mentioned specifically, they all are independent directors. Suppose Neeta Ambani is there. She is non-executive, but she is not independent. Because she is having interest in the company. Her husband is having substantial interest in the company. Getting it? So she is not a non-independent director. Getting it? So non-executive means those who do not involve in day-to-day affairs of the company. So here they exactly met the requirement of the LODR regulations. You can cross-check with other committees also. Whenever you are reading, just cross-check with other committees. Now you see, audit committee will have terms of reference. Audit committee will have terms of reference. You might have came across this word. So this is terms of reference of audit committee. What is terms of reference of audit committee? I'll discuss now. So that's about audit committee. Now, meeting. Audit committee meeting must be held 4 times a year, and the gap between 2 meetings shall not exceed 120 days. The quorum shall be minimum 2 members, and minimum 2 independent directors also must present. Quorum is minimum 2. That too, which members? Only independent should present. Or 1/3 of the members of the audit committee, whichever is higher. Suppose if the company is having audit committee's members 7, 1/3 means 2 point something it will come. So 3 is the quorum. If the audit committee total members are 6, 1/3 means 2. That is fine. Now powers of the audit committee. This itself can be asked as a separate question. What are the powers of the audit committee? Write about composition and powers of the audit committee. 4 marks question. They can investigate. They can investigate any activity which comes within their terms of reference. So terms of reference means what? What audit committee will do? They participate in all the following areas. So in the company annual report itself, they have clearly mentioned what are the powers of the audit committee, what are all their terms of appointment, everything is clearly mentioned. Now they can seek any information from any employee. They can get outside legal and other professional advice. So if they want any legal and professional advice on accounting or taxation or any other matter, they are having power to get that advice. Getting it? Which means what? What is meant by this power? So when they want any legal expertise from outside, board of directors cannot deny them. Rest of the board of directors cannot deny them. And they can secure attendance of any outsider with relevant expertise if it is considered necessary. They can talk with experts if at all they want to. That's it. And remember, all these 4 powers must be vested in audit committee. So the auditor should check whether terms of reference have framed mentioning above powers. So in the terms of reference in the Reliance also you will find all this. Getting it? So auditor has to check. Now what is the role of audit committee? The role of audit committee is again given here. The role of audit committee is again given here. All these points were given. Recommending appointment of auditors. Yes or no? Approval of payment to statutory auditors. You see. So recommending appointment of auditors, and even their remuneration is also fixed by, the remuneration, while auditors remuneration is fixed, the audit committee people should participate in the fixation process of remuneration. And what other services the statutory auditors can provide to the company. If stat auditor want to provide any other additional service, audit committee must involve in that. Only if audit committee approves, it will be proceeded further. And they can discuss with statutory auditors regarding nature, scope, timing, planning of the audit, all that. And they do annual financial statements review. See, this itself can be asked as a one of the function of the audit committee is or role of the audit committee is they have to perform a review of annual financial statements. So what do you mean by review of annual financial statements? They may ask you a sub question clearly. Only on this they may ask you a 4 marks question. You have to write any 4 points. So when you're doing annual review of the financial statements, you mainly look for, are there any changes in accounting policies? Are there any changes in significant accounting estimates? Are there any related parties transactions? Is there any modified opinion in the draft audit report? Getting it? And what are the matters which are required to be included in director responsibility statements? All these points audit committee should focus. So financial statements review means what? Only from reporting angle we will see. And they have to review quarterly financial statements. They have to review utilization of funds raised in case of IPO, NPO. They have to look at statutory auditor independence and performance, how they are performing. They will participate in approval of related party transactions. They review internal audit function. They will exercise, whistleblower policy making, whistleblower mechanism, and appointment of CFO. Audit committee approval is required, and any other function mentioned in terms of reference. So they will ask you in exam, write about applicability of audit committee as per LODR regulations and what is the role of audit committee. 6 marks question they'll ask. Means out of this, any 6 points you have to write out of main points. Able to understand? Write about role of audit committee and applicability of audit committee and composition as per SEBI LODR regulations. A straight question can come. Are you clear? All of you? Next. Resignation, I'll come to that later. And what about applicability of audit committee provision as per Companies Act? See, Companies Act talks about to which companies audit committee is applicable. See, LODR regulations is exclusively for listed entities. Whereas Companies Act provision is not exclusive for any company. Getting it? So they gave every listed company must have audit committee as per company law, and unlisted company who are satisfying any of the following 3 criteria. If an unlisted public company satisfies any of the following 3 criteria, audit committees must for them. Paid up capital 10 crore or more, turnover 100 crore or more, aggregate outstanding loans, debentures, deposits 50 crore or more. So they have to compulsory. Private companies not liable for forming audit committee, because in order to form an audit committee, minimum 3 directors are required. For a private company, minimum 2 is enough to form a company. Next. These limits shall be taken as per last audited financial statements. For listed companies, this kind of limit is not there, because for LODR regulations, it is strictly applicable for all listed entities. No monetary criteria. Able to understand? And the following companies are exempted even though they are listed. Even though they are listed, even though they fall under the above criteria, even though they fall under applicability criteria, they are exempted from forming audit committee. If it is classified as a dormant company under 455, or if it is a 100% subsidiary, if it is a 100% subsidiary, or if it is a joint venture. How can a company be 100% wholly owned subsidiary? How a company is formed as a wholly owned subsidiary? Suppose you take Tamil Nadu Power Distribution Corporation Limited, 99.99% of the shares are held by Tamil Nadu state government. Rest of the 0.0001% of shares held by some 9 or 10 nominee directors. Getting it? 9 or 10 nominee shareholders. Nominee shareholder means what? For namesake they are shareholders, but though the share is legally on their name, the beneficial ownership is with the Tamil Nadu government. Able to understand? See, ownership means which ownership is important in law? Beneficial ownership is important. Substance over form is important. Not the legal ownership. Able to understand? And what is the composition of audit committee? Minimum 3 directors are required, with independent directors forming majority. Majority means not 2/3. Majority means 51%. Understand? In under Companies Act, if majority of the audit committee members are independent directors, if majority of them are independent directors, then we call it, then it is enough. 51%. Suppose if there are 5, 3. If there are 6, 3 is enough. Or sorry, 4 is required. 4 is required. Even if it is 7, 4 is enough. Even if it is 8, 5 is required. Getting it? Simple majority is enough. Whereas in SEBI requirement, 2/3 majority, minimum 2/3 must be at least independent directors. And there I forgot to mention one point. What if a company is issued with superior rights? In India, listed companies having superior rights is prohibited before 2019. After 2019 onwards, after amendments, once again superior rights concept is introduced. It was there long ago. Later superior right concept is prohibited. Now again very recently, superior rights concept. A company, in India, a listed company is permitted to issue shares with superior rights. There are two types of differential voting rights. DVRs, we popularly call them as. These differential voting rights are two types. Superior rights, inferior rights. What is it? Superior rights and inferior rights. Tata Motors has issued shares with inferior rights. Getting it? What do you mean by inferior right? Generally, in meetings chapter, you might have learned, for every one share held by a shareholder, one vote is given. Suppose, for me, if I have to exercise one vote, I need 10 shares. Suppose, if I have to exercise one vote, I require 10 shares. Which means, for every share, I only have 10% of the one vote. Means 0.1 vote only I have for every one share. Like that, the shares were allotted to me. Then my shares are with inferior rights. Suppose if the company allotted me one share, with one share I can exercise 10 votes. I can exercise more than one vote. If I can exercise more than one vote with one single share, then that's called superior right. If I can only exercise less than one vote for one share, it's called inferior right. Mark Zuckerberg in Facebook is having shares with superior rights. So when shares with superior rights will be issued, in case of startups and all, it will be mainly issued because investor is somebody, business idea is of somebody. Now investor is investing 90% of the capital. This fellow is investing only 10%. But if I say equal share means this fellow will get 10% ownership owned in the company. Now how he will protect? But both of them agreed 50-50%. But in company law, how voting power is calculated based on investment. So this fellow have taken 10% amount. This fellow contributed 10%. Investor has contributed 90%. For him, we will give shares with inferior rights. I will take shares with superior rights. So I will compensate it 50-50. Able to understand? Though he purchases 90 shares, he will get 50% voting power. Though I purchase 10 shares, I will get 50% voting power. So likewise, the shares will be issued in case of startups. So in case if a company is having shares with superior rights, then the company must have only independent directors as part of audit committee. Getting it? Next. And whenever audit committee is applicable, all appointments, including filling of casual vacancy, shall be made after taking recommendations of audit committee. Incorrect question or correct or incorrect question. In case of casual vacancy, audit committee recommendation is not required. Incorrect. Even in the case of casual vacancy, audit committee recommendation is required. What are the functions of audit committee? Same. Any 6 points you can write here. They are same, more or less same points as per role of audit committee. In LODR regulations, role or function, both are same. Getting it? Whatever functions in respect of listed companies, audit committee is having similar functions only in respect of, under Companies Act, similar responsibilities only were given. Next. Next here. What are the mandatory points? What are the mandatory points that audit committee shall review as per Schedule 2 of LODR regulations? Schedule 2 is for what? As per LODR regulations, Schedule 2. So what are the points that audit committee shall mandatorily review? In this, one point is deleted. Statement of significant related party transactions. This statement need not be reviewed mandatorily. So that has been deleted. So that is what given in the RTP as well. If you check it out. Deletion of information on statement on significant related party transactions submitted by management under mandatorily review by audit committee as per schedule 2 of LODR regulations. So this point is deleted. So earlier the audit committee must review totally 6 items. Now it is only 5 items. Getting it? Statement of, now you see this is very important for MCQ. So which of the following audit committee need not review, they will ask. Getting it? And they'll put 3 review points and 1 this amendment point they'll put. You need to select the second point. Getting it? So this is very recently deleted. So this amendment is applicable for November attempt. Able to understand all of you? So this amendment is applicable for November attempt. So statement of significant related party transactions, audit committee need not mandatorily review because they are approving all the related party transactions. So why should they review once again? Getting the point? So they are participating in every, they see related party approval, related party transaction approval, everywhere they are involved. So they no need to review once again at the end. This review is performed by what, for what purpose? Totally in a year, what happened? So in order to check that only this review. So what are all they need to review? They need to review management discussion and analysis. They need to review management discussion and analysis regarding financial conditions and operations. They need to review compulsorily letter of weakness issued by stat auditor. They need to review internal audit report with respect to internal control weakness. And they have to compulsorily review chief internal auditor's appointment, removal, remuneration. They shall be reviewed on an annual basis. And they should review statement of deviations. Even quarterly statement of deviation, annual statements of funds utilized shall be monitored. Getting it? And auditor, as a stat auditor, what you need to check? You need to check from the minutes book of the audit committee whether the above mentioned points have been reviewed by audit committee and see whether as part of director's report a management discussion and analysis forms part of the annual report. You see Reliance annual report, you will find management discussion and analysis. So we need to check whether M&A report is given or not. Getting it? And wherever deficiencies or adverse findings are noted by audit committee, please see that these have been dealt by management in the report of corporate governance. So audit committee has to mandatorily review right now not 6 points, 5 points. This is an important question. Many a times this has been asked. This is an important question in this. Many a times it has been asked. So the audit committee shall mandatorily review management discussion and analysis of financial conditions and operational results. They need to review letter of weakness issued by stat auditor. They need to review internal control weaknesses identified as per internal audit report. They need to look at internal auditor's appointment, removal, remuneration. They need to look at statement of deviations. Quarterly statement of deviation they need to review. Annual statements of funds utilized. Getting it? For any purpose other than those mentioned in the offer document. If this point will apply only if the company raised funds. In that year, if the company raised funds only, this point will apply. Otherwise, this will not apply. Clear? All of you? Next. Now, the auditor has to certify on corporate governance. The auditor shall give a certificate on corporate governance. Whether the company is complying with all the requirements of corporate governance. Listed company auditor has given the responsibility to give a certificate on this. So, now how should we verify? Same general principles of audit he will follow. How we verify stock, how we verify cash, how we verify compliances with laws and regulations as per SA 250. Same audit procedures will apply while checking compliances with corporate governance policies. So, the principles of standards on auditing would be applicable in performance of the certification work. And the auditor should comply with code of ethics. The auditor should conduct verification as per guidance note on certification of corporate governance. So, if in order to certify, in order to give a certificate on corporate governance, what is the certification? You need to say whether company has complied with all corporate governance provisions or not. All LODR provisions or not, you have to give a certificate. So, there is a guidance note. How to check all this? So, institute has given a guidance note on how to execute or how to deliver a certificate on corporate governance compliance. Institute give a guidance note. So study that guidance note, accordingly apply that guidance note, do performance, do audit procedure, and finally get evidence, document it, then give a certificate. Able to understand? So whatever you apply, you see here, the auditor should document which are important in providing evidence to support the factual findings. So you have to document. And auditor should also get a written representation from the company. Yes, the company management has actively implemented all the controls to comply with corporate governance rules and regulations. Able to understand? Have you read all this? So what is auditor responsibility? The auditor's responsibility in certifying compliance with corporate governance, it relates to verification, certification of implementation of requirements of corporate governance as per LODR. Did the company incorporated risk management committee? Did the company incorporated HR nomination and remuneration committee? Did the company incorporated finance committee? Did the company incorporated audit committee? There are various conditions as per LODR regulations which company has to follow as part of corporate governance practices. So whether all these were followed or not, auditor has to verify and give a certificate. Getting it? See here, that is also given. Probably certificate on corporate governance is given by auditor in Reliance. Spelling tappa. This is compliance certificate. Yes, this is compliance certificate. Certificate from company auditor confirming compliance with conditions of corporate governance as given under LODR regulations. As given under LODR regulations. I think you will find that later. So you will find full-fledged certificate itself. You see here. This is how an auditor will give a certificate. Remember, this certificate is neither an assurance on the future viability of the company nor a guarantee about the performance of the company. Getting it? And this certificate is not on the financial statements. See, you see here, we will mention that clearly. Such a certification is neither an audit nor an opinion on financials. It is not an assurance for future viability nor it's an efficiency guarantee for the management. It is not about management performance. It is not about company future guarantee, company future. It is not about financial statements. This is purely a certificate on compliance with conditions of corporate governance. So that's what the auditors also will mention here. They will clearly mention here. So auditor responsibility. Our responsibility is to provide reasonable assurance in the form of opinion whether the company has complied with all this. So the procedures here they will mention clearly. This is not something, this is not something that an opinion on the financials. Where it is there? In other matters it is given. Fine. This report is neither an assurance as to future viability nor guaranteeing the efficiency of the director. Getting it? This report is addressed to the members of the company purely for the purpose of complying with listing obligations. So auditor has to give something like an audit report. Able to understand? So that is called certification on corporate governance. The company, after fulfilling all the corporate governance duties, they should give a report on corporate governance. That's again a separate report. Report on corporate governance is different. Report on corporate governance is prepared by management, prepared by those charged with governance. Certificate of compliance on corporate governance by independent auditor is a certificate given by auditor. Able to understand? All of you. That's it. Now, in our book, I clearly mentioned below, this, report on corporate governance we didn't discuss because this is a report which consists of exhaustive points. What are all the points to be included in corporate governance report? Something similar to board of directors report topic. This you will get in LODR, like SEBI. As part of law, you have to discuss. What are other disclosures? What is management discussion and analysis? Compliance certificate I already mentioned. What are statement of deviations or variations, you have to read as per law. Getting it? Information to shareholders, transfer or transmission or transportation of securities, risk management committee, stakeholder relationship committee, nomination committee, subsidiary of listed entity, whistle mechanism, code of conduct, obligations with respect to employees, composition of board, powers of the board of directors, all this, which companies must have a woman director. So much of content is there which is completely discussed for you exhaustively in law paper, not in audit paper. Clear? So in audit, we only discuss audit committee provisions. All of you confident? Remember, from other, whatever these which I have not covered in this material will be tested in exam for sure. Getting it? Possibility. Whatever the probability is there for audit committee. If I will say probability for testing, a question from audit committee will be 60%. From these topics, it will be 40%. Able to understand? So the probability will be very high from these questions also, from these concepts also. So don't ignore. I hope you will read all, you have covered all this as part of law. You have to read once again. Whenever you came across this chapter, open law book and read. Don't ignore. Able to understand? You will have what is risk management committee, what is the role of risk management committee, and what is the composition of risk management committee, what are the powers, what are the duties. So much is there. For every committee, there is so much of discussion. Then we'll discuss one pending topic, which is resignation of auditors. So the next one. So whenever an auditor of a listed company resigned from the company, first of all, we have a procedure. What should be the process of resignation is given under Companies Act. What should be the process? When you can resign, when you should not resign is not discussed under Companies Act. If auditor want to resign, you have to resign after checking all the legal compliances. Companies Act is not talking about have you resigned properly or not resigned properly. When you resign, what you have to do. That is only what Companies Act 140 subsection 2 talks about. What Companies Act 142 section talks about? 140 subsection 2. An auditor who resigned from the company shall intimate the company within 30 days. Within the same period, he shall file a form called ADT 3 with ROC. Getting it? If at all he is an auditor of government company, he shall also intimate to C&AG. And this entire process must be done within 30 days. And you need to clearly mention reasons in ADT 3 or even in your resignation letter why you resigned from the company. You need to clearly mention reasons to the company. Suppose if you fail to comply with this, if you fail to comply with this provision, 140 subsection 3 attracts. So what it says, 140 subsection 3, it says there is a fixed penalty plus variable penalty. There is something called fixed penalty plus variable penalty. What is fixed penalty? Straight away, remuneration of the auditor or 50,000 rupees, whichever lower. Whichever is lower. Plus variable penalty of per day 500 rupees from 31st day onwards. From 31st day onwards. Actually, what do they say? 500 rupees per day penalty for the delay after the first failure. Getting it? 500 rupees per day penalty for the continuing failure after the first failure. After 30 days only, no, first time you failed. Up to 30 days you have time to intimate. 31st day, if you do not intimate, then failure started. So from that day, continuing failure means until you file ADT 3 form, until you intimate the company, until you intimate the C&AG, until that you have to pay 500 rupees per day additional penalty, and both maximum penalty is 2 lakhs. Earlier it was 5 lakhs, amended, now it is 2 lakhs. Able to understand? This is the process of resignation. Whereas LODR regulations, what are they saying? They are not talking about process of resignation. They are talking about LODR regulations puts a restriction on resignation. When auditor should not resign. Getting the point? If at all you want to resign, what additional formality, what additional duty you have to discharge. So that is what LODR regulation discusses. Now the regulation says the moment an auditor of a company resigned and intimated to the company without any delay within next 24 hours shall intimate to SEBI. Shall intimate to the SEBI. To all the stock exchanges they need to intimate. Able to understand? A company, the moment they received the resignation information from auditor, they should intimate immediately to stock exchange. Now, in order to resign by an auditor, what is the condition? Suppose if auditor resigns within 45 days from the end of the quarter of a financial year, then before that resignation, compulsorily shall issue either a limited review report or audit report for such quarter. Like what? See, every listed company must file quarterly financial results. Every listed company must file quarterly financial results within 45 days from the end of the quarter. And every listed company shall furnish annual financial statements within 60 days from the end of the financial year. Which means by 31st May, 99% of the cases, most of the listed entities would have submitted annual financial statements, audit report thereon. That's why you take any company, listed company, popular listed company, annual reports, audit reports, financial statements, dates, they are before 31st May, before 31st May. That's a requirement under SEBI. See, like the reason why quarterly financials are important is, of course, because the stocks are listed, they are being traded. As an investor, I can't wait until next one full year to get the latest information. I want information as soon as possible. So quarter results concept has been brought. Same concept under Companies Act is added very recently, 129A. What is it? 129A. Very recently it was added by, the Parliament. 129A, new section. What it says? Periodical filing of the results by companies which are not listed. Listed companies already provision is there. In Companies Act, is there any provision that talks about quarterly results or periodical results? No. Newly 129A section added in 2021 year. Getting it? It's a newly added section. So now some unlisted public companies also, or some other notified class of companies, right now it is not yet notified, only section was given, applicability of the section is not yet brought. Any notified companies or class of companies must file periodical results with the ROC. So that is 129A. Whereas SEBI provisions are what? Every listed company must file quarterly financial results with the SEBI as well as with the stock exchanges. Yes or no? Quarterly results within 45 days. Now, the question here is, you see the provision. Suppose if the auditor want to resign within 45 days from the end of the quarter. Suppose you want to resign. Suppose actually we are talking about financial year 22-23. Let us assume. The financial year 22-23 means first quarter is 1st April to 30th June. Second quarter is 1st July to 30th September. Then it is 1st October to 31st December. Then it is 1st January to 31st March. These are the quarters. Getting it? Now, if you want to resign from the end of the quarter within 45 days. Within 45 days means what? 15th. Sorry. Yeah. So, 15th August. Correct? Within 45 days from the end of the quarter means 15th August. Here 15th November. Here 15th February. Correct? 45 days from the end of the quarter. Getting it? And here it is 15th May. So this is the 45th day from the end of the quarter roughly. Getting it? If you want to resign within 15th August. Suppose if you want to resign within 15th August. 15th August. Within 15th August means what? It will come after 30 June. But within 15th August. That period is nothing but within 45 days from the end of the first quarter. Within 45 days from the end of the first quarter. In such a case, you must give audit report for this Q1 compulsory and then resign. And then resign by 15th August. Intimate resignation. First give limited review report or quarter audit report. Mostly auditors will give limited review report only. Mostly auditors will give limited review report. The concept of limited review assurance engagement syllabus we don't have. SEO 2000 series. Getting it? SRE. SRE. Standard on review engagements. Getting it? We don't have in our syllabus. Now, so you must give. Suppose you want to resign after 15th August. Suppose you want to resign after 15th August. What is after 15th August? Interpret. 15th August is part of second quarter. Compared to first quarter, if you want to resign after 15th August, it will be nothing but after 45 days from the end of first quarter. You should always interpret it from the previous completed quarter angle. Suppose if the auditor want to resign 20th August, before this what is the quarter? April to June. Now June 30, from June 30 what is the date? 20th August, more than 45 days. If auditor is resigning after 45 days from the end of a particular quarter, then whatever the date on which you are willing to resign, don't resign. Give limited review report for that quarter and even limited review report for previous quarter. This is the condition. Like you will see this point. You might have came across this point in fraud, SEO 240 standard earlier. When an auditor has encountered an exceptional circumstance where he cannot continue the engagement, take legal and professional opinion and withdraw from the engagement. Suppose if withdrawing from the engagement is not possible, have you seen withdrawal from engagement not possible? Resignation is not possible. Have you seen that word? What is meant by resignation not possible? 20th August I found an unexceptional situation. But when I took a legal opinion, I was told that I'm an auditor of a listed company. And since I am resigning after 45 days from the end of the quarter, I cannot resign at this moment. When withdrawal is not possible, give disclaimer of opinion. Have you seen that? Whenever you have to give disclaimer of opinion, SEA 705 says, don't give disclaimer. Withdraw from audit. Withdraw from audit. If withdrawal is not possible, then only we will give disclaimer of opinion. Remember? Just a minute. Can you someone switch on that? Okay, I didn't open the charger itself. I was looking for that charger and thinking it's mine. இது பாரு பையனுங்க. That laptop plug, you remove it and then keep this one. Hey, wait. இது எப்படிமா போயிடுச்சு உள்ள? இது ஒரு தடவை ரிமூவ் பண்ணி கொடுப்பா எனக்கு லைக் remove it. So where this is? உள்ள வந்துருச்சா? இரு இப்போ போடுப்பா. அது போட்டுட்டு ஃபிளிக் பண்ணு. ஓகேவா? ஃபாஸ்ட். ஐயா அது ஏதோ போயிடுச்சே. Yes, let's continue. Sorry. Yeah. So, even when you look at SAS 705, When auditor encountered an unexceptional circumstance, see, this can be framed as an MCQ. When auditor is unable to obtain sufficient appropriate evidence on which to base an opinion and concluded that the possible effect of undetected misstatements, if any, on the financial statements are material and pervasive, what auditor shall do? So what auditor shall do? Option 1, they'll give you withdraw from the engagement. Option 2, take legal and professional opinion and withdraw from the engagement. Option 3, give disclaimer of opinion. Option D, withdraw from the engagement if possible. If withdrawal is not possible, then express disclaimer of opinion. So like this, a meaning will come. In such a way, the options will be framed. So you need to select the last option. You cannot straight away give disclaimer of opinion. The standard itself says, when you encounter a situation where you are supposed to give disclaimer, don't give disclaimer. See whether can you withdraw. Getting it? Can you withdraw? So that another auditor will be appointed. He will at least try to do the audit. May not be possible for you. For somebody else, it may be possible for you. Let him try. You withdraw from engagement. If withdrawal is not possible, then only you give disclaimer. Withdrawal not possible means for listed entities because of this, condition. In India, for listed entities because of this condition, at certain moment, withdrawal is not possible. Are you clear? So what is that we read now? If auditor want to resign within 45 days from the end of the quarter, after the end of the quarter, within 45 days, give the review report for that quarter. If you want to resign after 45 days from the end of a particular quarter, for previous quarter, give the review report, and the next quarter also give the review report. Able to understand? And there is another condition. If an auditor who gave review reports for 3 quarters, an auditor who gave review report for 3 quarters, for 3 quarters you gave review report, then compulsorily you cannot resign, do audit completely, give annual audit report, give quarterly review report on 4th quarter. It is compulsory. Then after only you can resign, and there is no point of resigning thereafter. Very good. Unless you don't want to continue for the next year, because you are appointed in case of non-government company for 5 years. So if you want to resign, suppose you signed 3 quarterly review reports, you have to give 4th quarter report, give annual audit report, then you can resign, so that the remaining term you need not serve. Able to understand? Suppose first quarter itself, let us look at. If I want to resign, suppose I was appointed on June 1st or June 2nd, and or maybe June 1st, within first week I was appointed. When I started interacting with the company, I came to know that the company will not cooperate with me for audit at all. I decided to withdraw from audit before June 30. Can I do so? Yes. Able to understand? You can absolutely do. If you want to withdraw before June 30. Getting it? Next, suppose I want to withdraw on 20th August, which is after 45 days from the end of the first quarter. Getting it? But it is not, it is part of second quarter, the date is. Here, withdrawal is not possible. So do simultaneously review, audit everything for the second quarter also. And the second quarter completes on what? September 30. Then October 1st week or 2nd week, please resign immediately. Which means, suppose you want to resign after the end of the second quarter. You want to resign after the end of the second quarter. Resign within 45 days from the end of the second quarter. So that you have to give review report for that quarter. Anyhow, since you are already late from first quarter after 45 days. Anyhow, you are late after 45 days. So that point says what? Give report for Q2 and Q1 both. Now compared to Q2, from Q2, you are resigning within 45 days. So give report for Q2. That's what the condition also says. Yes or no? Both the conditions you have to satisfy. Getting it? If you are resigning within 45 days from the end of the quarter, give review report for that quarter. After 45 days, that quarter, then next quarter. Suppose I want to resign on 20th August, which is 45 days after Q1. After 45 days. So I have to give review report for Q1 and Q2. Okay, I decided to continue and give Q2 report. And finally, I want to resign by October 15th. What is October 15th? From the end of second quarter, it is within 45 days. Give review report for quarter 2. That's it. So give review report and then resign. Suppose if you belatedly want to resign after November 15. If you want to resign after November 15, it is impossible. If you want to resign November 15, what happens? You have to give review report for Q2 and Q3. Okay, you will give. And those who give review report for Q2 and Q3 must give review report for Q4. Obviously, you have to give annual audit report. That's it. Able to understand? So with this, the resignation topic is also completed. Then next, what is the manner of resignation? How you should resign? First, whenever you want to resign, first report your concerns straight away to chairman of the audit committee. Especially if you want to resign because of non-availability of information, non-cooperation from the management, you shall approach audit committee. Getting it? Then all concerns with respect to proposed resignation means what? Before you resign, whatever concerns you are having, please bring it to the notice of all members of audit committee. Suppose if the proposed resignation is because you are not receiving explanation, the auditor inform the audit committee and details of information explanation sought and not provided by management. Mention to the audit committee that I requested management information but they are not providing it. With this kind of attitude, I can't continue the audit, I can't obtain sufficient appropriate evidence. It is better for me to withdraw. On receipt of such information, the audit committee or board of directors, getting it, shall deliberate, means shall take further steps on the matter and communicate their views to the management and the auditor. Okay, you're not receiving information. We will talk to board of directors, remaining directors, and what happened we will speak, and finally we come back and we will come back and let you know like what are the things happen. If at all finally we also decided, okay sir, you can take your final call. This is the situation in the company right now. Then you can take the final call. Able to understand? It's nothing but opportunity of being hurt. Even in resignation provision also, before you take a resignation call, you have to give an opportunity of being heard. It is compulsory. Getting it? Suppose if resignation is not possible, then you have to give disclaimer of opinion. If resignation is not possible. And remember, the manner of resignation, how auditor shall resign. Before he resign, he must bring all the concerns to the members of audit committee and to the chairman of audit committee. Audit committee will talk to board and auditor and then resolve the matter. If still that is not possible, then only auditor has to take a final call. Entire this shall be put as a condition in the appointment letter itself. And even whenever listed company auditor is appointed, these conditions must be mentioned in appointment letter. In the appointment letter of the auditor, look, you can't resign just the way like you want. This is the condition as per, LODR regulations. You have to follow all these regulations. These conditions for resignation, process of resigning from the company, this entire stuff has to be mentioned where? Appointment letter. It is compulsory. Able to understand? So that is what the last point says. So the conditions has to be included in appointment letter. Suppose if already appointed, appointment letter do not include, revise. Give a modified appointment letter mentioning these conditions. Getting it? And company secretary of the company shall certify compliance regarding this. That's it. With this, audit committee, resignation, corporate governance topic is completely done. Are you clear? And there are many topics in this chapter which are to be discussed by you, which are to be read by you in depth. And that can only be done from law material, not audit material. Because in audit material, they have not given properly the entire illustrations also not there. Practice questions also not there. You open ICI material, audit committee questions, governance chapter you open. So many concepts discussed over 30-20 pages. Yes or no? And they will not have single illustration. Single example also will not be there. But in examination, what they are asking, MCQs and all, they are asking case studies on this. They are asking practical questions on this. So for that, what you need to refer in order to get a proper understanding? Law book. All of you clear? That's it. So with this, audit committee chapter is done. So we'll discuss on peer review. Look, peer review statement has been revised in 2021. Like if you look at May 2021 examinations, peer review statement 2020 was applicable. December 2021 examination, peer review statement 2021 is applicable. Getting it? Of course, now the May 2022 examinations, which is going to be held, obviously November 2022 examination. For that also, peer review statement 2021 will be applicable. There is an authority called peer review board, and they have issued a peer review statement 2021, which is the latest statement. Before this, it's peer review statement 2020. Now this statement is applicable from December 21 and May 2022 exams and even for November 2022. Now the upcoming attempt is November 2022. For this also the same statement is applicable. This is the latest statement. Now I showed you in ethics chapter also when I am discussing peer review board is not a separate authority. It's part of ICI. Like in a company, how audit committee, risk management committee, nomination committee, how the committees are formed. Same way, ICI also, all the central council members will form various committees. One such non-standing committee is peer review board. So peer review board is a non-standing committee. After we give the audit report on audit, we are subjected to various types of reviews, various types of verifications from regulatory authorities. One such review is peer review. And another such review is quality review. And for ensuring tax audit, whether are you rendering qualitatively or not, we have tax audit quality review board. And there is another authority called financial reporting review board. There is another authority called financial reporting review board. Right now it is not very active, it is passive, not highly active. So what this financial reporting review board actually works is they verify how the company's financial reporting process is. They verify not audit, but they verify on financial reporting processes. Getting it? And apart from this, we have a review by NFRA. NFRA review is there, which is more severe, which is more dangerous. Apart from this, we have SEBI inspections, all that inspections under law, Argos inspections in respect of company accounts, getting it, RBI inspections in respect of banks, IRDA inspection in respect of insurance companies. These are all for companies. But as an auditor, we are subjected to these kinds of reviews. Now, in our syllabus, we have only peer review and quality review. The primary difference between peer review and quality review is, first of all, peer review is conducted by peer review board. Quality review is conducted by quality review board. Peer review board is within the ICI power, within ICI committees, whereas quality review board is a committee constituted by central government. It's a board constituted by central government by virtue of power given by ICI Act. In ICI there is some section, some 28B, some section is there. As per CA Act, you know, CA Institute has given power to central government to constitute an external authority to monitor quality of attestation services provided by members. So accordingly, central government has constituted quality review board. Now, peer review board is constituted by ICA. Now, peer review board and quality review board, what they do? They just review audit quality. What they review? They review audit quality, audit services, whatever we members are providing. So the service, how are we providing? Are we complying with technical standards? Are we complying with professional standards? Are we complying with code of ethics? All this, are we establishing quality control practices in our firms when we are running as a practice? Are we following with all these or not? This peer review board, quality review board, both will check on similar lines. But peer review board, the objective of checking is to figure out where and all members are lacking behind and accordingly give them a push, give them some encouragement, give them a reprimand, give them warning. That's the only purpose. The objective of peer review is not to punish a member, not to fault find. Getting it? Whereas the objective of quality review board is to find faults. Getting it? The main objective of quality review, where and all auditor has violated. There is a difference between not following the technical standards, violating technical standards. Getting it? Suppose if you do not follow a rule, it is not necessarily a violation. The word violation is much more severe than non-compliance. Remember, non-compliance is different, violation is different. Violation is very severe. Getting it? It's like, so quality review board main objective is to figure out violations that were made by statutory auditors while conducting audits. Now, if quality review board figure out, violations and all, they will straight away refer to disciplinary committee or disciplinary directorate. Actually, as per CA Act, quality review board refers to council. If any issues were there, they have to refer to council and the council has to refer to that disciplinary directorate like that. But the ICI Council gave a direct power to Quality Review Board to directly contact with the Disciplinary Committee, Disciplinary Directorate in case if Quality Review Board finds any lapses. Able to understand? Now, the basic terminological difference is peer review and here it is quality review. Now, whom we will review? An audit firm. What we will review? The files or the audits which they perform. Here, the audit firm is called as practicing unit. Here it is called as audit firm under review. Here, the person who is conducting peer review is called as peer reviewer. Here we call him as technical reviewer. Getting it? Now, between peer reviewer and between peer review board and peer reviewer, there is no mediation authority. Whereas between quality review board and technical review board, there is something called quality review group. There is something called quality review group. Are you getting it? Now, what else we are going to cover in this chapter? Now, who can be appointed as a peer reviewer? Nothing but what are the qualifications of peer reviewer? What are disqualifications of peer reviewer? What is peer review process? Getting it? And what is peer review certificate? In peer review, we give a certificate after completion of peer review. Whereas in quality review, there is no such certification. In quality review, the objective is, I'm telling you, to find a fault. Whereas in peer review, the objective is to certify whether the members are following with all technical, professional, all ethical standards. Getting it? Now here, what is the process of quality review? What are the qualifications of technical reviewer? What are the disqualifications of technical reviewer? What is technical review process? How quality review groups participate? Getting it? In the overall, this quality review process, what is the importance of quality review group? And finally, what quality review board will decide? So all that stuff we are going to discuss in the chapter called peer review and quality review. Clear everyone? Now, so if you look at this website of the ICA, we have various committees as I told. Non-standing committees, we have peer review board. You can identify here what are the list of firms that were having peer review certificates. What are the list of firms having valid peer review certificates? These are the firms which are having valid peer review certificates. So they have given, like in peer review, the firms are classified into two categories. The firms are classified into two categories. But you will find category 3 as well. Actually, you will find level 1, level 2, right? You will generally have 3 categories of the firms. Correct? So what are the categories of the firm? What are the categories of the firm? So we have in peer review certificate list, we even have level 3 firms. Getting it? But if you look at peer review statement 2021, peer review statement 2020, the firms are broadly divided into 2 levels, level 1, level 2. Older peer review statements, there the firms were divided into 3 levels, level 1, level 2, level 3. What you might have learned is for level 1 entities, for level 1 practicing units, the peer review shall be conducted once in 3 years. For level 2 practicing units, the peer review shall be conducted once in 4 years. But for level 3, it should be conducted once in 5 years. Now, after 2020, all these audit firms are broadly classified into 2 levels. Getting it? Level 1 and level 2. 3 years and 4 years. For level 2 practicing units, the certificate given is valid for 4 years. For level 1 practicing unit, peer review certificate given is valid for 3 years. Earlier we have level 3. The certificate is valid for 5 years. So that's why you see here, you will find the list here. You see, what is the validity period of certificate? It is approximately more than 5 years. Because of COVID, 1 year extension was given. Because of COVID, 1 year extension was given because in 2020, 2021, peer review was not conducted properly. So due to which, many firms, peer review certificate was expired. So validity extended for all these firms by 1 year straight away. Getting it? So that's why you see for level 3 here, the validity certificate is for 6 years. Actually, it is 5 years, but after extension, it is 6 years. Okay, this is downloaded before you right now from official website of the institute. These are the forms which were there in India. These were the forms which are there in India when the certificate was given, up to when it is valid, and what is the level of the practicing unit. Now, what is the peer review process? What is the peer review process? At first, the peer review board. See, peer review board is the central, communication point between everyone. Okay, the peer review board first sends, peer review notification to audit firms. Nothing but let us use the technical terminology now. So to practicing units. Now practicing units have to send a declaration to peer review board. In that particular declaration, this practicing unit shall send some information, nothing but they have to send some information to peer review board. Now based on that information, peer review board will fix, is it a level 1 or is it a level 2? Sir, which practicing units falls under level 1? Which practicing unit falls under level 2? We'll discuss later. Getting it? So, based on the prima facie information collected by peer review board from practicing unit, peer review board will decide whether that practicing unit is a level 1 or level 2. Based on this criteria, the peer review board will select one peer reviewer names. They will select 3 names. They will select how many names? 3 reviewers. They will identify 3 list of reviewers. Now, these 3 list of reviewers will be intimated to practicing unit. Okay, practicing unit, I got through your information. I know you are level 1 entity. Now, I wanted to conduct peer review of your audit firm. Now, these are the 3 reviewers I am recommending. Select any one. Suppose if practicing unit do not like any of 3, they can ask for request. In such a case, peer review board may change the recommendation. Getting it? Suppose if practicing unit selected among A, B, C, some B was selected by practicing unit. Now, Mr. B will be intimated by peer review board. Mr. B, you are selected as a peer reviewer for so and so XYZ and Co chartered accountants, which is a level 1 entity, which is located at so and so location. This is the affairs of the company, affairs of the firm. So they will send an intimation. Now this reviewer has to give his consent. He is interested to go or not. If at all he is not interested, once again process will start from the beginning. Getting it? Because he was selected and he was intimated. He was selected first by practicing unit, then he was intimated. Suppose he didn't accept, what we need to do? Once again we need to communicate practicing, sorry, Mr. B was not accepting, take another list of people. Among these 3, whom you will select. So it will process. The process will go like that. Now, suppose B accepted. Now, whatever peer review board has received the data about the practicing unit, the peer review board will instruct. The peer review board will instruct the practicing unit, dear practicing unit, Mr. B also agreed to conduct peer review for you. Please send your entire firm data to them. What the practicing unit will send? The practicing unit will send what are the audits that they performed in the last 3 years. What are the audits they performed in the last 3 years? Client names. And what is the fees charged? What is the turnover of the client? What is the number of days they performed the work? Getting it? So likewise, they will send a summary sheet to the peer reviewer. Sometimes you may not to, if you wish not to give client name, you can give client code. Getting it? Client code 105, client code 107, client code 109. Why some practicing units they don't give names of the clients. Whenever they are submitting information to peer review board or when they are submitting information to the reviewer, they don't give name of the clients. By giving name of the clients, we are unnecessarily influencing his selection process of the file. Yes or no? So some practicing units will send client codes to the reviewer. Now, what is client code so and so thing? This is the turnover. These are the number of days. This is the fees charged by the firm. So based on that, the reviewer will select some files. Okay, dear Mr. Practicing Unit, I am selecting 5 files totally for peer review. Take 5 days time. I am coming for so and so on-site visit. I am coming for on-site visit and I will review all the documentation. Take 5 days. Make every documentation ready. If at all it is there somewhere in Godon, bring everything. And then practicing unit should make everything ready. Now peer reviewer will come for on-site visit. The maximum number of days on-site visit shall not exceed 7 days. Maximum how many? 7 days. On-site visit means what? Maximum number of days I can go and verify the practicing unit at their location. I will go through all the files. I will go through all the quality control practices. I will verify entire, working papers and how they are taking conclusions, how documentation standard is complied, how evidence standard is complied, how SA 250 is complied, how SA 700 is complied. Every compliance I will check. I will see SQC, whether company has implemented all SQC requirements, all SA 220 requirements followed whenever they are doing audit or not. I will check in all parameters. Finally, I will prepare a preliminary report. Finally, I'm a reviewer. I will prepare a preliminary report containing my observations and remarks. I will give this preliminary report to practicing unit. See, this is a preliminary report. These are the objections I have right now. Give me your answer. And along with the practicing unit, I will also submit the preliminary report to peer review board. And once the reviewer received a reply from practicing unit, once the reviewer received a reply from practicing unit, that reply shall also be forwarded to peer review board. Now, the reviewer, he gave a preliminary report. They gave remarks, observations or rectifications or whatever. Getting it? Finally, keeping all this in mind, I will prepare my final peer review report. This final report I will submit to peer review board. Now board will check. So what are the objections or qualifications raised by peer reviewer? If at all these objections and qualifications are not so severe, according to the peer review board, they will straightaway issue peer review certificate. Getting it? Suppose if peer review board felt these qualifications are something material, something cannot be tolerated, they will not issue peer review certificate. They will immediately order for follow-up review. What is it? Follow-up review, which shall be completed within next 1 year. If at all practicing unit cannot wait up to 1 year, they can request to reduce the limit. Maximum limit that can be reduced is up to 6 months. These are the time limits. And first of all, this entire peer review process shall be completed within 60 days from the first date when peer review board intimated to practicing unit that it was selected for peer review. So from the date of notifying practicing unit by peer review board for conducting peer review, from that particular date within 60 days, this entire process has to be completed. This is peer review process. Able to understand? Now, who can be a peer reviewer? Can he take help of an assistant? What are his qualifications? What are his disqualifications? What is level 1 practicing unit? What is level 2 practicing unit? What is peer review board? What are their powers? What are their composition? That is what peer review syllabus is. Clear? So first, if you have an understanding of the entire process, internally whatever you are reading is quite easy. So what is peer review? See, actually if you look at the ICA book, or if you look at my main material also, the discussion will be so much. The actual discussion will be so much. But that is not required right now. For revision class, this is enough. Peer review means what? You are verifying, reviewing systems, procedures to check whether the same have been put in place by the unit for ensuring quality of assurance services. And look, peer review is only focusing on assurance services. Any services which are provided by peer review which do not fall under assurance service category, they are not covered within the scope of peer review. Same way, in quality review, only statutory audit of companies is covered. Comparatively, the peer review scope is very higher compared to quality review. In quality review, not every assurance service is covered. Only stat audit is covered. Non-statutory audit, other than assurance on other than historical financial information, they are all not covered in quality review. Whereas in peer review, every assurance service is covered. It may be stat audit, non-stat audit. Able to understand? What? Fine. Next. Now, who is a reviewer? He is a person who has been duly approved by peer review board and properly registered with the board. Empaneled means what? Registered with the board. Now, what is a practicing unit? It is a firm of chartered accountants. That firm can be an individual or can be practicing in the name of a trade name. So, it may be a sole proprietary firm or it may be a partnership firm. Doesn't matter. What is the main objective of the peer review? This is an important question. What is the objective of peer review? By the way, peer review can only cover what? Assurance services. First, let's look at what are all assurance services? What do you mean by assurance services? So this has been tested many times in examination from this chapter. So what do you mean by assurance services? What assurance services do not include? What assurance services do not include? Assurance service do not include consultancy works, representation before authorities, tax return preparation works, compilation works, providing expert opinion on principles, due diligence, getting it? Or preparing, compiling, collating information related to some other stuff, not financials, or testifying as an expert witness. See, witness is different, expert witness is different. Expert witness means, suppose if a doctor is giving an opinion, if a doctor is giving a witness, then expert witness we call it as. If CA is giving a witness, then it's called expert witness. If at all we are giving any witness in any regulatory authority in professional capacity, then it is called as expert witness. Generally, court, whenever some proceedings are going on, they want witness for everything. Normal they'll call witness. Not everybody is expert witness. They are just a witness. Expert witness means if in professional capacity if I am giving as a witness, then it is called as expert witness. Able to understand? All of you. So here you can keep any 4 points in your mind. Getting it? What assurance services do not include? What assurance services do not include? You can keep this answer. This is important question. Clear, all of you? Next. So the main objective of peer review is to check whether the members of the institute comply with technical, professional, ethical standards. So what are technical, professional, ethical? Ethical standards means code of ethics. Professional standards means standards on auditing, standards on accounting, guidance notes, all that. Guidance notes, all that come under technical standards. Getting it? Guidance note on audit of bank, guidance note on audit of insurance company, guidance note on audit of NBFC. These are all technical guides. These are all technical, industry specific guides. Are you getting it? Then, whether these practicing unit have in place proper systems including documentation thereof to amply demonstrate the quality of assurance service. Like, see, in SQC if you check, SQC there are so many requirements. Getting it? The firm should have HR, human resource policy, human resource training. The firm should have policies and procedures related to audit. The firm should have policy and procedure related to independence. The firm should have policy and procedure related to acceptance and continuation of client relationship. Likewise, standard on quality control has policy and procedure requirement for so many. If you see SQC, it always starts with see whether the firm has policies and procedure, policies and procedure, policies and procedure. What is the policy and procedure? It should be documented. It should be documented. Which client? When a client comes for, when a client approaches your office that he wants some work, can you accept the client? You have a procedure, you have a policy. What points you have to check in order to accept a work? It must be documented. So written, documented quality control practices must be there. If at all that is not there, peer reviewers straight away give modified opinion. Able to understand? So we have seen in reality, there are many firms which are maintaining quality control practices documentation. Getting it? Thus, the primary objective is not to find out deficiency, but to provide, to encourage members to improve quality of services. And clarifications have given. The peer review does not seek to redefine the scope and authority of technical professional standards, but only seek to ensure that they are implemented. See, in many standards, they use the word professional judgment of the auditor. If auditor applied professional judgment and chooses that it is immaterial, a particular item he felt that it is immaterial, peer reviewer shall only check whether materiality standard followed or not. Why you fixed this item as immaterial? Why you fixed this item as material? He cannot question the actual your work. He cannot. He just have to check, have you followed materiality standard? Yes, it is followed, it is applied. Have you followed documentation standard? Have you followed reporting standard? That's it. He will not sit. Why you gave qualified opinion? Here qualified is not required. Your reason is not proper. That and all peer reviewer cannot question. He cannot enforce the applicability of the standard or enforcement. The following of the standard. He can only see, is it followed or not? Is it applied or not? That's it. The key objective of peer review is not to identify engagement failure, but identify weaknesses which are pervasive and chronic in nature. So the conclusion, peer review seeks to identify and address patterns of non-compliance with quality control standards. Scope of peer review. The scope of peer review as per the statement. As per the statement of peer review, the scope of peer review revolves around compliance with standards, quality of reporting, office systems, procedures, compliance with assurance engagements, training programs for staff, including article and audit assistants. So how the firm is, making sure that whatever the work they are taking up, they are discharging it with utmost competence, utmost care. So that is what peer review will verify. Peer reviewer will verify. An entire process is directed at assurance services. What is assurance services? Which has assurance service means assurance engagement as defined in framework for assurance engagements issued by them. They do not cover related services. And this word can be used interchangeably with the audit, attestation and audit functions. So what is technical, professional, ethical and standard means what? So they have given the meaning also. So you can look at that. Now, applicability of the peer review. To whom the peer review is applicable, first of all. It is compulsory for certain firms to go for peer review. That is level 1 firms, it is compulsory once in 3 years. They have to compulsorily be reviewed by a peer reviewer once in 3 years. Level 2 firms has to be reviewed compulsorily once in 4 years. Special case review. Suppose if the secretary of the ICI, disciplinary directorate or any other committee has received a complaint, in their opinion, that practicing unit, whether are they doing everything properly or not, they want to check. On a special reference to peer review board by ICI. If ICI or any of the committee specifically request peer review board, please go and do XYZ and Co peer review. Then in such a case that XYZ and Co will be selected. Or voluntarily firm itself called. Our firm itself called voluntarily how far we are complying with standards, how far we are complying with quality control practices. So our firm itself voluntarily want to know. Then firm can apply for peer review or the client might have requested. Suppose a big client approaches our office and he verified he want to give us audit, and at the end of the discussion he asked us whether do we have peer review certificate. We said no. The client immediately told, how can I know that you follow all the quality standards? And moreover, the work which he wanted to give me is internal audit. So he want to know how far I'm following quality standards. So client requested peer review board. He sent a mail to peer review board to do a peer review. Or the board with the approval of the council can modify the above criteria. Getting it? If central council total 40 members, if at all a meeting has been convened and if they agree, the above criteria can be changed. So what is the periodicity of a peer review? For level 1 practicing unit, once in 3 years will do. For level 2 practicing unit, once in 4 years we will do. A shorter interval is also, maybe decided if peer review board decided. If peer review board decided, at a shorter interval also they can conduct peer review. Now what are level 1 practicing units? What are level 2 practicing units? Level 2 practicing units, simply you can keep a definition that any unit other than level 1 is simply a level 2 practicing unit. Now what are all falls under level 1 practicing unit? If a practicing unit has undertaken any of the under-mentioned assurance services in the period under review. What do you mean by period under review? Last 3 years. Last 3 years before the review year. Suppose today the date is 15th September 2022. Okay, which means right now we are financial year 22-23. Before this 3 years means what? 21-22, 20-21, 19-20. So in this financial year, whatever firms are going for peer review, what is the peer review period? Excluding this year, last 3 years. In these 3 years, if you have undertaken any of these works, getting it, then you are classified as, you are treated as level 1 practicing unit. Are you clear? Now, what are level 1 practicing units? If at all, the firm which I am a partner, if my firm has conducted statutory central audit of any bank or insurance company, if my firm has conducted statutory central audit of any bank or insurance company. You see here they use the word, if at all I did only a statutory audit of a bank, statutory audit of insurance company, they didn't use the word central. They didn't use the word central. Means which audit? It's a branch audit. It's a branch audit. Able to understand. Only if at all the word central is used, it's a statutory central audit. If simply the word statutory audit of bank, if the phrase is a statutory audit of bank, which means what? Branch audit. Able to understand. So, statutory central audit of insurance company, if at all you did, or bank you did. You know, in India, we hardly have 30 insurance companies. Only 30 or 35 insurance companies we have. When I'm discussing insurance audit, I'll discuss about that. Next. Statutory audit of central or state PSUs. And statutory audit of cooperative societies having turnover 250 crore or having net worth exceeding 5 crore. Net worth is 5 crore, not 50. It's 5. Getting it? Turnover exceeding 250 or net worth exceeding 5 crore for a central cooperative society. For a central cooperative. What is central cooperative society? If a cooperative society registered under Central Act 1912, then that is called as a central cooperative society. If a society is registered under a respective state act, it is called as state level cooperative society. Are you clear? Next. Suppose you are doing stat audit of asset management companies or mutual fund companies. Then you are called as level 1. You are an auditor of listed entity. Getting it? Then also you are treated as level 1. Or you are doing stat audit of any body corporate including trust which are covered under public interest entities. PIE. If at all you are doing audit of public interest entities, those entities where public interest is substantially involved, those entities audit if you are performing, you are also called as level 1. Or you are doing audit of an entity which raised funds from public or banks or FI by way of donation or contribution over 50 crore. Suppose if my client is a private limited company. They got a bank loan for more than 50 crore. Again, public interest involved. Getting it? Bank loan means what? Public money. So this is given as loan to my private limited company client. Even though it's a private limited company, since public money involved is how much? More than 50 crore. Then again, my firm is classified as level 1 practicing unit. What is it? Level 1 practicing unit. Or if I am doing audit of an enterprise having net worth more than 100 crore or having turnover more than 250, in these cases, private companies, high possibility is there that may come. So don't assume just because they may give you a question like this. All private limited companies, if at all a practicing unit is providing audit of private limited companies, they may not come under peer review. False, incorrect. If a private company is having net worth more than 100 crore or having turnover 250 crore or more, then it is treated as level 1 entity and our practicing unit performing work of that entity is treated as level 1 practicing unit. Are you getting it? Remember, in every case, the common word used is statutory audit, statutory audit. If at all you are providing any other services, it is not considered. If you are providing internal audit, it is not considered. Able to understand? Next. Or you are providing statutory audit of NBFC having deposits of 100 crore or more. If an NBFC is having deposits of 100 crore or more, then also it is treated as level 1 enterprise. Payments bank. Payments banks are all NBFCs. Of course, they're actually banks. Payment banks like Airtel, Paytm, Jio Payments Bank. Payments bank license hardly given for 4 or 5 enterprises in India. And finally, stat audit of entities preparing financials as per Ind AS. Getting it? If at all you are doing an audit of an enterprise who are preparing financials using Ind AS, then your audit firm will be treated as level 1 entity. Getting it? What is the significance of this level 1, level 2? What is the significance of level 1 and level 2? Peer review board will select appropriate reviewer according to his experience, the number of reviews carried out. According to the experience of the reviewer, they will allocate such experienced person depending upon your criteria. If at all you are level 1, a set of reviewers are there. If it is level 2, a recently qualified peer reviewer can be sent to verify your compliances. Suppose I never do audit of listed entity, but I am an empaneled peer reviewer. Getting it? If at all I was sent to conduct peer review of a firm which has undertaken listed entity audit, how can I do review? When I don't have experience. So the peer review board want to know the information exactly. At the same time, for a small firm where they don't have company client at all, where they only perform tax audits. Tax audit is also stat audit for your information. Tax audit is also a stat audit. So no. Statutory audit means what? Audit, if it is compulsory under law, it's a statutory audit. Under income tax, the audit is compulsory. It's a statutory audit. For the convenience sake, we are calling it as tax audit. Are you clear? And what are all level 2? If at all the practicing unit has undertaken any of the undermentioned services, they will be treated as level 2. Statutory internal concurrent audit of the or branches, review of branches or offices of PSU, any bank, insurance. Statutory audit of NBFC which not covered under level 1. In level 1, which NBFC is covered? Having deposits 100 crore or more. Yes or no? Any other NBFC which do not has deposits at all, or NBFC which has deposits but less than 100 crore, they all fall under level 2. And UDINs generated by practicing unit is more than specified number determined by the board. Suppose if at all your practicing unit has generated, your firm has generated more than 2000 UDINs in a year. If peer review board decided criteria for that year as 2000, you will be selected for peer review under level 2 category, prima facie, or any other services provided by practicing unit not covered under above 3. Nothing but this is a residuary clause. Indirectly what it says, any other services provided by practicing unit, nothing but if you are not a level 1 practicing unit, by default you will fall under level 2 practicing unit. By default you will fall under level 2 practicing unit. Able to understand? Earlier this point is not there. Earlier, not now, earlier. That time they are all coming under level 3. That time they are all coming under level 3. Next. Able to understand all of you? Now how to check? First you apply all level 1 criteria one by one. If any one criteria fulfilled, that's it. It's a level 1 practicing unit. Nothing is fulfilled. Then automatically no need to check level 2. It's a level 2. That's it. So totally 10 criteria. This itself can be asked as a 5 marks or 4 marks question. What are all when a practicing unit is treated as a level 1 practicing unit? Elaborate any 4 or 5 criteria. So they'll ask you to write any 4 or 5 criteria. Suggested answer will have entire these 10 points. If you write any 5 matching points, you'll get full marks. Getting it? MCQ can be asked, or correct or incorrect question can be asked on this. Next. Then peer review board. I'm not discussing peer review board. Okay, peer review board will have maximum how many? 12. 50% will be coming from council. Getting it? And the council may nominate even outsiders also. And chairman and vice chairman will be elected on year to year. Term of the members. The chairman and vice chairman will be rotated every year. Remaining members' term is maximum 3 years. 2/3 of the members shall be rotated for every 3 years or end of the term of the council. Suppose if the council term is expired, no, that time they will be vacating the board also. Getting it? So otherwise they will continue maximum up to 3 years. So once in 3 years, 2/3 of the peer review board members shall be changed. Meeting requirement not required. Eligibility of peer reviewer. Now, if you want to become a peer reviewer, what is your eligibility? First of all, you must be a member of the institute. Even technical reviewer is there in quality review. There also he must be a chartered accountant. So peer reviewer or technical reviewer in case of quality review, in both the cases, the fellow must be a chartered accountant. So he must be in practice with at least 7 years of audit experience. 7 years of audit experience. Suppose you are not in practice. You moved very recently from industry to practice. By the way, here understand what is meant by practice. Deemed to be practice, certificate of practice, all that discussion do not apply. That is only in respect of code of ethics, not in respect of any other discussion. Able to understand? So, in case a member moved from industry to practice and is right now in practice, means in order to be eligible for a review, you must be currently in practice. Currently you must involve in practice. And if at all you are a person who moved from industry to practice, at least 10 years in industry experience is required and at least 3 years audit experience is required in the practice, which means now if I have to be a reviewer, from the past 3 years I must be in practice. Before that 3 years, 10 years I worked with the industry. Now here, one confusing word I'll tell you. If at all you don't have that confusion, you can ignore happily. Now, 10 years audit experience in industry they used. They used the word 10 years audit experience. To best of my knowledge, what I felt is this is a mistake happened in copy pasting. The provision and all will not be drafted regularly, no, yes or no, with a clear-cut experience. What is 7 years audit experience in industry? 10 years audit experience in industry means only if I work in audit firms, I will get audit experience. Suppose if I am working in Flipkart as associate finance manager, example, from past 10 years I am working in that field, in that area. I moved into practice. 10 years, do I have audit experience? See, internal audit if is there, maybe, yeah, I can satisfy. Otherwise, so I don't think this is exactly audit experience their intention. I don't think this is audit experience their intention. Maybe if I apply your logic, internal audit experience, maybe in such a case, the possibility of number of reviewers moving from industry will be very less. Getting it? Okay, on a conservative note, considering reasonable interpretation, 10 years audit experience in industry means what? You may be working in any company. If at all you are working in internal audit department for more than 10 years, then only you are eligible to become a peer reviewer, provided you withdrawn from the job, started your practice, completed at least 3 years. Are you getting it? All of you. Probably here, by using the word audit experience, they are restricting the scope of number of peer reviewers eligibility. Getting it? By the way, this is updated review criteria. Earlier, peer review statement 2020 has a different criteria. For level 1 practicing unit, what is the eligibility to become a peer reviewer? For level 2 practicing unit, what is the eligibility of the peer reviewer? There is a different classification. Now there is no such thing. This eligibility of peer review means what is eligibility of peer review? Which chartered accountants can empanel with peer review board? Simple. Getting it? Now, whether you will be selected for conducting peer review of level 1 unit or level 2 unit, the board will decide. You and me need not decide. Understand, all of you? And the peer reviewer should have undergone training and cleared test of peer review as prescribed by board. So peer review board will conduct peer review test. Only once you qualify the test, you are called as a certified peer reviewer. Getting it? And you are empaneled onto the board. And remember, just because you are empaneled on the board, that doesn't mean you will be allotted peer review works. If at all board want to allot, they'll allot. There are so many reviewers on the board who are not having any work till date. Able to understand? Now, the person, if at all you're appointed as a reviewer, you have to furnish a declaration prescribed by the board at the acceptance of peer review appointment and sign a declaration of confidentiality. And the following person shall not be eligible for being appointed as a reviewer. You cannot empanel as a reviewer if any disciplinary action is taken or proceeding is pending. If any disciplinary action has been taken in past, you are straightaway disqualified to become a peer reviewer. You cannot. Whether this disciplinary action was taken last 3 years or last 5 years or last 10 years, that criteria is not given. In the past, if at all a disciplinary action is taken, once done a mistake, forever boycotted for peer review. Getting it? Next. Or you are found guilty of professional or other misconduct. Or you are convicted by court, okay, of an offense involving moral turpitude and you are punished with imprisonment. Less than 6 months, more than 6 months, nothing is given. If at all you are punished with imprisonment for even 1 month, you are prohibited to become a peer reviewer. See, becoming an auditor itself have so many disqualifications. In order to verify quality of audit performed by auditors, imagine the stringent level of disqualification. So this itself shows very clear. Once you are imprisoned, forever you are disqualified to become a peer reviewer. If at all a disciplinary action is taken, a misconduct was proven, you are forever prohibited to conduct peer review. Getting it? his partners, he or his partners or personnel has any obligation or conflict of interest in the practicing unit. In such a case, to that practicing unit, you cannot be appointed. To that practicing unit, you cannot be appointed. This is a firm-specific disqualification. Or you have undergone articleship training under any partner of the practicing unit. So wherever I did articles, to the same firm was allocated to me under peer review. I cannot do peer review. This was added in 2021. Able to understand? Totally 5 disqualifications. Remember, this is important question. What are the disqualifications of peer review? And further, when a practicing unit will be allocated to you, suppose I'm a peer reviewer, XYZ & Co audit firm is there. I was appointed as a peer reviewer. One condition I should satisfy. I was appointed as a peer reviewer, right? I should look back past 2 years. Between this firm and me, there is no any other common works we have. I didn't help them or they didn't help me. In the last 2 years, we don't have any association. After completion of peer review, next 2 years also we should not have any association. So a reviewer shall not accept any assignment from the PU for a period of 2 years from the date of appointment, and they should have not accepted any assignment for a period of 2 years before the date of appointment, because your review covers last 3 years. Your review covers last 3 years of the assurance works. If at all, in the last 2 years, if you performed any work, and that work you selected as a sample and you are reviewing, is it creating self-review threat again? Exactly, same logic. Getting it? All of you. Now, can a reviewer take the help of an assistant? Yes, provided he is a qualified chartered accountant. Getting it? He can take only a qualified chartered accountant. Right. Next, a reviewer is permitted to take help of only one assistant. Getting it? And remember, he does not attract any of the above disqualifications. Say, my assistant should not be article in the practicing unit. The name of the qualified assistant shall be intimated to the board, even to the practicing unit, before commencement of the work. Qualified assistant shall also have to sign the declaration of confidentiality. He should not directly interact with the practicing unit or with the board. He will only help the reviewer. You don't have any authority to talk with the board or the practicing unit. If you have any issue, talk to me, I will talk to them. That's it. Confidentiality point, it's a very simple point. Approach of the reviewer. Approach. So when I'm doing peer review, what is my broad approach? What I will focus? Most important document that I will focus is engagement letter. Suppose practicing unit has performed in the last 3 years 100 audit signs, 100 audit files they have. Out of 100 audit files, I have selected 5 files for conducting peer review. Audit files, all are stat audits. I have selected 5 statutory audit files of the practicing unit for verifying under peer review. First and foremost important thing what I'll verify is, first of all, why this practicing unit was appointed. For what they were appointed exactly. See, I need to verify what they worked on. First of all, what they are supposed to work on and what they actually did. That's how I need to verify that. So where can I find what is the scope of practicing unit in a particular audit? Engagement letter. So engagement letter defines scope of audit undertaken by practicing unit. So peer reviewer first focuses on engagement letter in a particular file. Able to understand? Then, how many assurance engagements you will select as a sample? It depends upon various factors. The factors were given below. The factors were given below. The number of assurance engagement, the selection of sample. Okay, it depends on many factors. Selection of assurance engagement for review. What factors you will consider? The standard of quality control prevailing in the firm. Size and nature of assurance service engagement undertaking. So what is the size of the client? What is the nature of the business? Methodology generally adopted by practicing unit. What methods they are following? How many partners they are having? How many CAs are involved in that audit work? Number of locations and branches the practicing unit is having. How much fees they are charging? How much GST they are paid? Getting the point? By looking at all these factors, very simple. If they are having more number of locations, I will select a file from each location. Suppose if the practicing unit has head office at Chennai, branch office at Bangalore and Hyderabad, I want to select 3 files. I will select one file of Chennai, one file from Bangalore, one file from Hyderabad. Then fees charged. The practicing unit is charging statutory audit fees ranging from 50,000 to 50 lakh. I will select a 50 lakh file. I will also select a 50,000 file. I will select a 10 lakhs file also. Able to understand why I am selecting? I want to see, are they following quality control practices even though the fees is low? Not only at fees is high. Able to understand? I want to check in all the dimensions. Getting it? Suppose number of partners involved. Suppose if the practice unit is having 5 partners, I will select files performed or signed where these 5 partners acted as engagement partners. I will select 5 partners related files, or I will select 3 partner related files. Able to understand how my selection affects. Methodology adopted by practice unit, that's normal thing. Size and nature of the assurance engagement. This is based upon the client. This is based upon the practice unit's client. That's it. So that is the approach. So number of assurance, and first you examine policies and procedures of the practicing unit. You will verify quality control practices of the practicing unit. You do compliance test of all these policies, independence related policies, acceptance of client related policies, HR policies, getting it, engagement quality related policies. They have so many policies. First I'll see how far they're having policies, how their file management, how their server management, how their confidentiality requirement, how they are having systems to enable this confidentiality, all that. And finally, I will take their working papers. That is called substantive test. Getting it? And check whether auditing standards are followed, accounting standards are followed. Getting it? Guidance notes are followed or not. Then, what are the duties of the practicing unit? They have to give access to records to the reviewer. They have to inform the reviewer, explain the reviewer if at all he is having any doubt. They should help the reviewer throughout the review. They should give clarification whatever the reviewer is asking. Same way, reviewer is also having some duties. First of all, he should not take any extract of the practice unit client papers. Client related document you should not take. Suppose you want to take you want to document practicing unit quality control practices, that you can take. But practicing unit has working papers with respect to client, right? Those working papers you cannot document because working papers are his own property. Next, the reviewer shall complete the review within the prescribed time, that is 60 days. The reviewer shall document all the working papers and submit a copy of working papers to the board if at all called within 18 months. So they'll ask a question. What is the retention period of working papers by peer reviewer in relation to peer review? It is not specifically mentioned. However, if peer review board calls for working papers of the peer reviewer, it shall be submitted at any time within 18 months after submission of the peer review report. After you submit final report, right, from there minimum 18 months you have to retain it. Able to understand? Documentation retention period is 7 years. That is what? When I audit a client, I collected so much of data. That is documentation. That you have to retain it for 7 years. Understood or not? Have you seen all this? Then peer review process. I told no. Notifying the practicing unit. Practicing unit shall give a declaration. Is it level 1 or level 2 within 7 days of intimation? 3 names shall be recommended to the practicing unit and select one reviewer within 7 days. Reviewer consent. The reviewer shall also consent within 7 days. You may have a doubt here how to remember the 7 days and all. If you observe this logic, no. Practicing unit will be notified by peer review board, right? Peer review board will notify practicing unit. No, I'll tell you now. Okay. Now, peer review board will notify practicing unit, right? Now, practicing unit has to reply. Whenever practicing unit has to reply, the time limit is 7 days. Now, whenever board is recommending to the practicing unit, no time limit. When the reply has to come from board, no time limit. When reply has to come from unit or peer reviewer, it should be 7 days. Able to understand the time? So now you read with that understanding, you will get a clarity. Next, planning. So on intimation by the board, reviewers consent, practicing unit within 2 days furnish the following information to the reviewer. Getting it? So complete filled up questionnaire. Questionnaire will be there. In the questionnaire, what is the date of establishment, year of establishment, number of partners, number of full-time associated CS, number of articles, senior articles how much, junior articles how much, and who are the clients list, what is the fees charged, what is the GST paid. So much will be there. Information which the reviewer will collect from practicing unit off-site. Off-site means what? He will not visit. That's it. And what are the pending proceedings against him? And information to be furnished by peer review. Peer review board also shall furnish to the reviewer. These are the UDIN data. Getting it? Related to practicing unit. Take this. Next. Finally, reviewer will select a sample. Getting it? And he will start executing. Within, he can do review visit, on-site visit. Maximum how many? 7 days. First, he will do a compliance review of all general controls related to independence, skills, consultation, staff recruitment, office administration, all this complaints. So how the environment, so that he will focus on. Then he will select some assurance engagements of the clients. Getting it? So audit A, audit B, audit C, like that he will be selecting. Then he will review the records. First, he will review the records for administration. He will evaluate system of internal control, substantive test, statements, presentation, disclosure, assurance service conclusions, and this is the last point, assurance service reporting. Broadly, I will see whether formats are followed, standards are followed or not. Then I will check inside the standard content. Getting it? Did they perform physical verification of stock? Did they perform physical verification of cash? Because it is required as per SA 501. So that kind of pointing out I will do. Getting it? Then if at all I discovered any lapses, then I will prepare a preliminary report. This is the report. So after completion of on-site review, before making final report, first communicate your findings in a preliminary report. Getting it? Then ask clarifications from them. The practicing unit within 5 days of the receipt of the findings shall make a representation. If the reviewer is satisfied with the reply, they will submit a final review report to the board. And a copy of the final report will also be forwarded to the firm practicing unit. If the reviewer is of the opinion that response given by unit is not satisfactory, they will submit a modified report to the board. In case of modified report, peer review board will not give you a certificate. They will put a follow-on review within 1 year. If board decided, it can be reduced up to 6 months, but not less than 6 months. Getting it? An entire peer review process shall be completed within 60 days from the date of notifying the practicing unit. Finally, peer review certificate. The peer review board within 3 months after receiving the final report shall issue a peer review certificate to the unit mentioning validity period. Inform the practicing unit a certificate cannot be issued when there is a modified opinion. What is the validity? What is the significance of the peer review certificate? Practicing unit cannot continue with existing certificate which is expired. Any document you signed in the expiry period, that is invalid. Further, we have seen in clause number 9. We have seen in clause number 9 of part number 1 of second schedule. Audit shall be conducted by complying with audit gap. In that, without a peer review certificate, as per SEBI notification, a practicing unit shall not accept audit of listed company without a valid peer review certificate. Able to understand? So you can refer here. Refer clause number 9, part number 1 of schedule 2. Getting it? Compliance with the audit gap. Compliance with the audit gap. Able to understand? All of you. Therefore, it is the responsibility of the practicing unit at least 1 month before the date of expiry of the certificate. Follow with the board. Please come and do review. Getting it? Now, like audit, peer review also have inherent limitations. Because peer reviewer select your audit files on sample. He will not exhaustively select. So, whatever, just because peer reviewer gave an unmodified opinion, does it mean practicing unit has complied with every standard? No. Now, then we have difference between peer review and quality review. So this we will discuss later. Just we'll take 5 minutes, then we'll start quality review. Are you clear with peer review, everyone? We have covered exhaustively. Hardly some 40 minutes around it take. 45 minutes around it took. Correct? So let's continue. So we have done with peer review. And now we need to start with quality review. Like there many are showing, even I have received in WhatsApp and Telegram as well from many of our students of CA Inter especially. Like paper valuation has so many loopholes. Getting it? It's not something we call it a scam. Okay. But I told, right, people who are valuing paper, they literally don't have knowledge of the subject. Very simple question. If I was given with SFM paper valuation, I was given with SEMP paper valuation or some other subject which I do not have command at all. Not about command, I don't even have basic idea. If at all you ask me to value SFM, I don't have any basic idea. I forgot long back. Now many concepts have changed a lot. Many theorems have introduced, many formulas have introduced. So obviously, when SFM paper is given to me for evaluation, I only do one thing. I look at suggested answer and your answer. If everything is matching 100% only, I'll put marks. Otherwise, again judgment is coming into picture. Of course, in the scheme of valuation, institute will say, if this point is given, give half mark. If this point is given, give half mark. If this answer is given, only then give overall mark. Sometimes you might have seen, some 1 mark has been put, but as a whole, they didn't give any marks. The reason is because of the scheme of valuation instructions. It depends upon the scheme of valuation instruction. As much as possible, your answering methodology should be in line with ICI material. Getting it? Maybe sentences can be your own choice, but the sentence should convey exact meaning, similar meaning of what ICI answer gives. If at all your answer is giving a different, outrightly a different meaning, then only they'll not give marks. So this is a main loophole. So don't think if you write an alternative answer, the valuationer have the capability to interpret it as an alternative answer. He'll think it's a wrong answer. Getting it? And look at the paper valuationer is not just valuing your paper alone. Along with your paper, he's having hundreds of paper to evaluate. And look at the pressure that pile up in his mind when he's valuing your paper. If at all it is your paper is at first paper on that day that he's verifying, maybe he's in a good mood, properly he'll verify. If at all it is your 99th paper or 100th paper in that day, he'll be in a hurry to finish up the valuation. Imagine. All these inherent limitations were there in valuation. So keep in mind, make examiner job as easy as possible. Valuing a paper which has correct and complete answer is easier for me rather than valuing a paper which is having a wrong answer. If it is having a wrong answer, I need to apply my judgment. Is it right? Is it wrong? Is it right? Is it wrong? But if you're writing the right answer completely, when suggested answer is matching everything, it is very flexible for any valuation. Correct? So think from his perspective and accordingly present your answers. It may be in terms of handwriting, it may be in terms of maintaining margins, it may be in terms of spacing, everything. Think carefully, apply strategically, and then, write the answers next time onwards. Next. So quality review. What is the primary difference between peer review and quality review? I already told at the beginning itself. Getting it? So peer review is to suggest improvements, is to identify loopholes and suggest improvements for the practicing unit to encourage them for better compliance. Whereas quality review board primary objective itself is to identify engagement failures, is to identify audit failures. What is an audit failure? Like he has given opinion, but that opinion is not suitable in that circumstance. Getting it? He has taken a decision about a particular standard. That decision is not suitable at that circumstance. We will question every judgment and decision taken by the auditor. Whereas in peer review, we just see, have you followed standard? Yes. Which decision you took? It doesn't matter. Whereas in quality review, have you followed standard? Yes. And have you taken proper decision? That also we will have to check. If at all I am there in his position, which opinion I will give? If I am there in his position, which conclusion I will take? If I am there in his position, how much sample size I will take? Everywhere I question the judgment of the auditor in quality review. Whereas in peer review, we don't question the judgment of the auditor. Able to understand? The basic difference is this. And remember, quality review is being performed by the quality review board, which is constituted by central government. Quality review board is not part of ICI. I'll show even the quality review reports. So quality review board. So we have the first one, quality review board. So this is the quality review board which was constituted in 2006. So here we can find quality review reports as well. You can find quality review reports. Annual reports will be there. So inspection and review, maybe here it will be there. So quality review report, if you look at, so report on audit quality review, which was given on 26th October 2021. Probably report on audit quality review of 21-22 not yet came, because this is the only one visible at latestly. So this is quality review report of the quality review board. So this is quality review report. So this is quality review report 21. So if you look at this report, they have clearly given information. So chairperson, composition of the board. So these are the nominees of central government and nominees of the council of ICI. So the council of the ICI itself have entered into quality review board and special invitees and secretary. What is their approach? So what is their approach for quality review? They have given the approach here. And how do they select? How do they select audit firms? That was also given. So here they have given how we select audit firms for review. I will correlate that with our discussion. Okay. We have that syllabus. We have in our syllabus. How we conduct audit quality review, that we don't have in our syllabus. How quality reviewer will conduct a review, that we do not have in our syllabus. And finally, the reportings. So overall trend of the audit engagements reviewed by quality review board, like in 2000, right now we are looking at 2021 report where the quality review board reviewed 34 files only. Hardly how many? Number of audit engagements reviewed, 34 works reviewed. Probably these 34 files may belong to 20 firms only. Probably they may belong to 25 firms, who knows. But 34 audit files only they reviewed. Look at this. So key highlights of 27. So totally 33 firms were reviewed, but 34 files were reviewed. Which means in one of the audit firm, 2 files might have been reviewed. Are you getting the point? And where and all they have issued advisory, 25 cases they have issued advisory, and 2 cases they refer to ICI council for taking a disciplinary action, and 7 cases no remark at all, they closed. And which of the firms have failed in which of the compliances? SQC1, how many firms have not complied? SQC200, how many have not complied? 210, how many have not complied? Most of the firms are SQC1 only. In every year quality review report, if you see, SQC1 only, non-compliance is high. Because many firms in India do not have documented policies and procedures for quality control. You all have worked in audit firms, right? Do you have documentation for quality control? That's it. So that is what. Out of 34, they have selected 36. What 36 here? Percentage. Okay, it's fine. Percentage. So almost 1/3 of the firms, do not have SQC documentation. That's why they are all under the qualification. You see, how many firms have failed to comply with 700, 705, 720, all these standards. Getting it? And you see here, 701 is not covered. Why? 701 applies only to listed entities. And quality review of listed entities can only be performed by NFRA and not by quality review board. Have you seen that? So that's why SA 701 non-compliance was not good, because SA 701 is applicable for listed entities generally. Non-listed entities, many firms will not even use it. So primary applicability for listed entities is, key audit matter is for listed entities, and listed entities quality review is performed by NFRA, not by quality review board. Yes or no? You have this. What are the companies that are excluded under quality review board purview? Whatever companies that were covered in NFRA purview, they are all excluded under quality review board purview. Yes or no? With effect from 2019. This is the amendment. From then only, I say worrying. See, QRB is also an external body. NFRA is also external body. As long as quality review board is reviewing all the files, ICA do not have a problem. CS do not have a problem. The moment NFRA took over listed entities, getting it? These jokes are circulated. For ICA, NFRA is the enemy. Yes or no? The why members made so much nuisance for NFRA? Because in quality review board, 50% of the board composites of council members. It is exactly like peer review board, no? Just because the board is outside, but inside the board, members are inside people. So what is the problem? If quality review board, if at all they find any frauds, any issues and all, we can at least negotiate with members. But NFRA board, only one person is in the board of the NFRA, ICA president. Only one member of the ICA, only one member from the entire ICA is a, governing body. In the governing body of the NFRA, only one person from ICA, that is president of ICA. Nobody else is there in the NFRA from ICA. Able to understand? So that is the main reason why members felt worried if the quality review has been moved from quality review board to NFRA. That's it. And in especially whatever the audits they verified, what are the accounting standards, there is a non-compliance, what are the IND-AS, and you all know with effect from 2020 onwards, many companies voluntarily adopted IND-AS, yes or no, especially public limited companies, even though they are not listed. Earlier quality review report, IND-AS, this point is not there. And so what SQC1, whether firm has, this is the focus area. Many firms have not established appropriate system of quality control. Likewise, they clearly mention which firms are violating. So in 2015-16, how many were there? In 2021, how many violations were there? Getting it? First of all, in 2021, you selected only 34 files. Out of it, 17 were not having SQC1 compliances. Getting it? Next. So every audit form, directly we'll go to scope and objective, we'll completely discuss from exam point of view, and I will always tell in class, a remote question is always possible. Last time, May 2022, such kind of question only asked from quality review board. Students study entire quality review boards thoroughly, but these points they'll observe, these points they'll miss, and that point only exactly ask. I'll show you. So what is the scope and objective of quality review? Examining whether statutory auditor had complied with all the standards in India and applicable ethical standards and all, similar to peer review. Whether auditor had complied with laws and regulations, whether audit firm under review has implemented quality control, and whether there are no material misstatement of assets and liabilities as at the reporting date in respect of selected entity. This is one additional feature compared to peer review. So in the above these 3 points, peer reviewers also will verify. But peer reviewer will not verify, is there any material misstatement in the financial statements even after performing the audit. Able to understand? So here, indirectly, quality reviewer is checking your judgmental capabilities. Able to understand? So this is important point. And the review of quality review board covers only statutory audit. It does not extend to internal audit, and it will not apply for members who are in employment right now. Even it does not apply for tax audit, GST audit, nothing. It is only applicable for company audits. And what is the composition of QRB? QRB will have totally 11 members. 1 person is chairman. Remaining 5% nominated by Government of India. 5% nominated from Council of ICI. So the Council of ICI nominate 5 members. The government will nominate 5 members. Nominated from eminence having expert in the field of law, economics, business, finance. Now what are the functions of QRB? The main function of QRB is this. This is the functions of QRB. They will make recommendations to the council regarding quality of services provided by members. They do take up quality review, verify whether members are performing qualitatively service or not, then finally give a recommendation to ICI council. And they review quality of services provided by members, guide the members of the institute to improve the quality. In the process of finding fault, they will also encourage members to improve the audit quality. And the Ministry of Corporate Affairs has clarified reviewing audit of companies' bodies specified under Rule 3 of NFRA. Nothing but what? The company is covered within the scope of NFRA. For them, can a quality review board do quality review? No. However, if a reference is made by NFRA to quality review board, NFRA only approached quality review board. Dear quality review board, in this year I am already vexed with so many reviews. You please take review of these 5 listed companies. Then only quality review board can take up those companies which are within the purview of NFRA. If at all a company is not in the, if at all a company is in the purview of NFRA, directly can quality review board take up quality review? No. Getting it? Now, so NFRA shall have power to monitor. This is completely discussed under section 132 of the Companies Act. So I asked you to refer CA Inter Company Law Marathon, right? In that this is covered. Not about quality review, but about NFRA be covered. Getting it? Now, so as per NFRA shall have power to monitor, enforce compliance with accounting standard, auditing standards, oversee the audit quality, undertake investigation of the auditors for listed entities, selected unlisted companies which satisfy any of these 3 criteria, any one criteria. Paid up capital minimum 500 crores, turnover minimum 1000 crores, outstanding loans debentures minimum 500 crores. If any of these 3 criteria is satisfied by an unlisted public company, that will also come under NFRA purview, or special body corporates like banks, insurance companies, they all come under NFRA purview. Or if central government made a reference to NFRA, that so and so body corporate review has to be performed by NFRA. Then NFRA will cover that body, that particular company review. And in such a case, whenever NFRA enters, quality review board will stop. Able to understand? Next, subsidiary company, associate company of the above companies. They are also covered within the purview of NFRA, provided they are material subsidiaries. They are material subsidiaries. What is a material subsidiary? Here they mentioned clearly, if a subsidiary company or associate company occupies 20% of the consolidated income, 20% of the consolidated net worth of the entire consolidated financials, only those subsidiaries and associate companies come under NFRA purview. Remaining subsidiary companies, remaining associate companies which do not come under 20% criteria, they will come under quality review board scope. Able to understand? So these are the companies which fall under NFRA purview. If these companies fall under NFRA purview, they are naturally excluded from quality review board purview. So who can perform audit quality review of these companies? Only NFRA. For rest of the companies, quality review board. On this 20%, they can give a case study. Be careful. If it is occupying more than 20% of the net income or more than 20% of the net worth, NFRA. If it is not occupying 20% of the net worth or 20% of the net income, quality review board will do audit quality review. On this also they can test. Getting it? Next. What are the powers of quality review board? By the way, NFRA may refer cases specially to quality review board. In such a case, quality review board will conduct the audit quality. Suppose Reliance is listed. By default, NFRA has to do audit quality review of Reliance company financial statements and auditors. Getting it? Suppose if NFRA decided, let us delegate the duty to quality review board, then quality review board will do that. Able to understand. Next, powers of QRB. In that, they asked on this point. Last time, May 2022 examination, they asked on this point. Getting it? In May 2022, when I'm explaining in my regular class also, everywhere I will tell like how a question can come. In exam, they will ask you a question. In my class, I spoke about this point, but actually this point came in the exam. Example I can tell. So how a question can be framed. Here, what is the question framed? You know, the quality review board does not receive information called by it from the company. What is the recourse or what is the response of the, what is the subsequent procedure? That is what the exact question was asked. Getting it? So you need to call for entire provision. The quality review board has power to call information from the institute. Information provided. If the board does not receive information from member, the board may inform the member, the board may request the institute, so that institute will call the member and then give the information. And another power, the quality review board can directly call information from the company. They can call directly the company. Okay. If suppose if the company board of directors did not give information, they may call for auditors. If auditors also did not give information, they may call for institute. If none of them are giving information, they may go for MCA. Able to understand? That's it. Of course, that entire discussion is not covered here. And quality review board can take expert advice, recommendations to the council, that is not required. Now, what services are covered within the scope of quality review? Only statutory audits will be covered. Quality of statutory audit and reporting by statutory auditor. Only this is covered. And quality control framework adopted by AFUR. Nothing but how the audit firm, how the AFUR means what? Nothing but practicing unit. How the audit firm established quality control practices, that quality review board will check. So the quality review will not extend to internal audit, tax audit, GST audit, any other special audits. Getting it? These may be covered by the board at a later stage. And this quality review will not even apply for those members of the institute who are in employment. Clear, everyone? Until now. All of you? Next. Selection of audit firms for quality review. How audit firms are selected for quality review? There are many criteria. One is criteria based on clients. Criteria based on clients, nothing but companies. Another one, criteria based on audit firms by applying simple random sampling. Or the quality review board may follow quality review cycle. Cycle means what? Periodically they will select that firm. Periodically they will select that firm. So these are the three approaches how quality review board will select audit quality reviews. Getting it? Generally, the popular selection method is this. The popular selection method is this. You see here, even in the quality review board, they mention that. They mention this point in the quality review board. So how we select audit firms? You see here, they have mentioned here very clearly how we select audit firms. They have given NFRA discussion, all that. Here they have given the top private limited companies not falling under 3.1 based on turnover, based on paid up capital, based on other criteria, especially risk-based approach, getting it, or concerns in the regulatory, or based on intelligence report, or based on reported fraud, based on likelihood of fraud, based on accounting irregularities, based on information highlighted by media, based on other reports, based on non-compliances of statutes which are highlighted in the past, based on all these criteria. This is called as risk-based criteria. What is this called as? Risk-based criteria. The quality review board may select an audit firm. Now that is exactly given in our book. On the basis of the following criteria, that is risk-based selection, where regulatory concern is there, or on account of being a part of a sector susceptible to risk, or a reported fraud or serious accounting irregularity. This is actually E point mark continuation, or there is a non-compliance under particular law. Based on these, the companies which are having these characteristics, the companies which fall under quality review board, the companies which fall under quality review board. Which companies fall under quality review board? Private limited companies, unlisted public companies which are not having paid up capital exceeding 500 crore, turnover exceeding 1000 crore, borrowings exceeding 500 crore. Because if at all they are exceeding 500, no, they will go to NFRA. So unlisted small public limited companies, all private limited companies, they all come under quality review board. Now among them, which private companies, which unlisted public companies quality review board will select? Those companies which are having these characteristics. To understand. So this can be asked as a separate question. Write about selection of audit firms for quality review based on entities audited or based on risk. You have to give this entire provision. Anyway, it can be asked in exam. Remember, don't think straight questions like composition of quality review board, qualification of quality review board, disqualification of quality reviewer, nothing but technical reviewer. Don't expect straight questions always. Next, sometimes in case of joint audit, no, all joint auditors may be reviewed. Suppose if a regulatory referred for quality review, in that time also quality review board will select that particular audit under quality review. The board shall not consider complaints received from individuals. Suppose if an individual filed a complaint with quality review board, I have a doubt on audit quality of so and so private company, quality review board will not check. Only if regulatory is given, then only they will check. And quality review board on their own also can select by using random sampling technique. This is not required. Now, criteria based on audit forms. First of all, audit forms may be selected on a random basis, or they may be selected based on the volume of work handled by them, like number of the clients, nature of the clients, sectors they are handling, high risk sector, account of fraud, or likelihood of fraud. Based on all this also they can select. Review cycle. If a firm is having 20 or more partners, once in 3 years they may be selected for quality review. If a firm is having 10 or more, but less than 20, nothing but 10 or more partners, then once in 4 years it can be selected for quality review. Remaining all other firms, once in 5 years it may be selected. Once I select a firm for review, once I select a firm for quality review, how many audit files I will select? Maximum 3 audit files of a particular firm I will select. Getting it? Suppose XYZ and Co have performed audits in the last year. It is not last 3 years, understand. Getting it? In the last year. Getting it? If XYZ and Co has performed audit, so I will take maybe if at all we are doing audit quality after 4 years review, then in such case, in the last 4 years, whatever audits they performed also we may select. But maximum, how many files we will select? 3. Suppose if there is no past findings. If there is no findings in the past review, last time when we conducted review, no findings, this firm is excellently performing, then we only take one audit engagement per engagement partner or per proprietor. So related to a same partner, maximum one engagement. Getting the point? Suppose in past there are adverse findings, then you may take more than 3 also, or you may take more frequently. Need not stick to once in 3 years, once in 4 years level. You may come every once in a year, you may come for quality review. If at all there are any adverse findings, you see quality review report 2021, 33 firms selected, 34 files only selected, which means for 32 firms, 1 file only selected. For 1 firm, 2 files are selected. Yes or no? That's it. So then we will have to discuss quality review process. Then we need to discuss about qualifications of the reviewer, disqualifications of the reviewer, qualified assistance means what, technical reviewers guidelines. So what is the approach of quality review totally? What is quality review group and what are their powers? All that we need to discuss. So we just now completed up to selection of firms for quality review. Up to selection process we have done. I think that all of you. So we'll take break and get back. So we have already discussed about the quality review cycles. Yes or no? Applicability of quality review on different circumstances. How quality review board selects audit files for quality review we have seen. Now let's look at broadly what is the quality review process and who will involve in this. Like people involved in this. First of all, this quality review will be performed by a person, we call him as technical reviewer. We call him as what? Technical reviewer. So quality review is carried out by a person who meets professional standards established by ICI. So he will function as technical reviewer for quality review board. In fact, maintaining quality in a quality review is also a final report of the quality review and is responsibility of the technical review. Final report, maintaining the quality in the quality review completely is the responsibility of the technical reviewer. So first of all, technical reviewers are also chartered accountants only, basically. Getting it? And those who meet eligibility criteria of quality review board, they will be treated as technical reviewers. And there is another group which is constituted by quality review board is quality review group. There are 2 types of groups, industry specific groups and general groups will be there. Getting it? Like suppose if you are doing a normal manufacturing trading company related quality review, that audit file we selected. This general quality review group will participate along with the technical review. Nothing but it is something like between quality review board and technical review, there is a mediator that's called quality review groups. They evaluate each and every report that is being forwarded to quality review board by technical review. See, quality reviews will be conducted at so many will be there. So board members may not be having that much time to review each and everything. So they have created a sub-wing, quality review group they have constituted. Getting it? Now this quality review group will go through technical review reports and after going through all that, they will give some recommendations to the board. And sometimes quality review group also will prepare a report. Getting it? The quality review group will also prepare a separate report on a particular, company related quality review. Getting it? So that report shall also be forwarded to the company or the audit firm under review, and that report will also be given to quality review board. If it is government company, that report of review group shall also be given to C&AG in addition to technical review report. That we will get it later. Those points will get it at later in the later questions. And these quality review groups will be assisted by technical reviewers. So these reviewers will prepare a report on review of stat audit function of the audit firm under review, and they assess quality of audit, reporting everything, while these audit firms are conducting audit. And if at all technical reviewer feels necessary, they can take help of industry experts. That's it. Now, empanelment of technical reviewers. What is the eligibility criteria in order to become registered on the panel of technical reviewers. Like we have seen, no, eligibility to become a peer reviewer. Same way, here also we have some eligibility criteria. Minimum 15 years post-qualification experience as chartered accountant and currently active in practice. Only a chartered accountant who already completed 15 years of post-qualification experience and right now active in practice, that is a primary condition to become eligibility for a technical review. And further, not only 15 years of post-qualification experience, you must also have hands-on experience, hands-on audit experience. What? You must have handled as a signing partner, nothing but engagement partner, or you can be a proprietor. You can be a sole proprietary firm for at least 3 statutory audit assignments as a central stat auditor in case of bank, public limited company, government company, or private company having annual turnover 50 crore and above during the last 10 financial years. In the last 10 financial years, like you must be a signing partner for bank, you must be a signing partner for public limited companies, you must be a signing partner for government company, you must be a signing partner for private company which is having more than turnover 50 crore and above, more than or equal to 50 crore. Now this private company just a minute. This private company must have more than 50 crore turnover in the last 10 years. Only for private company the 10-year criteria will apply. Now here, one point which they didn't specifically highlight is 3 statutory assignments they must sign, right? Is it per year or in the overall, like in his past 15 years? So what, for exactly how many they didn't clearly specify. But based on a reasonable understanding, the person doing quality review must have command on audit. What exactly happens in audit, which means I feel 3 audit assignments per year. Getting it? At least 3 audit assignments he must be actively working as an engagement partner. Able to understand. And for which companies you must actively work as an engagement partner? It may be a listed company, it may be a banking company, it may be a bank, a central statutory bank, public limited company, government company, and even private limited company having 50 crore and above turnover in the last 10 years. Consecutively for a private company, last 10 years the turnover is more than 50 crore. So to that private company, if at all you are a signing partner, then that is second eligibility criteria. And remember, how many you need to act as an engagement partner? 3 statutory. Suppose the 3 statutory assignments are only private limited companies which are having more than 50 crore turnover. Is this enough? No. At least one company must be other than private limited company, which means compulsorily you must be a signing partner for at least one public company or bank or something. And remember, you have to be principal auditor, not branch auditor. Statutory central auditor of a bank, they said. And even public limited company, private limited company, these are all also you must be principal auditor. Getting it? Next. And further, you should not have any disciplinary proceeding taken against you or penal action taken against you or pending against you during the last 3 financial years or thereafter. In peer review, if at all any legal action or disciplinary action is taken, you are forever prohibited. But technical review, only in the last 3 years was covered. Remember, this quality review board and quality review rules were drafted in 2006. That time, these kind of penal actions and all were very low. Those days, 3 years is only was given as a cooling period. But now, disciplinary action, peer review statement which we are studying is a revised statement. That is why they don't have any 3 years criteria. Once you are affected with a disciplinary action, you are forever prohibited to become a peer reviewer. Whereas quality review, this particular law was made in 2005, 2004 that time. So that time, 3 years only they have used the word. And the same is still continued today. If at all, the quality review statement is being revised at this time, they would have taken 3 years also. That 3 years time limit also will be taken away. Because compared to peer review, quality review is even more severe, even more important. Able to understand? Next. And further, the technical reviewer, whoever want to empanel as a technical reviewer, he must not be a member of the quality review board. He must not be the ICA council or regional council, branch level management committee. You should not be actively involved in any of the management of the ICA. And remember, for any TR, the board has right to reject any application. Just because you met with above eligibility requirement, that doesn't mean that you are guaranteed with empanelment. Getting it? And once you are registered as a technical reviewer, your registration is not permanently valid. It is valid only for 3 years. Getting it? So ongoing block period of 3 years. Whatever the block period they have, suppose, like, see, this is ongoing block period of 3 years, means suppose they are taking a block of 2019 to 2022. 21. Let's assume these are the 3 calendar years is one block. Suppose you empaneled as a quality reviewer. At the beginning of 2021. By 2021 end, the block completed, which means your appointment, your eligibility will be over. Again you have to write all the tests, you have to take all the training again. Suppose at the beginning of the block you join, 3 years you will actually enjoy that particular position. Able to understand? So it is block method they will calculate. It is not, suppose today I was empaneled, from today 3 years. No, that is not how it is calculated. So there is a block period of 3 years. In that block period of 3 years, whether you join in first year, then 3 years. If you join in second year, then 2 years. If you join in third year, only that 1 year you will be acting as a reviewer. It's a block period. What is the block? That is given in the technical review guidelines. Right now it is not there in our book also. Next. And they have to give annual declarations of compliances. Every year they have to give certain declarations. Approximately 6 or 7 declarations they have to give. Every year they have to give that you are not, that any case was not pending against you or case was not opened against you. You need to continuously show eligibility requirements, all that. Next. You must undergo mandatory training. You have to submit 6 annual declarations. Getting it? And you will find all this in technical guide on quality review. There is a guide on quality review, technical guide on quality review. You can download it from Quality Review Board website. Okay, that's a very big lengthy guidelines, technical guide, not required in our book. Getting it? For us, only examination point of view, moderate understanding is enough. Remember, from peer review, quality review, you need not have expert level of understanding. From here, the level of understanding expected is only moderate. Even PSU audit, bank audit, NBFC audit, insurance audit, the level of understanding expected from you, if I have to rate it on a scale of low, medium, high, low. Getting it? The level of expertise expected from you is low level of knowledge. That's it. They are not expecting from you high level of knowledge at all. If at all you need to understand bank audit thoroughly, you need to go through bank audit guidance notes, approximately 1500 pages. Getting it? Insurance audit guidance note, approximately 1000 pages will be there. In our book, insurance company audit is 50 pages. Where is 1,000 pages and where is 50 pages? Getting it? So level of expectation from you is very limited for all these chapters. Whereas from standards, ethics, code of ethics, audit reporting, level of expertise expected from you is full. Getting it? Next. So after completion of initial block period, the board may decide to renew or the board may not renew. That's their choice. Now, various stages involved in quality review. So first, how quality review will be conducted? First, board will select audit firm. Getting it? And audit files also will be selected. So and so XYZ firm they selected. XYZ have conducted audit of A Limited, B Limited, C Limited, D Limited, likewise so many. In that C Limited audit may be selected and identifies Mr. Q, technical reviewer, to conduct quality review. Now the board will offer letter for engagement to TR. Dear Mr. Technical review, you have to conduct quality review of C Limited, which is audited by XYZ and co-chartered accountants. So they will send a letter of engagement. Suppose if TR decided to okay, like accept, he conveys his acceptance letter of engagement to QRB by sending all the declarations and furnishing a statement of confidentiality. Once acknowledgement from reviewer came, then the quality review board informs to audit firm. Unlike in peer review, here there is no selection mechanism. In peer review, you are having selection. You are having an option to select peer review. Here there is no such selection. QRB will decide everything and then finally inform the AFUR. Able to understand? So finally, QRB intimates AFUR about the proposed quality review and QRB shall also send a copy of intimation letter to TR. Now TR will send all the list of questionnaire to audit firm under review and the firm shall reply to them, and finally the technical reviewer will start the review. So technical reviewer and his team is what? Maximum 5 assistants he can take, and all these assistants must be qualified assistants. All these assistants must be chartered accountants. Maximum how many you can take? 5. In peer review, how many you can take? 1. That's it. So his team will carry out review starting their off-site review. First from off-site, based on the questionnaire sent by AFUR. Based on filled up questionnaire sent by AFUR. First they will analyze all the things. Finally, arrive to some conclusions about what are all activities that we should do at on-site visit. Getting it? Then they will go and do, on-site visit after mutual consultation with audit firm. Suppose after completion of on-site review also, TR will send a preliminary report to AFUR firm, nothing but the audit firm which is selected for review. Now audit firm will give representation, will give reply on preliminary report. So after considering preliminary report and after considering reply given by audit firm, the technical reviewer will prepare a final report, and that final report shall be forwarded to quality review board along with preliminary report plus reply received from audit firm. Getting it? Then the quality review board will take a feedback from audit firm. How the reviewer was, what is his behavior, and how did he review, what is his level of expertise, how he was interacted, did you pose any difficult questions, like so many. They will take feedback on technical review. On technical review, they will take firm feedbacks. Getting it? Then whatever findings were there of the technical reviewer, so on receipt of final reply from audit firm, technical reviewer shall submit to QRB within next 7 days. What are summary of findings in the specified formats? Finally, quality review group is there. Board will not check everything. The group will check in between. And finally recommend to the board what they need to do ultimately, because board will not have time to look at each and every review thing. Getting it? So quality review group will consider the report of technical reviewer and response given by AFUR and finally make recommendations to board about what they need to do. Able to understand? It is like audit committee below board of directors. Ultimate supremacy in a company is who? Board of directors. But every matter will not directly go to the board of directors. First it will go to the committee. Committee will review and finally give some recommendations to board. Exactly on the same principle this was constituted. Getting it? And finally, quality review board will consider the report, will consider the recommendations given by QRG and decide what is the future course of action. Able to understand? Next. No, in quality review there is no completion of nothing. With respect to quality review, no restrictions. Depends on the reality. I have not seen quality reviews. Getting it? It depends on case to case. That's it. Now, what is the composition of review team? Like, should a technical reviewer carry 1 assistant or 2 assistants or 3 assistants? Depends upon the size of the audit firm under review, size of the entity under review. That's it. But you cannot take a firm itself as an assistant. Only a CA individual can be taken as an assistant. Suppose I want to take one assistant who is a chartered accountant. One audit firm is offering that I will become an assistant. I will send a representative. That is not permitted. You have all the assistants must come in individual capacity. First understand. Independence and qualifications of technical reviewers is very simple. In order to being a technical reviewer, you should not be affected with the following disqualifications. These are disqualifications. This is asked many a times. What are the disqualifications of technical reviewers? Getting it? Like that audit firm or that company related audit related quality review you should not conduct. If you are affected with the following disqualifications. 1. Should not have disciplinary proceedings under the CA Act, or pending proceedings against him or her under the CA Act, or taken disciplinary action under CA Act, or any penal action under any other law during the last 3 years and thereafter. And thereafter means what? Once I am appointed as a reviewer, getting it? Until I complete the review, I must not be taken for any pending legal case. If at all in the process of review, on me a pending case was opened, on me a case was pending, I have to withdraw from that immediately. Getting it? Next, the technical reviewer or his firm or or any of the network firms or any of the partners of the firm or that of the network firm should not have been the stat auditor of the company which is selected as an audit file. Getting it? Or have rendered any other services to the said entity in the last 3 years. This is to avoid self-review threat. This is again to avoid self-review threat. Suppose ABC and Co Chartered Accountants is there. They have rendered services for Reliance Industries Limited. Okay, for the financial year 21-22. For this year, I am appointed, Mr. X is appointed as technical reviewer. Now the condition is this Mr. X is having XYZ and Co Chartered Accountants firm, and this is forming part of some network. Getting it? Under network there are various other firms. These firms are having partners. Getting it? None of them must have done any service to this Reliance company in the last 3 years. Getting it? Either me or my partner or my network firm or my partners of the network firms, none of us in personal capacity or professional capacity should have associated with Reliance Industries Limited in the last 3 years. We should not have rendered audit or other services. Simply speaking, we should not render any service with Reliance Industries Limited in the last 3 years. Able to understand? All of you? Next, not only that, we should not have any association with the audit firm under review during the last 3 years. Same way with the company we spoke. Now with the firm, getting it? The technical reviewer and between them, between this entire group of firms and technical reviewer, there should not be any association in the last 3 years. And he should comply with all the eligibility conditions, disqualifications and all he should not meet. Suppose to Reliance Industries, I checked to the Reliance Industry, the technical reviewer or his partner or his firm or network firms or network partners, none of us are providing any service to the Reliance Industries. None of us are having any association with ABC and Co who are actual auditors of Reliance company. None of us are having disqualifications. Getting it? Me, I'm a technical reviewer or my firm. I must not be disqualified to become auditor of Reliance company. What is disqualification of an auditor? Tell me. What is a disqualification of auditor? When you are disqualified for a company, when the reason why disqualifications came into picture is because of independence. Auditor is affected by independence. Getting it? Auditor independence is affected. So Companies Act prescribed some disqualifications. Those who are having shares in the company, those who are indebted to the company, those who are having relative officer of the company, those who are having business relationship, those who are providing prohibited services, these are all disqualified. Yes or no? So for a statutory auditor it is disqualified. Now for a reviewer, same disqualifications apply even for reviewer. So Quality Review Board says not only these disqualifications, you should also check all the disqualifications under Companies Act also. Whatever disqualifications applicable to a statutory auditor, same disqualification apply to technical reviewer. If technical reviewer is affected with any of the disqualification, he should not take that technical review of that file. Able to understand? He should not take quality review of that file. Suppose to Reliance Industries Limited, suppose Quality Review Board called me. I'm a technical reviewer. Look, this is Reliance company. That's ABC and Co Chartered Accountants who did audit for 21-22. Now, you have to be the reviewer for that company. I cross-check all the 3 conditions, everything satisfied. Now, when I'm checking this point, I told review board, my relative is having shares in that company for more than 1 lakh. That's it. You are disqualified. You will not be given the review. Able to understand? Whatever disqualifications applicable for auditor, same disqualifications applies even for the technical reviewer. If a technical reviewer is affected with any disqualification, audit quality review of that particular audit firm or that particular company, you should not render. Able to understand? Finally, the technical reviewer shall not belong to the same city or region where head office of the audit firm is prevailing. Getting it? Suppose if I'm a technical reviewer, I'm a practicing chartered accountant, I have a head office in Chennai. I cannot take quality review of an audit file for which the audit is performed by another CA firm in the same locality, Chennai. Which region specific interest will affect? No. Some sort of interest is created. In all ways, The technical reviewers are, see, the ultimate objective is what? Making the technical reviewer completely a new party for the audit firm. Getting it? If at all they are having any association, the quality of review may be affected. So, clear all of you? So this disqualification is important. 5 disqualifications total. Getting it? Next. Same way. What about the assistants? Can a technical reviewer take help of qualified assistant? Yes, provided he is a chartered accountant. He also does not attract any disqualifications prescribed under CA Act. He should also have signed a statement of confidentiality. He should not have direct interface with audit firm under review, and all of them must be working with them at least 1 year as a member or partner in the firm. Technical reviewer firm, is there no? In that, these assistants must be working as a partner or as a employee. And he should not be associated with AFUR and concerned entity during the last 3 years. Same disqualification above. Technical reviewer should not be associated with the company or AFUR. Same way, his assistant also should not be associated with the company or AFUR. And he should not have any disciplinary proceeding pending against him or taken against him during the last 3 years. Simply speaking, whatever disqualifications applicable for a technical reviewer, all the disqualifications shall also apply to his assistants. Only condition is his assistant must be working in the same firm of the technical review, either as a partner or as an employee. Clear? Of course, and the technical reviewer assistant should not have a direct interaction with the board, direct interaction with the audit firm under review or the company. That's it. Yes, currently working. Currently working people only, they can take assistant. Sorry? Even for assistants also you have to apply. Even for assistants also you have to apply. Getting it? That point specifically was not mentioned, but it is applicable. And every one of them has to maintain confidentiality. Guidelines were given for technical reviewers. What guidelines? The guidelines says he must visit an on-site visit. This itself can be asked as a question. What are the guidelines given by Quality Review Board to the technical reviewers? Give any 4 guidelines, 4 marks question they'll ask. The technical reviewer shall make himself to visit on-site, getting it, along with assistants for conducting review of audit working papers, or you can write for conducting quality review. Next, he shall follow technical guide on conducting quality review. There is a technical guide on quality review in QRB website, you can download. They will have access to take abstract of the records and documents maintained by audit firm. However, if they are belonging to clients of the audit firm, don't take that. And the technical reviewer shall provide detailed comments giving justification and explanation in respect of various matters required to be commented upon TR in the final report. Whenever you are making any objections or qualifications in the final report, you have to clearly explain what exactly the problem. Getting it? You see Quality Review Board report, annual report I showed, excuse even many failed. They said 34% something. And in the below they explained what exactly the failure. Next. And the technical reviewer always, whenever he is finding observations, he should segregate it into material observations and non-material. That is a common process whenever we are doing. It's not required. Next point. And this is important. Technical reviewer shall specifically include a paragraph in the review report regarding adequacy of the fraud reporting by statutory auditor in their independence auditors report. How far statutory auditors are taking measures, getting it, in order to report identified frauds by them. Getting it? But this is a very rare scenario. Statutory auditors, if they identify the fraud, then how they are reporting it in the audit report only will come into picture. Otherwise, it will not generally come into picture. Now, once again, they have given stage-wise completion of the quality review. So this again, you can understand more or less similar content only will be there. Stage-wise approach of quality review process. But first of all, 99% this question will not be asked in exam. Because in exam, remember, we either can be asked for 4 marks or 6 marks. A big concept cannot be tested at all. In this probably any of the points may be tested on true or false questions probably. And these all have already been covered in the quality review process question. This they can be asked as a 4 marks question. Write about involvement of quality review group in the quality review of an audit firm under review. What is that? The report prepared by technical reviewer and the firm's final comment on the observations given by TR shall be considered by QRG. Now, after considering, QRG may issue some directions to the reviewer, enabling QRB to make recommendations to board. If at all review group felt the technical reviewer has not performed, have not taken full information, this group may call for additional information from the concerned TR or even from the audit firm. Even if at all they want information, they can call the company also. Getting it? And QRG, quality review group, will obviously interact with the technical reviewer and request him to explain present final report to the quality review group. The review group can call for TR and take a presentation on the final report prepared by TR. And you see here, if QRG is dissatisfied with the quality of the review report of the TR, to enabling TR to have a better understanding, looks very simple. If at all technical reviewer report is not satisfied, like if the report is, after looking at the report, the quality review group is not satisfied, they can once again ask the technical reviewer to go in deep and once again do quality review. And quality review group may interact with AFUR. First of all, understand quality review group is higher level authority compared to technical review. QRB is ultimate board. This is ultimate deciding authority. So this is something like audit committee. These people are there only for recommendations. These people are there to coordinate between them. Entire work pattern cannot be handled by board. Review groups were constituted. Remember, the board is consisting of members from eminent industries, all that, and council members of ICI. Obviously, the time will not be available frequently. So somebody should always be there in the quality review board, under the quality review board, who should fulfill all the quality review board philosophy, principles, all that. So there must be some full-time staff, and those staff is nothing but quality review group. Able to understand? Now, this question, how this 9th point can be asked is, what sort of recommendations a quality review group can make to quality review board? What are various recommendations that a quality review group can make to quality review board? So that itself they can ask as a sub question. What recommendation they can make? The recommendation of QRG may expressly mention the following. First, they mention particulars of the enterprise, company, audit firm under review, and detailed description of the evidences which support non-compliances, and detailed description of non-compliance with matters stated in terms of engagement to technical reviewers. Where and all technical reviewers, whatever points we told them to verify, where and all non-compliances were identified. Next, QRG recommendation about the course of action that should be taken by the quality review board ultimately. That's it. QRG, while recommending to board, they may recommend in the following way. If it is a material non-compliance, they will recommend to take a disciplinary action. If it is immaterial non-compliance, they will tell the board to give an advice to audit firm under review. In respect of other observations which are trivial, which are not at all material in nature. Getting it? The audit firms will be given to take effective corrective steps. That's it. And what about the expenses of QRB, QRG, TR? Audit firm under review will not bear. QRB only will bear. Getting it? The quality review board only will bear. Central government will compensate the remuneration, everything. Whereas in peer review, the remuneration will be borne by audit firm, the practicing unit. It's not there in our book. This is also not required that much from exam point of view. And finally, reporting. Reporting and other procedures related to, quality review. Technical reviewer, based on overall conclusions drawn from the review, first will issue a preliminary report, then subsequently gives a final report. In between, what happens? The firm will give some representation. After considering representation, after discussing with the firm, then final report will be prepared by technical reviewer. A clean report indicates that of the technical reviewer. Technical reviewer clean report indicates statutory audit is being conducted in a manner which ensures the quality of audit services. However, a reviewer may qualify his report in one or more of the following situation: non-compliance with standard, non-compliance with laws, quality control systems and but deficient, non-compliance with quality control policies and procedures. In all these cases, we will qualify. You see, technical quality review board annual report, non-compliances with auditing standards, non-compliances with accounting standards, everything was highlighted. So ultimately, the quality review board, technical reviewer looks for what? Identifying lapses in compliance with standards, compliances with laws and regulations. That's it. This can be asked as a separate question. What are the circumstances where a technical reviewer will issue a modified opinion? What are the circumstances where a technical reviewer will issue a modified opinion in respect of quality review carried out by him? Getting it? And what are the elements of review report? That's not required. Elements of audit, elements of quality report is not required. Now, what is the type of report you will issue? Will you issue an unmodified report, unmodified opinion, or will you issue a modified opinion? Whether a technical reviewer will issue an unmodified technical review report or modified technical review report, what factors you will consider? When he will give modified opinion, we have seen. Same points only we will mention. When he will give modified opinion, when the audit firm has not complied with technical standards, not complied with laws and regulations, not complied with the quality control practices and policies, do not have a proper systematic quality control. In all these cases, they will give a modified opinion. So what points I will consider to check? Whether the audit firm under review complying with technical, professional, ethical standards, whether the audit firm under review complying with relevant laws and regulations, whether the audit firm under review is complying with whether the audit firm under review have established proper quality control systems, whether the audit firm under review have documented policies and procedures related to quality control. All these, whether, if you put the word whether, checkpoints. If you do not use the word whether and put it as a positive statement or negative statement, ultimate answer. Getting it? So, whether policies and procedures that constitute the reviewed firms are designed in order to provide quality control with reasonable assurance that they are going to comply with technical standard. Actually, here the terminology looks little difficult. You can simply write whether the policies and procedures designed by audit firm under review, are they ensuring compliance with technical, professional, ethical standards? Same meaning will come. Entire the terminology will come. Whether personnel of the reviewed firm complied with policies, whether the staff of the audit firm, do they complied with all the policies? Independence of the audit firm, is it maintained? Whether audit firm has initiated or instituted proper mechanism for training the staff? Whether audit firm ensures availability of experts or experienced persons for consultation in case of audit engagements? In all these cases, if the answer is no, obviously he will give adverse opinion. In all these cases, if the answer is yes, positive, then he will give clean opinion. If at all mixed, maybe he will be giving qualified. He will give positive opinion subject to exceptions. Able to understand? Now here they are talking about report of quality review group. See, with respect to quality review group, we generally we will come across two different terminologies. First, understand QRB, QRG, technical review. Technical reviewer will give preliminary report and final report. Yes or no? QRG, their main responsibility is to give recommendations to quality review board. In some exceptional cases, QRG will prepare a detailed report. In some exceptional cases, QRG itself will prepare a detailed report. Generally, in the entire quality review process, QRG report concept is not discussed. Getting it? Now, what QRG report will contain? Getting it? It is something similar to TR report only. It is something similar to technical review report only. But whenever QRG prepares a report, that report shall also be forwarded to quality review board. So quality review group is not only meant for recommendations. Sometimes after looking at the technical review report, they can summarize it and prepare their own report. AFR also we will forward. AFR also will forward. That is what given here. This sentence, no, if you look at in the main material or even this material, it takes lot of time for anybody to understand. The quality review group report on quality of audit by auditor of a PSU should be furnished to the C&AG, and further on a case-to-case basis, QRG report and C&AG views shall be put up before the quality review board along with recommendations of the QRG. The sentence decoding is very difficult. Getting it? QRG report on the quality of audit of PSU. So in respect of PSU, technical reviewer will perform quality review and prepare final report. Based on that, QRG will prepare their report. That report shall be furnished to C&AG. That's one point. Further, this QRG report and C&AG views, because what is C&AG view? QRG submitted, reported to C&AG, right? Now C&AG would have given some reply, right? That reply once again will be forwarded to board along with final action to be taken. Able to understand? In all other cases, what do you mean by all other cases? Other than PSU. Getting it? The QRG recommendations along with the decision of the board on the quality of audit by auditor in case of a PSU shall be furnished to office. All other cases here means probably they have not prepared any report separately. QRG has not prepared any report separately. If QRG prepared a report on quality of PSU, then it shall be furnished to C&AG, get views of the C&AG, furnish entire stuff to board. In all other cases, what is all other cases? Where in respect of quality review of PSU, QRG not prepared report, not prepared QRG report. That is what meaning of in all other cases. These two sentences, getting it, will take lot of time to understand. Only if you thoroughly read in between the lines, then you will understand. Able to understand? All of you. You see, QRG report on PSU should be furnished to C&AG, and on a case-to-case basis if required, that report along with comments given by C&AG shall be forwarded to the board along with recommendations for upcoming actions to be taken. Next point. In all other cases means if QRG do not prepare a report, in such a case, just share your recommendations about audit of PSU, quality review of audit of PSU to the board. Getting it? The recommendations of QRG on audit of entities other than covered above means other than PSUs shall be placed before the board directly. Getting it? And the board, after due consideration of recommendations, wherever applicable, board may on suo motu take such further action whatever they deem appropriate. If the board decided against the recommendation of QRG, the board shall record the reason. Like board of directors in a company, whenever they reject with audit committee recommendations, they need to record the reasons. Same way, whenever quality review board disagree with QRG recommendations, they need to record the reasons and then take their own action. That's it. Clear? With this, mainly this entire quality review concept is completed. Finally, what actions that may be taken by QRB, Quality Review Board? They make recommendations to ICI, or they may give advisory and guidance to the audit firm and inform details of non-compliances with regulatory bodies. They may inform to regulatory bodies, and they will intimate AFUR as to findings of the report as well as action initiated. Suppose if the review is arising because it is received from a regulatory body, you must inform the results and action to be taken on to the regulatory body, and consider the matter complete and inform AFUR accordingly. As a whole, after everything is done, finally forward the summary to audit firm under review. What they need to do, what they need not do, all that. That's it. So mainly these 4 points are important. These 4 points. What actions that may be taken by quality review board? This itself can be asked as a separate question. Isn't it? And mechanism for follow-up of review findings, not that required. Okay, mechanism for follow-up of findings. Suppose in quality review, technical reviewer have so many findings. QRB will take some action. In addition to that, they will also insist on audit firm to rectify all this. Whether they rectified all this or not, they need to do a proper follow-up. So regarding that follow-up, this particular paragraph is about. Getting it? Actually, quality review is very in-depth. So they discuss so many things because the nature of work is so sensitive. That's it. Clear? Got an idea? Now you need to read. After understanding entire this structure, you need to each and everything. I figured out like where and all a possibility of true or false, possibility of manual question. Getting it? All that will come. So you need to next time when you're reading, you need to observe that. Whenever you're reading, you need to observe. Okay, this can be asked in this way. This can be asked in that way. You need to observe. That observation plays an important role in your understanding. Is it clear? So with this, quality review is done. So let's begin with NBFC audit. See, in NBFC audit, where generally students lack clarity is regarding exemptions and non-applicability of registration. And further, in NBFC audit, at majority places, you get a discussion on RBI directions kind of. There, many have confusion, especially the sentences were so big, like non-banking financial company, systematically important, non-deposit, deposit taking NBFC, RBI directions 2016. That's one direction actually. Likewise, 4 to 5 different set of directions we will come across. Now what exactly all this? Remember, in our book or ICS study material, it has not exhaustively given about the background data. See, NBFCs are nothing but non-banking finance companies. When an organization, and further, if you recollect, in CARO also I kept this point pending, that I told I'll discuss at NBFC. In CARO we have something clause, like 14 or 16, some clause is there, regarding not about reporting on registration of NBFC registration activity. So that point we need to discuss. So first of all, what is a non-banking financial company and how it is different from banks? Banks are the one which has both the functions, acceptance of deposits and acceptance of deposits and lending of loans. But remember, even NBFCs can do these two functions. But which kind of deposit NBFC cannot accept is demand deposit. What is a demand deposit? We all have bank accounts, right? By default, which bank accounts are there? Savings bank account. Savings account method is nothing but you can deposit whenever you want, you can use it whenever you want. This kind of deposit facility NBFC cannot give. NBFC can give a deposit facility where you can keep a deposit for a particular tenure, like fixed deposit facility they can give. Like NBFC can accept public deposits, or NBFC can give loans. Getting it? And of course, loans means any type of loan, demand loan, other than demand loan, overdraft, cash credit, whatever types of loans banks are giving, all such types of loans NBFC also can give. There is no specific, variation. Only in terms of acceptance of deposits, the restriction is. Getting it? NBFCs are not permitted to accept demand deposits. That's a primary thing. Now, when do we call an enterprise is involving in a non-banking financial activity? When do we call an enterprise involving in a non-banking financial activity? So we have to check principal business criteria. We have to check something called principal business criteria. Principal business criteria consists of two criteria and the condition is end. And the condition between both the criteria is end. Only if these two conditions of principal business criteria are satisfied, then only that enterprise is treated as engaged in non-banking finance activities. Now, if financial assets are more than or equal to 50, not even equal to, I think more than only was there. Getting it? If more than 50% of total assets, if financial assets occupies more than 50% of total assets. What do you mean by financial asset? Loans and advances, investments, and of course liquid assets like cash and bank balances, deposits. These are treated as financial assets. Getting it? And non-financial assets means fixed assets, plant and machinery, furniture, inventory. These are all treated as non-financial assets. The differentiation, financial asset, non-financial asset, this kind of classification we only use for NBFCs. We do not use for a normal agriculture industrial companies. Getting it? Then income from financial asset occupies major income of the NBFC. Another criteria, income criteria. If an organization is getting predominant income from financial assets, what is predominant? More than 50% of the total income is from financial asset. Nothing but is from investing activities, is from financing activities, not from operating activities. Able to understand? For an organization, majority of the items is from financial activities or investment activities, majority income. And majority assets of that organization constitute financial assets. Both the conditions are satisfied. Then the said organization is said to be engaged in non-banking activity, non-banking finance activity. And RBI says, 45 IA section says, any company, especially any company which is engaged in non-banking financial activities cannot continue that business without obtaining registration from RBI, which means these NBFCs shall obtain registration from RBI. Now, in order to get registration, there are some criteria. What is the minimum capital criteria to get registration? What is minimum net owned funds criteria for registration? There are some criteria given. Once you register, naturally, the following directions apply to these NBFCs. Once you register, the following directions apply. Remember, this is a criteria which we should apply on every company that we do audit. CARO 2020 says what? NBFC clause, what it says? Whether the company you are doing audit, is it satisfying these criteria, principal business criteria? Generally, you see any audit report of Tata Motors or Reliance or any other than NBFCs. The auditors will say the company has not satisfied the criteria given under NBFC. Accordingly, they are not liable for registration. That's how they reply. Able to understand? So this criteria we have to apply for every company and check and report it in CARO. Getting the point? Now, once your company is engaged in this particular, once your company satisfies principal business criteria, it must register with RBI as an NBFC unless exempted by RBI. There is an exemption list of companies even though they satisfy this criteria. Even though they satisfy this criteria, they are exempted. They don't require to register. Like National Housing Bank, insurance companies, we have some set of companies which actually satisfy this criteria, but they are exempted from getting registration. They are exempted. Getting it? The NBFC registration itself is exempted. And remember, the NBFC, the governing act is RBI Act. There is no separate NBFC Act. RBI Act itself is governing act. Entire 45 series sections talks about NBFC. Now, once your company is treated as engaged in principal business, it must get registration with RBI. It must then onwards satisfy capital requirement adequacy ratio and net owned funds ratio, all that they should maintain. Now, in addition to that, what are all the directions that applies to NBFC? Now remember, these NBFCs are broadly classified into two types: deposit taking NBFCs, non-deposit taking NBFCs. So it's an NBFC which involved in deposit taking. Getting it? Or non-deposit taking. Non-deposit taking. Now again, these non-deposit taking NBFCs are broadly classified into two more classifications, like systematically important, non-systematically important. They are again classified into systematically important, non-systematically important. What is systematically important NBFCs? What is non-systematically important NBFC? Systematically important means if the assets of the NBFC, if the total assets of the NBFC is more than 500 crore, if the assets of the NBFC is more than 500 crore, systematically, that's an important NBFC in the entire system, banking system financial system. It's an important NBFC because it is dealing with huge number of assets. Remaining NBFCs are simply called as non-systematically important NBFCs. Getting it? Now, accordingly, the RBI has given directions for deposit-taking NBFCs and systematically important non-deposit taking NBFCs. For deposit-taking NBFCs, systematically important but non-deposit taking NBFCs, in 2016, they have given a direction set. RBI has given directions. What are the prudential norms to be followed? What are the provision norms to be followed? What auditor has to report? Everything. What accounts have to be maintained? What special reports they need to furnish with RBI? What quarterly reports they need to furnish with RBI? Entire such directions were given in this 2016. Along with this, there is another set of direction. For non-systematically important, non-deposit taking NBFC. For non-systematically important, non-deposit taking NBFCs, they have given another set of directions in the same year 2016. In addition to that, NBFC acceptance of public deposit direction 2016 is given. In addition to this, there is another set of direction. If NBFC want to go for public deposits, RBI has given another direction. That's why you see in CARO, we have some fifth point, deposits. In CARO, we need to talk about deposits. Whenever the company has accepted deposits, check the provisions of Companies Act 73 to 76. Check the directions given by NCLT Company Law Board satisfied. Check the directions given by RBI. The directions given by RBI, which this point applicable for which entities? NBFCs it is applicable. Able to understand? In CARO, that particular point, public deposits, auditor has to verify what? Whether the company has accepted deposits from public during the year. If so, verify the compliance with the 73 to 76. Verify the compliance of NCLT. NCLT and 73 to 76 applicable for all the companies. RBI directions word, that is applicable for which companies? NBFC. Now, when an NBFC accepting deposits from public, they have to comply with company law provisions. They have to comply with the company law board, nothing but NCLT directions if at all given. They have to comply with the RBI acceptance of public deposits directions. Are you clear? In addition to this, now we have seen 1, 2, third set of direction this is. Now we have fourth set of directions. NBFC Auditors Report, Reserve Bank Directions 2016 again. NBFC, actually this was given in 2015, sorry. Acceptance of public deposit direction was came originally in 2015. Then NBFC Auditor Report Direction. What auditor has to report? Getting it? As part of the audit report or in addition to audit report. For that, RBI has given a separate directions. RBI Auditors Report, Reserve Bank Directions 2016. For all NBFCs it is given direction. In addition to this, there is fifth set of direction. NBFC Monitoring of Fraud, Reserve Bank Directions. Getting it? NBFC Monitoring of Frauds, Reserve Bank Directions. These are the words that you get in the book. If you have an idea, then when you are reading, you can easily correlate. Getting it? What are the first one, NBFC, non-deposit taking, systematically important and deposit taking directions 2016. For deposit taking NBFCs and systematically important non-deposit taking NBFCs, only one set of direction is given. Then NBFC non-systematically important non-deposit taking directions 2016. NBFC acceptance of public deposit direction 2015 or whatever. Then RBI, the NBFC Auditors Report within bracket Reserve Bank Directions 2016. Then we have NBFC Monitoring of Frauds, Reserve Bank Direction. Somewhere in NBFC you might have came across reporting of frauds. Cash shortage for more than 10,000 is to be treated as intentional, whether or not intention proved. Have you come across? There they will use this word, NBFC Monitoring of Frauds Directions. Enapa? You're getting it? Next. So this is the overview. Getting it? Now what we need to understand? We understood which NBFCs have to, which companies should apply for registration. We understood principal business criteria. Now we need to understand what are all NBFCs exempted from registration. Getting it? What is not treated as NBFC activity? That we need to understand. Then we need to understand audit reporting procedures, NBFC directions. This is the entire syllabus. Then we need to understand NPA norms and provisioning norms. Able to understand? NPA norms are different, provisioning norms are different. That's it. Next. So definition as per RBI 45I, okay, defines a non-banking financial company as what? It's a financial institution which is a company, which means only a company form of organization is permitted to render NBFC activities. And it's a non-banking institution which is a company which has principal business of receiving deposits under any scheme or lending in any manner, or such other non-banking institution or class of institution with the approval of central government by notification in the official gazette specify that they are NBFCs. Next. Meaning of principal business. A company's financial assets occupies more than 50% of the total assets. Income from financial assets consists of more than 50%. And here the condition is end. It is both the conditions must be satisfied. Only then principal business criteria is satisfied. A company which fulfill both these conditions will qualify as NBFC and they would require registration by RBI. Now registration. Compulsory. 45 ISS, it is compulsory. No NBFC, no non-banking financial company is allowed to start the business, to carry on the business without a certificate of registration. And further, it must have a net owned funds of 25 lakhs, later revised it to 2 crore. Minimum, what is the net owned funds required? 2 crore. However, for systematically important deposit taking for deposit taking NBFCs and systematically important non-deposit taking NBFCs. They are big NBFCs but non-deposit taking. They don't take deposits, but big NBFCs. For them, the net owned funds criteria is not 2 crore. For them, the net owned funds criteria is 15% of risk-weighted assets. Getting it? 15% of the risk-weighted balance sheet items that we will get later. For them, what is the capital requirement? That is the minimum capital which they need to maintain. The minimum net owned funds which they need to maintain. Able to understand. At CA Inter, in Group 2, Advanced Accounting, we have a chapter called NBFC Accounts. In that, how to calculate net owned funds, how to calculate provisions, all that were already covered at CA Inter. Here, we are only discussing audit context. Getting it? At CA Inter, we don't have audit context. At final, we are having audit context. That's the only difference. Next. And if yours is a company incorporated under Companies Act, desirous of commencing NBFC, then it can apply to Reserve Bank of India in prescribed form along with documents, provided you check net owned funds criteria like this. Suppose yours is a systematically important NBFC, then 2 crore is not the minimum capital. The capital required is proportionate. Ad valorem basis, 15% of risk-based values of balance sheet items and of the balance sheet items. That's all. Like we will get that later. Clear? So this 2 crore net owned funds criteria is applicable for non-systematically important, non-deposit taking NBFCs. Earlier, 2 crore criteria is applicable for every NBFC. But after introduction of directions, after introduction of NBFC directions, now many institutes, many organizations are starting NBFC business because of the profits it is showing. NBFCs give a loan at a higher rate. Getting it? Suppose Muthoot Finance you take, it's a gold loan company where they charge interest 12% per annum. And you know, Canara Bank you go, same gold loan, they'll charge at 7%. They'll charge at 7%, substantially lower. But these NBFCs, because of the capital which they get, because of the private sector participation, they spend huge on marketing. And that's why Muthoot Finance got many customers. Many customers taking loan in Muthoot Finance are not aware that the rate of gold loan interest is very, very lower in public sector banks. Getting it? Next. Now, directions to NBFCs. So, RBI has given directions to NBFCs regarding acceptance of deposits. They have given directions, prudential norm, income recognition, asset classification, provisioning, risk exposure norms, and financial solvency norms, reporting by NBFC. For all these, RBI has given directions. They may ask you a question only on this. Write about various directions that RBI can give in respect of NBFCs. Not only that, RBI has given even directions to auditors. That's what I have told here. What are the directions actually? What directions actually they have given here I have mentioned clearly. Able to understand? Next. So types of NBFCs. So what are various types of NBFCs? Like what activities NBFC can involve? They can involve in loans and advances. They can involve in shares and securities, acquisition. They can be doing leasing activity. Remember, the mutual fund company is also basically an NBFC because it satisfies principal business criteria. It satisfies principal business criteria. For a mutual fund company, predominant assets is investments. More than 50% is investment. Investment is a financial asset. And predominant income is also income from investment. So it's a financial income. Obviously, it satisfies NBFC principal business criteria, but they're exempted by RBI. Because they are already governed by SEBI. Next. Leasing companies, hire purchase companies, insurance companies, chip business. So these are all NBFC activities only. But chit fund companies, insurance companies, and especially mutual fund companies, asset reconstruction companies, asset management companies, many of these companies were excluded from registration purview. They were exempted from registration. That we will see that. Now, what does not constitute financial activity? Agriculture activity is not a financial activity. Industrial activity is not a financial activity. Trading is not a financial activity. Immovable property dealing is not a financial activity. You see, any business will come under any of these four categories only. What Reliance Industries is doing? Industrial activity. They are doing trading through retail. They are dealing in immovable properties through Reliance Infra. They are dealing agriculture activity through retail. So they may have some agriculture operations as well. Getting it? ITC is doing agriculture, industrial, trading and immovable property. Getting it? So trading in immovable property means what? ITC hotels. Getting it? They are renting immovable properties. Getting it? So all these activities these are the businesses which are there other than finance businesses. That's it. And further, a non-banking company which has a principal business of receiving deposits under a particular scheme or arrangement in lump sum or an installment is also NBFC. This is called as residuary NBFC. Suppose if a particular entity has the principal business is what? Accepting deposits in a particular scheme or arrangement. Their only duty is to accept deposit. So that is also treated as NBFC. Now, NBFCs which are registered with RBI are categorized as below. Deposit taking, non-deposit taking. Systematically important, non-systematically important. Actually, the limits in the book were not given. What is systematically important? What is non-systematically important? ICA book did not cover the exact information. Systematically important means NBFCs with asset size 500 crore above. It's called systematically important. Any other NBFC other than this are non-systematically important. Now, what kind of activities that NBFC can conduct? We have already seen. Based on the activities, NBFCs are classified into the following various categories. Remember, this is only inclusive list, not exhaustive list. Investment credit company, infrastructure finance company, core investment company, IDT, IDF, infrastructure debt company, MFI, factors, non-operative financial holding companies. Non-operative financial holding company is something similar to core investment company. It is something similar to core investment company. Getting it? All NBFCs are either deposit taking or non-deposit taking. If they are non-deposit taking, ND word will be suffixed to their name. So NBFC ND, that word will be there. So which NBFCs are exempted from registration? This itself can be asked as a 4 marks question. Write about NBFCs that are exempted. Getting it? Actually, these NBFCs, they satisfy principal business criteria, but they are exclusively, specifically exempted by RBI. Housing financial institutions, merchant banking companies, stock exchanges, stock broking and sub-broking companies, venture capital companies, Nidhi companies, insurance companies, chit fund companies, microfinance companies, SRCs, securitization and reconstruction companies, MB company, mutual benefit companies, mortgage guarantee companies, core investment companies. Remember, not every core investment company is exempted. Non-systematically important core investment company. What is it? Non-systematically important core investment companies are only exempted. For core investment company, systematically important, non-systematically important means not 500 crore, 100 crore. Only for core investment company, what is the criteria to classify them as systematically important, non-systematically important? 100 crore and not 500 crore. Able to understand? For all other NBFCs, what is the criteria? 500 crore. For core investment companies, it is only 100 crore. Able to understand? Now, which is not a systematically important core investment company. Core investment company which is not a systematically important, that is only exempted from registration. Systematically important core investment company. Systematically important core investment company is liable for registration. Tata Sons Private Limited is a core investment company which is systematically important. In India, there are many NBFCs which are there, like a list of NBFCs. You can find them in RBI website, list of NBFCs. So in RBI site, you will find here. See, these are the list of NBFCs having. These are the list of NBFCs having. So these are the list of NBFCs having registration for accepting public deposits as on Jan 31st. This list is updated list. These are the NBFCs which are non-deposit taking but systematically important. These are systematically important. These are NBFCs which are not accepting deposits other than NBFCs non-deposit systematic, nothing but non-systematically important NBFCs. These are NBFCs whose registration was cancelled as on September 1st. This is most updated list. And these are NBFCs which are classified as microfinance institution, debt fund, factors. You will get entire list. You will find the list. And a list of core investment companies. You see, these are the core investment companies. You will find so many core investment companies. These are purely core investment companies. Hardly in India we have 59 core investments companies. Hardly we have 59 core investment. So in that Aditya Birla Group we know, Tata Group is there, and even Chain Irrigation Group, Reliance Industries. There are many L&T Finance Holding Company. See, what is that core investment company means? Nothing but their business is what, their business is incorporating subsidiary companies. Their only business is what? Incorporating subsidiary companies. What Tata Sons Private Limited do? They invest in shares of Tata Group of companies. Almost every Tata company you call, for that the holding company is Tata Sons. So their only business is what? Investing in companies. 90% of the assets, not 50, 90% of the assets of a company, if it is in the form of investments, it is called as core investment company. Able to understand? If 90% of the total assets, are represented by investments in securities, not just securities, in getting holding company status in many other companies, then only we call it as what? Core investment company. And alternative investment fund. For all these meanings, we can't explain in revision. Getting it? Next. And core investment companies with asset size less than 100 crore or with assets more than 100 crore but not having public funds, nothing but not taking deposits, they are exempted from registration. So non-systematically important core investment companies and non-deposit taking core investment companies are exempted from registration from RBI for NBFC, which means deposit taking core investment companies, systematically important core investment companies, they are compulsorily have to obtain registration. So this can be a twisting point. Getting it? So only this can be twisted. Remaining points they can't twist. Straight list. No confusion. Now what is the difference between NBFC and banks in this point weights merit? NBFC, whenever you are having a deposit, you will not get deposit insurance and credit guarantee. You will not get, insurance on the deposit. There's an institute called Deposit Insurance Credit Guarantee. Up to 5 lakhs, your savings account is insured. In the event if the bank defaulted, up to 5 lakhs you will get from this insurance company. Getting it? Irrespective of your balance in the bank. Of course, if it is lesser balance, you get that lesser balance. If it is more than that, minimum 5 lakhs, your bank amount, bank savings is guaranteed. Next. So this kind of deposit insurance and credit guarantee facility is not available for NBFCs. And NBFCs, there is no condition that they have to lend some percentage of deposits to priority sector. There is no such condition. You see, banks, they have to compulsorily lend out of total deposits accepted, out of total loans given by them. Some percentage must be given for agriculture. Some percentage of loan must be given for housing loans. Some percentage must be given for MSMEs. This is called priority sector in India. Getting it? So there is no such kind of compulsion on NBFCs. That is why some business organizations, see, for banks, they don't want to give loans to agriculture. They don't want to give housing loans. They don't want to give this because they don't get any rate of interest on them. But why they are giving? Because it's a compulsion by RBI. If a bank do not follow, they will be leviable with penalties and all. Next, capital requirement and prudential norms for NBFCs. Now here you see, every NBFC which is systematically important, or it may be deposit taking NBFC, shall maintain a minimum capital ratio consisting of tier 1 capital, tier 2 capital. Tier 1 plus tier 2 both together, minimum how much? Not less than 15% of its aggregate risk weighted assets on balance sheet and off risk adjusted value of off balance sheet items. Very simple. They will give risk weights. My main material contains that risk weights. In the smart notes I have not given. Not relevant also from exam point of view. Getting it? So the NBFC will have some amounts. Okay. For all this, risk weights might be given. You need to arrive that value. So total this value. On this, 15% should be the capital, net owned funds of the NBFC. What should be the net owned funds of the NBFC? 15%. This is the actual asset value. This is the risk weights given by RBI. After applying that risk weight, you will get the final figure. Total it. On that you have to apply 15%. So that much capital must be maintained. Generally, 2 crores is a capital requirement, right? The 2 crore is what? It's an RBI Act related provision. It's an act. But directions says what? You have to maintain this much. Remember, these directions are applicable for which NBFCs? Systematically important NBFCs. For normal NBFCs, small NBFCs, whose assets are less than 500 crore, they don't have to maintain this. For them, 2 crore criteria is enough. Are you getting the point? So here, the NBFCs which are systematically important, deposit taking, shall maintain a minimum capital ratio of tier 1 and tier 2. Tier 1 capital is nothing but share capital, reserves and surplus, all this, which are absolutely in the control of the company. Tier 2 capital is something which is not in your control of the company, but it's your own capital. It's a capital which you got. Getting it? Subordinate debt. Subordinate debt means I will give securities, I will give loan to somebody. I will take loan from somebody. Getting it? In the event I default, they will get priority over and above preference shareholders. Something like that we have subordinate debt concept. That is something called subordinate debt. You will get it in SFM as well. What is subordinate debt? All that. That's called tier 2 capital. Getting it? You can find it in Google as well. What is tier 1, tier 2? But that much in-depth knowledge is not required because in our book is also not given tier 1 versus tier 2 capital. In fact, there is another one called tier 3 capital as well. There are 2 types of tier 1 versus tier 2 capital. So tier 1 capital consists of mainly share capital and disclose. Tier 2 on the other hand consists of reserves and surplus such as subordinate debt, and here you will find that. It is not given in our books. It might be given in NBFC directions, which is not relevant for us. So tier 2 capital includes revaluation reserves, hybrid capital instruments, general loan loss reserves, undisclosed reserves. Undisclosed reserve means what? Secret reserve. Secret reserve will not have any sort of disclosure. Getting it? Tier 2 capital is considered as less reliable than tier 1 capital because tier 1 is what ultimately reliable for the public. Now, whether it is tier 1 or tier 2, both together how much you must have? 15% of risk weighted assets on the balance sheet and off the balance sheet items. And remember, out of this 15, minimum 10 must be tier 1. Minimum 10 must be tier 1. Out of 15, minimum how much tier should be there? Tier 1. This one. So remaining balance can be tier 2. So it is not given for your discretion. 15% of tier 1 plus tier 2 means I don't have tier 1 capital at all. I will maintain completely tier 2. No, that is not possible. Predominant portion must be tier 1 capital. Suppose if the NBFC is engaged in gold jewelry, liquidity should be extremely high. So tier 1 capital must be 12%. These are important for MCQs or true or false question. Getting it? So what is the capital that an NBFC, systematically important non-deposit taking and deposit taking NBFCs shall maintain? So these NBFCs, these NBFCs shall have a minimum capital ratio consisting 15% of total aggregate assets on the balance sheet and off the balance sheet items, both the tier 1 and tier 2, out of which tier 1 must have 2/3 portion minimum, 10%. If it is a gold lending NBFC, 12% must be there out of 15. Able to understand? Of course, at any point of time, it should be maintained. It is not only on the closure, it should be maintained at any point of time. But the criteria will be balance sheet date, assets and liabilities we will consider. Probably last year balance sheet will be considered and this year it might be maintained. Next. However, in case of non-systematically important, non-deposit taking, net owned funds criteria is enough. What is net owned funds criteria? 2 crore. Getting it? What is net owned funds criteria as per RBI requirement? 2 crore. Now here we have given just an explanation, not required from exam point of view. Next. Next. Are you all clear until now? All of you? Next. Now, what are income recognition asset classification norms? These are also called as IRAC norms. Income recognition asset classification norms. Now, first let's look at NPA. Remember, non-performing asset for banks, the definition is different. Non-performing asset for NBFC, the definition is different. In respect of bank, an asset is treated as non-performing. In respect of a term loan, an installment or interest or principal is overdue for more than 90 days. Or in respect of a overdraft and cash credit facility, the account became out of order. These are the main criteria. These are the main criteria in case of banks. Whereas for NBFC, there is no such kind. Because, yeah, NBFCs give term loans. NBFCs give overdraft facilities and all. Maybe OD facility may not be given by NBFC, but term loans only they'll be giving. So you see, for NBFC, what is the NPA norm? An asset where interest has overdue for period exceeding 6 months. For period exceeding 6 months or more. And you know what? In all these cases, you see, 6 months is common. 6 months is common. Getting it? All these cases, 6 months. Only for hire purchase and lease rental, 12 months point applies. Only for hire purchase and lease rentals, 12 months point is applicable. Now, it may be an asset, normal asset where interest is overdue, or it may be a term loan, it may be a demand or car loan, it may be a bill, or it may be in respect of debt or income on receivable, or it may be because of sale of asset or service rendered, which means you sold an asset, amount is not received. More than 6 months, NPA norm shall be applied even on that. Generally, we apply in a bank NPA norm only on loans and advances given, not on any other asset. Correct? Now, general criteria for all these is 6 months, 6 months. For lease rental, suppose NBFC is engaged in leasing activity, or if the NBFC is engaged in hire sale or hire purchase activity, then 12 months is the criteria. Now, for all these assets, in case if the NBFC is systematically important deposit taking, straight away 3 months. Straight away the criteria is 3 months. This is to make it in line with banks. For banks it is 90 days, right? So here they made it 3 months. For systematically important, non-deposit taking NBFCs, nothing but big NBFCs, public interest involved. For them, NPA classification is always based on 3 months. Any asset. If it is overdue for 3 months, it is straight away. For all other NBFCs, which are non-systematically important, 6 months. For leased assets, 12 months. Whereas, whether it is leased asset, other asset, for systematically important, it is always 3 months. Able to understand? All of you. The criteria is 3 months for systematically important deposit taking NBFCs. For non-deposit taking, non-systematically important NBFCs, it is generally 6 months. For lease assets, it is 12 months. That's it. Clear? Observation is very important. Only then you can be able to write in exam very well. Next. Next, this one, asset classification. How NBFCs will classify assets. Assets of an NBFC are classified into 4 parts: substandard, standard, substandard, doubtful, and loss asset. What is a standard asset? Where there is no overdue, which has not become NPA. What is substandard? What is substandard asset? When an NPA should classify a particular asset, particular loan, particular bill, particular thing, has to be classified as what? Substandard. If It is already classified as NPA for a period not exceeding 18 months. What do you mean by that? It is already NPA and up to 18 months after it became NPA. Up to 18 months after it became NPA, you can treat it as substandard asset. However, systematically important NBFCs only up to 12 months after 3 months, understand. Whereas here it is 18 months after 6 months. Whereas here it is 12 months after 3 months. For systematically important NBFCs, asset become NPA after 3 months overdue. And from there up to 12 months it is treated as substandard. Whereas non-systematically important, up to 6 months, it is NPA. Beyond 6 months overdue, NPA. Up to 18 months, they are substandard. Suppose substandard asset, it crossed 18 months. After it became NPA, it already crossed 18 months, then we will call it as doubtful. However, for systematically important assets, again it is 12 months. For systematically important assets, for systematically important NBFCs, that period is comparatively reduced. Getting it? Then finally, loss asset. If NBFC decided or auditor decided that so and so asset is a loss asset, it will be completely written off. Now, what is the provisioning requirement? What is the provisioning requirement? Have you all understood the classification? Everyone, NPA 6 months, 12 months generally, but systematically important 3 months. Then normally substandard assets up to 18 months. Beyond 18 months, next 18 months it is doubtful. After that it is loss. However, for systematically important, after 3 months NPA, up to next 12 months substandard, that next 12 months doubtful. Got clarity? Next. Provisioning norm. For microfinance institution, this provisioning norm do not apply. So what is the provisioning norm? Loss asset 100% you must write off. Doubtful asset, if it is not covered by security, unsecured portion 100% provision. Secured portion, first year how much provision? Second year you have to create additional provision. Third year you have to create this additional provision, making it totally 100% by the end of third year. Sir, this is a secured loan. Security is there. Ignore it. You see this point in bank. You know, the NPA classification provisioning should be based on record of recovery. Existence of security shall be ignored. Have you seen it? Whether security is there or not. Sir, customer, housing loan he took, 50 lakhs we gave, house value is 1 crore, security is there. Why should we create provision? Doesn't matter. It is overdue, default, you have to classify it as NPA, create provision. If you later recover, that time you write back the provision. That's okay. But until you recover the money, follow NPA norms, provisioning norms. NPA classification, provisioning norms should be based on record of recovery. Getting it? Not based on the security. If it is secured, provisioning percentage might reduce for temporarily. After 3 years in bank also it is 100% provision only. Even in NBFC after 3 years it is 100% provision only. Yes or no? Substandard assets generally we keep 10% provision on the outstanding loan. For standard assets 0.4%. However, if it is non-systematically important NBFC, 0.25%. For non-systematically important NBFC, on standard asset, they have given little lesser provisioning requirement. For systematically important, they have to create higher provision, 0.4%. Are you clear? All of you? Now, this point may be asked as a true or false. I don't know this much they'll observe while setting up the paper. But the provisioning towards standard assets shall not be netted off against contingent provision against standard asset. They both should not be netted off. What is it? What is contingent provision against standard asset is not discussed in our material or even in the bank. That may be an additional provision which is contingent. Like it's an additional provision. Both should not be netted off. That's what they're saying. Now, what are the steps that are involved in audit of NBFC? First, look at the company, look at the business. See what actual business they are doing. Look at the principal business criteria. Look at the business policy. Look at MOA and AOA. Then, look at the internal controls. See whether these controls are periodically reviewed by management for are they operating effectively or not. Then, check registration with RBI. Look at the registration copy. See whether both the conditions, financial asset condition, income condition satisfied. See whether NBFC is investing in liquid assets, especially this investment in liquid asset is applicable for NBFCs accepting public deposits. So if an NBFC is accepting public deposits, they have to invest a specified percentage of deposits accepted into liquid assets, and they need to file with RBI quarterly returns. Getting it? See whether these returns are filed quarterly or not. Auditor has to verify. Getting it? Now this is regarding non-deposit NBFC. NBFC acceptance of deposit directions, nothing but NBFC acceptance of public deposit directions. That also auditor has to check. The company has to comply with credit rating given. See how much deposits an NBFC can accept from public. First, a company law give some limit. In addition to that, they need to follow RBI directions. Only after that, they need to finalize one amount, and that only they should rise. Now, one of the criteria is credit rating. So the quantum of public deposits is completely linked to credit rating. So auditor has to get a copy of credit rating assigned to NBFC and see the deposits accepted or held are in accordance with credit rating given to them. Then suppose whenever an NBFC has got an upgrading, it is their choice. Can they go for higher deposits or not? Their choice. But when there is a downgrading, with immediate effect, they should stop accepting fresh deposits, and all the existing deposits shall run off to maturity. And the moment it was downgraded by credit agency, approved credit agency regarding credit rating of the NBFC, within next 15 days, what is the position shall be intimated to RBI. The moment the NBFC received a downgrade, earlier I have some higher grade where I accepted 100 crore public deposits. Now downgraded, I can accept only 60 crore. But right now outstanding balance is 100 crore. What should I do? Should I repay? No need. You have to run off them to maturity. Able to understand? Now this information you have to give to RBI within next 15 days. And further, whatever mature deposit is there, don't renew without express and voluntary consent of the borrower. Depositor, lender. Depositor is nothing but lender. Getting it? Now we need to clearly tell him that we have received a downgrade in credit report and sign a risk document. It is out of your own risk you are depositing here. So we need to get a signature from him. Then only accept deposit. Otherwise don't accept. Getting it? And check interest calculations and all. Getting it? See the interest is paid not in excess as per the specification in the deposit form. And see the deposit is given. Deposit is accepted only based on an approved written application. And see that company is maintaining register of depositors. And see that investment is made in the approved liquid assets by RBI. And see that the company is filing timely returns. And if an NBFC decided not to accept deposits, nothing but non-deposit taking NBFCs. The non-deposit taking NBFCs every year at the beginning should take an oath that they should not accept deposits. For that, see board resolution, whether no deposits will be accepted. That kind of resolution is taken by the directors or not, check it out. In case NBFCs which are not accepting or holding public deposits, check whether a board resolution has been passed by NBFC to that effect. It has neither accepted deposits nor it would accept deposits during the year. Able to understand? It is something like oath that they will not accept deposits. The next point is not required. Then NBFC auditor has to check step number 5, prudential norms. So one step what you have to check regarding deposits you need to check. Another step what you need to check. You need to check registration formalities. You need to check internal controls. You need to check business of the company, internal controls, deposits accepted by NBFC, and the prudential norms you have to check. What are prudential norms? We have seen. This is normally given here. Same discussion is given here. Getting it? Same points were given. Like they may ask you this question itself. Write about audit of NBFC prudential norms. Write about audit of NBFC prudential norms. You may have to write this entire step 5 related answer. Getting it? Now, write about classification of frauds by NBFC. This is also important question. How NBFCs classifies the frauds occurred in their organization. Like the frauds are broadly classified into the following categories: misappropriation and criminal breach of trust, fraudulent encashment through forged instruments, unauthorized credit facilities extended for kickbacks, illegal gratification, negligence and cash shortage, cheating and forgery, irregularities in foreign exchange transaction, and any other type of fraud not coming under above specified. Whatever frauds that were taken place in an NBFC, all that frauds list, they should maintain separately as per the above classification. Now, they have given a clarification. Cash shortages more than 10,000. Generally, negligence and cash shortage, irregularity in foreign exchange, no. Negligence and cash shortage. See, cash shortage need not be fraud always. It may be accidental. It may be accounting error, or it may be something else. Generally, it is not treated as fraud unless intention is proved. Unless intention is proved, you can't classify it as a fraud. How can you call cash shortage as a fraud? Cash theft is a fraud. Cash shortage is how come a fraud? Getting the point. However, cash shortage more than 10,000 rupees is always treated as fraud, whether intention is proved or not. And not only that, if the cash shortage is more than 5,000 and the person dealing with the cash has not reported to higher authority, getting it? Not reported to management, auditor, inspectors. There is a cash shortage more than 5,000, but he has not reported. See, in all NBFCs, as part of internal control, daily cash tally mechanism will be there. Every day cash tally has to be done. If at all cash do not tally, he should immediately bring it to the notice of higher management. If at all he brought to the notice of higher management and the cash shortage is less than 10,000, generally not a fraud. Suppose if it is more than 5,000, this fellow did not bring it to the notice of top management, this is to be treated as fraud. Or if it is more than 10,000, whether this fellow brought to the notice or not doesn't matter. It is to be established as fraud, whether intention is proved or not. Clear? All of you. Next. And NBFCs monitoring of frauds directions which are having overseas branches should report all the frauds perpetrated as such branch also to RBI. With respect to foreign branches also, any frauds noticed shall be reported to RBI. Then special audit checklist. Special audit checklist for NBFC, and we still have auditor's report, additional duties of auditor for reporting to RBI. Auditor has to give a special report to board of directors. Auditor has to give a special report to RBI. Auditor has to give an exception report. Getting it like that? There are three kinds of reports. What are the contents of that reports? That is also can be tested in exam. Getting it? So shall we discuss this after a break? Okay? Yes. Then after that, what we will do is we will discuss this. Then we'll take some 5 minutes gap and then we'll straight away start with the standards. Today we will complete standards discussion. Then immediately the next one is bank audit, hardly 2 hours chapter, 1.5 2 hours chapter. Then insurance, 1.5 2 hours chapter. Then risk assessment, 1.5 hour chapter. That's it. Clear? So I think with that we will be definitely completing more than 80 marks for sure. So the continuation, special audit checklist for NBFCs. See, actually they didn't talk generally about NBFCs, though the side heading was like special audit checklist for NBFC. They didn't generally talk about all NBFCs. They took an example of ICC, investment and credit company. For an investment and credit company, what audit checklist you must have? For investment and credit company, what audit checklist that we must verify, what we must have? So first thing, it says physically verify all the shares and securities which are held by NBFC. But of course, nowadays physical verification cannot be done because everything is held in demat form, dematerialized form. So you need to check the demat accounts and see that verify that NBFC has not advanced any loans against own securities, because it's a prohibition under Companies Act. Against my own securities, I cannot give any loans. And see that income on these securities. What is the income on these securities you will get? Either you will get interest income or dividend. You have to recognize? You have to recognize as per the prudential norm given. If you are following accrual basis, dividend income shall be recognized only if it is declared by the other party. And from bonds and debentures, interest rates will be given, and see that the interest is received regularly and not in arrears. Next. And you need to verify investments made by this NBFC, namely investment and credit company. So we are only looking at the context of ICC. NBFCs may be different types. We are looking at which type of NBFC? Investment and credit company. Now see, how are they classifying the investments? Are they classifying the investments into current and long-term investments? And see, how are they valuing the investment? See, the valuation is as per prudential norms. And if at all they are making investment in group companies, like while purchasing the shares, what is the basis of arriving the price? While purchasing or while investing shares in group companies, what is the basis of arriving purchase consideration? Nothing but. Then see accounting standards are complied or not. Get a confirmation certificate from the depository if the shares are held in dematerialized format. And if it is unquoted, nothing but unlisted investment, it is to be treated as term loan. If at all an NBFC is investing in investments or shares of a company which is unlisted, it is not to be treated as investment, but it is to be treated as term loan as per some prudential norm. What is the reason? All that I think prudential norms will clarify. So that's not relevant for us. Next. And see that NBFC has not invested in excess of specified limit in a particular group or particular group of borrowers. See, like we should not invest more than a particular amount. We should not give loan more than a particular amount to a single borrower. See, these kinds of limits are there even for banks. Getting it? That's why, syndicated loans concept will come. Consortium loans concept will come. Why banks will form as a consortium and give loans? For each bank, they have their own credit limit. See, just because you can repay 1 lakh crore, you have the capacity to repay 1 lakh crore, but I cannot give 1 lakh crore at a time to you. So out of my credit deficiencies or capital requirements or because of the RBI norms or because of credit norms, I can't give 1 lakh crore to you. I can only give 25,000 crore, but you want 1 lakh crore. What I will do? I will take lead. I will call remaining banks. All of us together will give you loan, whatever the required for you, 1 lakh crore. And this is called consortium loan arrangements. All the scams that you see today are consortium loan arrangement. Group of banks put together, participate and then give. PNB scam. PNB the lead bank. And there are member banks. Getting it? Consortium loans, we call it as. Then, now this investment credit company might have given some loans and advances also. See that loan has been given only with a proper sanction. See the security taken for the loan. Is the value of security adequate or not? Get balance confirmations. Bills are discounted. Verify proper documents have been maintained in respect of every bill discounted. Test check some transactions. And NPS. Auditor has to check NPA whether proper appraisal and follow-up of loans and advances. Analyze the trend of recovery performance. Like NPA and NPA classification. See, NPA classification is driven by directly systems. Today, we are not doing NPA manually. We are not identifying NPAs manually. System only will identify. The software should have all the features. And see the classification of loans and advances are properly classified into these categories or not. And see adequate provision has been made or not. So this is a checklist. In this, they may ask you specifically, how do you verify? How do you verify investments held by NBFC? Give an audit checklist in case of investment and credit company. In case of an investment and credit company NBFC, what as an auditor you verify in respect of investments held by them? Give audit checklist, they will ask you. So this answer you have to write. Any 4 or 5 points you have to write. Getting it, everyone? Next. This question is asked at December 21 exam. I think it has been asked. December 21, I think it has been asked. 4 or 5 points is enough. 4 or 5 points only enough, generally. Remember, which 4 or 5 points? Whatever is there in the suggested answer, out of that 4 or 5 should come. Getting it? Yes. Out of them, any 4. Any 4 or 5 you can give. That's enough. Next. Additional duties of an auditor for audit of NBFC under RBI direction. So this is nothing but NBFC Audit Report, Reserve Bank Directions 2016. So this is Reserve Bank Directions for auditors in respect of NBFCs. So report to RBI. The auditor has to give a report to RBI for deposit taking NBFCs. You have to give a report to RBI. So what auditor has to give? The auditor of a NBFC which has accepted deposits inquire whether the company has furnished to RBI the statements, particulars relating to deposits. Nothing but deposit taking NBFCs have to file with RBI some quarterly statements, monthly statements. Likewise, they need to file with RBI. Auditor has to inquire that. And if auditor is not satisfied about the compliance by the company, auditor, it is the duty, he has to report to RBI giving what is the total amount deposits held by the company. Auditor should also require to report these amount, under section 143. Whenever the auditor has identified any non-compliances with provisions of RBI directions, auditor has to report it in his audit report under 143. Where he will report in audit report under 143? CARO 6th 5th clause. Public deposits point is there, right? Public deposits point is there, right? So where and all RBI directions not complied in respect of accepting deposits from public. So RBI has to give entire that in the audit report under report on legal and other regulatory requirement. Inside that CARO, inside that 5th clause, you have to comment about this. Able to recognize? Next. Further, the auditor has to give a report to Board of Directors. Further, the auditor has to give a report to Board of Directors. Auditor has to give a report to whom? Board of Directors. It's not general audit report. It's in addition to audit report. See, you give audit report, right? SA 700 format. That is something which we give to shareholders. But this is an additional report given to Board of Directors. As per NBFC Auditors Report, Reserve Bank directions, auditor of every NBFC, getting it, shall apply. I mean, this will apply to every auditor, and auditor has to submit an additional report to Board of Directors. That's what here. Auditor has to submit an additional report. What that additional report will contain, what matters auditor will include. For all NBFCs, these matters he will include. 3 matters. For NBFCs accepting deposits, these additional matters will include. Total how many? Some 12 points. For NBFCs not accepting deposits, these matters auditor will report to Board of Directors. Now once again you see the list here. Auditor has to give an additional report to Board of Directors. It's an audit report by audit. I mean, it's a report, special report by auditor to Board of Directors. What the report should contain? That is a question. What the report should contain? For all NBFCs, commonly these points has to be reported. Commonly 3 points you have to report irrespective of deposit taking, non-deposit taking, systematically important, non-systematically important. For all NBFCs, these 3 points auditor has to compulsorily report. What he need to report? Did auditor verify principal business criteria? Auditor shall examine whether certificate of registration is obtained or not. Whether the company is having certificate of registration or not. Now see whether the company is entitled to hold that certificate of registration. Can the company hold the registration certificate? Is it eligible to hold? In order to hold registration certificate, principal business criteria should be satisfied. Getting it? Whether it is meeting with net owned funds requirement as laid down in master direction. For a non-systematically important 2 crore net owned funds. For systematically important 15%, out of which 10% tier 1, out of which 12% tier 1 in case of gold lending. Yes or no? So these are the 3 points which auditor of every NBFC while making a special report to Board of Directors will cover. These 3 points he will cover in every report submitted to Board of Directors in case of all NBFCs. Suppose, now look at what NBFC I am doing audit. Look at what NBFC I am doing audit. Suppose I am doing audit of public accepting an NBFC which is actually accepting public deposit or actually holding public deposit. Suppose I am doing audit of deposit taking NBFC. I need to report to Board of Directors few other additional matters. In examination, they will ask you a question. What are the points the auditor's additional report to Board of Directors shall cover in respect of an NBFC which is accepting or holding deposits? Write any 4 points. Only if you precisely understand this, only if you specifically understand this and observe this, you can correlate the answer. Otherwise, you don't understand the question itself. Getting it? So, the auditor has to give a special report to board of directors, which will contain 3 standard informations above we have seen. In addition to that, suppose I'm doing audit of NBFC which is actually accepting deposits, then whether the deposits accepted, getting it, together with unsecured non-convertible debentures and bonds from the shareholders are within the limits admissible to the company as per the provisions of NBFC directions. Actually, we splitted this as a point. Let us not read it as a point. It's a continuation. It's a continuation. See once again, whether public deposits accepted by the company along with unsecured non-convertible debentures and bonds, like by issuing this, company got a loan from all the shareholders, whatever is collected from all the shareholders, are they within limits permitted to the company as per NBFC acceptance of public deposit direction? I told NBFC acceptance of public deposit Reserve Bank direction 2015. There is a direction, 2016, okay, 2016. Getting it? There is an acceptance of public deposit direction is there. That direction says how much public deposit NBFC can accept. There is a limit given. Maximum whatever money you are raising in the form of debentures and non-convertible bonds. Non-convertible debentures, non-convertible bonds. That is also a borrowal. Raising money through deposit is also a borrowal. Both together have given a particular limit. Auditor has to check and give a report to the board of directors whether their company's borrowings in the form of public deposit, in the form of unsecured debentures and bonds, non-convertible, are they within the limits given by the direction? Are you getting the point? Are they within the limit given by the direction? Beyond, suppose if at all they are exceeding, it's a violation. If at all they are exceeding the limit permitted by Reserve Bank direction, it's a violation. Accordingly, penalty punishment clauses might be there. Second, suppose if at all they are having excess beyond permitted, see that it is regularized in the manner provided. How come excess, sir? They can't raise excess, no. Suppose they accept a deposit, credit rating was downgraded later. Credit rating was downgraded later. When credit rating was downgraded later, how much maximum outstanding loan that you can have, how much maximum outstanding deposit you can have, that will also reduce. In such case, you have to regularize it. How to regularize it? When there is a downgrading, don't accept new deposit. Whatever existing deposit, wait them until maturity. The moment you are downgraded, within the next 15 days, what course of action you are going to take, inform to RBI, and that is called regularization process. Are you getting the point? Next, suppose if the NBFC is accepting public deposit without minimum investment grade, inform to board of directors in the special report. And see whether the NBFC is maintaining capital adequacy ratio, and see it is correctly determined, and whether the ratio is in compliance with the minimum CRAR prescribed. Capital requirement adequacy ratio is what? 15% of risk weighted assets on balance sheet plus off the balance sheet items. Out of this, tier 1 capital must be 10% and tier 2 capital must be balancing figure. Minimum 10 it is. If it is 14, it is 1 minimum. This is further understand, this is minimum. This is minimum capital. It can have 20, it can have 25. Muthoot Finance and all were having 20 to 25%. Tier 1 total this capital adequacy ratio. Minimum 15 they have to maintain. Next. Suppose in respect of NBFC referred to in the clause 3, nothing but NBFC is accepting deposits. Whether credit rating has been assigned by approved credit rating agency, check it out. Whether total amount of deposit outstanding exceeded the limit given by that rating agency. And see whether any restriction on the deposit has been violated. And is there any default in repayment of amount payable to depositors? Check it out. And see prudential norms have been complied with respect to income recognition, accounting standard, asset classification, provisioning, all that. And see whether this NBFC is maintaining the liquid asset requirement. They should always maintain liquidity, liquid asset. Why? A depositor, if at all he don't want to continue the contract, he can surrender the deposit certificate and take back his principal. Getting the point? So you have to maintain liquidity requirements. Suddenly if a depositor comes and asks, able to understand. Next. Return on deposit. See, the NBFC is filing with RBI regularly the quarterly returns, monthly returns on the deposits. And see, quarterly returns have been filed as per prudential norms. And whenever any new branches or offices are opened, okay, or any branches were closed, the company has complied with requirements contained in directions. How to open a new branch, how to close an existing branch. For all that, directions are given. In case of banking companies, when a bank want to open a new branch, they require permission of RBI. When a bank want to close a branch, they require permission of RBI. Likewise, some sort of direction might be there. Are you clear? On all these points, you see, on what are all these points? Operational aspects of the NBFC. And all this, auditor would have verified, right? Give a report to board of director, which means board of director want to listen from auditor about the compliances by the company, about the non-compliances by the company. Are you getting the point? Suppose you are doing audit of NBFC, which is not accepting deposit. Then you have to report on these additional points. See that board of directors has passed a resolution that company will not accept deposit. If at all they accepted any deposit, you have to report to board of directors because that is not permitted, because it's a non-deposit taking NBFC. And whether they complied with prudential norm, check it out. Especially if it is systematically important, see the capital adequacy ratio has been maintained, correctly arrived, whether that ratio is in compliance with the capital requirement adequacy ratio prescribed by RBI, whether the company has furnished to RBI annual statements of capital fund, risk asset ratios, all that. Whether NBFC is classified as microfinancial institutions, getting it, as defined in all the directions I have given. Is it classified as an MFI? Check it out. If it is classified as an MFI, report to the board of directors that it is an MFI. For microfinancial institutions, certain exemptions were given. Getting it? And in case, if the company is engaged in non-banking financial business, but it is exempted to hold registration certificate, auditor, where a company has obtained a specific approval from RBI that it's exempted to hold CBOR, the auditor shall include a statement that the company is complying with conditions given by RBI while giving report to board of directors. Wherever you are giving a qualified point, unfavorable point, you must give reasons. Further, you do give report to board of directors, right, like this. You are giving report to board of directors, right? Now, when you are making this report, if you find any non-compliances, you have to directly report to RBI the non-compliances, and that report is called as exception report to RBI. Write about exception report to RBI by auditor of NBFC as per master direction. They will ask you a question. Able to understand? They'll ask you a question only on the 5th point. So you have to be very careful. Okay, once again I'll summarize. Once again reporting point I'll summarize. Don't worry. Next. Where in case of NBFC, statement regarding items reported in para 3, nothing but reporting to the board of directors. Generally to all NBFCs, what should be reported? NBFCs accepting deposits, what should be reported? NBFCs not accepting deposits, what should be reported? We have seen. Now in all this, whenever you're reporting to board, you came across non-compliances, like where provisions of RBI not complied, acceptance of public deposit directions not complied, non-systematically important non-deposit taking directions not complied, deposit taking NBFC, systematically important non-deposit taking NBFC directions not complied. Where and all these directions are not complied? Chapter 3B is nothing but 45IA provisions. Chapter 45I provisions, RBI Act. See, Companies Act is divided into multiple chapters. Income tax is divided into multiple chapters. Each chapter deals with certain set of sections. In RBI, chapter 3B deals with NBFC provisions. RBI auditor has to give an exception report to RBI. Which exception report? That should contain where and all the NBFC has violated with RBI Act. Where and all the NBFC has violated with the NBFC acceptance of public deposits direction. Where and all the NBFC has violated with the NBFC non-systematically important non-deposit taking Reserve Bank directions 2016. Where and all the NBFC has violated NBFC systematically important non-deposit taking and deposit taking NBFC directions Reserve Bank 2016. So that auditor has to imply nothing but whatever directions list I told, it came here. Auditor has to give an exception report to RBI wherever auditor identified non-compliances with RBI Act, acceptance of public deposit directions. Here 2 directions are covered. This is one direction, the below is another directions, 2 directions. So with all these directions, wherever there is a non-compliance, you must report. Clear? Now, these are all you have to report now. Where this point is mentioned? Auditors report directions. Right now, whatever we are reading this, whatever we read this, entire this segment is mentioned where? This entire segment, additional duties of auditor. Additional duties of auditor. It is mentioned in where? NBFC, Auditors Report, Reserve Bank, Direction 2016. Audit report directions. Clear or not? All of you. Understood? So what are the 4 set of directions that NBFCs are having? 4 set of directions. First one, acceptance of deposits directions 2016. Second one, for systematically important non-deposit taking and deposit taking directions 2016. Third one, non-systematically important non-deposit taking directions 2016. Last one, NBFC Auditors Report Reserve Bank Directions 2016. That's it. What the Reserve Bank Directions says, like Audit Report Direction says, auditor has to give a special report. Auditor has to give a special report to RBI. Now that RBI special report shall include what matters? For all NBFCs, these 3 points we will talk. For NBFCs which are accepting deposits, these points we will specifically mention. For NBFC not accepting deposits, these points we will mention in our report. Getting the point? Saw the breakup clearly? That's it. See, like this is called summarization. Whenever you're reading something, always you should understand the overall structure exactly. Getting overall structure you should understand. Now in NBFC, what we covered actually, if you observe, first of all, what are all liable for NBFC? First of all, what is an NBFC we discussed. Then when an activity is called as non-banking financial activity, principal business criteria. If they met with the criteria, they should obtain registration. They should have a minimum net owned funds of 2 crore. Even though they are complying with this criteria, who are all exempted from NBFC registration? What is meant by NBFC activity and what is not meant by NBFC activity? Agriculture, industrial, trading, immovable property. They are not treated as NBFC activity. Then we understood audit checklist for NBFC investment credit company. Then before that we understood NPA norms. We understood asset classification norms. Then we saw provisioning norms. Then we saw capital requirement adequacy ratio for systematically important NBFCs and deposit taking NBFCs 15%. Then we finally came to this particular auditors report directions. That's it. This is what the syllabus is. Of course, one more concept, that is fraud. How NBFCs classify the frauds. That is also an important question. Getting the point. Next. Then, what auditor has to report on CARO 2020 related to NBFC? What auditor has to report in CARO related to NBFC? This clause number 3. See, not only this clause number 3, all the clauses of CARO 2020 will apply for NBFC wherever it is applicable. Cost records clause might not apply because NBFC principal activity is not manufacturing or service. It's something else. So cost records point might not apply. Fixed assets point will apply. Inventory point will not apply. Loans and advances specifically applicable for NBFCs. Specifically applicable for NBFCs. So this point we have seen, remember, in CARO. The same point we have seen demand loans, loans scheduled, loans obtained by, all this. Then NBFC clause number 16 of the CARO. Getting it? Is it 16 only even in the new CARO? It's earlier it is 16. I think it's 14. Just once let me check it out. $16 I think no change le. 14 is internal audit. 16 only na? Then fine. Last time also it is 16 only in the last CARO also. So in the last CARO only 2 points were there, but now third point, core investment point has been added. Getting it? Now what CARO report should convey? Remember, for every company you should check whether your company is required to be registered under 45 IA means for every company we should apply principal business criteria and check is it satisfying NBFC definition. Now, if at all the company conducted NBFC, is it conducting without a certificate of registration? Check it out. Suppose if it is a core investment company, whether the company is treated as a core investment company and is it continue to fulfill the criteria as a core investment company. Suppose if it is an exempted core invest company, is it fulfilling that exemption criteria? What is an exempted core investment company? Even though it is having assets more than 100 crore but not accepting deposits, or it is having assets less than 100 crore and non-deposit taking, that is a core investment company. What is systematically important core investment company? Having asset size more than 100 crore. Whether group has more than one CIC as part of the group. If so, indicate number of core investment companies which are part of that group. So we'll see one reporting requirement. I don't know whether do I have, did I download this Muthoot Finance one or no? So we have Reliance, Volkswagen. No. We'll see Tata Motors itself in CARO, what they reported here, we will see. We'll see what they reported here. They will mention at least that they are not liable for, registration. They will at least report that. Yes. You see what Tata Motors have reported. The company is not required to be registered. The company is not required to be registered because it is not so applicable. The company is not a core investment company. According to the investment, according to the information, the group, as per the provisions of, has more than one CIC as part of the group. The group has totally 6 core investment companies as part of the group. Actually, they're supposed to give the list as well. We'll look at the audit report of an NBFC. Muthoot Finance will take. Muthoot Finance annual report. So 20, 21 and 22. So these are the annual reports of Muthoot Finance. You can verify. They will mention what is the capital adequacy maintained by them. Everything they'll mention. So this is Muthoot Finance annual report. And you see here, they have given shareholding pattern and borrowings from banks how much secured. I think they might have given even compliance norms at the beginning or maybe later. So here, it's okay, financials we can see, but is there any report on corporate governance? I think this might contain, see, they have maintained a capital adequacy ratio of 29%. They have maintained a capital adequacy ratio of 29, out of which the tier 2 is hardly 0.87%. Compared to 26%, our CRAR for tier 2 is hardly 0.87%. Hardly 1% is tier 2. Majority of the capital maintained is tier 1. And they have even given all this, we'll go to the top. And we'll see CARO report of this Muthoot Finance. For NBFC, CARO applies. Only for banks it is not applicable. Understand? So, this is CARO report. And same format of audit report applicable. The same format of audit report. And what auditor will make a report to board of directors? I don't know whether it is given here, whether do they give here, because it is not requirement. Maybe audit report directions may say it should be a public document. We don't know. We'll see index later once again. And here you see here, loans and advances point they have given clearly. So how many properties, sorry, this is immovable property. These were held in the name of the director. These are held in the name of George Jacob. The properties were acquired by the company under scheme of arrangement and amalgamation. Okay. So some court order was pending. So this is the property which was not held in the name of the company, immovable property. Remember CARO requirement. So these are the properties which are not held in the name of the company. For everything they have given the same reason. For everything they have given the same reason. And we still have the 16th clause to be checked. So 16th clause, you see, the company is an NBFC and is required to obtain registration, and that registration has been obtained. The company has a valid registration from RBI. Both the points are more or less same. And no business has been conducted without a certificate of registration. And the company is not a core investment company. Accordingly, this clause do not apply. And core investment company, there are no core investment company in the Muthoot group. That's it. So these are the reporting requirements that are applicable. And we'll see, is there any other, I think in the financial statements, they might be giving additionally. What accounts of companies form they have given here. So this is AOC1. Silent features of statements of subsidiaries, associate companies and joint venture. So this is probably a requirement under Companies Act. Getting it? Silent features, like it is something like abridged consolidated financials. It is something like abridged consolidated financials. A statement containing features of financial statements of subsidiaries, associates, joint venture, like important features of their group companies, basic features. This information is enough to understand about the group. That's it. So now still we have Ind AS applicability on NBFC. How far Ind AS is applicable? Schedule 3 is divided into 3 parts. Okay, Division 1, Division 2, Division 3. Division 2, Division 3 both deal with Ind AS. Getting it? Division 2 is applicable for companies which are non-NBFCs. Division 3 applicable for NBFCs. As per Division 3, see, they'll ask you a question in exam. What is the difference between Division 2 and Division 3? What is the difference between Division 2 and Division 3? And that answer also we have given here. Difference between, actually here heading was wrong. Here it is heading was wrong. Here it is Division 2, Ind AS non-NBFC. Division 3, Ind AS. Here actually it is NBFC. Getting it? Here it is actually NBFC. This heading please modify. So what is it? Like Division 3 of NBFC are mostly similar to Division 2. However, the following are the differences. For NBFC, they are allowed to present items of balance sheet in the order of liquidity. Instead of using non-current and current, they can present the financial statements in the order of liquidity. In the order of liquidity, they can present. So if you observe the balance sheet, they will classify the assets as financial assets and non-financial assets, rather than non-current assets and current assets. What, this much is there? And tell me, all this can understand? Can it be understandable by a normal shareholder? So financial assets and non-financial assets. Liabilities are also classified into financial liabilities and non-financials. So here it is not based on current, non-current. It's based on liquidity, order of liquidity. Order of liquidity means financial assets are highly liquid, non-financial assets are generally less liquid. That's it. So NBFCs are permitted to have based on liquidity. And NBFCs shall disclose by way of a note any other income or other expenditure which exceeds 1% of the total income. Whereas for other companies, it is 1% of the revenue or 10 lakhs, whichever is higher. That is as per division 2. Then NBFCs have to specifically disclose under the receivables. General receivable means what? Loans given to customers. Or normal company receivable means what? Goods sold on credit. Getting it? Here, if any amount is due from LLP in which director or partner or director is a partner. Suppose if the NBFC director is a partner in one LLP, from them this NBFC has to get a loan. They have to recover. That should also be classified under receivable. Generally, in normal division 2, schedule 3, we don't classify them as receivable. We will classify them as loan due from directors or related parties. Next. NBFCs are required to disclose items comprising revenue from operation, other comprehensive income on the face of P&L. Generally, division 2, other comprehensive income, we will show it as a separate statement. Have you seen division 2? Separate disclosure of trade receivable which have significant increase in credit risk and credit impaired. All credit impaired trade receivables shall be shown separately. This kind of breakup is not there for division 2. And the conditions or restrictions for distribution of statutory reserve has to be disclosed separately in the notes. With respect to statutory reserves, what are the conditions of utilization? All that must be disclosed in notes. This is a division 3 requirement. So this is how division 3 is different from division 2. This itself can be asked as a question and has asked previously in one of the attempts. Getting it? Almost in NBFC, I covered what are all various possibilities the questions can be asked. With this, NBFC chapter is closed. Clear all of you? Confident? And even I have given question banks, all of you can read this question bank which covers bit advanced concepts. Few advanced concepts it will cover. So, question November 2019, the same question has been asked. How division 2 is different from division 3? November 2019 it was asked. November 2020 this question was asked. So this is regarding, you see I told no, whenever there is a downgrading, what steps the NBFC have to take. So what is the question here? Actually, what aspects CA and order should look into in relation to activity of mobilization of public deposits by RHL, particularly in relation to downgrading of credit facility. So provision you will write and what are the consequences. Okay, actually there will be few more questions. This question bank I updated actually in 2021 beginning. Later I didn't update. Getting it? So there might be another few more questions also might come. Clear? And I told in December 21 attempt, I think what question was given is, what is the audit checklist for investment and credit company? What is audit checklist for investment and credit company? That question was asked in December 21. In the May exam, what question asked, I'm not exactly sure, but I made a video on that paper analysis video. You can see that. But anyhow, you directly open suggested answer and you can figure out. Getting it? But remember, studying from question bank purely is not a recommended approach. You need to study question bank just to see how the questions are being tested and not a learning source. It's not a learning source. Like many students, like you might have came across, they don't study main material, nothing. They only open the question bank or scanner and they only read from that. That's very dangerous approach, because in the past 4 or 5 attempts, the questions which were asked were never asked earlier. They were never asked earlier. That kind of questioning pattern was never there. So don't risk by following that kind of approach. Always follow from the main material. That's the best choice. So with this, NBFC audit is closed. We'll continue with the standards. So let's start with the audit of insurance companies. So in this, again, like if you observe what is the level of expertise is required, is again here moderate level. But here they have covered almost all the elements of financial statements. How to do audit of items of insurance business. How to do audit of items of insurance business. How many of you have gone through this chapter already? Hardly 4 or 5. None of you have an idea about this chapter? At least not even listen to the classes. Like earlier, how many of you have at least listened to the classes or revision or gone through these notes once at least? Revision, gone through the classes, whatever, something. Fine. So everyone have gone through it once at least. So have a basic idea what is there in this chapter at least. Maybe you may not understand, you may not remember, but had a basic idea that what is there in this chapter. Correct? All of you? So, now you see, for audit of insurance companies, we have, first of all, what is the regulatory framework for insurance companies is? An Insurance Act is the first one, which has given power for the government to constitute an authority, and IRTA Act was formed and IRTA authority was constituted. IRTA Act was formed somewhere in 1998-2009. Until then, insurance was not such highly regulated business. In India, before 2000, we have more than 300-400 insurance companies. Hundreds of insurance companies were there. But after IRDA has came into picture, after they regularized everything, hardly you find some 30-40 insurance companies now. And even getting audit of insurance company is not an easy task, because it requires the firm experience, the partner's experience. The eligibility criteria for getting audit of insurance company is very tough. Same like similar eligibility criteria for stat audits. Similar eligibility criteria for bank audits, principal audits. Like central stat auditor, appointment, becoming an eligible, satisfying the eligibility criteria for statutory central auditor of banking company. Whatever the criteria severity is there, a similar criteria is only fixed for insurance companies. Getting it? You take IRDA site, there are hardly 30 or 40 insurance companies you will find in India. Not beyond that. Like you can get entire the data in IRDA site. So this is the IRDA site, and here I think you will find insurance companies here, like about us, insurers. Yes, here you will find who are all the list of insurers, reinsurers, list of reinsurers, list of general insurers, list of life insurers. This is list of life insurers, and you find some 24 life insurance companies as on today. Getting it? This is an updated list as on 22nd August. So as on 22nd August, hardly there are only 24 life insurance companies that were there, which is including Life Insurance Corporation of India. And same way, you can find general insurance companies also. You hardly find 32 general insurance companies. Something ICI Lombard and Bharati AXA, they both have merged on 3rd September 2021. Thereafter, these are the insurance business companies which are there in the general insurance. And there is another insurance category called reinsurance. So there is only one reinsurance company that is in India, which is General Insurance Corporation of India, which is the only reinsurer. See, like you might have came across this word. What is an insurance company definition? Insurance company means an Indian insurance company. You might have seen the word an Indian insurance company, or Indian Insurance Cooperative Society, or a foreign insurance company engaged in the business of reinsurance. This is the definition of insurance company under this one, this Insurance Act. So what is the definition indirectly conveys? Foreign companies are only permitted to act as reinsurer in India. They can only do reinsurance business. And you see, who are all the list of reinsurers? Only General Insurance Corporation. That's the only reinsurance company that is there in India. There are no other reinsurance companies. For foreign companies, only reinsurance permit is given. They were not given with the main insurance business permit. And moreover, we can't incorporate foreign insurance company. Can we have foreign shareholding? Yes, maximum 49%. Maximum foreign investors or foreign portfolio investors altogether, institutional investors altogether, whatever. A maximum shareholding from outside India permitted is maximum 49. So an insurance company in which the foreign shareholding do not exceed 49% is an Indian insurance company. What is it called as? Indian insurance company. Only an Indian insurance company is permitted to render insurance business, permitted to provide insurance services in India. Foreign insurers are not permitted. Simple. Indian insurance means indirectly the definition you reverse it. Minimum 51% of the shareholders belongs to India. They may be individual shareholders, institutional shareholders, portfolio investors, whatever. 51% minimum must be Indians. Only then it is called as Indian insurance company. And only an Indian insurance company is permitted to operate insurance business in India, whether it is life insurance or general insurance. Now, the insurance is of two types again. As we know, insurance is of two kinds. Life insurance, general insurance. Under general insurance, we have these categories. Fire, marine, miscellaneous insurance. Now tell me, which business is huge? In general insurance, which business is very huge business? Fire or marine or miscellaneous? Miscellaneous. Just because the word miscellaneous is there, don't think it is miscellaneous. Miscellaneous covers various types of insurance, safety insurance, medical insurance, all accidental insurance policies. Everything is covered under miscellaneous. Miscellaneous insurance occupies 70% of the business income, whereas remaining to occupies hardly 30% of the general insurance company business. Able to understand? So what is miscellaneous insurance? It has so many subcategories. Miscellaneous insurance has so many subcategories. Health insurance comes under miscellaneous insurance. Accident insurance policy comes under miscellaneous insurance. Able to understand? Now again, these insurance contracts are technically classified into two categories. They are benefit contract, indemnity contract. Insurance contracts are broadly classified into two types. Benefit contract, indemnity contract. General insurance is generally indemnity contract. Example, I took a car insurance. Getting it? In the event of damage to the car, the insurance company compensates the repair cost. They will not give me any lump sum. If at all I lost my car in theft, getting it? Insurance company will replace me the car at max. Able to understand? They will not give me any guaranteed sum assured, price. Cash outflow, cash inflow for the policy holder will not be there in the general insurance. It is not cash outflow, correct word. Cash inflow for the policy holder will not be there in the general insurance. Whereas benefit contract is mostly for life insurance policies. Life insurance policies means death benefit. Life insurance policies means generally which benefit? Death benefit. Again, health insurance is indemnity contract. If you pay every year medical premium, if at all the person is admitted in hospital, the hospital expenditure will be borne by the insurance company. You will not be given any cash. Able to understand? So whereas in life insurance only we get something called death benefit, and which is also called as maturity benefit, which is also called as maturity amount. And the amount you get is maximum generally sum assured plus any bonus promised by the insurance company. Able to understand? Now, not only that benefit, you will also get maturity benefit. So the maturity benefit will be there, death benefit will be there. Death benefit means, suppose if the policy is not yet matured, policy tenure is still going on, and suddenly the policy holder expired, he'll get death benefit, irrespective of a maturity date. The policy will stop then, there itself. Suppose if the policy holder do not die, depending upon the type of the policy, he will have maturity benefit. There are various types of life insurance policies. One example where we will not get maturity amount is term insurance. What is that insurance? Term insurance. Term insurance is something like 1 crore term insurance or 2 crore term insurance. There is a movie, Tegadi. Have you seen that? There is a movie, Tegadi. You are a pizza to hero. Tegadi movie. Tegadi movie is based on the term insurance concept. They find some orphans and they take death accident insurance policy, term insurance policy on them, 1 crore, 2 crore, and they will only make accident. And the nominee will be their name. And they will go and take the money. Getting it? That is a movie. So term insurance means, if a person, whoever is taking term insurance, if at all unexpectedly he expired, and he will get, his nominee will get that entire guaranteed money, sum assured. So that is called term insurance. The premium will be hardly in a year 25-30,000. If at all you are aged below 30. If at all you are aged above 30, it will be some 35-40,000 rupees. Every one of you, your parents, whoever is there, advise them to take term insurance. If at all your parents do not have now, they may not give them because of the age factor, all that. You must get it. Getting it? It's a very good thing. It will be support for your parents or anybody. Nobody can predict what happens tomorrow, yes or no. So it is always better. And also take medical insurance. Don't ignore. Take medical insurance as well. Health insurance. The hospital expenditure completely will be borne by the insurance company. Almost all the hospitals are covered, entire bed cost, everything, ICU charges, everything will be covered. It is something very good. Getting it? Next. So, there are various other insurance policies. Now maturity benefit, death benefit, rider benefit, like that there are some terms. Rider benefit means, like when we are buying a policy, for that we can do add-ons. It is something like add-on. Getting it? Add-on benefit. They are called as rider benefits. So if a policy holder is having rider benefits, the insurance company has to pay the rider benefit as well. No. This is the basic idea about the contracts which insurance companies, generally take up. Now, remember, in all the insurance policies, generally sum assured will be there. In all the insurance policies, there will be sum assured. Now, what is sum assured? Is it minimum guaranteed amount or maximum guaranteed amount? It's a minimum guarantee. It's a minimum guaranteed amount in the event of meeting with uncertainty. It is not maximum. It is minimum. Assured means what? Assurance means what? Minimum. Simple logic. That's a minimum amount which insurance company will pay you in the event of meeting with uncertainty. So that's it. Next. Now, with regard to, so what is our context of learning? Our context of learning is nothing but IRDA, preparation of financial statements and auditors report, guidelines or rules 2002. So these guidelines is what covered in our syllabus. And if you see the guidelines, they were exactly copy pasted. In the ICI book, they didn't even change full stop, comma, nothing. They exactly copy pasted from IRDA guidelines. Nothing, they exactly copy pasted. You can see your ICI study material, you will wonder. You will wonder how ICI can, how the, people who are behind ICI can copy all this. This is the IRDA financial statements regulations which is downloaded from IRDA site. This is the notification regarding preparation of financial statements and audit report guidelines, nothing but. So you see, what is a form? Now you see, Schedule A. Now, IRDA financial statements guidelines, they consist of 3 schedules. Schedule A, Schedule B, Schedule C. Schedule A contains guidelines for preparation of financial statements by life insurance companies. Schedule A contains guidelines for preparation of financial statements for life insurance companies. Whereas Schedule B contains guidelines for general insurance companies. Schedule C contains guidelines for auditors report. What auditor report should cover? What auditor report should cover? We have seen similar to this in NBFC also. NBFC auditors report directions of Reserve Bank 2016. Similar to that here also. Every RBI will give directions to the auditor what auditor has to cover in the report. Similarly here, IRDA preparation of financial statements and audit report guidelines itself covers audit report related guidelines, and that is discussed under Schedule C. Now Schedule A talks about financial statements for life insurance. Now Form A, the format given is Form A. Form A, receipts and payments account. Form A, profit and loss account. Form A, balance sheet. So these are the 3 accounts, these are the 3 statements which a life insurance company shall prepare in format A given in schedule number A. Same way, a general insurance company shall prepare in Form B, receipts and payments account, Form B, profit and loss account, Form B, balance sheet. Able to understand? So, a general insurance company shall prepare financial statements in the format B given under schedule B. Are you getting the point? Now, what is the receipts and payments account? What is the profit and loss account? Receipts and payments account is nothing but called as shareholders account. It is nothing but called as, policy holders account. What is it called as? Policy holders account. It's also called as direct account. Getting it? Whereas profit and loss account is called as shareholders account. Receipts and payment account is called as policy holders account. Whereas profit and loss account is called as shareholders account. Able to understand? Now, what is the difference between receipts and payments account and profit and loss account in case of, actually it's not receipts and payments account, it's actually revenue account. It's actually what? Revenue account. What is it actually called as? Revenue account. Now this is also revenue account. What is this also called as? Revenue account. So revenue account, profit and loss account, balance sheet. More accurate word is revenue account. Revenue account, profit and loss account, balance sheet. Life insurance companies have to prepare. Same way, general insurance companies also have to prepare revenue account, profit and loss account, and balance sheet. Now, what is the difference between revenue account, profit and loss account? Look, whenever insurance company is collecting premiums. See, for an insurance company, what is the inflow? One inflow is investment. Investment in this company is one inflow. Another inflow is what? Income received from policy holders. Now, how do insurance company insure the risk? How do the insurance company meet the liabilities? Whatever they collect, suppose if you look at a trading manufacturing company, suppose you look at a bank or trading manufacturing company, they are taking money from somebody, they are investing somebody, and they are doing some business and sharing the profits to everyone. Correct? In a bank, what happens? I take money from depositors, I give loans, get money, and reissue them. In a normal manufacturing trading company, I get money from shareholders, invest in the business, run manufacturing activity, produce the goods, sell the goods, and share the result. So in banks, insurance, I'm taking from somebody, investing in somebody. Able to understand? Same thing happens in insurance also. Business principles will not change anywhere. What insurance companies? Okay, insurance companies' income is this. Now what they do with this inflow? What they do with this inflow? They are getting inflow from investors, shareholders. They are getting inflow from policy holders. Now with this inflow, what they do? They should invest somewhere, right? They invest in securities. They invest in securities. They do investment in the pattern given by IRDA guidelines. IRDA investment guidelines were given. Getting it? IRDA investment guidelines were there. So insurance companies, whatever money they are getting, they invest as per IRDA investment guidelines and get return from that and meet policyholder contingencies. Are you getting the point? All of you. Insurance business runs on this principle. Not everyone will die on the same day. Getting it? It is based on this principle. Insurance business survives in India, which is one of the most profitable business if at all executed properly. So that's why many companies, whenever IRDA opens for new licenses, many companies participate on getting that license. That's it. So that is a brief overview about, now you see, whatever investments I am making, by taking money from policy holders, that income on the investment will be transferred to revenue account. Income on the investment made out of policy holder premium receipts. From all the policy holders, what will I get? Premium. This is nothing but whose money? Policy holder money, not my money. This money I will invest as per IRDA investment guidelines. Whatever return I am getting on that, I will transfer to revenue account. Whatever expenditure, people I am employing, investment manager I am employing, actual cost I am incurring, all expenses that I am incurring in relation to policyholder activities, I will charge to revenue account. Any other operating activities, any other operating expenses which are related to business but not insurance business, general administrative expenses, they all will go to profit and loss account. Same way, I will also make some investment from shareholders' fund money. Insurance company has some reserves and surplus. That reserves and surplus is invested in stocks or somewhere as per guidelines. That money is an investment income from the shareholders' funds. That money will go to P&L. Are you getting the point? So, insurance company auditor should check whether investments are properly classified into two types. Investments made out of policyholder funds, investments made out of shareholder funds. Insurance company must classify investments in balance sheet like these two parts. Investment made out of policyholder funds, investments made out of shareholder funds, and they should be valued accordingly, current to long term, depending upon the factors. Now, income on these investments shall be transferred to revenue account if the income is from policyholder investments. If the income is from shareholders related investment, that should be transferred to P&L account. Are you getting the point? All of you. Any surplus that is available in revenue account will be transferred to P&L account. Any surplus available in revenue account will be transferred to P&L account. Are you getting it? All of you. So this is how broadly the relationship between revenue account, profit and loss account and balance sheet. Now, in addition to this insurance company shall prepare cash flow statement, which is actually called as receipts and payment account. I actually used a wrong word above. This is actually called as receipts and payments account. Insurance company shall prepare cash flow, nothing but receipts and payments account. This has to be prepared under direct method. This has to be prepared under direct method. As per the guidelines, both life insurance companies, general insurance companies, they have to prepare the cash flow statements on direct method. Are you clear? As a whole. Now the same way we have guidelines for the auditors. Oh, those audit firms which meet eligibility criteria. Those audit firms which meet eligibility criteria for getting audit of insurance company as per IRDA, they will only be allocated with audit. And now the point here is, how many maximum insurance company audits in a particular financial year a firm can do? Maximum 3. Maximum 3. Maximum 3 insurance companies only we can do in a year. Out of which not more than 2 should be on similar line of business. Not more than 2 must be on similar line of business. Which means if you are selecting 2 general insurance, 1 life insurance should be there. Suppose you want to get 3, you are eligible to get 3 insurance. 3 life insurance companies approached you that they will give you audit of 3 companies. You can only accept maximum 2. 1 you cannot accept. Are you getting the point? Any one must be other. If it is not there, okay. But which means indirectly what are they saying? Maximum you can do audit of 2 life insurance, or maximum you can do audit of 2 general insurance. As a whole you can do maximum 3 insurance companies audit. This is the restriction given by IRDA. Are you all clear? All of you. Then now just we discussed almost various topics. Now what is the income for the insurance company? Is a premium collected. Nothing but when the policy is issued, premium is collected. Now in order to issue this policy, insurance will incur some cost. That cost is called as acquisition cost. That cost is called as acquisition cost. Now acquisition cost consists of various things. What? Commission and brokerage paid to agents. That is one expenditure. What is the biggest expenditure for insurance companies? Claims. What is the biggest expenditure? Claims. Getting it? Claims cost. Claims will consist of 2 types. Claim cost, and claims settlement related cost. Getting it? Claims amount. That itself is one major expenditure. In order to pay this amount, we will employ some surveyor, administrative expenses, all that. They are claim settlement related cost. Able to understand? So claims is another expenditure. Another major expenditure for insurance companies, commission. Commission is really huge expenditure for insurance company. Getting it? Especially if it is a first year premium, the commission will be very high. Commission will be very high. Generally the commission will range from 15% to 35-40% also. So out of the first year, whatever the premium you are paying, 30-35% goes to agent as his commission for procuring your business. Getting it? Now balance amount, whatever is left, out of it, company has to make investment. You see, literally the appropriations are so many. And remember, the risk involved in insurance business is extremely high. Yes or no? By issuing a policy in first year for 1 crore term insurance, I am just collecting 25,000 premium from you, out of which 10,000 is going to the agent, only 15,000, out of which I will invest some percentage, and suddenly within the same year, if you affected with uncertainty, I should pay 1 crore. Think of the obligation and think of the nuts I am getting. So the risk involved is extremely high. So that's why IRDA frequently issues various guidelines on operation of these insurance companies. So claims cost is one. And we have another cost, that is commission or brokerage. Now claims will be paid during the year. Claims will be outstanding at the end of the year. Two things will be there. Claims will be outstanding. For that we will make provision. Claims which are already paid, claims paid will be there. How to verify claims paid? How to verify claims provision? Getting it? And very recently in the last exam, this question was exactly asked, which I told even in my class as well. In which of the following cases, insurance company shall not accept risk? In case of a life insurance business, in which of the following cases policy shall not be issued? That is a question which is asked. I'll show you. Getting it? You don't even expect that kind of question. That matter when you read it, so general it looks like. But that question was asked for 4 marks. In which of the cases, insurance company will not issue policy document in case of life insurance? When policy document will not be issued? Nothing but when insurance company will not take up the risk. So that is a question which is asked. When they will not take up the risk? When you did not pay premium. Or you paid premium through check and the check was dishonored. That kind of reasons only the answer is. Getting it? A simple answer only. It's not complicated answer. But that question we don't pay attention at all. So when you look at this, in what are the cases insurance company will not give policy document means we think of so much of complex answer. Yes, sir, now whatever the list they give is dishonored check. That's why insurance company will not give policy document. Why insurance company will not give policy document? Always they'll give. If at all you pay premium. Every kind of risk they will accept. Only thing is premium will vary. Are you getting the point? Then again in insurance, there are multiple types of insurance. Normally we have insurance. We have another thing called reinsurance. We have something else called co-insurance. We have something else called co-insurance. So what is insurance? I am the original insurance company. My agent approached you, convinced you about the policy which we are launching, a policy that we have, and you are convinced and paid the premium. I am the insurance company, you are the insured. Nothing but policy holder. Remember again, policy holder and insured can be different. Policy holder and insured can be different. Example, suppose I am the policy holder. The policy is in my name, but the people insured are my entire family was there. Medical insurance. In medical insurance, policy holder will be only one person, but the family members covered are different. Getting it? So they are insured people. They are insured. I am the policy holder. But most of the cases, they both will be same. In some cases, number of insureds might be higher in some documents, some policies. Now, there is something else called reinsurance. What is reinsurance? In reinsurance, we get this word called reinsurance ceded, reinsurance accepted. What is reinsurance ceded, reinsurance accepted? Most of the insurance companies, in respect of risk coverage given to you, I will take on you reinsurance. Okay, if something happened to you, I will pay. But it is so risky for me. Yes or no? So the risk has to be neutralized. No. So in order to neutralize the risk, in order to leverage the risk, what will I do? I will buy another insurance policy on your name. If something happened to you, I will pay entire money. First of all, primary liability is with me only. And on your name, I buy another insurance policy from another company. I will transfer some percentage of risk to another company. That's called reinsurance ceded. The other company is accepting the risk. Remember, you are not their customer. You don't have any link with the reinsurance company. If tomorrow some uncertainty happened, you cannot go and ask reinsurance company. Reinsurance contract is a contract between the original insurance company and another insurance company. Getting it? Your name might be there in that, but that doesn't mean you are liable to claim from reinsurance company. You don't have any interaction with the reinsurance company. Able to understand? Now, what is co-insurance? This is something related to something similar to consortium loans. This is something similar to consortium loans. Like if one insurance company cannot give you full protect. Suppose you want to, take an insurance of stock and your stock value is approximately 50,000 crore. Your stock value is approximately 50,000 crore. Entire risk I cannot accept because I have to maintain solvency margin. I have to maintain solvency margin. Every insurance company shall maintain 150% solvency margin. Means the total of assets should be higher than liabilities by extent of what? 50%. If liability is 100 rupee, asset must be 150 rupee. That is called 150% as solvency margin. Now because I have to maintain all this margin, I can't accept risk like that, just like that. If 50,000 cover is there, 50,000 crore worth of cover is there, I need to create some unexpired risk reserve and all. There is so much that I need to create. If I create unexpired risk reserve liability, my solvency margin will affect. So I cannot accept whatever the level of business I want to. So in some big insurance contracts, one insurance company will not give insurance. One insurance company collaborates with a few more insurance companies and give co-insurance. They will give co-insurance. Out of these insurance companies, one insurance will act as a lead insurer. We call them as what? Lead insurer. Remaining are called as other insurers, or we can also call them as member insurance companies. This is called co-insurance. Here 100% of the risk is shared by all the insurance companies. Whereas in reinsurance company and insurance company are not entering into contract with the customer directly. In co-insurance, all the insurance companies contract directly with the customer. Customer can claim against any of the company. Whereas in reinsurance, customer will contact original insurance company. Original insurance company has actually taken another contract from reinsurance company. That's a between them. But reinsurance company will never interact with the customer. Customer should not interact with reinsurance. Whereas in co-insurance, all of them will have liability, accountability to customer directly. That's a co-insurance. Able to understand. Now, in reinsurance, you have many types of facultative reinsurance, treaty reinsurance. There are two types. Facultative reinsurance, treaty reinsurance. Treaty reinsurance is of two types. Proportional treaty, non-proportional treaty. In non-proportional treaty, we have many other types. Getting it? What is facultative insurance? What is facultative insurance? Like I took a contract on you. I took a contract on you. Now I will go to the insurance company by taking your contract. And that company will sit and evaluate and tell me how much percentage they will take. 30% risk they are ready to take, 50% risk they will take, 10% risk they will take, or they may not take. They may not accept. On a case-to-case basis, if a reinsurance company is evaluating your cases, that is called facultative. Treaty. Treaty means what? It's an agreement. Me and another insurance company have entered into an agreement. It depends upon the nature of the policy, geographical location. Getting it? Various factors, based on various factors, we enter into a treaty agreement. What treaty agreement? Every life insurance policy that I buy, 30% reinsurance this company will accept. That's a kind of agreement we have. Like one customer you accept, another customer you reject, one customer you accept 50% reinsurance, another customer you accept only 10%. No, nothing such. Let's enter into contract. Getting it? Proportional treaty, we call it as. What is it called as? Proportional treaty. Non-proportional treaty. Non-proportional treaty, percentage of risk may not be identified at the beginning. But whatever the loss they will be distributing, the loss they will distribute. Like once a claim has been lodged, what is the total loss? That loss will be distributed among the insurance companies upon as per the agreement. And that is called non-proportional treaty. Able to understand? So proportional treaty, non-proportional treaty. Proportional treaty means some percentage of it always you will take. Or whatever insurance companies, whatever insurance contracts I am selling in Chennai, for all the contracts that I am selling in Chennai, I will enter into proportional treaty arrangement with a reinsurance company situated in Chennai. Able to understand? So that is geography based proportional treaty arrangement. So this is types of reinsurance, facultative and proportional treaty reinsurances. That's it. Non-proportional treaty, they will not fix at the beginning how much percentage of risk they will share. It depends upon the loss. Depending upon the loss, they will once again negotiate. But they will have a range bound. They will have a range bound. They'll have a range bound. Or they may give ad hoc payment. This much you take. Risk, this much premium you take. And this much risk you cover. Ad hoc settlement. There's so many types in that. Different. Facultative, the other company need not accept the policy if at all they want. Whereas in treaty, they have to accept. But loss is uncertain. In non-proportional treaty, for every policy I execute, they will definitely take reinsurance. But how much loss they will take up is the question. Whereas in facultative insurance, I took 100 contracts. All the 100 contracts, this company should take. No guarantee. On a case-to-case basis, they will take up insurance. That is called facultative reinsurance. Able to. Proportionate treaty means I issued 100 policies. All the 100 policies reinsurance this company will take for sure. And percentage is also fixed at the beginning itself. Non-proportional treaty, they will take. But how much is not determined. They may determine based on the loss. They may determine based on the claim amount. They may determine based on summation, whatever is as per the treaty agreement. Now, co-insurance, we will actually call them as council. Insurance council. We call them as what? Insurance council. In banks, we have consortium, right? Here it is called as what actually? Insurance council. Insurance council will act as a mediator between all the co-insurers. Getting it? These people only will select council. These people only will select council. Council will have a committee. This committee will fix the terms and conditions for co-insurance. How settlements should happen, everything. Co-insurance company, how the settlement should happen, how the premium should be fixed, everything will be settled by council. We have all the topics in general insurance. Are you getting the point? So this is what actual syllabus is about. Entire insurance audit syllabus is this. Now let's look at each and everything. So what is benefit contract I told? Indemnity contract I told? Yes or no? Now what is the difference between life insurance, general insurance? To best of my knowledge, they will not ask this kind of question. Legal framework, regulatory IRDA. There are two legislations. One is Insurance Act and IRDA Act. There are many directions issued. The key provisions. Who is an insurer or what is an insurance company? Nothing but insurer means an Indian insurance company. Insurer means an Indian insurance company. And a statutory body established by Act of Parliament like LIC, GIC. Yes or no? Insurance Cooperative Society or a foreign company which is engaged only in reinsurance. Getting it? Now who is a policy holder? A person to whom the whole of the interest of the policy is assigned once. So that person is called as policy holder, but does not include assignee thereof. What do you mean by assignee? Suppose some insurance contracts, no, I can keep it as encumbrance with the bank and take loan. Now I am assigning the policy to banker for the security creation. Now is the banker policy holder? He is only assigning. Next. Prohibition of insurance business by certain person. Nothing but only Indian insurance company is permitted. Any other person other than Indian insurance company cannot do insurance business in India. And no insurance, no consideration. Insurance policy cannot be given at free of cost. It should not be given at free of cost. There must be some consideration. You will get some marketing costs. உங்களுக்கு இன்சூரன்ஸ் பாலிசி ஃப்ரீயா கிடைச்சது வாங்க வந்து எந்துக்கோங்க 1 lakh இன்சூரன்ஸ் சம்மிஷன் அந்த மாதிரி. Once upon a time they used to do big marketing in order to sell insurance products. No, these insurance agents, no, they set up an office like this, one room like this, and they'll keep all the tables, they decorate everything, they'll have a telecalling department. What they do is they call each and every person, whoever number is there, that numbers they'll get earlier. Once upon a time, nowadays we are recharging phones and all through Paytm and all. Earlier we used to go to some vendor, he will have a demo phone and you will write in his notebook your phone number, 30 rupees, 40 rupees, 50 rupees, 100 rupees recharge, and that fellow will say after 1 hour I'll put recharge, you will go home. That entire number he will sell each number at 1 rupee to these marketing companies. Getting it? And these companies will call you and then ask you that you want 1 lakh insurance free. Getting it? You want a trip to Goa, you want a trip to like so and so, all that. And you some people know, they believe it, and of course initially everyone believes it. As later everybody is sharing this information that it is fake, then only they come to know. So once you visit there, so they'll call you, they'll give you one small gift, and they'll make you sit and explain about the policies they have. Getting it? And they'll explain all types of grabber. Okay, you get this money, you get that money, you get this back tomorrow, you pay today, tomorrow itself you will get this much money, all that. And people, of course, because of not having that much exposure, they buy the policies. That's why IRDA gives advertisement in all the movie theaters and all. You see, PVR, first 15 minutes advertisement, you will find one advertisement of government. Getting it? Like consumer awareness programs, consumer awareness advertisements, all that. Getting it? Insurance policy terms are subject to market, some disclaimer will come. Have you seen? So mutual fund, don't attend for OTPs. So every day you will be getting message from some bank that don't share your OTP. Bank will not call you, bank will not ask you. Yes or no? That's it. Next. Next, I received some 2 or 3 calls very recently. That fellow will not be given proper training also, idiots. Amma, they will not be given proper training, so dumb. Okay. He called me, sir, your account is going to be blocked, sir. There is one OTP, please share it. Then I replied him, you share me one OTP which you received now, immediately. Tell me, I mean, he's speaking in Hindi, I don't know Hindi. Okay, suddenly by the time I'm thinking to scold him about a word and he put the call, like he kept the call. Getting it? Like Hindi varadile, basically for South. We only have Hindi as a subject, not as a language. Getting it? In Tamil you don't have Hindi, no? You have Hindi second language? In schools, in Kerala you have In Kerala I think people can speak at least little Hindi because they have a language. Ana engalku adu language kadadu, engalku adu subject da. Next. Then registration. Every insurer shall obtain certificate of registration before commencement. Without certificate of registration, you cannot commence insurance business. And what is an Indian insurance company? Where maximum foreign shareholding not exceeds 49% of the paid up equity capital. And foreign company can only involve in reinsurance. Now, what is the minimum paid up capital in order to start? This is nothing but something like capital requirement ratio. Minimum 100 crores should be there, excluding preliminary expenditure, all license acquisition cost, getting it, legal compliances for acquisition of insurance license, all excluding all that preliminary expenditure, you must have 100 crore. Later, you can increase that capital, you can enhance it as per Companies Act later. And every insurance company shall maintain a minimum solvency ratio of 150%. On this, they'll ask you a 4 marks question. What to write for 4 marks? Below we have another paragraph on that. So write about solvency ratio. What happens if insurance company do not maintain solvency? First, they should give a plan to IRDA. What is the financial plan? If IRDA convinces, okay. If IRDA do not convince, you have to liquidate. Getting it? You have to liquidate. Next. What is the form and content? Every insurance company shall prepare balance sheet, P&L, receipts and payments account, and revenue account. Receipts and payment is nothing but cash flow statement, revenue account. Now they have given Schedule A is applicable for life insurance business, Schedule B, general insurance business, Schedule C. It is applicable for auditor's report. How audit reports shall be prepared? Whether it is life insurance company auditor or general insurance auditor, whatever it is, Schedule C. Now, audit of accounts. Every insurer compulsorily should underwent audit annually by an auditor. And what are the rights and duties? Same rights as given under Companies Act. And auditor, should you do audit of receipts and payments accounts also? Yes, it is compulsory. What it says? Insurance Act, if you look at section 11, that is a section which is actually talking about audit. Getting it? In insurance company, it says every insurance company shall prepare a balance sheet, P&L, receipts and payment, and revenue account. Further, IRDA guidelines also says receipts and payments account of the insurer shall be in agreement with the books of accounts. Auditor has to certify. So, which means indirectly, what is it saying? Auditor is required to audit receipts and payments account. Now, appointment. Who will appoint? For government-owned insurance companies, C&AG will appoint. For government-owned insurance companies, C&AG will appoint. For other public sector companies, the appointment of stat auditor, general insurance and its subsidiaries and divisions and all other public sector companies is made by C&AG. Nothing but all government-owned, government-controlled entities are made by C&AG. Other insurers, auditor is appointed at AGM after ensuring auditor satisfied IRDA guidelines. Getting it? There is eligibility requirement. And currently, an auditor can conduct only 3 insurance companies, not more than 2 life, not more than 2 general. That's a condition. Remuneration, same, section 142 only applies. Either shareholders will fix or shareholders will decide how to fix it. Getting it? Now, insurance companies, do they have branch audit concept? Yes. LIC, you see, they have divisions. Divisions are nothing but what? Branches. So divisional audit in insurance company is nothing but branch audit. When the divisional auditors are appointed separately, whatever SCA 600 requirements were there, everything is applicable. And most of the private insurance companies, accounting is centralized. So the principle of division office, all that is not applicable. Obviously, the concept of branch audit may not apply. And remember, insurance companies have to compulsorily go for joint audit. Insurance companies have to compulsorily go for joint audit. Minimum 2 or some 4 number is there. Guideline, that guidance is also, I think I have downloaded. I think there is compulsory joint audit requirement. This is, I think in this it will contain. You see, joint audit is compulsory. Rotation of joint auditors. Here it is given. Here it is given. What is the audit required? The eligibility. The auditor of insurer shall be a firm, including LLP, The firm should have been established for at least 15 years. The auditor should have minimum 5 full-time partners, of whom 2 must be full-time practicing partners and continuously associated with the same firm for 10 years. At least 2 must be continuously associated for 5 years. 1 full-time practicing partner, minimum 1 year. Out of total partners, at least 2 must be FCA and must be in a period of 5 years. Or alternatively, there is another criteria. At least 1 partner or employee of the firm should possess DSA qualification, compulsory. The audit firm should have minimum experience of 5 years in audit assignments in financial sector. At least one of the joint statutory auditors of an insurer must have an experience. So it is saying compulsory joint audit. Somewhere below they would have mentioned. Insurer should verify their satisfaction. Any change, the authority must be informed. Insurers are advised to file return. You will find it here, okay? You will find somewhere below. Here you see. An insurance company shall be entitled to carry out statutory audit not more than, okay, that is 3. That's what I told you, 2 life insurance, 2 general insurance. Sorry, minimum 2 joint auditors, correct. Every insurer shall have a minimum of 2 joint auditors. And the 2 joint auditors should not come under same network, by the way. And rotation guidelines also given here. And what about the statutory auditors taking up other works? If code of ethics is there, that you need to check. If additional guidelines given, this also you need to check. You see here, the aggregate of fees for additional work shall not exceed stat audit fees. The same council guideline is given here. Getting it? Of course, this much is not there in our book. Next. Now, there is another audit which insurance companies must do. Investment risk management system. Many people confuse this word with information systems and management system. Information risk management system, something like that. Don't confuse. It is about investment risk management system. What is it? Investment risk management system. Every insurance company must have an investment risk management system in its place, and that must be audited. That must be audited by whom? Not the statutory auditor, but a separate chartered accountant. Another chartered accountant, which is not internal stat concurrent auditor, shall certify about investment risk management system and processes that are in place of an insurance company. They need to give a separate audit report. And they should follow directions of CNDG and CARO do not apply. As usual, tax audit is applicable for insurance companies. For that, you need to look at guidance note. Next. Now, to what extent Companies Act is applicable? Simple line. To the extent it is not contradicting with the Insurance Act. Wherever Insurance Act is silent, Companies Act will apply. If at all Companies Act and Insurance Act both are talking about the provision, Insurance Act will apply. Suppose Companies Act says appointment will be for 5 years. In Insurance Act that may not be there. Insurance guidelines that may not be there. Getting it? This question is important. This question itself can be asked as a straight question. Write about applicability of Companies Act to insurance companies. It's a very simple question. You can read and understand on your own. And how to do audit of insurance companies in automated environment. So your auditor has to familiarize himself with IT environment. You may select a few samples and check the system and understand flow of transaction. And based on this, you will understand the result, whether the processing is correctly happening or not. See the design and operation of IT system. And if at all IT systems are effective, you may limit the extent of checking. Sample size can be reduced. Get a written representation that all changes in IT systems have taken place during the year. Whatever changes were there, informed to the auditor. And auditor should separately examine efficacy of each such system. And first of all, 143 subsection 3 IFC report you must give anyhow. Operating effectiveness of internal financial controls. And today, all the controls are implemented through the computers. So we have to check operating effectiveness of the computers. Getting it? That's it. Then we have the actual provisions. How to do audit of life insurance business. How to do audit of general insurance business. What are the aspects to be covered? Getting it? We'll take a break and cover this. Cover them after the break. Getting it? Have got clarity? In audit of assets and audit of liabilities, in audit of assets, we have totally some 3 or 4 categories. One is cash and bank balances. How to verify cash at bank? How to verify money at call and short notice? How to verify money held with RBI? Those are easy points you can understand. Getting it? Then, how to verify investments made by the bank? Again, easy points. Advances is something very important, bit technical. The next one is how to verify fixed assets. It is same like for any other company. For bank also fixed asset, how to verify? They will maintain register. Same pattern. Now you see here in banks, first of all, advances is something which is the major item of the asset in the banks. Yes or no? In advances, what is the most important thing? Provisions. Getting it? Asset classification of the advance and provision is the major thing. How the loans and advances given by the bank are classified: standard, substandard, doubtful, provision. And here the norms are again different from NBFC norms. For NBFC it is expressed in months, different months. For banks it is 90 days. And remember, for overdraft and cash credit it is not 90 days. If it is out of order, it is treated as NPA. So verify whether bank has system of identification and classification of advances through core banking without manual intervention, and see its accuracy in crystallizing the date of NPA. When the bank actually recognizes a loan as NPA, see whether is it matching with RBI guidelines or not. Whether classification made by the branch is appropriate, particularly classification of advances where there are threats to recovery. Actually, this is what repeated in the first point. But this is newly added. This was old point. The old point, instead of deleting, they continued. In 2020, this first point is not there. This first point is added in 2021 material of ICI. In old material, this is first point, old material. This they should delete and then put the first one. But they didn't delete it. Understood? Then verify secured and unsecured portion advances were segregated correctly and provision has been made. And review and compare date of NP of the loan in the current year with that of the previous year. Reasons why there are any changes. Like this is nothing but analytical procedures. So this point is actually simple. The point is here. Accounts which are regularized near balance sheet date. What is meant by assets regularized at balance sheet date? This is CA inter concept. But still it is covered at final. See, actually now it cannot be done. But we do mainly focus NPA provisions all that as on 31st March. Getting it? Suppose an account actually become NPA. An account actually become NPA because it was overdue for more than 90 days. Getting it? But before 31st March, the customer made payment, or in the loan account there is a credit entry. In the loan account there is a credit entry. With the special authority or power given to the branch, that account was removed from NPA to regular. By the time balance sheet date comes, account became regularized. If you find inherent weakness in that account, if you think it is an intentionally, removed from NPA and then kept as regular account, if you think there is some problem with that account, auditor will have to, recommend the bank. The auditor will have to instruct the bank to treat that account as NPA. Accordingly, asset classification and provisioning norm will apply. So, auditor should carefully assess whether repayment was genuine source or not. Whenever there is a customer account, credit is there. Actually, it is NPA. But suddenly repayment was there and become from NPA to regular account. Where account indicate inherent weakness, the account should be treated as NPA. Suppose it is genuine case, bank must give satisfactory evidence to the auditor about manner of regularization. How they regularized. How they removed from NPA to regular. Generally, if an account become NPA, banks what they will do is, they will start recovery proceedings. And they will mention that account while reporting to CIBIL, they will mention the account as settled. Getting it? They will mention it as settled. Once if the word settled appears, the customer will not get loan in future from any other institution. Because the customer went for settlement of a loan. That's how it appears. Getting it? So, if an asset become NPA, how to migrate it from NPA to another account? It's a very tricky process. So, you need to call them. See, the bank only should file revised CIBIL report with CIBIL authorities. So that CIBIL authority will change in the back end. It is not NPA, it is a normal account. Getting it? Now, drawing power calculation. There are two words. One is sanction limit, another one is drawing power. There are two terms. One is sanction limit and drawing power. Last time in CA Inter, on drawing power, they gave a problem in auditing. They gave a problem in auditing. How to calculate drawing power? They gave a problem actually. Getting it? Now, so what is sanction limit? What is drawing power? You will be given sanctioned. You will be given a loan sanction limit based on your repayment capacity, especially working capital loans or any other term loans. Based on your repayment capacity, you will be given, let us assume 5 crore sanction loan. Let us assume you are given 5 crore sanction. However, you gave the banker stock statement. You gave the banker stock statement. And the stock statement has a value of 6 crore worth of stock. Now, banker has a policy to maintain 30% margin. The banker has a policy of maintaining 30% margin. Banker decided to give you only 4 crore drawing power. What is drawing power? How much you can withdraw? Drawing power means what? How much you can withdraw from the loan sanctioned to you. That is called drawing power. How drawing power will be calculated? Drawing power will be banker will give you drawing power only based on not stock available in your godown. Out of that stock, how much is your own stock? Able to understand? Suppose in my godown I have 10 crore stock. But related to this, I have 4 crores creditor outstanding amount. I will remove this. Then paid stock value is how much? 6 crore. Now what is the margin as per bank policy? But since you have 6 crore worth of stock, I will not release 6 crore fund. I have some margin to be kept because of fluctuations in the price of the stock. So bank is having some 30%, 40% margin. So 3.8 or 4.2 crore, something is only bank can draw, allow you to draw. Auditor should check whether the drawing power limit is calculated as per bank norms and see that the outstanding balance of a loan account in a customer account is always less than drawing power, always less than sanction limit. If at all you find any amount, any outstanding loan is more than drawing power, any outstanding amount is more than sanction limit, the account is to be treated as out of order. Out of order means NPA. If a overdraft account or cash credit account, nothing but working capital loan accounts, these are. If at all they exceeded drawing power, exceeded sanction limit, it is to be treated as out of order. And when an overdraft account and cash credit account is treated as out of order, it is to be treated as NPA. Overdraft means in the same account, beyond your available balance, you can draw more. That is called over and above your balance, you can withdraw. That's called overdraft. What is cash credit? It's a separate credit facility to meet your temporary working capital needs, and that's called cash credit. So the bank should ensure, the bank software should have controls that the customer cannot withdraw more than drawing power, more than sanction limit. Auditor should verify all that. Getting it? Special consideration will be given for creditors, stocks covered under LC. They should be considered while calculating drawing power. It is to be ensured that the stock shall not cover liability outstanding from creditors and all. It should be reduced. Getting it? The drawing power needs to be calculated carefully in case of working capital advances. The valuation of work in progress should be ensured consistent and proper. Especially where funded exposure is more than stipulated limit is 5 crore. See again, no, loans and advances are two types. Funded loans, non-funded loans. Funded means where there is an outflow from the bank. Where there is outflow, I gave you loan to you, cash outflow. Non-funded means I gave guarantee on behalf of you. Is there any outflow? That's a non-funded loan and advance. Now in respect of non-funded loan and advance also, if customer went to default, I should pay the amount. Provision has to be created for that. But the further provisioning norms are different. Getting it? Funded loan. Suppose if funded advance, funded loan is more than 5 crore. Funded loan means what? Where there is an outflow. If at all bank has given more than 5 crore funded loan to any customer, that too which is based on stock, stock audit must be conducted. The statutory auditor has to check whether stock audit is conducted by the branch or by the bank in respect of loans where funded exposure is more than 5 crore. So that is what drawing power. Now you read this answer, you understand better. Getting it? Next. Accounts with temporary deficiencies. This is newly added point. Bank should not classify a loan merely due to existence of some deficiency which are temporary in nature, such as non-availability of drawing power based on latest available stock statement, balance outstanding exceeding limit temporarily, non-renewal of limit on due date. However, the stock statement should not be older than 3 months. Getting it? The outstanding in the account based on drawing power calculated from stock statement should not be older than 3 months, if at all. The stock statement based on which you give drawing power allocation to customer, if it is based on old stock statement, again it is treated as irregular account, NPA. Getting it? Same way, banks know, whenever they gave you sanction limit and drawing power, they should be regularly reviewed. What is regularly reviewed? Stock statement should be seen regularly. If at all they were not reviewed within 180 days, it is considered as NPA. This can be asked as an MCQ or true or false question or case-based MCQ. These points can be tested in case-based MCQ. Getting it? They'll give you a story. So-and-so customer has got a loan on so-and-so date. Stock statement is submitted on so-and-so date. Bank has not reviewed the customer account on on this date, till that date bank has not reviewed. Immediately you should remember, if the gap is more than 180 days, it should be treated as NPA. Below they will frame questions accordingly. Getting it? And remember, once an account of a customer, a loan account of a customer is treated as NPA, all other his loan accounts that are there in the same bank shall also be treated as NPA. NPA classification is not advance or loan wise. NPA classification is customer wise. Very simple. Suppose you have taken from my bank housing loan, car loan, personal loan. You are repaying personal loan, housing loan correctly. Car loan you defaulted. Car loan I treated as NPA. Remaining 2 loans also shall be treated as NPA. You are having some other loan in some other bank. That is their choice. If you are repaying them properly, they will not treat it as NPA. Bank, whenever a bank is giving multiple loans and advances to a same customer, if one of the loan become NPA, all other loans will also be treated as NPA within the same bank. Getting it? So that is what asset classification will be borrower wise, not facility wise. Now, government guaranteed advances. Government guaranteed advances are 2 types. Central government guaranteed advances, state government guaranteed advances. Central government guaranteed advances, state government guaranteed advances. Now, suppose state government guaranteed advance, NPA classification and all is same like any other loan. No change. However, if the loan taken by me from State Bank of India, for which central government gave a guarantee, then what is the NPA norm? I repaid to the bank regularly, but in the past 3 months I did not pay EMI. 90 days crossed. Now my account generally treated as NPA, but because central government gave guarantee, my account by State Bank of India will not be treated as NPA, even though 90 days overdue period crossed. Able to understand? Even though the overdue amount crossed for 90 days, because central government guarantee is there, my account is not treated as NPA. Now, my account not treated as NPA means, will my account be classified under substandard doubtful category? No. Will provision be created on my account? No. Standard asset provision 0.4% or 0.25, that is only will be applicable. Understood or not? All of you. Now tell me, you might have learned this point in bank accounts chapter. When an account is treated as NPA, interest on that loan account shall be recognized only on cash basis. Correct? Means only if I recover the money, recognize. Otherwise don't recognize, because it's a non-performing asset. On a non-performing asset, how can you recognize the interest income when there is uncertainty about the recoverability? Accounting standard principle. Yes or no? Now tell me, here, central government guarantee given, no. I did not pay EMI, no. Bank is not treating it as NPA, correct? They are not treating. Now, can this bank recognize my interest income on accrual basis? Principal is not recognized as NPA, however, interest is treated as NPA. However, interest is treated as NPA. What is meant by that? Very simple. Only the principal will be treated as regular. Suppose I have taken a loan guaranteed by central government. Now I defaulted for more than 90 days. Will NPA norm apply? No. Now what is the treatment? Principal amount, what is the treatment? No provision, NPA. What about interest? However, interest recognition point of view, we will apply NPA classification principle. We will not recognize. Interest on loan given with a central government guarantee, actually it's NPA. But we are not reading it as NPA because government guarantee is there. What about interest? Can I recognize it on accrual basis? No. Recognized only on cash basis. Interest point of view alone, apply NPA norms only. Getting it? Because government gave guarantee for principal, not for the interest. Now, sometimes I will get loan from bank. I will give security. What security I gave? Term deposit, Kisan Vikas Patra, Indra Vikas Patra, National Saving Certificates. These items which are highly liquid, equal to cash, easily convertible to cash. These assets I gave as a security to bank and I got a loan. I gave as a security to the bank and I got a loan and I defaulted. More than 90 days. Will my account treated as NPA? No. Will my account is treated as NPA? No. If at all I am obtaining loan by keeping these items as a security, my loan account will not be treated as NPA. Okay, principal is not treated as NPA, no provision. What about interest? Interest can be recognized on accrual basis. Interest can be recognized on accrual basis so long sufficient margin is available. My cash is with the bank. First of all, understand. My cash is with the bank. I kept 5 lakhs term deposit in the bank, got 3 lakhs credit card facility. I used 3 lakhs credit card. 90 days over, did not pay. Will it be treated as NPA? No. Getting it? Now, every month 10,000 interest is accruing. Now, this 10,000 should bank recognize on accrual? Yes. Because still 2 lakhs credit is there. Margin is there. Customer cash is with me. Saving certificates are with me. Vikas Patras are with me. It's just one click I can convert them into cash. Getting the point? Since customer cash is with me, in these cases, security I will consider. Generally, suppose I took a car loan. Car is hypothecated to bank. I defaulted for more than 90 days. Is car convertible asset easily? No. Existence of security, ignore. Existence of security, ignore. Treat it as NPA. Create provision. Stop recognizing interest. Government guarantee is there. Principal, treat it as regular asset. Don't create provision. Interest, don't recognize. Security with the bank is term deposit, Indra Vikas Patra, Kisan Vikas Patra, National Saving Certificate. Don't treat it as NPA. Interest also don't treat it as NPA. Recognize as long as margin is available. Once margin is about to expire, bank will set off. Bank will set off the loan account and deposit account, transfer balance money to the customer. Able to understand? All of you. Next. So that's about the NPA norm CO. You can read that later. Entire matter I have covered. Understood or not? All of you. Next. Agriculture advances. Agriculture advances. Agriculture advances are again 2 types. Agricultural advances are again 2 types. Agricultural advances normal. Agricultural advances affected by natural calamities. Agricultural advances, normal agricultural loans. I gave loans to you. What is NPA norm? For that it is different. I gave loan to you. You harvested exactly that time. Natural calamity affected. You defaulted. How to do the NPA treatment for this? This is completely different. I will discuss that later. Now generally, what is the NPA treatment for agriculture loans? 90 days criteria we will not apply. For agricultural loans, we look at crop season. We look at crop season. Agricultural loans are broadly divided into 2 types. Short duration crop loan, long duration crop loan. What is it? Short duration crop loan, long duration crop loan. What is a long duration crop? If the crop season is more than 1 year, if the crop season, what is crop season? Right from tilting the land, planting the seed, till the harvest of the product which is coming for commercial sale. Getting it? If the gap time gestation period is more than 1 year, then the crop is said to be long duration crop. Tobacco, best example. This long duration crop. Getting it? Now, if a loan is given for this long duration crop, it is treated as which loan? Long duration crop loan. Now, what is short duration crop? Other than long duration crop is a short duration crop. Now, what is the NPA treatment? For long duration crop loan, what is the NPA treatment? For short duration crop loan, what is the NPA treatment? For long duration crop loan, if the installment or the amount is overdue for more than one crop season. Overdue more than one crop season. Farmer harvested, still did not pay money. I waited for 14 months crop season. His crop season is 14 months. I waited for 14 months. Even after that he didn't pay. Actually due date came. After due date I waited for 14 months crop season. Still he didn't pay. After 14 months after crossing the due date, then the bank will treat it as NPA. Suppose if it is short duration crops, if the loan is overdue for more than 2 crop seasons, it is to be treated as NPA. Here crop season is suppose 11 months, then bank will wait 22 months after due date, then it will be treated as NPA. For agricultural loans, you see how much time bank is waiting in order to treat it as NPA. Because of considering difficulties of sale of produce of agricultural commodities, banks have given this much additional criteria. Are you clear? Then, what about agricultural advances affected by natural calamities? It is bank's discretion. No specific NPA norm given by RBI, bank's discretion. If an agricultural loan is affected by natural calamity and the farmer is unable to pay the loan, do you want to treat it as NPA directly? Okay, treat it as. Do you want to give additional credit period to farmer? Give him. Do you want to give him fresh loan and so that he will repay the old loan? Give it. Whatever decision you take, follow as per that. Suppose you want to treat it as straight away NPA, treat it. Suppose you give additional credit period, then don't apply NPA norm now. After credit period, if he defaulted, then apply NPA norm. Able to understand? So, in case agricultural advances affected by natural calamities, the bank shall follow the rescheduled terms. Able to understand? You see, that is what given in the next page, reschedulement. Provisioning, that is restructured advances. What is the restructure? In which a lender, for economic or legal reasons relating to borrower difficulty, grant concession to the borrower. Like how he will grant concession, terms of advances, including amount of installment, repayment period, rate of interest, sanction, all these will be modified, helping him to cure the default. Banks may restructure the account classified under standard, substandard. Bank cannot restructure account with retrospective effect, only with the prospective effect. On restructuring, account will be downgraded from standard to substandard. NPA will remain in the same category. But agricultural advances, it is different. Getting it? Now, upgradation. What is upgradation? Doubtful to substandard, substandard to standard. That is called upgradation. There can be possibility of incorrect upgradation of account on the basis of partial recovery made in account, and overdue portion might not have wiped out completely. Customer did not pay fully. Without paying fully, how can you upgrade the account? So, there is a possibility of recovering being made in account after cutoff date, account being upgraded as on the date of balance sheet. Actual recovery was done after 31st March, but as on 31st March itself upgraded, because now bank managers will have huge pressure. As on 31st March, they want to minimize as much as possible NPA flow. Next, sale or purchase of NPA. This is called bad bank concept, asset reconstruction company concept. Banks can sell NPAs to recovery companies, asset reconstruction companies. They will revolve around the customer. Getting it? Bank will get some lump sum amount settlement. So regarding that. So the entire risk associated with NPA should be transferred to the purchasing bank. The purchasing bank is actually technically called as bad bank. The bank which is paying bad debts. The bank which is paying bad debts. You see in news and all, how the ignorance. Bank have written off some loans given. Bank written off is not waiver. Banks will write off because of the RBI norms. That is not waiver. Correct? So when the bank write off, that is an accounting adjustment. That particular write-off, if at all if a newspaper knows, so and so big headline, RBI, State Bank of India write-offs 70,000 crore loan, and that post is circulated on Instagram saying banks are waiving. Waiving is different, write-off is different. Banks will never waive. The recovery agents, bad banks and all will be revolving around them. Even still today, bank is trying to recover money from Vijay Mallya. Because of the legal issues only, we are unable to bring him to India. Able to understand? Under no circumstances, NPA can be sold to another bank at a contingent price. No, you should not sell at contingent price. Important for MCQ or correct or incorrect question. The entire sale consideration has to be received on upfront basis. In my customer, Book value is 10 crore. I need to recover from customer. I will sell this for 5 crores to that bank. They will recover whatever they want. Are you getting the point? Upfront, I should receive immediately. In case of sale of NPA, if the sale price is below book value, the shortfall should be debited to P&L in the same year. If the sale value is higher than net book value, excess provision shall not be reversed but will be utilized to meet the shortfall on account of other NPA financial assets. If at all in one of the customer NPA sale, I got profit, I will not transfer to P&L. I will use it for some other NPS. Next, same way, purchase of NPS also, there is a provision. This is the special point, tricky point which people can't understand in the bank audit. Remaining audit of investments, audit of fixed assets, same points. Long term investments value at cost price unless there is a permanent decline in the value. Short term investments value at market price. Investments shall be classified into various parts. That is plain reading, anybody can understand. If I tell the same, no, you will feel like I am reading. This is only requires explanation, understood or not. So, in audit of assets, advances is critical part. And remember, read it only from study material. Don't read from other books. Remaining audit of advances is very simple. Remaining audit of assets. Fixed assets, you see how to do audit of fixed assets. How to do audit of first general controls. Premises means buildings. Other fixed assets, how to verify. Sale of fixed assets, how to verify. Lease assets, how to verify. Impairment, how to verify. Simple points. Then other assets. Inter-office adjustments, how to verify. Interest accrued, how to verify. Tax paid in advance or TDS, how to verify. Stationery stamps, how to verify. Understood all of you? These are all simple points. Next. Others. Non-interest bearing staff advances means employee loans. Loans and advances to officials and relatives. For all these, banks will have internal powers. These are not customer loans. Remember, when a bank employee is getting a loan from the bank, how he is getting the loan? Is he getting it in the capacity of employee or is he getting in the capacity of a customer? If at all the bank is giving loan to employee as a banker, not as an employer, then NPA norm we will apply. Suppose NPA norm we will apply. Because I am giving as a bank, he is taking housing loan as a customer. We saw credit worthiness, everything we saw, documentation we gave. Same employee took 2 months salary advance. Next 2 months salary, give me now itself, they asked. I gave. That is as part of employment relationship I have that I gave. Now whenever I am giving any loan to employee, because of the employer-employee relationship, that's another asset, not loans and advances. When I give to same employee a housing loan, car loan, treating him as a customer, that's a loans and advances. Understood or not? Security deposits, how to verify. Prepaid expenses, how to verify. Miscellaneous balances, how to verify. Ellame simple da. Okay. Next, capital adequacy means what? They have given some like G10 nations, Basel Committee. In Basel Committee, 10 countries will participate. 10 country representatives. Stress testing means what? Basel 3 means what? This and all we have just done in our book. Now, they may ask you a question on this. Write about capital adequacy measures in India. Write about capital adequacy measures in India. There is a possibility. Because that is tempting to ask. What is tier 1 capital, tier 2 capital? Exactly, internet. The moment you test Google, it will support starting 2 lines, it will show definition. That definition is copy pasted here. Next. How to do audit of reserves and surplus. General reserves and surplus, how to do audit, same points were covered. Now, how to do audit of deposits? This is little, not complicated. This is something specific to banking industry. Now, deposits are what? How many types? Current account deposits, savings account deposits. Now, verify on a sample basis current account and savings account which are opened during the year. Are they complying with all the KYC norms? And verify savings accounts are opened in the name of individual HGF and some approved institution like Trust Education Institute. Remember, savings accounts are not opened for business or professional concern. See, like generally, when a customer is opening savings account, he will say that non-business or non-profession. But he will use it for commercial purpose. But tea kadai irukku veliya. Phone pay. Actually the savings account. It's not current account. They don't open. Small tea businesses and all, they don't open. Though they have good number of transactions, they don't open. And inoperative accounts, called dormant accounts, they are high risky area of frauds in the banks. Inoperative accounts are used for money laundering transactions. Like what? If at all, some political parties, how do they convert their black money, How do they convert their black money? They create a dummy company. and they create a dummy contract to that company. And the entire money will be collected in the form of cash by the company. That entire money will be distributed as salaries to various employees. Those employees' Aadhaar cards will be there, PAN cards will be there, bank accounts will be there. One time 100 crore transaction they will do. And the account will become inoperative. That 100 crores become white to all the employees. Now what 1,000 employees they will create. 1,000 bank accounts they will create. From all these banks, cash withdrawal will happen. That entire cash will go and sit in somewhere. This is how it happens. Getting it? So these are all was done at the time of demonetization. Of course, this is a popular method. So inoperative accounts is a high risky area, possibility of fraud. A savings or current account should be treated as inoperative if there are no transactions over a period of 2 years. Earlier it is 6 months. Later it was revised to 2 years. Verify on a sample basis some inoperative accounts which are revived or closed during the year. Ensure that inoperative accounts are revived only with proper authority. The moment 2 years over, it should be stopped functioning. Bank can revive only with again proper KYC. What is KYC norm? You must clearly identify who has opened this bank. Only a proper person having proper identification who is alive. Only for him bank account should be given. That's why KYC norms. In this regard, where there is a significant reduction in balances of such account as compared to previous year, examine authorization for withdrawals. Suppose in these inoperative accounts, last year there is a huge balance. Now suddenly balances have came down and the account stopped functioning. Auditor has to investigate. See, these and all, bank system have exception reports feature. Bank's system will give exception reports. That exception reports is enough to study all this. Term deposit. Verify in case of bulk deposit, where and all 2 crore and above. See whether correct rate of interest has been offered as per the bank policy at that particular time. In case of closure, test check whether required foreclosure penalty has been deducted from applicable rate of interest. Foreclosures. Verify on sample basis some recurring deposit accounts which are opened. Correctness of rate of interest. How to verify term deposits? Very simple. Check with term deposit certificates. And what is the rate of interest given? What is the approved rate as per the bank internal committee? Banks, what is approved rate by management of the bank? Some deposits may be designated in foreign currencies. Verify some FCNR accounts opened during the year on sample basis. Ensure these conform to RBI. Like FCNR probably might be foreign currency notes to accounts something. Or maybe these might be like in foreign accounts. In foreign we have 2 types. NRO or NRE. Some accounts. These accounts. Getting it? Non-resident accounts. That's it. And here also they have given NRE, NRO accounts. Verify on a sample basis credits and debits as per RBI guidelines and see the repatriability feature. In NRO we can't repatriate except for current income subject to generation. NRO is operated in Indian currency. NRE is operated in foreign currency. Actually, this is another big subject that is relevant for bank exams, IBPS, not for CA exams. Getting it? Next. See that deposits are not inflated for balance sheet purpose. Some customers might be given overdraft near balance sheet date and the resultant overdrawn amount may be placed as deposit with banks. Some ODs and all will be shown as deposits. Actually, nowadays these frauds cannot be done because it is completely system and the bank management or staff cannot change that information. That's it. And borrowings. Borrowings all are general points. Auditor should get external confirmation from the borrower and see that borrowings, that's a general point. No specific point is covered. And balances, bills payable, inter-office adjustments, interest accrued and other provision. In the last exam, what is the audit approach for contingent liability they asked? Last exam. May 22, the question asked is, write about audit approach for contingent. The auditor is primarily concerned with getting reasonable assurance that all contingent liabilities are properly valued. Of the balance sheet transactions have been accounted in books of accounts, letter of credits and all. All of the balance sheet items have been entered into after following the procedures. Swift software will be there. Getting it? All international financial transactions, everything will be entered in Swift software. PNB scam happened because the transactions were not entered in Swift software. Getting it? And all the off the balance sheet transactions are supported by underline. See, off balance sheet items means those transactions which will not come in the balance sheet. They are called as off balance sheet. Those transactions where and all we have to disclose it in the notes to accounts. They are called as off the balance sheet transactions. See that off the balance sheet transactions are accounted in books of accounts in Swift software or something, some other. See that off the balance sheet transactions are entered after following the laid down the procedure, and see that they were supported by documents. All year-end liabilities are disclosed. All the disclosed liabilities do not include any crystallized liability. Crystallized means what? Actual liability. When I show something as contingent, it should be contingent. It should not be something materialized one. And what is the effect of contingent liability? Financial effect. It should be estimated as per AS 29. And remember, for banks, Ind AS do not apply. In case of guarantees issued on behalf of banks directors, the bank has taken appropriate steps to ensure that effective arrangements have been made so that commitments would be met out of the party's own resources, that the bank will not be called upon to grant any loan or advance. Any 4 points if you write, that's enough. Audit approach in this. Any 4 points. It is asked for 4 or 5 marks. 5 marks means 5 points you have to write. That's it. So write about audit approach for contingent liabilities. They ask. This is the question. Now, what are all contingent liabilities? Claims against bank, but not acknowledged as debt by the bank. Liability for partly paid investment. Liability on account of forward exchange contracts. Guarantees given on behalf of constituents. Acceptances, endorsements, and other obligations. Other items which bank is contingently liable. So, contingent liabilities. So, how to do audit of contingent liability? This question has been asked in the last exam. So, suggested audit approach. So, what is the audit procedure? This is actually getting a representation. I think representation or audit approach, if something is asked, just to look at the question in the previous exam, I think, is it audit approach or which one asked? Audit approach only, yeah? Nationalized bank. So here you see which question was asked. And audit firm intends to obtain representation from the management. Highlight points or checklists that are to be covered in representation, not audit approach. Representation only asked. So the auditor has to get a representation that all the off the balance sheet transactions are accounted. All the off the balance sheet items are entered with proper procedure. All the off the balance sheet transactions were having supporting documents. All contingent liabilities are disclosed. They do not include crystallized liabilities. These are all representations management should give. So the question clearly asked. See, I'm telling you, you should observe what is what. Getting it? Here they are asking representations from management you should get, right? What points are covered in the representation? That is a question. What is the audit approach for contingent liability? They didn't ask. Audit approach means what? Auditor should verify letter of credit. Auditor should verify, ensure that there exists a system whereby non-fund based facilities or ad hoc facilities extended only to regular customers. Constituents means customers, nothing but. Now verify letter of credits. The payment to overseas supplier is made based on shipping documents. Whether accounting system of the bank provides for maintenance of records in respect of obligations, internal controls, are they properly recording all the contingent liabilities? See the completeness of the recorded obligations. So like this is audit approach. There are some claims against the banks which are not acknowledged as debt. Like somebody has lodged a claim, but bank has not yet decided as a debt that bank has to pay or not. Until then it will be showing it as a contingent liability. Liability on account of forward exchange contract, what is the audit approach? Guarantees given on behalf of the constituent, what is the audit approach? Acceptances and endorsements and obligations, what is the audit approach? Any of this can be asked. How to do audit of bills for collection, they may ask. Getting it? All of you, observe. When you are observing, what you are reading. So what is that? How a question can be framed on that? If you have to check. You have to judge at a particular concept how a question can be framed. Getting it? So if you observe that, you can recognize later and you will not confuse. You will not write a wrong answer. Getting it? If you plainly read without processing the information, if at all a question was slightly twisted, you will make a wrong answer. Getting it? So with this, bank audit is completed.